Wait, why are you skipping the video? Watch the introduction. Okay, I mean, people skip. No, that's the reason. So this 10 minutes is very important. I gave certain instructions. Watch that, then you go start watching the nature, objective and scope, whatever as per the timestamp that you want to. So but initial 10 minutes, please watch it, don't skip it. So let's begin the CA inter audit revision. First thing I want to talk about is the material. Nothing can beat ICAI material. The first point. Okay, in this marathon I will prove reading ICAI material is much more easier. The first one, the myth is what? ICAI material is lengthy, vast, time taking, right? After we revise certain topics, I will revise it from the ICAI material and you will understand, like whatever that myth that you have, I'm telling you, it will break completely. So reading ICAI material is as fast as any other chart notes, I'm telling you. How much time you think reading a chart notes takes? The same time is what ICAI material reading also takes. Because your reading speed is influenced by the grip that you have on the subject. It's not the size of the book, it's the grip on the book. It's always the command that you have that decides the speed. It's never the size of the book. If I give you a Sanskrit book of 10 pages and ask you just study for 4 hours and then come back and explain me, you can't. Though it is just 10 pages, you can't, because you don't know the content. So it's not the number of pages. Fine. Anyhow, that exercise we will do for 1 or 2 standards. Okay, 1 or 2 some tough standards will take. So for those 2 standards we will see, how you can do with ICAI book itself. Now, and those of you who are following my GoTo notes, any of you, whoever is following PDF, black and white, print or color notes, whatever, okay, we have 2 versions now. One is 2025 version. If at all you are using this, no problem, absolutely relevant, absolutely updated till Jan 27 exams also. So until Jan 2027, this 25 edition is useful. And now I hope you know that there is another version, 2026 version. Even that is relevant up to Jan 27 exam. So you don't have to worry about it. So now the first question, I hope you all seen, majority of you have seen the GoTo notes. Can we write the exact matter in the exam? Which is quite challenging, not that easy. But if you are able to write, you are meeting 90%. You are meeting 90% of the exam standards at which they are expecting. So 90% standard you are meeting. But if you write the notes, whatever content which I give now, as it is, if you write in exam for the questions asked, I'll tell you what sort of questions they'll be asking, all that we'll be discussing. If you're able to write 100% of these GoTo notes, or whatever content I gave in this GoTo notes, 90% if you're able to reproduce correctly, you get 5 out of 5. For example, you attempted 60 marks in the descriptive, you'll get 50 plus. Pakka. But the problem is, who will attempt that much accuracy? With that level of accuracy, who will write? Some students, they message me, they ask me on comments, YouTube comments, they'll put me, sir, if I write matter in the GoTo notes, will I get full marks? No, should I even study ICAI material? First you finish this, pa. First you finish this. Then you can think of the ICAI material. My answer is, can I write as it is? Can I completely believe this notes, GoTo notes, and then go and write the exam? My answer is, first you achieve this. If you're already perfect in this level, then you can think of the advanced version. That's why what we did, in our entire question bank, we retained as it is the ICAI language. In the sense, I hope you have seen mock test papers, revision papers, suggested answers you would have seen, right? That's absolutely, the text is based on ICAI material. No, cut, copy, paste, correct, copy, paste. The same thing is what we retained here. Okay, so strategically this question bank has been made. You can see how many questions were there in each and every chapter. And in this question bank, we gave illustrations, TYK, and this actually we call them as MRP category. Mock revision past exam paper. Simple. MRP category. Even that we gave. Until Jan 2026 attempt also it is covered. Even May 26 MTPs, I'm telling you, it's a repetition of the same. There won't be any new question in that. So typically this particular question bank is updated. And if you read this question bank, you don't have to touch any other questions. You don't have to touch any other questions. Take any attempt in the last 10 attempts. You will find a question here. Now, if you see these questions, if you see this question bank, we have used some 3 colors. If you see here, some orange color is there, okay? And if you see again in the next pages, blue color will be there. And again, if you see, yellow background will be there. The difference is, orange color background indicates illustrations, blue indicates TYK questions of ICAI book, whereas yellow indicates MRP questions, mock, revision, past exam questions. And wherever we feel that question is somewhat tricky, okay, we have even mentioned it as exceptional. Exceptional means these are the questions which you must solve at any cost. Rest of the questions, whether you read it or not, solve it or not, that's secondary. I'm not saying it's irrelevant. That's secondary. But primarily, you need to solve all these exceptional questions. Okay. This PDF is also available at free of cost. You don't have to buy. You just download the PDF, put it on laptop, and then read it. One time or twice, 2 times reading is more than enough. Question bank. The biggest mistake many students do in the CA entire course is they neglect question bank. That's the biggest. It's a sin. Even I tolerate if you even ignore the GOAT notes. Even if you ignore this main concept book, it's somewhat tolerable. It's somewhat excusable. Question bank you should never ignore, because that is the only way you understand how a question has been tested. Many focus only on the concept. Conceptual learning is utmost important for MCQ purpose. But for descriptive answering, you should know the mechanism to write. In order to write descriptive skills, if you want to establish, if you want to understand the question in what direction they are testing, question bank is the only way that can give you. So if at all you have not yet read question bank, that's a big mistake. Okay, you read once the question bank and see, the level of confidence will be amazing. Once you solve question bank entirely, the confidence level on the subject that you will have will be amazing. So read a question, corresponding concepts, try to sync it with the concept book and try to understand. That's it, done. Okay, next. And I hope every one of you know the paper will be for 118 marks. With choice, the paper will be for 118. And if you see, within this 118 marks, you have 30 marks MCQ, you have 88 marks descriptive, right? Out of this, 18 marks is choice. How this choice will be asked? 114 marks question will be there, and another 4 marks question which is part of another question. Like how they will ask you is 6 questions will be there, descriptive. 6 will be there. Out of that, any 5 only you have to write. And each of these questions will have 14 marks weightage, and that's how 70. And one question will be there of 14 marks, which is choice. Now, out of these 5, any one question will have additional 4 marks choice. That's how the paper is like. Okay. So this is the paper composition. This is how the paper composition will be. And if you see, the total number of chapters that we have were 11. We have only 11 chapters in our syllabus. And if you observe, the chapter order here which I used and the chapter order which is given in ICAI book is completely different. If you study the subject in the ICAI order, CA Institute Study Material order, you will never love the subject. You will hate it, in fact. Because the second chapter is what there? Audit strategy. As per ICAI book, the second chapter is audit strategy. There, they discuss about quality control topic. There, they discuss about something relating to reporting objectives. It is something you can't understand at all. Audit strategy, the chapter is very small. This chapter is very small and has 8 marks minimum weightage. But many students can't score. They gave a lot of importance to this. Why they can't score is because most of the times they can't understand that. Because in the chapter, you have something called planning, strategy, plan. Planning is there, plan is there. What is the difference between these two? This is where the complete, there are 2 questions. What are the considerations in development of an audit plan? What are the considerations in planning? So tell me which answer you write. Because both appear same. If a student who don't know the difference between these two, he feels both are same. Understood? So this is the kind of, the differentiation that you should make. What is strategy? What is plan? What is program? So that's not easy. Okay, I will tell you how to approach to this chapter once we learn certain topics. So in this book, I arranged the topics also in such a way, in the order in which you are supposed to read. You're supposed to learn the subject. This is the order in which you are supposed to learn the subject. Okay. And again, there is one more strategy called 3/4 strategy, which is already there as a video on my channel. So you can just go through it. And I'm telling you, 3/4 strategy you follow, 95 marks plus you can attempt. 90 marks plus you can attempt for sure, irrespective of whatever the level of toughness it could be. 90 plus of them, 90 marks plus you can attempt. You know, there are many All India rankers who write 85 to 90 marks on an average, and they score 70 plus in audit. There are many of our students who followed 3/4 strategy and scored 80 plus in audit. Even recent results also I posted. Every attempt we get 80 plus at least for 4-5 students. Okay, so I won't take their photo and then post. I won't do that. Just the message, they'll message me, I'll just share the screenshot. Okay, so you can find there. How come they're able to score 80 plus? It's not because they attempted 90. It's because they attempted perfectly. There are many students who write with choice 110. And you know what they score? 18 marks they score. They wrote with choice, 110 marks they attempted, but the score is 18. So what is most important is accuracy is most important. Today, if you think, I'll write some answer, I'll attempt something and come back. At least they'll put half mark. No, because valuation is now standardized. Only when your answer matches with the suggested answer, scheme of valuation, you will get a mark. Just because you filled 2 pages for a descriptive question, out of mercy, no, he's not soft cornered. He was not even having that power. First of all, he can't even put half mark for you. So that's the most important thing you should learn. So if you're writing an answer, it should be perfect. Okay, and if it's a perfect answer, 5 on 5 perfectly. If at all you deviate from the perfection level, you are giving a moderate answer, don't expect even half marks also. In the sense, out of 5, 2.5 also you won't get. A perfect answer always get full on full. Anything below a perfect answer will always have, extra cut. Marks extra cut will be there. In the sense, you might expect, I wrote an average answer, above average answer. So you might think out of 5, you'll get at least 3. No, you get only 1.5 there. So when you're self-evaluating yourself also, if you write a perfect, solid, 100% accurate answer with at least 90% accuracy, you can expect 4 or 5 out of 5. But if you're writing a moderate answer, don't expect 3. You expect only 1.5. You're able to understand? So a moderate answer will not get half. Moderate answer will get only quarter. If at all your answer is right only by quarter, you get 0. So this is how you should evaluate when you're doing self-evaluation for theory papers like audit and law. And even any FM theory, costing theory, that whatever you're writing. Clear? That's it. So this is the introduction which I want to give. Okay. So shall we begin? Yeah, 1 minute. Yeah, the first topic that we will begin is nature, scope and objective of the audit. That's the first topic, where always you have 4 to 6 marks weightage. Simple chapter, not a big deal at all. So, so the nature, scope and objective of the audit. So what is nature of audit? What is scope of the audit? What is objective? On these 3 terms itself, we have 3 concepts. Okay, on these 3 terms itself, we have 3 concepts. And I guess you are aware of this fact that we provide various types of services. Whatever the service that we provide, we call it as engagement. Correct? What do we call it as? Engagement. So there are various types of services that we provide. We call them as engagements. And these engagements are broadly 2 types. One is assurance engagement. Correct? Assurance engagement. And another one is non-assurance engagement. One is assurance engagement, another one is non-assurance engagement. Assurance engagements are again 2 types. Reasonable assurance engagement, limited assurance engagement. Correct? Reasonable assurance engagement, limited assurance engagement. In the last exam, they have asked a difference between these 2. In the JAN exam. Okay, so one is reasonable assurance, another one limited assurance. What is reasonable assurance? It's a high level of assurance. Reasonable assurance is a high level of assurance. Limited assurance is a low level of assurance. One is high level, the other one is low level. Okay, now reasonable assurance engagement is called as audit Limited assurance engagement is called as review of what? Of historical financial information. Okay, assurance on historical financial information. If at all you are giving assurance, assurance means what? Giving confidence. To whom? A third party. Giving confidence to a third party. So on historical financial information, if you are giving confidence, what level of confidence you are giving? High level if you are giving, we call it as audit. If you are giving a low level of assurance, then we call it as review. And for audit, we have standards on auditing, and for review, we have standards on review engagement. Apart from historical, you can also provide assurance. You can also provide assurance on other than historical financial information. You can also provide assurance on other than historical financial. Tell me, for the past, what is the opposite? Future. Generally. Yes or no? So, historical, future, prospective. What is it actually called as? Prospective. So, one of other than historical means it might be dealing with prospective financial information, or it might also be dealing with non-financial information. It might also be dealing with non-financial information. On this, if you are providing assurance, what is it named as? For example, reasonable assurance is named as audit. Limited assurance on historical financial information is named as review. Then what about assurance on other than historical financial information? They did not name it, so it's called assurance. They did not name it. It's simply called as what? Assurance. So for that, SAE will apply. Standards on assurance engagements will apply. Okay. Apart from assurance, we also provide something else called consultancy services. We provide certain services which do not involve assurance. Like me and the client will agree with me to perform certain procedures. Okay, the client will agree with me to perform certain procedures which do not involve assurance. Okay, and those services we call them as non-assurance engagements. We call them as related services. What do we call them as? Related services. Okay, so for that we have a standard segment called SRS, standards on related services. Understood until now? Now we have totally 38 auditing standards. We have 2 review standards. We have 3 assurance standards. We even have 2 more related services standards. Totally we have 46 engagement standards. We call them as what? Engagement standards. 45 engagement standards we have. Apart from that, we have one more standard called quality control. We have one standard on that. We have one standard relating to quality control. Totally we call them as engagement and quality control standards, where the number is 46. And in CA Intro, what exactly we have in the syllabus? Out of this 46, review standards, SRE, we don't have in syllabus. We have it in final. We'll discuss it in final. Then we have 3 SAE, assurance engagements. We don't have in syllabus. Then we have 2 SRS. We don't have that in syllabus. We don't have it. Then we have 3 special purpose framework related standards on auditing. We don't have in the syllabus. Then apart from some 7 standards out of 35 main auditing standards, there are total auditing standards 38. 3 standards dealing with special purpose framework, 35 dealing with general purpose framework. Out of this 35, 7 more were there, which we will be exclusively discussing at CA final. Able to understand? Okay, for example, what are they? 240, 250, okay, and 402 and 540. Then we have 540, then 600, 610, 620, 720. These are the standards we don't have in CA Inter. Only these were discussed exclusively at final level. Okay, and if you remove all that, you get 28 standards. How many that we have in CA into 28, correct? Yeah. So 10, 36, 36 minus 7. Okay. I mean, with the quality control, it is 29. With the quality control standard, it is 29. 28 auditing standards we have, 1 quality control standard we have. This is what we have in our syllabus, first of all. Now, the first question, how much is the weightage from standards topic? 80 marks, 70 marks. Obviously, entire all the chapters are standards only, right? Non-standards topic is what? Different types of entities, where the weightage will be 8 marks. Sometimes it can also lead to 12. Okay, but generally it is 8. Then items of financials, which is 12. Bank audit, which is 6 marks. That's it. Only these are non-standard topics. Yes or no? How many? 26. Out of 118, if I remove 26, rest all is standards topics only, right? Rest all standards topic only, right? Without choice itself 70, I'm telling you. With the choice it will be more than 90. So almost 90, 85 to 90 marks is the weightage of standards. And you should never read in the standard order. You should read in the order which I am discussing in this marathon. So tomorrow also when you're revising, so revise in the same order. Okay, fine. So these are the various types of standards, and regarding this we have the matter given at here. Look at what are various standards that we have. Define an engagement. Technically, whatever service that we are performing, we call it as what? Engagement. So engagement refers to a formal agreement between auditor and client. Simple, right? Engagement is nothing but a contract. Contract is nothing but an agreement between a service provider and service receiver, or a seller and buyer. So in our service, in our audit service, who are the service provider? Auditor, and the client is the service receiver. It's a formal agreement between auditor and client. So it contains audit services to be provided and is documented in an engagement letter. Now, what is external audit engagement? What is external audit engagement? External audit engagement, first of all, remember, assurance engagement means what? We have a question on that. Assurance engagement means what? What is an assurance engagement? You call a particular engagement as assurance engagement only if it has a 3-party relationship. Only when 3 parties involved. First of all, in an assurance engagement, there are elements. There are like 5 elements. One is report. Evidence you should obtain. There is something called criteria. There is something called subject matter. And there are 3 parties who are involved. If these 5 elements are present, then only we call that engagement as what? Assurance engagement. 3-party relationship. Only when 3 parties involved, we call it as assurance. For example, you know, internal audit. Internal audit. If at all the client is asking us to provide internal audit service, it's not assurance engagement. Sir, it's audit? No. It's not audit that is discussed under assurance engagement. Audit discussed under assurance means what? Audit of historical financial information. And first of all, assurance means what? There must be 3 parties. The one who prepares the financial statements, the one who audits and gives a report on the financial statements, and the one who will use these both. The one who will use the financial statements and audit report and take an economic decision. Am I right or not? So user. Assurance means what? To whom you are providing assurance? To the user. To the users of the financial statements, if at all you are providing assurance, user must be different from responsible party. Responsible party means what? The party who prepared financial statements. Tell me, you know, right, a company, you know, see, by the way, in this subject, we discuss this entire subject from the context of audit of a general purpose financial statements. We discuss this subject entirely in the what context? General purpose financial statements context. We don't have in our syllabus. Special purpose financial statements we don't have in the syllabus. We discuss this entire subject from general purpose financial statements audit point of view. We take a company form of organization as an example, that to listed company. We take example of which company? Listed company, which is preparing general purpose financial statements, where management of the company will be there, right? They are responsible for preparing the financial statements, and those financial statements are used by users, third party users, shareholders who are not part of management. Shareholders who are not part of management. Reliance Industries you take, they have 20 lakh shareholders. The number of shareholders Reliance had is 20 lakh plus. Number of shareholders I'm talking about, 20 lakh shareholders. And guess what? Reliance company is managed by just 14 board of directors. How many directors were there? 14. Where is 20 lakh owners, and how many were running the company actually? 14. So these 14 people prepare balance sheet, P&L, cash flow. These board of directors will prepare financial statements, and on that we give an audit report, and this audit report and these financial statements are used by these 20 lakh shareholders. Now in this entire Reliance related example, financial statements is there, right? That is what we call it as subject matter. What is it actually called as? Subject matter. Subject matter means what? Audit is conducted. We are doing audit of what? Audit of what? The subject matter. We do audit of subject matter. Okay, who prepared the subject matter? Management. Management prepared. How the subject matter was prepared? In accordance with applicable financial reporting framework. In accordance with applicable financial reporting framework, and that is called criteria. Subject matter is always prepared using some criteria. Tell me, we prepare balance sheet P&L for a company using what criteria? Schedule 3. We use accounting standards. We use Schedule 3. So that is called criteria. Subject matter, criteria. And we obtain evidence. What is the objective of audit? What is the objective of audit? The objective of audit is to obtain reasonable assurance. What do you mean by reasonable assurance? Sufficient and appropriate evidence. And since it's an audit, we call it as audit evidence. Sufficient and appropriate audit evidence we obtain, and that's the way we obtain reasonable assurance. Correct? Huh? And finally we give a report. So the subject matter is prepared by responsible party. You, who is an auditor, audits that financial statements, where you are simply called as a practitioner generally. Accountant, you are called as what? Accountant, auditor, practitioner. These three terms are used interchangeably. Okay? And there will be intended user. So three-party relation must be there. Only then we call that as assurance engagement. Okay, so assurance engagement involves three parties: practitioner who provide assurance, and responsible party who prepares subject matter, users who use the assurance report to make a economic decision. Whereas audit relates to historical, while practitioner may also offer. Auditor generally word is used when the word auditor can be used when you are providing assurance on historical. That to which type of assurance? High level of assurance. That's called reasonable assurance. If you are providing reasonable assurance, we call it as audit. If you are providing limited assurance, we call it as review. And subject matter, it refers to information that you are going to examine. What is the subject matter that you are going to verify? That's what information. Next, criteria. These are nothing but standards, guidances, law, rules, which we typically call them as benchmarks to evaluate subject matter. How do I know whether financial statements are prepared properly? How do I know? I will cross verify that with accounting standard. I'll cross verify that with Schedule 3. Yes or no? The subject matter will be compared with benchmarks. Benchmarks are nothing but what? Standards, law, regulation, all that. Yes or no? Then the auditor, the practitioner generally obtain sufficient and appropriate audit evidence to form opinion. Sufficiency refers to quantity, appropriateness refers to quality. Correct? Evidence which gives more comfort is called as qualitative. Yes or no? And appropriate, like what is sufficiency and what is appropriateness, more in depth you will understand when we are discussing audit evidence topic. So when we are discussing audit evidence topic, there we have a standard called 500. There in-depth discussion will be there. Clear? Then finally, in an assurance engagement, a written report will be provided. The written report will be provided which contains our conclusion, which contains our opinion. Our conclusion is called as what technically? opinion which conveys the assurance about the subject matter. Written report is the outcome of an assurance engagement. What is the ultimate outcome of an assurance engagement? Written report. Who will use this report? Predominantly users, third party users. That's an assurance engagement. Elements of an assurance engagement. Are you clear? A 5 marks question can come. Hello? That's it. Now again tell me, what are two types of assurance? One is audit, another one is review. Just we already saw, audit is a high level of assurance, review is a low level of assurance. Yes or no? For audit, auditing standards apply. For review, review engagement, standard on review engagement will apply. First of all, tell me why we give in audit, how do we give in audit high level of assurance? Why are we not able to give high level of assurance in review? In review also we can give high level, no, but why are we not giving? Because in review, we perform limited procedures. We perform limited audit procedure. Remember, the word audit evidence. What is audit evidence technically means? In a simplest way, how can you explain audit evidence? Audit evidence is nothing but information. Audit evidence is nothing but what? Information. That's it. Now, when you're reading a sentence, if the word evidence is there, sufficient, appropriate, audit evidence, that and all is there. When you're reading, you're unable to comprehend the meaning. You're unable to digest the meaning. Remove that word and put information and then read again. You will get that meaning. Audit evidence is nothing but information. You see audit evidence definition under 500. Information which is obtained by auditor is called as audit evidence. This information is two types. Information contained in accounting records, information contained in others. That's it. So typically audit evidence means what? Information. Audit means what? Verification. What is an audit? Verification. Correct? So what is the difference between audit and review? In audit, we perform detailed procedures, whereas in review, we do not perform detailed audit procedure. We only perform limited audit procedure. In audit, for example, Reliance company is there. Reliance financial statements are there. Let us assume. Just a minute. Yeah. If you observe the Reliance consolidated, P&L, the turnover is almost 9,60,000 crore. Okay, 9.6 lakh crore, the turnover. Whereas from income from service 1.1, total 10.7 lakh crore is the turnover of this company. Revenue of this company is 10.7 lakh crore. In audit, what I do, for this, in audit, first I will inquire management. I'll inquire management, how much is the turnover? And I'll ask them what records are available. I'll inquire them, like what records are available, how the company do the business, all that. Then I will apply something called analytical procedure. Last year it was 10 lakh crore, this year it was 10.7, 7% increase. Okay, 7% increase. Like I will see the factors, overall industry factors I will see. Is the increase common? I will say corresponding expenses. Oh, expenses also increased, purchase also increased. Yes or no? So look at, oh sorry, not that. Here you see raw material consumed. Oh, this one also has increased. Almost 4 into 6%, 24,000. Yeah, almost like 5.5–6%. Purchase also increased. And here also sales also increased by 7%. For example, if purchases remain constant, but sales alone increased, the only reason could be selling price increase. If that proof is there, fine. Suppose selling price also not increased, but sales increased, purchases remain same, then that means something is wrong. Yes or no? Like this we logically analyze, that's called analytical procedure. In a review engagement, we only do these two. In a review engagement, we only perform inquiry analytical. Sir, like tell me, I'll ask management, I'll logically analyze. I get some information, I get some evidence, but that is not sufficient to give high level of assurance. If I have to give high level of assurance, if you ask me low level of assurance, logical I'll see, I'll inquire management, I'll discuss with people, and logical I'll see. If nothing seems wrong, I will tell you, this seems right only. But I'll not say that it is true and fair. I will not say that it is true and fair. Suppose, in audit, what extra I will do, I will verify, I will inspect invoices. I will do inspection of invoices. I will do, recalculation, recomputation. I will do reperformance. I will get external confirmation from third party. I will open the books of accounts and scrutinize it in depth. In audit, we will do these extra procedures. Whereas in review, we only perform inquiry and analytical. And that's why we call, in a review, it involves what? In review, we perform few procedures like only inquiry and analytical, whereas in audit we perform elaborate and extensive procedure. What else what are all? Inquiry, analytical, these two common everywhere. But we also perform inspection of records, recalculation, reperformance, external confirmation, so many. Yes or no? So in audit, reasonable assurance engagement provides high level. Limited assurance provides low level of assurance. Reasonable assurance, it draws reasonable conclusion. In a review, we draw limited conclusion. In an audit, we draw reasonable conclusion based on sufficient and appropriate evidence. This word, right? I will call it as SAAE. Sufficient and appropriate audit evidence, whereas in review we only obtain sufficient and appropriate evidence. We don't use the word audit there because there it is review. Yes or no? Then what is the example of reasonable assurance? Audit. What is the example of limited assurance? Review. That's it. So this is what they ask in JAN exam. And don't have this false assumption that if it is asked in the last attempt it will not be tested. No, paper setters will not have that kind of logic. When they are seeing, if they feel that is important, they'll test it. That's how they think. They will not think last attempt it is asked, so this time I will not ask. No. Okay. Next. In BCom, no, generally what happens is they'll have some 4 set of papers, 3 to 4 set of papers. Every time one paper will be picked up and then given. They'll have only 40 questions, for example. Out of the 10 questions they need to ask. So every time some random 10 questions will be picked and then asked. So that next year another remaining 10 will be picked and asked. That next year another 10 will be picked and asked. But in audit we have 500 questions, not 500, more than that. We have more than, I can say here in this subject we have close to 600 to 700 questions per there. 600 to 700 topics will be there, if at all, if I have to number it. So out of the 600 to 700 anything can be tested. In exam how many we get? Tell me. 6 questions we get. Descriptive, 6 into 4. No, 6 into 3. Yes or no? 6 into 3. 18 questions we get. Correct, no? I hope you know. 14 marks question will be there. What is the composition? 5 plus 5 plus 4. Yes or no? Sometimes it could be 4, 4, 3, 3. It could be like that also. So, but 5, 5, 4 is popular. So, 5 plus 5 plus 4, which means 3 questions in each question. So, 6 into 3, 18 questions. And one extra choice question, 19. So we will get 19 questions out of the 600 concepts that we have. So that's the probability. Next, clear all this until now? Next, and I told you assurance can be provided not only on the historical, but it can also be provided on other than historical. So apart from reasonable limited assurance where they focus on historical, there includes assurance on prospective information or internal controls of the company, and those assurance are called as other types of assurance engagements. Correct? Now so here the subject matter is what, ma? Prospective financial information, not historical. What do you mean by prospective financial information? Prospective refers to financial data. It's also financial only, which is based on assumptions about future events and actions. Simple. What is prospective financial information? PFI refers to financial information based on assumptions and events about the future. Yes or no? And it can be either a forecast, it can also be called as a projection, or it can also be called as a combination. Generally, if I am giving future financial information of next 1 year, that's called forecast. Beyond 1 year, second, third, fourth year also in future I'm talking about, then they were called as projection. You know, forecast is based on best estimate assumption. Forecast is always based on best estimate assumption. Projection is always based on hypothetical assumption. What is projection is based on? Hypothetical assumption. Sir, where do this matter entirely there? CA final. In CA final, we have 3000 series discussion. There you will understand that. Okay. Next. What is the focus of these? What is the focus of these assurance engagements? These assurance engagements, they focus not on historical. They focus on other than historical. That is nothing but prospective. These engagements do not examine historical. Rather, they focus on prospective. Look, historical information reflects financial information about past events and conditions, whereas prospective is based on assumptions about future events and actions. The difference is historical financials is rooted in past, which actually represents actual events occurred, whereas prospective information focus on future, which is based on assumptions about future that might occur, which means the actions are not actually occurred. In prospective, the actions might occur. Correct? Now, that's why, since it is obviously about future, can we give a reasonable assurance? Can we give a high level of assurance? No, we can only give a low level of assurance. But here they have used another word called moderate assurance. What they have used? Moderate assurance. Don't think moderate means high, low, between. No, it's low only. Anything less than high level of assurance is a low level of assurance. Remember that. Anything less than high level of assurance is low level of assurance. That's it. Moderate means medium level of assurance. No, there is no such meaning. Moderate means low only here. Clear? Next step. So in engagements where PFI is involved, generally what we verify, you know what in PFI we verify? Prospective financial information is financial information about future, which is prepared based on assumptions about the future. Correct? We prepare PFI based on assumption. For example, just now we saw Reliance related, P&L we saw. What is the growth rate here? 7%. Yes or no? 7%. Suppose no, they are asking me, sir, 25-26, 26-27 financial year, how much could be the turnover of the company? Estimated turnover. I can't randomly tell. I will look at the past trend. I will look at the economics. I will look at the geopolitics. Then I will take one assumption. Okay, sir, 10% growth is expected. Every year the company can grow by 10%. Okay. So in 26-27, it could be 12 lakh crore. Now in PFI, my objective is whether this 12 lakh crore is right or not. No, that's not my objective. In PFI, 10% is right or not. You have used assumption, right? What assumption you have taken? 10% growth rate. That 10% growth rate assumption you have taken, right? Is that assumption reasonable or unreasonable? This is what we verify in PFI. If the assumption is reasonable, then the second step what I verify, based on this assumption, is the number arrived. Is the number 12 lakh crore you arrived? No. Is it based on this assumption correctly arrived or not? Then the clerical accuracy, arithmetical accuracy I will check. I will never give assurance about this 12 lakh crore. That's not my duty. Whether it will be 12 lakh crore or 14 lakh crore or 15 lakh crore, that doesn't matter for me. All that matters for me in PFI assurance engagement is assumptions. I verify assumptions. Look at. So in engagements where PFI is involved, the practitioner ensures that assumptions are not unreasonable. You see how we wanted to see, they can say in other way, auditor has to ensure whether assumptions are reasonable, but they didn't say that. They said assumptions are not unreasonable. Yes or no? Okay. Are you a smart guy? Yes or no? Is the student smart? No, that's not. You should verify, is the student not fool? Clear? So there is a difference. When you watch a movie, you have this. Is the movie good or bad? Suppose if the movie is really good, you will say yes, really good. But movie is not bad. For example, you can watch one time. What do you say? Not bad. Not bad. If you are using the word, okay, not bad, one time watch, it gives a low level of assurance. As to the other person, he will not get that excitement to go and watch. Suppose your friend is asking you, Macha, after you come back, tell me how's the movie review. Then depending upon your review, I'll go and watch. You came back and told fun, wonderful, fantastic, good, must and watch. Then that's a high level of assurance. Yes or no? Not bad. His excitement will go off. So in a limited assurance, in a moderate assurance, in a PFI, we don't talk whether it is true and fair. We say whether is it not true and fair. Is it not unreasonable? In review, how do we give opinion? In audit, no, opinion paragraph, how we draft, because ultimately in audit, what is our objective? Opinion. Correct? See, by the way, I took one fundamental assumption here, that every one of you know the subject to little extent. So that's the reason I'm not discussing so fundamental level also. Okay, fine. Yeah, look at. So in audit, we give our opinion like this. In our opinion, to the best of our information and according to the explanation given to us, the aforesaid financial statements give true and fair view. This is how we give the wordings. Okay, in our opinion, to the best of our information, according to the explanation we got, okay, the financial statements were true and fair view. This is how we give. Whereas in review, how do we give? Based on our examination, nothing has come to our attention. How do we give in a limited assurance engagement, review engagement? I'm telling you, based on our review, nothing has come to our attention to state that these financial statements are not true and fair. Are they not true and fair? To say that I don't have anything in my hand. For example, this marriage typical example you take. Okay, a bride is looking for a groom. Okay, a girl is looking for a boy. Alliance. Okay, match. They found some on some matrimony. They found some alliance, and the the boy, that guy. Yes or no? So that groom, we do inquiry. Yes or no? I hope you know this. In marriage, the girl side and boy side, they do inquiries, as if like a CBI investigation. Nothing, they get information. Okay, fine. So just the satisfaction, that's it. So the girl side, they came to the boys side. They just came like a detective. Okay, and to the neighbor, they went and asked. Okay, so how is this fellow? If at all the neighbor knows very well about this guy, all that, and he's good, then neighbor will say, no, very good, nalla mapula. No, you definitely, you can give your girl, he'll take care of her very nicely. Yes or no, he'll give. Suppose if the neighbor says, nothing has come to my attention to say that. Yes or no? Fine. If at all the neighbor says, this guy is good, to say that he's bad, I don't have anything to tell. I'm not saying he's bad. To say that he's bad, I don't have any information. Now tell me, the other person, will he get assurance? Exactly. That's the low level of assurance. That's the whole point of low level of assurance. If you say nothing has come to my attention to state that the financial statements are not true and fair, are you mean to say are they true and fair? No. I'm not saying they're true and fair. To say that they're not true and fair, I don't have any information. You understood? Is the guy bad? To say that he is bad, I don't have any information. Are you mean to say he's good? I'm not saying he's good. I'm saying he's not bad. Even that also I'm not saying. I'm saying based on my understanding, he's not bad. Do you understand the level of assurance? Exactly. So this is how we draft. Even in PFI, we draft negatively. Okay, nothing has come to our assumption. Nothing has come to our attention that causes us to believe that the assumptions used by the management are not unreasonable. You could have said they're reasonable. No, we don't want to say that they're reasonable because I don't know they're reasonable 100%. I got limited assurance. First of all, how can I say they're reasonable? Because it's about future, right? Future is uncertain. How can I say that they're reasonable? So nothing has come to my attention. Nothing has come to my attention that causes me to believe that these assumptions are not unreasonable. Are they unreasonable? No, they're not unreasonable. To say that they're unreasonable, I don't have any information. Clear? So that's how we give assurance here. That's why it's a limited. So first point is we should ensure that they are not unreasonable. We should ensure that they are reasonable, nothing but. We should ensure that assumptions are reasonable. Second point that we should check is what? Information. Tell me, PFI. PFI information is prepared based on assumptions. See that the information is prepared and presented based on the assumptions. Not only that, most important characteristics of PFI, in the financial statements, they should honestly disclose the assumptions. Correct? Otherwise, how the user will know? How the user will know 26, 27, 27, 28 financial year, how much is the turnover? How did they predict? It is based on assumption. So you should disclose the assumption. In a PFI, what auditor has to verify, what practitioner has to ensure, see that assumptions are not unreasonable, see that information, PFI is prepared based on the assumption, see that the assumptions are adequately disclosed. These are the 3 points that you should ensure. And what is the assurance level? Since it is future oriented, it can only be moderation. Correct? Why it is moderate? Limitations were there. Prospective pertains to future. Evidence may be there to support assumptions. I may say, you may say, assumptions, sir. Last track record, based on that only we are assuming. No. Now, why can't you give high level of assurance? No, man. This is future. Who knows? Geopolitical scenario. What is going on? Anything can happen. Yes or no? So I can't give a high level of assurance whether PFI will be achieved or not. Hello? Next, the practitioner cannot confirm whether the result shown in the information will actually be achieved. So the practitioner assures that nothing has come to their attention to suggest that assumptions do not provide reasonable basis. Nothing has come to my assumption, nothing has come to my attention to state that these assumptions are not reasonable. I'm not saying they're reasonable or not reasonable, but nothing has come to my attention to say that they're unreasonable. Nothing but. Clear? PFI, that's it. Then we have, I told you, all these engagements, we are having standards, and what those standards are named as engagement and quality control standards. We simply call them as what? Engagement and quality control standards. I told you, standards on auditing, standards on review, standards on assurance, standards on related services. What is the purpose of these standards? Tell me. To ensure high quality standards. The purpose is to establish high quality standards and provide guidance in the financial statements audit as well as other types of assurance. Are you clear? Yeah, 1 minute. Yeah, next one. So what do you mean by standards on auditing? What are standards on review? What is standards on assurance? And what are standards on related? You know, in May 25, they have asked what are the 3 engagement standards? Nothing but you should write standards on auditing and what it deals with. Then you should write standards on review, what it deals with. Then what is assurance, what it deals with. This is the question which they asked. But actually, when you see that question, any 3 engagement standards they asked, there is an alternative answer which is also possible. I can actually take some standard names and standard numbers. I can write that also. Yes or no? That's how the question was. But what they expected is this one. What are the any 3 engagement standards? Write about any 3 engagement standards they told. Engagement standards are standards on audit, standards on review, standards on assurance engagement. Yes or no? Now, tomorrow once again if the similar question comes, what might happen is, you know, next time when a person who is designing the suggest answer, if at all they gave may attempt answer only originally, but the examination committee, some, you know, review committee will be there. So what they might do is, this answer is not correct. We will take standards on auditing, say examples, SA 200, SA 210, SA 230. That answer they might give. That's why what you do, you know, if a similar question comes, what are various engagement standards? Give all this 4 classification, then also give few examples of auditing standards. Further, the auditing standards are having various, there are various auditing standards. Few of them are as below. 4 auditing standards, number heading you write. Hello? What is SA 200 number? Overall objectives of an independent auditor and conduct of an audit in accordance with standards on auditing. SA 210, terms of an audit engagement, like that. Okay, fine. So standards on auditing. Standards on auditing, they apply to audit of financial statements by independent auditor. They set high quality benchmarks for conducting audit of historical. So these standards on auditing, they have objective related standard is there, documentation standard is there, planning standard is there, risk assessment standard is there, sampling standard is there, evidence standard is there, opinion standards were there. Yes or no? So objective 200, yes or no? 230, planning 300, risk assessment 315, sampling 530, audit evidence 500 series, 700 series. Correct? And few examples they gave. Then the second set of standard is what, ma? Standards on review engagement. They apply to review of financial statements. A review provides limited assurance which is lower than that of audit because review involves few procedures. What are the few procedures? Inquiry and analytical procedure. That's it. Now, assurance. Although providing limited assurance, a review also requires you to obtain sufficient and appropriate evidence. For example, when reviewing interim financial information, there is something called review of interim financials 2410 standard. Okay. Now, there are 2 standards that are dealing with review. Only 2 were there. 2400. What is this 2400? Review of historical financial information. Then there is another review. Review of interim financial information by independent auditor. What is this? Listed companies. I hope some of you at least watch news in the stock market at least. Listed companies, they publish something called quarterly results. Have you heard of it? Quarterly. Infosys published quarterly results Q1, Q2, Q3, Q4. Yes or no? Quarterly results. On the quarterly results, Infosys auditor will be there, right? He should give a review report for every quarter. So review report is given by whom there? Independent auditor of the entity. That's what. On what? On quarterly. Quarterly means what? Interim financial information. Review of interim financial information by independent auditor of the entity. That's called 2410. Hope you're able to remember. Yes or no? Then Assurance engagement. Standards on assurance engagements, they apply to engagements which are dealing with subject matters other than historical financial. Yes or no? They do not include audit and review. These engagements may also involve PFI or non-financial matters. Example, we give assurance on controls. Controls at service organization. What is it? Controls at service organization. There is a standard called 3402, and in auditing we have a corresponding standard called 402. Okay, what is 3402 standard? I'll discuss it in, I have covered it in 501 standard. I've covered it in 501. In 501 there is one word called service auditor. What do you mean by service auditor? In 501 it will be there. Okay, service auditor means very simple. If you want to understand a brief background about it, Hindustan Unilever is there. For example, they're manufacturing shampoos, everything, all that, cosmetics. Now, most of the manufactured stuff, whatever that they manufacture, some of the stock will be directly kept at Amazon warehouse. Will be stored at where? Amazon warehouse. Now, Hindustan Unilever has registered as a seller on Amazon app. And you and me as a buyer, we place an order for a shampoo bottle. Who will dispatch it? Amazon will dispatch it. Yes or no? From where they will dispatch it? Amazon warehouse. From there they will dispatch it. Who actually manufactured that? Hindustan Unilever. Whose stock it is? Actually? Hindustan Unilever. Inventory lying with third party. How to verify inventory lying with third party? 501. We have a verification there. One of the example is service organization. You know, Amazon warehouse is a service organization. Yes or no? Hindustan Unilever is the client for us. So we are doing audit of the client. When the client inventory is lying with service organization, what we should do? 402 standard will apply. That is there in CA final first syllabus. You understood the context now? Yeah. Next. So there are two assurance standards. One is 3400, another one 3420. There is one more standard, 3402. Apart from that, we have few more assurance standards. Sustainability related assurance standards were there. Sustainability reporting. Sustainability standards on sustainability reporting, like that 3000 one standard is there. That is also comes under assurance. But whenever we discuss engagement and quality control standards, we don't cover them. Okay, there are three assurance standards. Two examples were given. One example is 3400, examination of PFI. What are you doing? Exactly nothing but your examination of PFI. Second one, assurance engagement to report on pro forma financial information included in prospectus. Assurance engagements to report on pro forma financial information. Assurance engagement to report on pro forma financial information, where it is included? Prospectus. What is pro forma financial information? You will understand that in CA final. Okay, or else my CA final marathon is already there. Okay, inside the timestamp will be there, 3420 part 2. Okay, so there you can, if you want to have an idea, you can just look at there. Some 2 minutes discussion will be there. Next, related services. Related services apply what? Standards on related services apply to engagements that involve performing agreed upon procedure regarding financial statements. So if at all you are providing agreed upon procedures, what is an agreed upon procedure? Simple. A company called me. They have sales, credit sales were there. There are so many debtors. They want to get external confirmation from the debtor voluntarily on their own. Their auditor is not insisting. Their auditor also might get. Okay, but this company, they wanted to get external confirmation from debtors, but they don't know how to get it. And they approached you, sir, we want you to perform external confirmation procedure, get confirmation, compare it with our books of accounts. If there is a difference, resolve the difference, and why the difference is there, please report me findings. You just have to perform the procedure, report the findings, and that procedure is called as what? Agreed upon procedure. In a related service, we only report findings. We don't give any opinion. We don't give any conclusion. Able to understand? We don't express it at all. First of all, it does not involve assurance at all. Clear? Next. So what is an agreed upon procedure? It's an engagement which require performing specific procedure. Example, accounts payable, accounts receivable, related parties, financial statements such as balance sheet. You just have to perform some agreed procedures with the management. Are you clear? And there is another type of assurance engagement. Sorry, there is another type of related service. What is it? Compilation. There are two related services. 4400, agreed upon procedure. 4410, compilation. What is compilation? You know, suppose the company, all these days they are preparing financial statements as per part 1 of the schedule 3 accounting standards. Now from the next year onwards, for the company, Ind AS is applicable. What is applicable? Ind AS is applicable. Accordingly, they need to prepare financial statements as per part number 2 of the schedule 3. But they are not experts in that. So they're approaching you, sir, can you please do help us preparing financial statements as per Ind AS? You are going and helping to prepare the financials. Then what are you providing? Compilation engagement. What are you providing? Compilation. So compilation means what? A compilation engagement involves assisting management in preparation and presentation of historical financial information without providing assurance. First of all, if you are compiling, you are prohibited to provide assurance. Independence of mind, self-review threat. When I compile the balance sheet P&L, I should not give any opinion on that. Yes or no? So if you are helping the management in preparing the financials, you are naturally prohibited to give opinion on that. You are prohibited to express any form of assurance on that. Hello? Yes. So the practitioner will issue a report stating that he only helped in compilation, but no opinion is expressed. There are two related services standards. One is 4400, engagements to perform agreed upon procedure, and another one 4410, which is compilation engagement. That's it. Next. Then we have standards on quality control. Okay, we will discuss this as an introduction at the time of SQC 220. So once we finish there, you come back and read this, you will understand. That's it. So half the topic is over. Almost. What are the qualities of auditor? Personally, you should have some qualities. Then professionally, you should have some qualities, which is very easy. Personal qualities, you should have common sense. Yes or no? That's what they said. I am not saying that. Okay. So audit should have tact, caution, firmness, good temper, integrity, discretion, industry, judgment, patience, clear-headedness, reliability. All of this lacked in everybody. Yes or no? An auditor must have high level of culture, highest integrity, backed by independence. Whatever basic human qualities that we expect, the same qualities must be there from auditor. An auditor must have basic human qualities like trustworthiness, all that. Professionally, you must be expert in accounting, in review of financials, knowledge of all accounting areas, taxation, law. So you must have expert knowledge in all this. Yes or no? That is a professional expectation from you. Personal expectation from you. Personally, what qualities you should have. That's it. Clear? Next. So what is an assurance engagement? An assurance engagement is where a practitioner provides conclusion. Why are we providing any conclusion in assurance? To enhance confidence of the user. Not responsible. He only prepared it. Why should I give him confidence? He doesn't require confidence. He only prepared it. My worry is about the user. Yes or no? About subject matter where I am evaluating against criteria. So in an assurance engagement, we provide assurance on, assurance to a user. To user of the subject matter other than responsible party, where we evaluate the subject matter against criteria and provide an assurance. Correct? Purpose is what? Simple. We allow users to make confident decisions, knowing that the chance of incorrect information is low. Since we provide assurance, people believe that, okay, this information could be maximum right only. There is nothing wrong in that. Yes or no? So the chance that the financial statements will be wrong, that the chance will be reduced if at all you provide assurance. Clear? Because you verify it and then give it. No. So since you verify the financial statements and provide assurance, people naturally have more trust on that. Next. Who appoints the auditor? For private sector companies, company audit. Members at AGM will appoint. For public companies, government companies, C&AG will appoint. Yes or no? For government companies, C&AG will appoint. In case of partnership from LLP, the deed, partnership agreement will tell you who will appoint. Naturally, partners will appoint. For government authorities like Income Tax Department, ICAI Institute, or statutory corporations, in the respective act, appointment of auditor provisions would have been discussed. Correct? So in specific situations, auditor will be appointed for a government authority as per applicable law or regulation. To whom the report is to be submitted? For companies, it is submitted to shareholders. For partnership firms, it is submitted to partner. Next, is audit mandatory everywhere? No. See, by the way, in the entire subject, in what context we are discussing? Financial audit context. We are discussing this entire subject in what context? Financial audit. That to which financial statements? General purpose financial statements. Which entity? Listed company. This is the context in which we discuss the entire subject. Okay. At some places, if they specifically tell a firm, then we discuss about the firm. For example, different types of entities: audit of a hospital, audit of a firm, audit of a sole proprietor, audit of LLP, like that. Some questions were there specifically. So whenever they specifically talk about some other entity, then that entity point of view we will discuss. Otherwise, by default, we interpret this entire subject. We interpret this subject from the context of listed company, from the context of general purpose financials, from the context of audit engagement. Hello, let's see into now. So audit is not always mandatory, correct? But companies, they are legally required to get their books of accounts audited under law. What about non-corporate entities like sole proprietors and partnership firms? They might be liable for audit under tax law. For example, in India, if turnover is reaching certain limit, more than 1 crore as per 44 AB section, then audit is mandatory. How many of you have watched my tax marathon? DT. Oh, you all, how many of you cleared group 1 already? Oh, good. Okay, fine. So tax marathon will be there. You just watch it if possible. I mean, if at all you're writing group 1 also, you will get tremendous clarity. Okay, next. Look at next, government grants. So some entities like schools, they may have to get their accounts audited because they are using government assistance, government grant. When a grant is given, naturally the donor will expect how are you utilizing the grant. So conditions will be there for the grant. You have to use the grant as per the conditions attached, and you should give me a grant utilization report. Yes or no? For that reason, audit might be mandatory. Yes or no? Then voluntary. Sometimes even though there is no audit, because even though there is no mandate requirement, because of so many benefits that audit provides, some enterprises, they go voluntary for audit because of various benefits. Correct? What are the benefits of audit? What are the benefits of audit? Ultimately, see, first of all, the purpose of audit engagement is to increase confidence of the users in financials. Audit engagements are basically reasonable assurance engagements. The benefits are, it will provide to shareholders who does not involve in management. Yes or no? They rely upon auditor to ensure the financial information, the financial statements are qualitative. Yes or no? Then moral check. Audit acts as a moral check on employees. Since audit fear is there, employees will be prevented from doing fraud. Then audit will be helpful for the government. Audited financials of many companies will help the government authorities to determine tax liability. Look at PGBP. We start our PGBP calculation with net profit as per P&L account. If P&L is true and fair, then only the PGBP income computation will be true and fair. If P&L itself is not true and fair, the PGBP calculation under income tax is also not true and fair. I hope you're able to understand. Yeah, next. Bankers use audited financials to take credit decisions. Audit helps in detection of frauds and errors. An auditor, since auditor will come and do the audit, he will identify flaws, he will identify weaknesses, he will identify deficiencies in the internal control system. Tell me, what is an internal control? It's a process. Internal control is a process. This is something that you see in your day-to-day life. Every minute and every hour you are doing, you have some control. Yes or no? Internal controls. At the end of the day, you just lock your home and then sleep. Yes or no? That's an internal control. That's a process. In a company, you see DMart, you see Big Bazaar, you see Reliance Trends. Yes or no? The moment you see, you understand, there is something called control environment. There is an environment which is under a controlled conditions. Yes or no? There is a procedure. Yes or no? Like when you buy some garments, they bill it, they remove all the tax, everything, and then when you're exiting, when you're about to exit from the store, again a security check will happen. All this is what? Controls. These are typically controls. So since in an audit, auditor will verify controls. Naturally, auditor will identify weaknesses in the control. In that way, it is helping the management, it is helping the company to identify weaknesses in the control. So this is one more benefit in the audit. Any 4 points. Okay, now is audit mandatory or voluntary? A 4 marks question can come. Who appoints the auditor? A 4 marks question can come. What is assurance engagement? What is the elements of assurance engagement? A 5 marks question can come. What is the difference between review and limited assurance? Review and audit. A 4 marks question can come. What is an assurance engagement and PFI? A 5 marks question is possible. Then we have what are engagement and quality control standards? Give you examples. A 4 marks question can come. That's it. Easy. Fine, we'll take a break and get back, and then we will discuss the rest of the chapter. We will discuss. Okay, another half an hour, this chapter will be over. That's it. Yeah, let's proceed discussion. We have covered already half the topic of NOS. Now we need to discuss the rest of the NOS chapter. Now, what is the origin of auditing? Only a person who was born in this time will ask this question in exam. Next one. What is the meaning, nature of audit, and aspects to be covered in auditing? So what is the meaning of audit? Definition of audit. Audit is an independent examination of any entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. Correct? Whether you are doing audit of a charitable institute, whether you do an audit of Section 8 company or a commercial non-government private sector, any entity you do audit, the objective of audit remains same, to give opinion. Ultimate objective is to give opinion. Don't think that audit means only for commercial enterprises. No, audit can be for every enterprise, for any enterprise. Ultimately, our objective is to give an opinion whether the financial information shown is true and fair or not. Yes or no? A Section 8 company, they can manipulate books. A charitable institute, they can manipulate books. A trust, a religious trust, they can manipulate books. Yes or no? So any entity, management can manipulate books of accounts and transactions and do frauds and errors. Correct? So audit is not about the nature of the entity. Audit is about the financial information. So it doesn't matter whether profit oriented or not. It doesn't matter whether it's a size, a big company or small company. Yes or no? Irrespective of size or form. Form means what? It could be LLP, it could be a partnership firm, it could be a company, it could be a Section 8 company, a financial institution, or a bank, anything it could be. It doesn't matter. Legal form also doesn't matter. Audit objective remains same. The objective of audit remains same. What is the objective of audit? To give opinion. Correct? So what is the objective of audit? The auditor has to obtain reasonable assurance whether the financial statements are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to form an opinion, and whether financials are prepared in accordance with applicable financial reporting framework. Now tell me, what is financial reporting framework? What is financial reporting? Rules. Financial reporting means preparation and presentation of financial statements. Framework means rules and regulations. Financial reporting framework means rules and regulations for preparation and presentation of financials. Correct? Schedule 3. It contains rules and regulations on how to present balance sheet, how to present P&L, how to present events and transactions. Correct? Accounting standards. It's nothing but rules, processes. Accounting standards are nothing but the rules for recognition, measurement, presentation, disclosure of financial information. So our objective is whether the financial statements are prepared in accordance with applicable financial reporting framework. Now what is applicable financial reporting framework? Depending upon the nature of the entity and objective of the financial statements, depending upon nature of entity and objective of the financial statements, the financial reporting framework which is adopted by the management is called as applicable financial reporting framework. For example, for a bank, applicable financial reporting framework is Schedule 3 of Banking Regulation Act. For an insurance company, applicable financial reporting framework is IRTA, Preparation of Financial Statements Regulations. For an NBFC, applicable financial reporting framework is Schedule 3 Part 3. So the applicable framework will vary based on nature of the entity. Will also be influenced by objective of the financials. Is the objective of the financials general purpose? Is the objective of the financials special purpose? Again, that decides the applicable framework. Hello. Next. And what is the second objective? Then the auditor must report on the financials and communicate findings as required by standards on auditing. So giving a report and communication of findings. This is second objective of the audit. Primary objective of audit is to obtain reasonable assurance. Secondary objective of audit is to give a report. Are you clear? Then now what is reasonable? We told, right? Reasonable assurance we should get. What is reasonable? In an audit, we can only get reasonable assurance. It is impossible to get absolute assurance. Why it is impossible to get absolute assurance? Because of inherent limitations. Because of inherent limitations. Simple. You take Reliance company, 10 lakh crore turnover is there. This 10 lakh crore turnover is belonging to so many segments, so many businesses. One of the business segment that they have is telecommunication. Sales in telecommunication is sales from customers. How many customers are there? For Reliance, approximately they have close to 20 crore. 25 to 30 crore customers were there. So no. Now sales, look at the volume of transaction. These many customers, every month they recharge. Look at the number of transactions only with respect to sales, that too only with respect to one business venture. Telecommunication. They have another business, garments, ready-made garments. They have another business, crude oil. In fact, that's the major business for them. 60-70% of the Reliance turnover comes from crude refinery. Yes or no? So major businesses these are for Reliance company, correct? Look at the volume of transaction. Take DMart example. They have 250 plus stores across India. 365 days business will be happening. In every store in a day 300 to 500 invoices will be there. 250 into 365 into 500 invoices. You see the number. So big it will be. Yes or no? Only sales. What about purchases? Reliance has 5.5 lakh employees. 5 lakh employees they have. DMart has close to 2.5 lakh employees. Employee benefit expense, you see, the volume of transactions are so heavy. It's impossible for us. It's impossible for us to cover 100% of these transactions because it's practically impossible. That's a practical limitation. What is it? That's a practical limitation. Let's go back to inherent limitations of an audit. Why audit suffers? Why auditor cannot give absolute assurance? He cannot give absolute assurance. It's impossible to give absolute assurance because of various limitations. One of the limitation is the way we do audit. Nature of audit procedure is a limitation. What exactly? What issue is involved in audit? What is the problem with audit? Practical limitations we have. What is the practical limitation? We cannot test all the transactions or balances. Then how do you give opinion? By doing sample testing. How do we give opinion? By doing a sample, by verifying a sample. He forms opinion based on sample. This is a practical limitation. It's not, it's practical, it is impossible to verify 100% of the transactions, agreed or not. Apart from that, there is one more limitation, legal limitation. What legal limitation? You can't do narcotic test on the management and then say truth. As an auditor, will you apply third degree to the management and tell me the truth? What happened? No, you can't. Yes or no? That's a legal limitation. Whatever information management gives you, you have to accept it. You have to apply your skepticism and decide whether it is true and fair or not, whether it is reliable or not, correct? You don't know what exactly happened in reality. How do you know? Material was purchased. For example, company purchased from April 1st to 31st March. So much of raw material they purchased. So much of goods they sold. Or let us assume company has 4 lakh employees. And to them they paid salary every month. How do you know 4 lakh employees were there? It's impossible for you to count. I'm suspecting management might be hiding from me. There might be some ghost, dummy employees. I want to know this information from the management. No matter whatever you try, you won't get that information unless you apply some narcotic test or third degree or something like that. When you apply only, you will get the true. Yes or no? But we don't have legal power. We don't have that power to do that. So that's a legal limitation. Management may not provide complete information which is requested by auditor, and you cannot force management to provide this information. If at all management is not providing, you can only report that matter. This is a legal limitation. Management might be dishonest. They might involve in fraud. They might have designed a scheme to conceal it. Yes or no? They do a fraud. They post, for example, 10,000 employees are dummy. There are no real employees at all. You will find Aadhaar card, documentation, background verification, every record will be there. Employee will not be there. Understood? Dummy employees. Still the company is paying salary to them every month. You don't understand. You won't even identify which 10,000 employees. Out of 5 lakh, scattered. The employee ID numbers are scattered. Yes or no? You can't. So management might involve in fraud. They may design sophisticated scheme to conceal the fraud. Suppose you want to physically go and meet the employee. The company immediately says, sir, the employee is on site. He went abroad or he went for some client place. Yes or no? No, I want to talk to him. Somebody will respond there. Who knows that he's real employee? Yes or no? So they might present fabricated documents to mislead the auditor. Look at the Aadhaar card, sir. Look at the employee various other identity proofs and all. No, they are all employees genuine. They try to prove you that is genuine, but these entire documents are fabricated. Okay, so causing the auditor to accept the evidence even though the evidence is invalid. So this is a legal, these are all limitations. Again, related party transaction, that is one more limitation for us. Within audit, one more limitation is related party. The entity might engage in paper transactions with related parties, which may not have actually occurred. Paper transaction means what? Dummy, bogus transaction. So I will tell I purchased from company A. Yes or no? Company A sold goods to company B. Company B sold goods to company C. Again, I purchased from them. So we are inflating sales everywhere. We are passing on input tax credit and then doing some GST fraud here. Some input tax fraud and all they're doing. Yes or no? So in these kinds of transactions we can do with related parties. Why we need to give special emphasis on related parties? Because related party is the biggest source of fraud. The biggest source for fraud in any company is related parties. Look at Coffee Day. When the fraud was discovered in 2024, yes or no, it was all completely rooted through related parties. Most of the frauds, you know, Adani Group, there was an allegation on them by Hindenburg. You know, have you heard of this? Some 2 years ago, 1.5 years ago, there's a Hindenburg report on Adani Enterprises that Adani is doing manipulation. But of course, it was not proven ultimately. It was not proved also. Even American, they just put some allegations, false allegations only. They're not completely true. They're false only. But related party manipulation. So related party is one way where you can distort, you can manipulate the financial position and showcase a better performance. Suppose no, in my company, for example, I already got a loan. I'll tell you how simple frauds banks do. What Anil Ambani group of companies did, similar thing. For example, suppose I have a company and I have 100 crore turnover and I have a profit of, let us assume, 10 crore. But still my turnover is there, liquidity is good. You know, banker is convinced. He gave me, let us assume, to the extent of 300 crore loan he gave. The banker gave me 300 crore loan. Now again I want some 50 crore loan. I went to the bank. They said, no sir, sorry sir, you're already full. Your limit is full, your company, we can't give you further loan. Then I'll do one thing. I'll incorporate one company. Okay. I will sell goods to that company at a lower price. Now I will incorporate another company. This company will sell goods to the other company. Okay. I will do the fund adjustment. Now a new company was established where it has a good track of revenue, a good track of profit. But actually the purchases and sales both are dummy. The profit is dummy. I incorporated two different companies now. To one company I'll sell the goods. From another company I'll purchase the goods. This company will sell the goods to the third company. Yes or no? Now automatically the second company, revenue is there, profit is there, GST paid, I got the input, I don't have to suffer any loss because of this. Just by doing this. Now another company, now I want loan, right? I will apply loan in this company name. Now banker, what they will check, this company when it was incorporated 2 years back, it got incorporated, very good turnover, very good profit. Banker will convince it. Yes or no? So we will also convince with the banker. We will tell this entire situation in background. We'll tell them, convince the banker. So based on the entire company track record, he will sanction 100 crore fresh loan. See what I did? Nothing. I just incorporated two dummy companies and then pass dummy transactions, all this. That's why when bankers are giving loans, no, they look at related party transactions. So related party is one area where frauds will happen. So nowadays only these people are discovering, bankers are discovering these kinds of fraud. Related enterprises and all, they're investing. Sometimes to hide from this, bankers also should not detect it, no. So we send money to multiple chains and then ultimately that money comes to the company as an Indian company, and that Indian company will buy. That's why we have in 143 subsection 3 funding party, intermediary, beneficiary. Have you seen the reporting requirement? Funding party, intermediary, beneficiary, reporting requirements, that and all will be there. Fine. The auditor cannot detect, especially if at all you don't know the relationship. If you don't know the other company is a related party, you will understand that it's a genuine transaction. If it's a related party, you will look at reality. Why this transaction happened? Is it a genuine or not? You will look at if it's a related party transaction. These are the limitations in case of audit procedure. So audit procedure itself is a limitation. Second limitation, nature of financial reporting. Tell me, Reliance company is there, profit is there. Do you think that profit is absolutely realized by the company? Is that profit 100% accurate arithmetically? Why? No, obviously not. Arithmetically it is not 100% accurate because the P&L account includes so many debits which are non-cash expenditure. Provision, depreciation. Depreciation, is it 100% accurate or is it an estimation? Provision, estimation. your P&L account itself is influenced by an estimates. Your profit itself is an estimate. Technically, your profit is not 100% accurate. It involves some estimation. Now, which means the financial reporting itself is not 100% accurate. How can I give 100% assurance? What is absolute assurance? Saying that the balance sheet P&L is 100% right. What is absolute assurance? 100% right. Yes or no? The balance sheet P&L itself is by default, they are not 100% right. How can I give absolute assurance when that itself says I am not 100% accurate? How can I say that it is 100% accurate? Are you clear? So preparation of financial statements involves many judgments, yes or no, which are subjective, which will have some degree of uncertainty. Correct? Depreciation will have a degree of uncertainty. Yes or no? So the management is responsible for preparing financials as per applicable framework. Management is responsible for effective internal controls, and these controls may not always be reliable due to inherent limitations of internal control. Business will happen smoothly when internal controls are operated effectively. Management is responsible for these internal controls, and sometimes these controls might have not operated effectively. Management would have overridden the controls. Management would have passed dummy entries. Yes or no? For example, a company may require that purchase bill reflects stamp and signature of the person indicating goods have been received. However, if the accountant and authorized person collude, they can override internal. This is a limitation. Limitation of internal control. What is it? Limitation of internal control is one of the limitation in the audit. The company financial reporting, the company business process itself has some limitations. Yes or no? Maybe the top management who are responsible for preparing balance sheet P&L, they may be honest, but the middle level management may not be honest. Yes or no? So preparing financials involves judgments which are subject to decisions and having degree of uncertainty. Management who is responsible for effective internal control, where the control may not be effective because of inherent limitations. Example, there is a goods receiving department, accounts department, both are separate departments. Goods receiving department has to receive the goods and then forward the documents to accounts department. Then they will pass the journal entry in the books of accounts. But what if they both colluded? Without even receiving the goods, they can record a dummy transaction, and accountant also will pass a journal entry. Finance team will make the payment to the vendor where the vendor himself is not existing. Hello? This is a limitation. Limitation in internal control. Limitation in internal control causes financial statements not absolutely true and fair. That limitation causes us not to give absolute assurance. Why we are giving reasonable? Because of these limitations. Hello? Next another limitation. Just a minute. And the next one, remember what we are doing is audit but not investigation. Investigation, in investigation only we give absolute assurance, but not in audit. Audit is not an official investigation. Yes or no? So the auditor cannot guarantee that financials are free from MMS. Moreover, over the time, information relevance decreases. Auditor cannot verify every matter in detail. Balance must be struck between reliability of information and cost of obtaining it. If you keep on sitting on the same information and trying to go dig it more deeper, you won't get it sometimes. For example, employee, they hired an employee somewhere in April, and that employee left in August. 4 months he worked. How do you know that the employee worked for 4 months? Will you go and do physical verification to the employee home and then visit and then get the evidence that he really employed or not? No, over the time that information loses its relevance. Yes or no? So the auditor has to strike a balance between obtaining the evidence and cost of it. For example, information relied upon from previous year may lose relevance and reliability if something new happened. They gave another example. Then future events. Further, I give assurance on financial position and performance of the company. Just because I say true and fair, that doesn't mean company financial position is strong. Many have a wrong assumption about audit. If we give positive opinion, it means people think it's a positive outlook of the company. No. Tell me, company is really performing well. Company is performing extremely well, but the financial statements are completely showing a negative picture. Financial statements are showing a negative picture. Actual company has a very good profit, but financials are showing a negative loss. So tell me what opinion I should give. Okay, opinions let us divide into two types: positive opinion, negative opinion, for the sake of convenience. Now, financial statements are showing a loss. In reality, the company is well performing. Tell me which opinion I'll give. Negative opinion. Why? My opinion is not about how you are performing. My opinion is not about how the management is, how the directors are, how the company is performing. Is the company has a good view? That is not my responsibility. Financial statements, are they true and fair? What do you mean by true and fair? What is there in reality? What they are showing here? Both should match. If there is a mismatch between what happened in reality, what they are showing, then I'll give negative opinion. So I will give positive opinion, not because company has a profit, not because company has a good net worth. No. My positive opinion indicates P&L account is true and fair. Balance sheet is true and fair. Suppose company is really performing bad. They're performing very bad. The performance is negative. Position is negative. In fact, company will shut down in another 2 years. If they continue like this, 2 years, they'll close. But you know what? Whatever the financial difficulty that they're facing, no, exactly they showed in the P&L. Exactly they showed in the balance sheet. They are not doing window dressing. They're very honest. Now tell me which opinion I'll give. Exactly. So whether I give positive opinion, whether I give negative opinion, depends upon true and fairness of the financial statements. So when I say positive opinion, that doesn't mean company is performing well. When I give negative opinion, that doesn't mean company is performing poor. My opinion is influenced by true and fairness of the financial statements. Hello? Yes or no? Next. So future events may adversely affect the entity's ability to continue business. Market changes, new business models, unforeseen events could cause businesses to cease operations. New business model, for example, today electric car companies, they are selling cars with BAS model, BAAS, battery as a service. What is it actually? Battery as a service. For example, you want to buy Maruti has recently launched some car called Vitara, e-Vitara. Or you take MG, they have a car, they have a electric Windsor. You know how they're selling it? If you want to buy the full car exactly 100%, you want to get 100% ownership, some 15 lakhs is the price of the car, let us assume. In this 15 lakhs, approximately 6 lakhs is only for the battery cost. I'll do one thing for you. You pay 9 lakhs and get the car. What about battery? Battery also you take, don't worry. Without battery, how will you run? Yes or no? So battery also you take it. Then how come like I can own it? No, battery I will lease it for you. Battery I will lease it for you. Every month, for every kilometer, 5 rupees you pay me. Pay me 5 rupees per kilometer of usage. In this month you drove 2000 kilometers, pay me 10,000 rupees. Next month you drove only 1000 kilometers, pay me 5,000 rupees. Okay? Again, after 5-6 years, you want to sell the car. You go and sell outside, whatever. Okay? How much amount you get for the car? Out of it, battery related depreciation portion we reduce and then take the balance amount. And then you take the car price, I'll take the battery price. You understood now? New business model. This is a new business model. Traditionally, selling a car means selling the car as a whole with package, complete. But now, battery as a service. To increase the sales of electric cars, battery we are not selling. We are leasing the battery, but car we are actually selling. It's a new business model. Yes or no? So these business models might affect operations. Suppose the one company brought this model. It was really powerful. It clicked very well. The cost of the car, initial cost of the car substantially reduced. The other competitors who could not adopt this business model, their operations might cease. Their operations might come to closure. Yes or no? If at all they don't innovate, their business will shut down. So future events also will influence. These are all inherent limitations. Are you clear? Yes. Next. So in exam they can ask you, write about nature of audit procedure, 5 marks, or nature of financial reporting, 4 marks. Audit is not an investigation. This point they can ask as a 4 marks. Clear? Next. Then we have scope of audit. Then we have scope of audit. Scope means what, ma? Scope means what is covered in my purview. Yes or no? Scope of syllabus. CA into scope of syllabus, we have 6 subjects. Like that. Scope of audit means what? What exactly in audit includes? What audit excludes? What is included in audit? What is excluded in audit? What is excluded in audit? You don't have to do any task beyond your competence. You don't have to do anything beyond your competence. Suppose no, client gave you, suppose a immovable property is there. In CARO, we have to verify title deeds of immovable property. So you want to verify title deeds of immovable property. Company has brought some title deeds which they purchased. The corporate office is a right for company. They purchased in 1980. That time these papers will be there, no title deeds. They came and showed you that papers were completely like, you know, they were tore. I mean they were teared and so much of dust. Everything is there. Yes or no? And I'm skeptical. Is this original, duplicate? I am not expert in deciding whether this is original or duplicate. I don't have that skill. Yes or no? Company might have taken print of them very recently. Yes or no? And made the paper wet and then dried it so that the paper looks old. Yes or no? And they just did some small all this ink and all they applied to appear it like 40 years old paper. They did all the thing. Now whether this paper is latest, a 40-year-old paper, only a carbon testing, some testing will be there, some scientific testing, only that testing will decide whether the paper is really 40-year-old paper or is a fabricated one, is a original one. I am not expert there. So don't expect from me that level of competence. Yes or no? There are so many which are outside my competence. The auditor is not expected to perform task which is outside their competence. For example, physical condition of asset like machinery. You know, suppose client said machinery we purchased, sir, depreciation is there, we calculated. Show me the machinery. I'll go and see the machinery. That's it. I don't know what is the condition of the machinery. Yes or no? I don't know the condition of the building. Next, the auditor is not expert in authenticating documents. He cannot verify genuineness of documents as it requires expertise in that field. Audit is not an official investigation. The auditor does not have a legal power like search, recording witness statements, all that. Audit and investigation are different. Investigation involves detailed examination, such as checking fraud. If a fraud is suspected, it turns into investigation. The scope of audit is general and broad, whereas investigation scope is specific and narrow. Correct? And the objective of audit is ultimately to obtain reasonable assurance whether the finances are free from MMS, allowing the auditor to express an opinion. So what audit does not include? Auditor is not expected to perform tasks beyond outside his competence. Auditor is not expert in authentication of document. Audit is not an investigation. Investigation scope is specific and narrow. Audit scope is general and broad, and the objective is to obtain sufficient appropriate evidence, reasonable assurance, and to give an opinion. This is what exactly scope of audit does not include. Then what scope of audit includes? Scope of audit includes, scope of audit includes, you should cover all the aspects. Purchases, sales, employee benefit expenses, fixed assets, current assets, businesses, segments, everything you should cover. You should obtain evidence on reliability and sufficiency. You should get evidence on financial information, reliability and sufficiency. You should get evidence on whether proper disclosure is made or not. You should get evidence on proper disclosure. What evidence? This itself can be asked as a 4 marks question. One of the auditor's responsibility is to ensure proper disclosure of financial information. Okay, what do you mean by that? They'll give a big case study, and at the end, this is what the question actually that they're testing. Only this answer only you should write. So the auditor ensures that relevant information is properly disclosed considering applicable financial reporting framework. Okay, applicable statutory requirement. Then the auditor should ensure financial statements properly summarize the transactions and events, and auditor will evaluate judgments made during preparation. Management makes many judgments such as choosing an appropriate accounting policy, all that. The auditor evaluates whether these accounting policies are appropriate and consistently applied over time. Auditor understands that financials are based on historical, which actually reflects past events and conditions. So look at what auditor has to. Auditor has to ensure financial statements properly disclose the information required as per applicable statute. Second one, the auditor has to ensure whether financial statements properly summarize transactions and events and evaluates judgments made by the management. Management makes so many judgments, especially relating to accounting policy. For accounting policy, what you should verify? Whether the accounting policies are suitable, appropriate, and are they applied consistently. And auditor has to understand the fact that the financials are based on historical financial information which reflects past economic events and conditions. So auditor has to verify disclosure and transaction summary. Auditor has to verify accounting policies. Auditor has to understand the fact that it is based on historical. This is what included in scope of audit. Scope means what? A range of something or a reach of something. The purpose of audit is to increase confidence of the user. The auditor expresses opinion whether financial statements are prepared as per applicable framework. Yes or no? So the framework used in preparing financials must be acceptable. In India, companies follow financial reporting framework under Schedule 3. For a company, Schedule 3 is acceptable framework. For a bank, Schedule 3 of Banking Regulation Act is acceptable framework. Hello? Everyone? Next. Objective of audit. Again, we get only reasonable, which is a high level of assurance, but not a guarantee like absolute assurance. Correct? Huh? The audit of financial statements is conducted by auditor, where he will use competence and skills following standards on auditing. Audit evidence is gathered. Evidence means what? Nothing but information. Information is gathered about the financial statements. About financials, we gather background information, evaluated, and conclusions are formed. So regarding turnover, in the Reliance company, I will get background information. What is the background information? Sales data, sales invoice, e-way bills, debtors credit worthiness assessment, debtors confirmation, goods dispatch report, transit copies. Background information I will gather, I will evaluate, and I will form a conclusion whether 10 lakh crore is true and fair or not, whether this 10 lakh crore is right or not. This results in reasonable only, but not absolute. In audit, the nature of evidence that we get is persuasive. What is the nature of evidence that we get? Persuasive. There is a difference between pervasive and persuasive. Both are not same. Okay, so there is a word called pervasive. That is different. I am talking about persuasive. I am talking about what? Persuasive. Persuasive means convincing. What is it? Convincing. Pursue him, persuade, convincing. Are you clear? In audit, the evidence that we generally get is persuasive. In investigation, we get conclusive. We get what evidence? Conclusive evidence. Yes or no? 100% conclusive evidence we get in investigation. Whereas in audit, we only look for convincing evidence. How do you convince me that you paid salary to employee? How do you convince me? Simple. Show me the bank statement of the employee. Show me the statement of fund transfer. If I show you that amount is paid to so and so, if I show you amount paid, I show his identity proof, I show employment contract, you will believe that yes, employee is there, you paid salary. Yes or no? In reality, there is no employee. In reality, the bank statement is forged, fraud, fabricated. Who knows? In audit, we don't look for conclusive evidence, we look for persuasive evidence. If at all based on the information, if you are able to convince that it is true and fair, that's enough. That's why the level of assurance we give is only reasonable, but not absolute. Then you might get it out, sir, when it is only convincing, when it is not absolutely true, then what is the purpose of audit? Something is better than nothing. Yes or no? Something is better than nothing. That's it. Okay. It is like policing job. Yes or no? They don't control absolute crime. They won't prevent and detect absolutely what is happening, but they can control to some extent. Yes or no? The fear of morality will be there. The morality, that fear will be there, right, in the public. That's it. So for that reason only policing job. The auditors are no, I mean, it's like a policing job only, nothing but. We are called as watchdogs, We are called as watchdogs. You can only bark if something is wrong. You can't bite. You can't curse the client, no? Yes or no? Next. So, misstatements, they can arise due to fraud or error. The ultimate objective of auditor is to ensure financials are free from MMS. The auditor opinion is communicated in a written report as required by standards on auditing based on auditor's finding. So this is what objective of audit and detailed explanation. In exam, they can ask you as a 5 marks question. Clear? Next. Scope of audit. What it includes? Proper disclosure. One attempt they asked. What it excludes? Scope of audit. In one of the attempt they have asked. Okay. Next. What are the points auditor has to ensure that the financials are not misleading anybody? What points auditor has to check so that financials are not misleading anybody? In the recent September 25 or May 25, somewhere this was tested for 5 marks. What points auditor has to check so that financials are not misleading anybody? Very simple. First point I will verify is whether financials are matching with books of accounts. Obviously they will match. Now my question is the books of accounts right or wrong? check it with background documents. Background documents means what? For sales, sale invoice will be there, e-way bill will be there, purchases, purchase bills will be there, expenses, bills will be there, check with. So first, confirm whether financial statements are matching with books of accounts. Verify whether books of accounts are supported by sufficient and appropriate audit evidence, and see that no transactions are omitted. See that the transactions are not recorded multiple times, no omissions and no duplications, and see that the financial statements information is there, right? In the balance sheet, P&L information, notes information is there, right? It should be clear and without any ambiguity, and check whether financial statements are complying with accounting standard. What do you mean by complying with accounting standard? What should be complied? Financial should be in compliance with accounting. What financial statements consist of? Basically amounts, classification, presentation, disclosure. Amount, classification, presentation and disclosure, they must comply with accounting standard. And ultimately you need to ensure financials present a true and fair view of the results, of the assets and of the liabilities. So what are the points that we need to ensure? We need to ensure financials are complying with books of accounts. We need to ensure books of accounts are supported by vouchers. We need to ensure there are no omissions or duplications. We need to ensure that it is clear and without any ambiguity. We need to ensure that they complied with accounting standard. We need to ensure that they are true and fair view. Over chapter. Easy or not? Yes or no? So with this understanding, you once again go back and then read it thoroughly once again, you remember it. Okay, fine. Now, auditing relationship with others, not that important, but give a single reading. Give a single reading. That's it. I think all the points I've covered. What is the nature of auditing? Definition of audit, nothing but nature of audit is audit process must be independent. Auditor, the person who is auditing should not prepare that statement. I'm only, if I'm auditing balance sheet P&L, I should have not prepared it. Yes or no? So audit must be independent. Auditor's judgment should not be influenced by entity being audited. Your decision making should not be influenced by management. Okay. Now auditor must be free from any external influence. So auditing applies to both profit oriented, non-profit oriented. It can be done for any size of the entity, any form of the entity. The purpose of audit is to express opinion. Auditing provides assurance and build confidence among the user. It is ultimately the purpose of audit is to enhance confidence. The confidence for the users will come from auditor's opinion, whether the financial statements comply with applicable financial reporting framework. You're buying a jewelry. If the hallmark is there, you naturally believe that the jewelry is having purity of 916. Correct? So it's like hallmark on a water bottle, on a pen, on laptop, anywhere. ISI mark will be there. Yes or no? So why that ISI mark is important? It is a certification of quality. Yes or no? You will find QC check, okay. That stickers you will find. That and all gives you an assurance. Auditing is just like that. It gives an assurance that you don't have to worry. You just happily proceed, take a decision. Clear? So nature of auditing, this itself can be asked as a 4 marks question. So, tomorrow what you have to do is, after again, if at all you're thinking to watch again this marathon, after this immediately go and solve the question bank. Then again watch the next chapter, go and solve the corresponding question bank. So same repeat for all the chapters. That's it. Clear? Fine. So 5 minutes, we'll continue. Yeah, there is one more topic in this, need for these standards. What is the need for these standards? And what is the duty of the accountants to comply with this? Duties in relation to these standards. What is our duty? Any work, any engagement that we perform, we have to perform that engagement by complying with these engagement standards. Correct? Professional accountants must follow standards in their engagement. Yes or no? If a specific procedure in the standard is ineffective, suppose a standard is saying you should follow some procedure. A standard is saying you should follow some procedure. So you might have performed some other procedure and you should document how that procedure served it. For example, if inventory lying with third party, you should either get external confirmation from the third party or you should visit the third party. Yes or no? Suppose you are unable to get confirmation, you are unable to visit also there. Some of the procedure is not possible for you here. Still you are confident that inventory lying with third party is right. Why? Because we sent inventory to third party, right? For some repair work we sent. Then again that inventory was returned to us later on. Inventory returned to us later on, right? That means inventory is lying with them, right? That's an alternative procedure. What is it? That's an alternative. By performing an alternative procedure, I got evidence. So if a specific procedure is not applicable or not possible, you should document how a different audit procedure helped you to achieve this objective. Okay, 501 standard says if inventory is lying with third party, you should get evidence on that inventory by getting external confirmation from third party, or two, by visiting the third party location. Okay, these are the two methods is what the standard says, but here these two methods are not possible. Still you want to get evidence on inventory. How can you get evidence on inventory? I'll try alternative method. What is alternative method? I sent inventory with third party. Inventory is lying with the third party. Later on we received the goods. Later on again we received the goods, which means the goods were delivered back to us. Goods were delivered to us. Ultimately it indicates the goods are lying with the third party earlier. That's an alternative procedure. That's an alternative evidence. Next, they must also document reasons for departure unless it is clear. Yes or no? Unless it is clear, and draw attention to these departures. Every point that they are saying in the standard you should follow. If you do not follow a particular point in the standard, why you did not follow, reasons you should document. Disclosure alone does not absolve the accountant from complying. You know, just because you are giving a disclosure, that so and so standard I didn't follow, that doesn't mean you are exempted there. Don't think that by disclosing what you have not complied with, you are exempted from the rule. A rule is applicable, a standard is applicable, you must do audit as per the standard. Why you did not follow the standard? It was impossible for you to follow there. Then only if you do not follow, you tell the reason, then we'll accept. Suppose it is possible for you to follow the standard. It is very much possible for you to follow requirement in the standard. Still you are not following and you are disclosing. Don't think you are exempted there. Able to understand? So disclosure will not relieve the auditor from the applicability of the requirement of a standard. So these are the duty. What is the duty? You must follow the standard, and if a specific procedure in the standard is ineffective, you should document how alternative procedure you followed served the purpose. And you must also document reason for the departure and draw attention to these departures in the report. In the report also you should specifically tell so and so 501 standard, so and so procedure we did not follow. Okay, we'll discuss reporting there. I will tell you what are all this. Disclosure, just because you're disclosing, that doesn't mean you're exempted from this. Okay, what is the need of these standards? These standards ensure audits are conducted against benchmarks which is aligned with global practices. These standards will improve quality of financial reporting. They promote uniformity in audit. They equip professional accountants with knowledge and skill. They ensure audit quality. These are the need for quality control standards. They bring uniformity in the way we do audit. They equip you how to do the audit. They make sure audit is qualitative. Standards are basically nothing but standardization. Standards are meant for what? Standardization. If you have standard, you will have a minimum assurance on quality. Imagine Domino's pizza. Okay, Domino's, McDonald's, you see. You go Domino's anywhere in India, anywhere in the world. You go McDonald's anywhere in the world, you get the same taste. The burger remains the same. 95% accuracy, the same taste, same shape, same size, same that fluffiness, everything. Yes or no? So it is exactly the same. Why are they achieving that uniformity everywhere? Because the burger making process is standardized. Pizza making process is standardized. Standards were there to make a burger. Standards were there to make a pizza. Who introduced those standards? The respective company. So the pizza making company, Domino's, have released some standards on making the pizza. McD has established some standards to make the pizza, which ensures uniformity. Yes or no? Which ensures uniformity. Which will train the chef. Yes or no? Which will ensure the quality of the pizza remains the same. The same is what standards on auditing objective. Standards promote uniformity. Standards promote quality. Standards make you skillful. Standards make you competent. That's it. So Domino's, McD, all these have standardization. They have a quality control policy and procedure. You have SQC, no? What is SQC objective? Establishing quality control policies and procedure. Why you need to establish quality control policies and procedure? The way you are working has to be standardized. How a Domino's is standardizing pizza making process, you are doing audit, right? Your audit process has to be standardized. That's what SQC says. What is SQC? Establish policies and procedure. Establish policies and procedure. They say establish policies and procedure for leadership. Establish policies and procedure for ethical requirements. Establish policies and procedure for acceptance and continuation of client relationship. Establish policies and procedure for human resources. Establish policies and procedure for monitoring. Establish. What is established? What you should establish? Policies and procedure. What do you mean by policy and procedure? Standardization. SOP. SOP means what? Standard operating procedures. You go to metro, whether you are Chennai Metro, Bangalore Metro, Delhi Metro, uniformity, the way the ticket is given, the way you are entered into the station, everything is standardized. Able to understand now? That's it. So that is the need for quality control standards. Okay. Look at the intensity at which I talk. Look at the intensity at which I am working. That intensity is what required for you when you are preparing. If you are intense in preparation, your absorption rate is very high. If you are not intense, even most of you, are also listening intensely. That's very good actually. That intensity if you have in your preparation, some students they read many times, still they don't remember, they can't connect to it. That's because of lack of intensity. Whatever you do, you should target, you should work like, I should finish it today. That's it. You target something today, finish it today. And for that, intensity required. Intensity comes only from attention, only by giving focus, whatever focus it requires. So don't think about when I'm talking, I don't have an option. I don't have an option what is going around, like what is happening. I don't have an option to think like that because I'm so hooked up. I can't even divert. My mind cannot be diverted. If I divert, I can't teach like this. The same way, if you are able to study with the same level of intensity once or twice, if you read twice the audit subject, you can score exemption. That's not a big deal at all. In fact, I'll tell you one more strategy for descriptive purpose. You don't have to study all the 11 chapters for descriptive. If you're able to get 30 marks in descriptive paper, 24 to 26 marks in objective, MCQs, 55. Scoring 54 to 56 marks in audit is not a big deal at all. MCQs you can score if you thoroughly understand the subject. You remember the entire subject. If you don't understand it, you can't score at all in MCQ. Maybe 8 marks or 10 marks you can score. But at least 12 to 14 marks of the MCQs require you to have an analytical understanding of the subject. And sometimes the MCQs are so connected with the case study, you can understand the case study only when you have a subject knowledge. Otherwise you can't. So in MCQs, you should be targeting 24 to 26 or 30 on 30. Technically 30 on 30. Even in my regular class, I teach with the same objective. You should bank 30 on 30 in MCQ. And in the descriptive, 24 to 26. Just by 24 to 26 marks if you are getting, or just targeting 30 marks, exemption. In order to get 30 marks, if you attempt 40 marks of the paper is enough. You attempt 40 marks of the paper, that is enough to score 30. Because you get 30 if you write 35 to 40 marks perfect answers. Even if you write 90 marks of the paper, 80 marks of the descriptive paper with average answer, you can't even score 10. Because I told already at the beginning itself, something I'll write, something I'll get. No, you write something, you get nothing. You have to write 100% accurate answer, at least 90% accuracy, then you get 90% accurate marks. If you are writing a moderate answer, you get a quarter mark. If you are writing a quarter answer correctly, you get 0. So this is the logic. So 40 marks if I have to attempt. Nature and objective, 6 marks. Ethics and terms of engagement, 10 marks, 15 already. Audit report, 15, 30 marks already. Audit evidence topic, 15. 50 marks almost I can attempt here. Just by studying 4 to 5 chapters, we can attempt 40 to 50 marks of the paper. 40 marks of the paper easily you can attempt just by studying 4 or 5. Items of financials, you become perfect in the 12 marks you can attempt. You don't have to study all the 11 chapters to score 30. To score 30, you have to write perfect answers of 35 to 40 marks. Even if at all you are writing perfectly for 70 marks, you score 60 plus in descriptive itself. If you want to score 30 plus in descriptive, 40 marks perfect answer if you write, that's enough. MCQ, you read the entire subject with proper understanding, proper clarity, with understanding the context behind it. 30 on 30 MCQ scoring is not a big deal. CA inter audit is quite easy. Just that our lack of attention, lack of connectivity with the subject is what making it fearful. Clear? Yeah. So 5 minutes we'll take a gap and we'll immediately start ethics and terms of engagement. Yeah, let's begin. In our book, the second chapter is ethics, terms of engagement, whereas in ICAI book it is 11th chapter. Okay. This chapter has totally 3 parts. Part 1 deals with ethics. Part 2 deals with terms of engagement. there is a third part in this, that is quality control. And this chapter weightage is minimum 8 to 12. In Jan exam or September, even it was asked for 15 marks. Okay, that's the weightage of this chapter. Though it is not that lengthy, but most important. Now, first I will finish terms of engagement. Okay, first I will finish SCA 210 standard, nothing but. Whatever that we have understood in nature, objective and scope, right? That's actually 200 standard. What we discussed in entire that first chapter, nature, scope and objective, that's nothing but SCA 200 standard. Whereas this chapter is about 210, SQC 220. Okay, 3 standards we are going to discuss in this chapter. But for now, right now we are going to discuss 210 standard, 210. So what the standard exactly dealing with? Tell me, in any contract, there will be some terms and conditions. Do you agree with that? For any contract, there will be some terms and conditions. Right now you are attending this marathon, some terms and conditions were there. Yes or no? Who decides the terms and conditions? Is it the seller or buyer in case of goods? Or is it the service provider and service receiver in case of service? Who will decide? Nothing but, will the seller and service provider decide the terms, or will the buyer and service receiver decide the terms? Provider. Service provider will decide. Seller will decide. Correct? Huh? You're going for a movie ticket, the terms and conditions, who decided? Book My Show or the Phoenix Mall or whatever that particular Inox theater or PVR, they decided the terms and conditions. You're buying a train ticket or bus ticket or a flight ticket, who decided the terms and conditions? Seller. You want to go to a salon, who decided the terms and conditions? The salon service provider. The same way in audit profession, who are service provider? We are service provider. The client is service receiver. Who should decide the terms and conditions? The seller, the service provider. So engagement letter is issued by auditor to the client. Correct? Huh? So who will issue to whom? No need to confuse. Engagement letter, terms and conditions, terms of the engagement. Terms means what? Terms and conditions. So in an audit, the terms of engagement, terms of audit were decided by auditor. Obviously, the buyers, the service receivers, they may not aware of all the consequences involved. They don't even know what is an audit means, because you are only learning what is audit now. Yes or no? How do you think client will know audit meaning all that? So the client will think auditor means he will take care of everything. The client thinks we appointed auditor. What about income tax? He will pay. What about IT return file? He will file it. What about your finances? He will take care of everything. What? He will take care of everything. He will not take care of everything. You should engage into, you should decide the terms and conditions. Correct? Huh? Some clients thinks when we appoint an auditor, when we meet a CA, once CA says okay, he thinks work is done. He feels the work is done. He will take care of everything. And we went and the client, he discussed with the CA that that client is having some company. All the discussions is over. Year end came. This CA approached the client. Sir, okay sir, I'm ready to do audit. Show me the financials. Sir, what financials? Sir, you only should prepare. Okay, fine. Where is books of accounts? No, you only should prepare books of accounts also. Hello sir, I am only here to audit. I should not prepare books of accounts and financials. How do I know? You should have told me that day itself. No. Dispute will come. To reduce this misunderstanding, at the beginning of the audit, it is better to have terms and conditions documented. Correct? Huh? So that's the engagement letter. So what is a letter of engagement? Letter of engagement is an engagement letter sent by auditor to the client to reduce misunderstanding. So the auditor must agree on the terms of engagement with the management or with those charged with governance as appropriate. Generally, we agree terms with those charged with governance. And of course, some important people from the management also might present. Then for non-statutory, tell me where it is even most important. Terms of engagement, stat audit or non-stat auditor? Non-stat audit. Because in stat audit, at least, what are my responsibility, what are the client responsibilities, Companies Act at least says. In non-stat, there is no law. There is no governing law. So the chances of disputes are going to be much more higher. So in a non-statutory audit, engagement letter is utmost important to avoid conflicts. And tell me, all the terms and conditions should always be in writing. Correct? So that both the parties have a clear idea about nature and scope of the work. Sir, look, I will only do audit. I will not prepare financials. Preparing financials is your responsibility. Doing business is your responsibility. Designing and implementing internal control system is your responsibility. Giving me the information is your responsibility. Giving me explanation is your responsibility. Am I right? Hello? So what engagement letter will contain? Tell me. First, what is the scope of the work? Objective of the work. I will tell the audit. The scope of the work is audit. We do audit of financial statements of the entity for the financial year 25-26. You requested, I am accepting. The objective of the audit is to provide opinion on the financial statements, whether they are free from MMS, whether due to fraud or error. So first I will tell scope and objective. Then I will tell what are my responsibilities. Then I will tell what are your responsibilities. So engagement letter includes scope and objective, management responsibility, auditor responsibility, reference to applicable financial reporting framework. I will also tell management the framework applicable. Can you close that curtain? Yeah. AC will go off, that's why. Okay. Yeah, please close fully. So engagement letter consists of what? So objective and scope of audit, management responsibility, auditor responsibility, financial reporting framework. Management has to prepare financials as per some framework, no? Financial reporting framework reference. And tell me what we need to deliver ultimately. Audit report. How this audit report looks like. Expected form and content of audit report. That also I will tell in the terms of engagement. So by telling objective and scope, audit responsibility, management responsibility, applicable financial reporting framework, reference to what? Expected form and content of audit report. How the audit form is going to be, how the audit report format is going to be, content is going to be. I will not tell which opinion. I will tell how my opinion looks like. So I will tell you, sir, I will give audit report. You want to know how my audit report looks like? Go to 700 standard and read it. That fact I will mention in engagement letter. Hello? We are not mentioning actual form of the audit report. We are not mentioning in the engagement letter actual opinion. We are mentioning expected form. We are mentioning expected content. This content could be expected. So that's what. Now, further, if the terms are prescribed in detailed by law, suppose, no, what are all terms you want to engage, no? The terms and conditions you want to tell the client, no? If at all these terms and conditions were already there in the law, you don't have to include them in the engagement letter. You don't have to include them in the engagement letter. But you know what we do in reality? We include it. It's okay. What's wrong? See, if any of the terms and conditions, sir, what are your responsibilities? What are my responsibilities? Company law already said. I can skip them in terms of engagement and remain in terms I can agree. Because in the law already, your duty, my duty is already decided in the law. So therefore, whether I put the duty in this, whether that responsibility, whether I kept it in engagement or not, doesn't matter. You should know your responsibility. I should know my responsibility because it is there in the law. So if law contains in detail certain terms, those terms can be excluded. Auditor need not include them in the letter. However, in the letter, what you will mention, you will state that there are certain management responsibility, there are certain audit responsibility as per Companies Act. Please refer so and so section as per Companies Act. That point I will mention, except for stating that law or regulation applies and management acknowledges its responsibility. So engagement letter will be sent by auditor to the client. We will send it. What they need to do? They need to sign it. Nothing but they need to accept the terms. They should acknowledge their responsibility and then they should send it back. One copy you keep with you, one copy I'll keep in my working paper. Yes or no? So this is terms of audit engagement. Are you clear? Now tell me, once you send the terms, management now understood what exactly you are trying to do. All these days management is thinking you only prepare books of accounts, you only prepare. That's what over the phone call even I told. Management told me, sir, we don't know anything about accounts and financials. You should only take care. Okay, sir, I will take care. Don't worry, I said. And then I sent an engagement letter that I will not prepare books of accounts. That is your responsibility. That I will not prepare financials. That is your responsibility. I told everything clearly. Management read it. Now sir, no, you should only prepare financials. You should only prepare books. They called me back. Sir, no, we need to change the terms. Now I'll listen. What are they asking? If there is a reasonable justification for it. What do you mean by reasonable justification? If the changes which they are requesting is acceptable for me, permitted to accept for me, then I will accept the change. If I'm accepting the change, what I will do? Okay, sir, don't worry. That letter you throw off. I will send a new letter with new terms and conditions based on the latest discussion. Am I right? Suppose management is asking me, sir, you only prepare books, you only prepare financials also. No, you only do audit. I told management very politely, no sir, that is not possible. That's not reasonably justified. I should not prepare financials. I should not prepare books of accounts because I'm the auditor. There is something called self-review threat and all is there. Even ICAI prohibits me to prepare books of accounts for the same client where I'm doing audit. I told them, management is not ready. No, you should only prepare. Last year auditor also did the same. You also do the same. No sir, sorry. Whatever he do, it doesn't matter for me. I will not do this. And client is not ready to proceed further. Do one thing, withdraw from the engagement. If you think it is not correct, what client is asking you, it is not correct from the client, and client is not cooperating you, do one thing, you withdraw. Okay sir, fine, do one thing, find another auditor who will cooperate with you, fine, I will not be ready. Simple. If there is no reasonable justification, auditor will decline the change request. What client is requesting for change, no, we will decline it. By the way, when a client is asking for a change, no, there are some points which which I want to look at. If a client is asking for changes, what are the matters to be considered before agree to the change? Whether I agree to the change or not, forget about it. But there are some points which I should look at. One is law and regulation I should look at. Before agreeing to change, change the engagement, the auditor must assess what are the legal implications of the change, what are the contractual implications of the change. Legal implication, for example, client is asking me to prepare books of accounts also. Legal implications are legally not permitted. I will have to evaluate legally. Contractual implication, sir, originally we agreed for audit only, where the fees is agreed 1 lakh. Now you are asking me to prepare books and financial statements also. I will charge another 1 lakh rupee. Contractual implication. So before you accept a change, legally is it permitted for you, check it out. Contractually, is there anything that you need to discuss, check it out. Correct? Logical. Second one, if the change is justified, suppose change, whatever the change client is requesting, it is justified. Actually, when he requested for change, after I started the work, I finished half the work also. Now he is asking me to change. In fact, originally he asked me to do audit. But later he came back and told me, sir, audit is not required, sir. High level of assurance not required, sir. Low level is enough for us. For you, a review is enough, sir. So the client is asking us to change the terms of an engagement to a review. And I legally saw, yeah, permitted. This is a non-statutory client. It's a non-statutory audit. First of all, the audit itself he requested is not as per mandatory under law. So it's a non-stat audit. Now he is asking me, sir, audit is not required, review. Okay, there is no law here. First of all, whatever you ask, I'll do that. Yes or no? Now he is asking to a review. If the change is justified, yes or no, I will accept the change. I will agree. From audit to review, I will change. Now tell me, should I once again restart the entire work? Already some portion of audit I completed. That work will be useful for review also, no? Exactly. The work done until the change may be relevant to new engagement. So use that. By the way, finally you give report, no? Final report should be as per original terms or revised terms. Exactly. However, the work and report will be those appropriate to the new engagement. That's it. Now tell me, I will prepare the report, no? Final report, no? I will prepare once the review work is completed. Originally I was appointed for audit, later changed it to review, and whatever audit work I did, that evidences and all, I am using it for review also. But ultimately I should give review report or audit report, review report. Now I am giving a review report. Inside that, should I have to talk about original engagement? All the discussions happened with me and client. Should I have to discuss it? No need. To avoid confusion, the report on the new engagement, the report on the new should not mention original audit engagement, any procedures performed in original audit. Don't talk about previous audit. Suppose in exam you're writing, first question 1A you started, answer was wrong, you striked off the entire answer. Then second page you started, because I striked in the previous question the answer, I'm writing this new answer. Will you write that? Exactly. To avoid confusion, don't refer about the original engagement. Yes or no? That's it. And whatever the new terms that you agreed, record the new terms on a new engagement letter or any other suitable written agreement. That's it. So can an auditor, suppose what if a client requested you to change the terms? What matters you consider before agreeing to changes? So 5 marks question. Suppose these are the matters you should consider. Now you will decide whether to accept for change or decline for the change. When you will accept? If there is a reasonable justification. Yes or no? The auditor and management must agree and record new terms of engagement. Correct? Suppose the auditor, no, if there is no reasonable justification, the auditor will not accept the change. Suppose if the auditor cannot agree to the change, management is not allowing you to continue the work as per the original terms, do one thing, withdraw. And when you're withdrawing, you have an obligation to report the circumstance to other parties, correct? Withdrawal means what? Resignation. When you're resigning from the audit because the client is asking you to change some terms and conditions and which is not possible for you to accept, you withdraw from the audit and see whether do you have any obligation. Do you have any obligation to report? For example, if it is a sole proprietary concern audit, voluntary audit, I am resigning, I don't have any legal obligation to report it to anybody. Suppose if I'm resigning from a company, I have to report it to ROC. I have to file ADT 3 form. If it is a government company, I have to even inform to C&AG about my resignation. If it is a listed company, I even have to inform to SEBI. Yes or no? So look at, you withdraw. Check whether do you have any obligation to report the circumstance to any other party, regulators, legal and regulatory, legislator, regulator, or any other party. Check it out. And now, for example, why management will ask, first of all, reasons for change. They misunderstood original terms. They thought audit means everything. Now only they got to know after you send the letter that audit means audit only, not anything else. Yes or no? So changes in circumstances. Circumstances might have changed. Originally, they asked you to do audit of only head office. They thought of appointing a branch auditor separately, but later they could not find a branch auditor. Now they're asking you, sir, scope of audit is increasing now. Originally, we thought of head office, right? Now you have to do branches also. Changes in circumstance. Or with a view to restrict the scope of the engagement. Yes or no? Management might want to restrict the scope. Originally, they thought entire company. They requested you for the entire company. Now they're asking you to change. Yes or no? Sir, only do head office, sir. For branches, we'll go with branch audit because you're taking so much time. Are you clear? With a view to restriction on the scope of engagement imposed by management or imposed by circumstances. That's it. Sometimes, no, management may not be able to give you evidence required for audit. It's a sole proprietary concern. They've originally appointed you for audit. Since it's an audit, you look for high level of assurance. But management don't want that level. Then they might come and ask you, sir, let us do one thing. Change from audit to review. Okay, we don't want that level of assurance. You're going too in depth of verification. That much and all not required, sir. You just check. You just come, verify the books, verify the financials, say, is there anything wrong? That's it. If nothing is wrong, just give me the report that nothing is wrong. Okay, prima facie verification is enough, sir. You don't have to verify in depth like audit. Okay, which means I understood now. They just want a formality verification, formality kind of verification. They don't want an in-depth verification. So I told them, sir, for you audit is not suitable, sir. Review is suitable. Then do one thing, change the terms to review. So that's why if the auditor is asked to change the audit engagement to the one with lower assurance, because audit is a higher level of assurance. If at all client is asking you to change the engagement to the one which have a lower level of assurance, then they must determine whether it is reasonably justified or not. Hello? If there is a reasonable justification, you will accept the change. Yes or no? And the new auditor and management will agree, new terms in a new letter. If there are if it is not reasonable, you will not accept. If management is not okay to proceed without change, you withdraw. Now there are some points which you should consider before agreeing to the change. Look at the legal and contractual implications. If the change is justified, whatever work until the change is done, that can be used for the new engagement, but the ultimate report should be as per the new terms. To avoid confusion, new report should not include original terms agreed, original work performed. Hello? Yes or no? That's it. Over first year, successfully audit completed or successfully review completed. Second year, they are reappointing me again. Now, should I once again send the engagement letter? This is the question. So, should I send engagement letter even though it's a recurring engagement or recurring audit? This is the question. Last year, I did audit. Some initial misunderstandings came, but we resolved it. Okay. I properly finally sent an engagement letter for audit. I completed audit, gave an audit report. This year also, they're appointing me. Same management, same auditor, same business, same circumstance. Now my question is, should I have to tell me what is the purpose of engagement letter? To avoid confusion. Management may not aware of what exactly audit means. Management may not aware of what are their responsibilities. Management may not aware of what are my responsibilities. So at the beginning, I educated them. Now should I once again remind them their responsibilities is the question. Should I remind them their responsibility is the question? No need to. If it is a recurring audit, You don't have to remind every time the responsibilities of the management. In case of a recurring audit, engagement letter issuance is not required. However, even though it's a recurring audit, even though the same client, same auditor, even though you're continuing audit for one more year, in the following circumstances, it is advisable for you, it is mandatory for you to give engagement letter when management changed. Change in management, yes or no? When there is a change in top management, or when there are changes in terms have been changed. Last year terms were different, this year terms were different, then again issue engagement letter. Or changes in legal and regulatory requirement. Last year I did audit of the financials which are prepared as per schedule 3 part 1. Now the company has to prepare financials as per part 2. Okay. Or when there is a change in financial reporting framework, example right now I told. Or when there is a change in audit reporting framework. Sir, last year I told no, I'll give audit report as per so and so format. Now the format is changed, sir. Please remember. I'm just reminding you once again. Or when there is a change in nature or size of the business. If entity originally misunderstand the terms, I will once again give a new letter with a detailed explanation. If the entity misunderstand the terms, I will send an engagement letter once again with a detailed explanation so that to avoid this misunderstanding. Clear? So generally, auditor should issue engagement letter in case of newly appointed audit, and that's called initial audit engagement. Correct? Recurring audit. What is recurring audit? Previous year auditor is reappointed for current year. In recurring audit, should I send engagement letter every year? Decide whether a new engagement letter is needed based on circumstances and professional judgment. You decide based on the circumstance. Everyone. That's it. So with this, terms of engagement is completed. Now there is one more topic, that is preconditions for an audit. So preconditions for an audit. What do you mean by preconditions? That's what I mentioned in engagement letter. In engagement letter, what I mention is nothing but what? Preconditions. These are the conditions preceding the starting of the audit. Before I start audit, these are the conditions which you must agree, which I must agree. Only then I'll start the audit. What are the preconditions? Management should accept these conditions. Management should accept these conditions. Regarding what? Their responsibilities only. I am not asking something else. They need to accept their responsibilities. Preconditions are nothing but management responsibilities. What is the responsibility? That they should prepare financial statements as per applicable financial reporting framework. Responsibility for preparing financials in line with applicable framework. Correct? Responsibility for necessary internal control to prevent material misstatement, whether due to fraud or error. Who should give me information? Management. Management is responsible for providing the auditor with management is responsible to provide the auditor with access to all relevant information, additional information, unrestricted access to persons within the entity from whom I can obtain valuable information. So what are management responsibilities? Preparing financials as per applicable financial reporting framework, maintaining internal control system to prevent material misstatement, providing the auditor with access to all the information, explanation, yes or no, unrestricted access to persons. If I want to talk to anybody in the company, I should be. You should not restrict me. Only when you accept these conditions, I will do the audit. If preconditions are not present, if you are not accepting the responsibility, if preconditions are missing, I will discuss with management. I will try to convince them. If still they are not convincing, reject the audit unless required by law. Decline the audit engagement. What is it also called as? Decline the engagement. What is it? Decline the engagement. Okay. In the two circumstances, one, financial reporting framework is unacceptable. The company, at the beginning itself, they said, sir, we will prepare balance sheet P&L, but not as per schedule 3, sir. We will prepare in our own format. I will not, because this is a stat audit. In a stat audit, my responsibility is to verify whether the financial statements are prepared as per applicable financial reporting framework. At the beginning itself, if I know that you are not going to follow the framework, I will not accept the audit. See, after I accepted the audit, you didn't prepare like that. I will give negative opinion that time. But before accepting the audit itself, you are telling all this. I will not accept the audit itself. If the financial reporting framework is unacceptable, and if management is not agreeing on the responsibilities regarding financials, regarding controls, regarding access to information and people, suppose if management is not accepting financial reporting framework, unacceptable, management is also not accepting their responsibilities, I will not accept the audit. I will decline the engagement. Suppose if management imposes a limitation, yes or no, the auditor should not accept such engagement. At the beginning itself, you got to know management is having so many restrictions on you. Management is trying to place so many conditions, so many restrictions they're imposing. At the beginning itself, you got to know. Don't accept. See, you accepted the audit, you started the audit, in between now management is restricting you. That time what you should do? 705 standard says regarding limitation on the scope of audit after acceptance. If there is a limitation on the scope of audit before acceptance, do not accept the audit. If there is a limitation on the scope of audit after acceptance, resign from audit. Resign, that point is mentioned where? 705. Here the limitation on scope of audit is what? Before accepting. Here it is talking about what? Before accepting. Clear? Hello? Yes. So, what are preconditions? What is premise to audit? What are management responsibilities? Nothing but all are same. So, first responsibility, financial reporting framework must be acceptable. The financial reporting framework which the company is willing to follow should be acceptable. So the framework should be acceptable. Second point that you should check is whether they're accepting responsibility to prepare as per the framework. They should only accept the responsibility. They should accept responsibility to prepare financials as per the framework. They should accept responsibility for controls. They should accept responsibility to provide me data, information, explanation, additional information, unrestricted access to people. So 210 standard says, as per 210 standard, as per 210, preconditions includes management using acceptable framework, agreement by management. Agreement by management means management has to agree on the premise of the audit. What do you mean by premise of the audit? These are the premise. Clear? Next. So what is the objective of the standard? The objective is to accept or continue an audit. You can accept an audit, you can continue with an audit only when preconditions are present. And second one, you will accept and continue the audit only when there is a clear understanding between the auditor and management about what terms of audit engagement. That's it. One part is over. Easy. 210 standard is over. So what are their preconditions? When engagement letter is issued, what are the content of the engagement letter? You know what they can ask you, preconditions, 5 marks question, or they can ask you what is an engagement letter, what are the contents of engagement letter, changes in terms of engagement, 5 marks, you know, recurring audit, sending new engagement in recurring audit, 5 marks. Every attempt one question will come. Easy. Yes or no? That's it. Yeah. Generally, you know, some students think like in marathon everything you're teaching, you know, why should we buy a course? You don't have to buy, I'm just telling you, because it feels like that, but only a regular student will know the difference. Because the learning depth, the question bank application, the MCQ solving, applying the subject correctly, and discussing that minute changes, the terms, how they can change in an exam, that question, that and all will be the difference. Otherwise, in marathon, we give almost 14-15 hours of marathon, I give personally. But my regular class is almost 90 to 100 hours. What do you think it will be there? Do you think we discuss unnecessary stuff? Never. In fact, in our entire regular class, in our entire CA inters, the time wastage in the classroom will be 1%. Less than 2 maximum. Means if it is 100 hours of session, if at all there, maximum 2 hours will be the out of the subject topic. Like right now what I'm talking, this kind of content will be less than 2%. That's a strict rule for us. That is the reason you find our course duration shortest than anybody in the competition. And we give huge amount of coverage. We solve practical questions, we solve mock exam questions, past exam questions, ICAI sessions, we scribble and solve everything, practical papers, theory. You saw the question bank, we discuss 100% of it in the class. We sync it with you, we sync multiple papers, we verify, we instantly solve some papers, okay, take some random papers and then we'll solve in the class. We do multiple revisions in the class. For that is what we are charging the fee. See, I'll tell always one thing. If at all you're affordable, For your final, I'm telling you this, because all of you are going for CA final tomorrow. Don't try to settle with YouTube content. Don't try to. You can understand, but you have to struggle a lot. Why you have to struggle? We are struggling, no. You pay fee for us. Okay, we are struggling more than you. See, it's like you have to pay for the comfort. Today, I always strongly feel, today we are the coaching academies, we are especially online, we are running because of the comfort that we give to you. Why you have to take stress? Why you have to carry that uncertainty in your mind? Okay, so choose a proper mentor, proper guide, and then surrender to them completely. We'll give you entire question bank, will solve. We will explain you, we will link everything, we will make you understand everything. That comfort, right? You focus on revising thoroughly and then going and qualifying. Why you stress about learning? Half of learning. Again, that there is half only. Half learning only properly happens. So a formal learning is always different and informal learning is always a different. Cricketers, no? Why they need a coach? That's the reason. Even international matches when they play or 2020 they play, in the dressing room, a coach will always be there. The coach will always continuously monitor the match and he will give an input, certain inputs. You think the captain is guiding the entire team? To the captain, the coach is guiding. This nobody recognizes. Any game you take, there will be a formal coach. Political you take, IAS officers you take, anywhere you take, a formal training will happen everywhere. That formal training is always different from an informal learning. Informal learning is undoubtedly a good learning, no doubt. I'm not degrading it or denying it. But a formal learning with a right mentor, that too. Okay, that will transform the way you learn the subject. You learn anything about for that matter. It's not just the subject, anything in that matter. The formal learning is so important. So don't try. See, unless you really don't want to go with a formal learning, you have some solid reason for it, then okay. Because most of the students in CA fraternity, they might have a bad experience. They generally had a bad experience with the original academy with which they joined originally, where they paid some 50, 60, 70, 80,000, 1 lakh, and then they might have had a bad experience. And the same thing is what they think about us also. Natural, that's a natural thing, yes or no? But you see the resources that is provided, you see the feedback that is there in the ground reality. You ask your friends you ask your seniors who enrolled, they'll tell you what kind of commitment that some academies work. And I'm proud to say that we work very committed. You see the marathon itself, with so intense. I make sure in the entire marathon of, for example, 12 hours if I take, I make sure the time wastage in the marathon is less than 30 minutes. So that's my norm. But 30 minutes I'll pakka waste time. I'll talk like this, something, definitely it will be uncontrollable, but I'll restrict it. Clear? If I talk something unnecessarily, all the things, everything stuff and leave the subject, what you will get? That's why our marathons and our content is high performing. That's it. Okay, fine. So 10 minutes I'll relax and come. So then we'll continue ethics in terms of, ethics topic will continue. We will finish that in half an hour. Then we'll go to audit report topic. Quality control, I'll come back and discuss again. Quality control later we will discuss. Yeah, 1 minute. One more request is, once I uploaded this on the YouTube, all you have to do one thing. First to open and like the video. Comment what you learned here. What you honestly have to do, okay? Because in north side, no, every student do that, most of them. In south side, students are, not that active to comment. So that comments and likes will push the video more. So do that. Only that too when you genuinely feel it. If you genuinely like it, if you genuinely loved some content of it, you just comment it. If you also, please, you also have to comment, okay? That's it. Yeah, let's discuss the concept of ethics, which again has a minimum 5 marks weightage, okay? In every attempt, there will be a question from ethics, one question from terms of engagement, one question from quality control. That's why the weightage will be 12 to 15 marks, this chapter. Very rare only, any 2 topics only get tested. Most of the times, all the 3 topics get tested, okay? Now, ethics, we should always understand it from both rule-based approach and principle-based approach. What is a rule-based approach? For example, you see Companies Act, disqualifications were there, right? Auditors disqualifications were there. Why the disqualifications of auditors were given? To make sure auditor is independent, to make sure auditor is competent, to make sure auditor is not influenced by any of the interest in the company. Correct? Huh? So the disqualifications are to protect independence of the auditor, to protect quality of the auditor. For that reason, disqualifications were there. But you can't put every restriction by law. For example, my grandfather is a director in a company. One of the disqualifications says, relative of the auditor, if at all he is a key managerial person, officer of the entity, auditor should not accept the appointment. Relative definition is given. That does not include grandfather. Now, can I accept that company audit? No, still you should not. Law cannot be exhaustive. Rules cannot be exhaustive. Understand the spirit of the code. That is what principle-based approach. So, the rule-based approach, in a rule-based approach, accountants have to follow established rules. This will narrow the outlook, may overlook the spirit of the ethics. If at all, grandfather is not covered in relative, since grandfather is not covered in relative definition, because he is not covered in relative definition, I should not interpret strictly that disqualification relative definition. I should not interpret strictly and say I will accept the audit. If at all your grandfather is a director, are you permitted to do the audit? Companies Act does not prohibit. It is not permitting you. It is not prohibiting. There is a difference between permitting you and not prohibiting. Yes or no? There is a difference between prohibition and permission. Companies Act did not say you explicitly yes you can do, but it is not prohibiting. There you should see whether is it still viable, is it still ethical or not. You should see. You can be influenced. Your grandparents can influence you. If influence can be there, don't accept it. So understand ethics in principle-based approach, not just rules-based approach. If you strictly follow the rules, it will narrow the scope and it will, spirit of the ethics will not be complied. Okay, so it is rigid. Rules-based approach always rigid, and not all practical situations can be handled by rules alone. My best friend is a director in a company. Can I accept the audit of the company? No, you should not, because rules does not define friendship. Yes or no? And in a principle-based approach, you must always comply with spirit of the ethics. It requires use of professional judgment in every situation, based on knowledge, based on skill, based on expertise, to evaluate and reach conclusion. The given scenario, suppose my friend is a director. I need to evaluate the scenario. I need to take a conclusion whether can I act independently. Can I, if at all something is wrong in the company, I should be able to report it without any fear, without any influence. If I can do that, accept it. If you cannot do that, ignore the law, ignore everything. You can't do, you can't ethically be, you can't ethically continue the engagement. Don't accept it. So that's the difference between principle and rule-based approach. Principle-based approach, rule-based approach. So what is ultimately important? Spirit of the code is important rather than the letter of the rule. Not just the letter of the law, but the spirit of the law, intention of the law you should always look at and then take a decision. Clear? Now, there are certain fundamental principles. Okay, in any profession, whether it is a CA, doctor, lawyer, engineer, any profession you take, the fundamental principles and ethical principles are common. What are they? First one, integrity. Integrity, objectivity, confidentiality. Integrity, objectivity, confidentiality, competence and due care, professional behavior. These are the 5 fundamental principles which are common in any profession. One additional principle is there for our profession, chartered accountancy profession, is independence. There is one more additional principle is there, that is independence. But remaining 5 principles are common everywhere. A doctor has to be competent. He has not studied some questions saying that it is not important. And a patient exactly comes with the same problem. You should not that time sit and study and then operate. Yes or no? That's it. So a doctor has to study comprehensively everything. He does not have important questions choice. If at all he do that, and still he'll get a degree, medical degree, but think of the risk. Exactly. Same way as CA. Important questions. So, that's good actually. For last minute it is okay, fine. But normally, it is a fundamental responsibility, moral responsibility for you to be competent. Without competence, you should not deliver the service. So what is professional competence? You must attain the competence, you must maintain the competence. So accountants must attain and maintain the required knowledge and skill to provide a competent service based on current standards and legislation. You should always provide competent service based on the latest knowledge and latest law and latest standard. So for that you should attain the skill, you should maintain the skill and competence. Due care means what? You have to be careful, you have to be diligent. What is due care principle says? You must act diligently, thoroughly, timely, following technical professional standards. Suppose you promised the client that I will file your IT return in the next 2 days. You breached. You didn't file the return within 2 days. The client can sue on you on the fact that you did not apply due care, because you have to deliver the service on a timely basis. Yes or no? Whatever the time that you agreed with the client, you should deliver it. Then objectivity. What is objectivity? You should not compromise professional judgment due to bias, due to conflict of interest, due to undue influence. Grandfather is not covered in relative definition, I know. If I still accept the audit of the company, he can influence me. So that's why you have to be unbiased. Whatever the service that you are performing, you perform the service in an unbiased manner, no bias. If it is right, say that it is right. If it is wrong, say that it is wrong. Yes or no? So instinctually, instinct based, always. It should never be based on the facts. It should not be based on it should not be based on relationships that we had. It should always be based on the fact and circumstance. You should take a decision. Correct? That's called unbiased decision making. So the auditor has to act, the accountant must be unbiased, without bias, without influence, without conflict of interest. So that is what objectivity principle is saying. So accountant should not take activity where relationships might influence your judgment. Your decision making is influenced by a relationship, or there is some circumstance. My friend is a director, that circumstance will influence me to take a professional judgment, to take a decision. Don't take up that work. So accountant should not take activities where relationships and circumstances that exist, which might influence unduly your professional judgment. Clear? Next, integrity. You must be straightforward and honest in all professional and business relationships. Okay, integrity means fair dealing and truthfulness. Accountant should not associate, you should not sign the report, you should not sign an information which is misleading, which is negligently provided, recklessly provided, or that report contains some omissions. It does not contain important information where that omission is misleading. Able to understand? So integrity means straightforward, honest. Integrity means fair dealing and truthfulness. Accountant should not be associated with reports or information that is furnished negligently, that contains a false or misleading statement, or that omits or obscures information which is misleading. Then confidentiality. Obviously, every doctor, lawyer, everybody, accountants, you must respect the client information. You should not disclose the client information to any third party without the consent of the client, unless there is a requirement under law. If it is mandatory under law, you have a professional duty to disclose, then you can. Otherwise, you should not disclose. Look at, confidential information can be disclosed only in the following 3 circumstances. 1, mandatory under law, or you have a professional duty, or you have a right there to disclose. Yes or no? When not prohibited by law. What do you mean by professional duty to disclose? We have something called peer review. We have something called quality review. Okay, quality review by NFRA. NFRA can do AQR, audit quality review of CA firms. As a part of that review, you have a duty to disclose working papers to the NFRA. Because of that, what happens is some client information has to be disclosed. You have it, it is required under law. Moreover, it's a professional duty for you as per CA regulations. So for that reason you're disclosing, then no problem. Then I will not say that you breached confidentiality. Able to understand? So it is assumed that you still complied with confidentiality. And confidential information may be disclosed only when it is permitted under the law and authorized by client. Generally, there won't be any permission specifically in the law. Explicitly permission won't be there. Prohibition will not be there. If prohibition is not there, that's an implied permission in the law. And if client is also agreeing for you, then you can disclose it to third party, no problem. So confidentiality means what? Accountants should respect confidentiality of the information obtained through any relationship, professional or business relationship. Confidentiality support public interest by ensuring free flow of information. Only when the client trusts you completely that you keep the data confidential, the information will be flowed freely. Yes or no? The free flow of information, the communication happens only, when the client believes that you're honest. Clear? Behavior. What is professional behavior? Any work that you do, the accountants must comply with relevant laws and regulations and avoid actions that would discredit the profession. Don't put a post on YouTube saying that I will help you in money laundering. We are experts in money laundering. Yes or no? Because we are CS, we are experts in money laundering. Never. You should never. That will bring disrepute to the profession. Yes or no? Accountants should not engage in any activity that will harm the integrity, objectivity, reputation of the profession, as it is incompatible with fundamental principles. So your behavior in any way should not bring disrepute to the profession. That's it. Clear? If at all you are behaving rude to the client is asking you some information, he has taken service from you, you're blackmailing the client, you're threatening the client, that's a violation of professional behavior. In May exam, they've given 5 situations and they're asking you which fundamental principle is violated. You just have to write the principle name. That's it. A 5 marks question. Able to understand? Then what is another fundamental principle? Independence. Now audit is an independent examination, right? What do you mean by independence there? Independence of mind. Independence, when I say, it is predominantly dealing with what? Independence of mind. But for the public to get confidence on you, you should not only be independent in terms of mindset, in appearance also you should be independent. What do you mean by independent in appearance? Independence in appearance. Independence has 2 perspectives. One is appearance, another one is mind. Mind is a fundamental expectation. Auditors should be unbiased, straightforward, with integrity. His decision making should not be influenced by the decisions making of the management. Auditor's judgment should not be subordinate to the wishes and directions of those who appointed him. When you are acting as an auditor of a company, your judgments, whether asset useful life, for example, Reliance, in 1819 year, what happened is they increased the useful life of the asset from 30 years. Plant and machinery is there. The plant and machinery cost is 4 lakh crore. That plant and machinery useful life is originally 30 years. That useful life is increased to now 50. Okay. Now you need to check whether the useful life of the plant and machinery really 50 years or not. You should decide it based on the facts. You should decide it based on the reports. You should decide it based on the engineer certificates. You should not decide it based on because management likes it. Your judgment should never be subordinate to the judgment of the directions of the wishes of the person who appointed you, and that's called independence. What is the difference between independence and objectivity? Objectivity means unbiased attitude. Independence means behavior. Objectivity is internal to you. Independence is something external to you. Able to understand? If objectivity gets compromised, independence gets compromised. So they both go side by side. Sometimes, in fact, it appears like 2 sides of the same coin. Independence and objectivity are 2 sides of the same coin. Able to understand? So what exactly the difference between these two? You can't exactly. Having an unbiased attitude is objectivity. Not listening to you is independence. I'll not listen what you say. I'll follow what is right. That's independence. Why you follow that? Because you're objective. Able to understand? So objectivity is a feeling. Independence is an expression. So independence of mind means your decisions are, look at independence. What is independence? What is independence? Independence means judgment is not influenced by another person. Your decision is not influenced by another person. Yes or no? So where you take decisions purely based on the facts and circumstances, only based on the facts and circumstances and actual situation, not based on influences by others. In order to be independent like this, you have to be skeptical. What is it? You have to be skeptical. That skepticism, that skeptical concept is what we call it as what? Skepticism, professional skepticism. Sadhguru, his taglines, you see, skeptic, mystic. Yes or no? Skeptic, not septic. Skeptic. Okay, yeah. Skepticism means what? You have to be skeptical, means questioning mind. Don't believe everything, as you, the more you hear something, don't believe it. Question it. Only when you question, the knowledge unfolds. Don't accept. CA is a tough course. Yes, it's a tough course. No, you should question it. Yes or no? You should see the facts. Compare with MBBS, compare with doctor. They study 13 years. You study 2 years. No, honestly, excluding internship, I'm telling you, they're also excluding internship. You're also excluding internship. They study every day 8 hours for almost 11 years in college. 11 years. They attend 11 years for formally classes. You are thinking about spending 100 hours on a subject. 100 hours a subject, ayyo, waste, not required. They spend 11 years. Imagine. MBBS 4.5 years. First NEET they take for 1 year. Then MBBS 4.5 years. Again they have to go for NEET. Again they have to go for specialization. Again they have to go for NEET. Again they have to go for super specialization. So specialization 2 years, 2.5 years. Super specialization 2.5 years. And 6 months NEET. 3 times they write NEET. 6 months, 1.5 year. So 6.5 years until year. 4.5 years. MBBS 12 years. And after all that, once they enter into a corporate job, they get salary of 1 lakh. You are getting 75,000, 80,000. By the time they clear MBBS and come out and with earning 1 lakh, their age is 34, 33, 34. You are coming out as a chartered accountant even with multiple number of attempts, provided you are from 12th background, not degree background. Okay, if you are from 12th background and if you clear CA course or CMA course, your age is going to be 20, 21, 22, 23, even with multiple failures. Maximum 24. Means you're able to, you can start earning 10 years before a doctor. By the time he start earning 1 lakh, by the time he's earning 1 lakh, you'll be earning monthly 7-8 lakhs. Now tell me, which is tough, which is easy? And all that they're earning after spending 1 crore. You would have spent an entire CA cycle itself. Foundation, inter, final, all put together everything, 3 lakhs. With the registration fee, with the exam fee, with the coaching classes. Yes or no? 3 lakhs. See the risk and reward ratio. See the investment and return ratio. Everywhere CS beat. MBBS will always fail. You think doctors are earning so super good? Though who will earn, those who constructed the hospital. Those who built himself. And most of the doctors, by the time they build a hospital, it will be their age is 50. That's why you see all the big established hospital owners, they're 80 already. Yes or no? Apollo hospital owner is 82 or 85 years age. So that is the thing, okay? You should analyze like this informatively. Don't say, CA course, tough course. Why tough course? Everybody saying tough course. You won't study for 2 months also. Day before, 1 month exam, now you will become alert. That alertness will be there only for 2 days. After 2 days gone only, again watching motivation video, when should I study? I'm not getting focus, I'm not getting it. What you did last 2 months? Nothing. Correct, no? So 2 months before you start studying and doing this much overaction, how much they need to do? Imagine, NEET students who prepare for NEET to get that medical seat in the government quota, they have to study 4 months daily 11 hours. 4 months they study. Literally, you go and see NEET student, you'll understand, Amma, thank God I choose CA. You will thank, you just go and see. You go to Rajasthan quota. You go and see, morning 6 o'clock they'll go, till night 8 o'clock the class. 14 hours, in between 2 hours, 3 hours break. 12 hours of class session will go. That will, like the 4 months it will be continuously, 4 months the classes. Today people will come here, tomorrow half the crowd will be absent here. I'm just telling you. That is the level of dedication which they have. So if peeps, when I hear, if students say CA course is tough, it's purely because of ignorance. They don't know about other courses. They don't know about IIT. They don't know about NEET. They don't know about MBBS. How torturous it will be. I have friends. I know it. Yes or no? They'll always ask me, hey, what exam you wrote immediately? 3 months only you prepare. 3 months, that itself is over, too much for us. One group, 2 months is enough, basically. So, but that time in our days, exam papers are easy, 3 months is enough for both the groups. Hey, so easy, I made a mistake choosing this. Past 8 months, I'm attending college. All lab works, night time, hectic, all this work. They all get, most of the doctors, you see, dark circles will be there. Most of them. 11 years it will be there. So, technically, we are safest profession, easiest profession. Don't compare with a degree student who don't even study and qualify. Don't compare with that. Right? No? Because we are asking you to study, you are calling it as difficult. Had CA Institute also put marks without, you write something 2 pages, you fill answer. Some story you write, you get the marks. Then you will say CA course is easy. Because we are asking you to study, you are calling it as difficult. So, we are very narrow-minded, I feel. CAs are very narrow-minded, I feel, because they never look at the other side of the coin. MBBS, IIT and all, you see how tough they will be. IIT, they finish IIT, they'll not get job. They have to do masters again. They'll go another 3 years. Here 4 years, there 3 years, 7 years. Before that, they need to write IIT entrance. That's for 1 year. For that only Rajasthan they go. 1 year they study in all these LN, physics wala, in all these academies. There is a web series on this. I didn't watch fully. Some 2 episodes or 3 episodes I watched. Quota. The web series name is Quota, I think. Quota. Okay, Quota web series. You just see that. You'll understand. Not now. Okay, now you study. After exams, you go and see. Yeah. IAS, UPSC 12th fail. The web series, some movie, 12th fail. I only saw some movie scenes only in Instagram. Nowadays, you don't have to go for a movie. Entire Instagram you're getting, no? Yes or no? Yeah. So, the 12th fail, you will understand the other side. Only when you look at all this, you understand, thank God I've chosen CA course. So, this is so thankful course. You have to thank ICAI a lot. Exam fees, everything was very low for us. ACC and all, exam fee 60,000 rupees. One exam per paper. Per paper 20. Somewhere around 20-25. CP and all 1 lakh you have to pay per attempt. CA Institute is charging 2,000. For that you will say CA Institute exploiting. Per paper valuation in CA, they pay 150 rupees to the examiner. You paid for six papers, for example, both the groups. 3,000, 2,700. Out of that, 900 rupees go for valuation. 6 days you attended, no? 150% they need to pay in the exam hall. 900 will go there. 1,800 gone already out of 2,700. Then remaining 900, then wait. Paper cost, invigilator, remuneration. CA will be there, observer will be there, his remuneration, reviewer's remuneration. Understood? So all administrative logistics charges. So maybe per student probably they might be making a margin of 100 rupees, 200 rupees. Now again here our clever students, what they do? This many students into 200 profit is there, no? That will go to development fund. Yes or no? Paper setter fee will be there. So that's it. You should see other courses, how much fees they are charging, you will understand. Okay, ICAI is not saying that, see ACCA, see CPA, we are giving you more valuable degree, so I will charge more. No, they are not doing it. This is what skepticism is. Okay, skepticism means what? Question everything. Don't accept the norms as it is. Question everything. Is this the only way to do? No. Question it. You will understand it better. Your thought process will evolve better. So that skepticism, apply in the context of profession, apply in the context of audit. You are doing audit of a company. Management will always tell you, yes or no, sir, we are very honest, we are with integrity, our financial statements are like this, we are very transparent, business practices transparent. Be skeptical. Don't trust everything 100% as it is. Be skeptical. So skepticism is an attitude of questioning mind. It's an attitude of being alert to unusual situations. You visited godown. So a warehouse you went. CCTV cameras were not there. Registers were not maintained properly. The goods were not properly in the shelf. The boxes were open. Skeptically, you must be immediately alert. What? Alert means what? Something is suspicious. Yes or no? That becoming alertness, you become alert only when you're skeptical. So skepticism is equal to alertness. You should not be sleeping. Intense. That's what I tell you. Intense. You have to be intense every time. And critical assessment of audit evidence. Audit evidence means what? Information. Client gives you some information. Assess it critically. Assess it. Is it genuine or not? you don't have to. You can accept documents given by the client as genuine. Generally, you can believe the client. You don't have to doubt him every time unless there exists a doubt. So the auditor should always evaluate reliability of information. But if we are suspecting a fraud, further investigation is needed. For example, how we apply skepticism in real life audit is, right, first we do something called risk assessment procedure. First, what we do is risk assessment. So in risk assessment, what happens? I will first understand the entity and its environment. So I'll visit the company the moment they appoint me. The moment they appoint me, I'll visit the company. First, I went to the factory. And at the moment I went into the factory, I was just observing how the production facility, everything is operated. So many workers, so many machines, so many were there. And I noticed 3 uniform colors. Okay, workers are having 3 classes, 3 types of uniforms. One is wearing orange uniform, another one wearing green, another one wearing blue, like that. Orange uniforms were there. If I'm not alert, if I am in a sleepy mind, I'll not figure it out. If I'm alert, I figured it out. Yeah, 3 uniforms. Why 3 uniforms? Why 3 colors? What does each color signifies? Then the company told me, sir, blue color uniform, they're permanent employees, sir. Green, they're contract laborers. Means we have a contractor. So every day we will tell how many we need. This month how many we need, they will send that many. Manpower supply. So their contract. Then what about orange? So they're daily laborers. Okay, we don't have any contract with them. If today we need 150, we'll put a board outside the factory, and looking at the board, nearby locality people, one union head will be there. So that head will bring 150. Tomorrow it might be 120 only. Day after if I want 200 people will be there. Oh, these are all casual labor. Who are they? Casual labor. I asked them, how do you pay them? No, sir, it's not a fixed pay, sir. Like, it depends upon skilled people get 1200 per day. Semi-skilled will get 800 per day. Unskilled will get 600 per day. How do you pay them? We pay by cash, sir. So at the end of the day, they all stand in the queue. From head office will get the cash, and the cash will be paid. Who is paying it? Manager only, sir. Production manager only knows who is skilled, semi-skilled, all that. Who will classify them? Manager only will classify. Same person is classifying, same person is paying. There can be a possibility of manipulation. Yes or no? What the manager can do? He will hire all unskilled only, and may show to the company management as skilled, and he will pay bigger amounts to them, and he'll go outside and collect with them again. Possibility there or not? Skepticism. Only when I'm skeptical. Here I'm suspecting a fraud. Why am I suspecting a fraud? Because I'm alert here. Why am I alert here? Immediately when I see the incident, I found out that different uniforms were there, different. This is how skepticism works. Analytical procedure is nothing but skepticism. Analytical procedure is nothing but skepticism. Sir, what is the last year employee count? 1000. This year how many employees were there? 1500. Then why turnover is the same? Employees have increased by 50%, right? But turnover remains same. Your profit remains same. Skepticism. Able to understand? Tell me, employees increased, but sales have not increased. This is something unusual. Hello? What is usual? Employees increase, sales increase. That's usual. But employees increased, but sales have not increased. That's something unusual. Analytical procedures is analysis of relationship between financial information and non-financial information for identifying unusual fluctuations, for identifying values that are different from expected value by a substantial amount. Definition of analytical. So you need to identify fluctuation, you should investigate it. How do you apply analytical procedure? By skeptical mind. Able to understand? So professional skepticism means alert to, what is it? Alert to information that contradicts other information. You substitute the word information, you understand. Now substitute audit evidence contradict with other evidence. Employees increased, sales have not increased, contradiction. And information questioning reliability of documents and response. Manager told they're casual labor. Where I got a questions about, I have lots of doubts about how much amount actually incurred, how much they're paying. Conditions indicating possible fraud. Need for additional procedure than required as per SCA. Because of skepticism only, sometimes you go beyond what is required as per standard, because you investigate. When you suspect a fraud, you investigate in depth. Able to understand? So skepticism means alert to all this. Now, what are the benefits of skepticism? Because of skepticism, I can reduce risk of overlooking. Tell me, if I'm not alert, what happens? I just like that, I just casually look at everything and then just come. I don't have to, I will not get this doubt. Only because I'm alert, because I'm questioning everything. The uniform colors I identified and I questioned it. I could able to recognize the fact that different uniforms were there, which means some classification is there. So professional skepticism reduces risk of overlooking. I didn't overlook. Yes or no? When I entered into the factory, I didn't overlook. I was very careful in looking at each and everything, and that's the reason I found the difference in the uniform, and I found casual labor, I found amount is paid in cash, I found possibility of fraud. So risk of overlooking, risk of overgeneralizing. I didn't generalize. All are laborers only, different uniforms will be there. I didn't generalize it. Yes or no? It can reduce risk of making inappropriate decision. Making inappropriate decision, overgeneralizing, overlooking will reduce because you are skeptical. And remember, you should be skeptical even though you know that management is honest. Skepticism is not about looking at them with a criminal mindset. Skepticism is about being alert for my own safety. Able to understand? So auditor cannot ignore past experience with honesty and integrity, but still maintain skepticism regardless of past. I know management is honest, management is with integrity, consider that, no problem, take that into mind, but remain skeptical. Yes or no? Be skeptical. Even though they are honest, below level management, low level management, middle level management may not be honest. Who knows? That's it. Understood skepticism concept? In exam they can ask you what is skepticism. Give you examples. These two are nothing but examples. 4 marks question. Hello everyone. Are you all clear? Then now independence, again go back to. So what is independence? Independence has 2 perspectives, correct? So what is, so it is there to protect, it is there to promote professional conduct. So rules of professional conduct aim to promote independence, but rules alone cannot ensure it. Independence is a state of mind and personal character. Do not confuse independence with legal standards of independence. Don't think under Companies Act, relative definition does not include grandfather. With grandfather you can be independent. Wrong. Yes or no? Do not confuse independence with legal standards. Under company law, relative definition includes only so and so, so and so. Grandfather is not there. Grandchildren is not there. That doesn't mean Companies Act is saying grandfather is independent of grandson. Yes or no? So don't confuse independence with legal standards. These standards may change, but the quality of independence must remain constant. The spirit is always constant. Circumstances might change. Correct? Next, 2 perspectives. There are 2 perspectives of independence. One is independence of mind, independence in appearance. What is independence of mind? It's a state of mind that allows unbiased decision making. I can take a decision purely based on facts and circumstances. Okay, it ensures integrity, objectivity, and skepticism. Then what is independence in appearance? For a third party, yes or no, he may conclude that integrity, objectivity, proper skepticism has been compromised. If at all a third party looking at me and this company, if they think that my integrity is compromised, my objectivity is compromised, which means I am appearing lack of independence. I am appearing like I'm not independent. Why am I appearing that I'm not independent? Because in my social media, me and that guy always going to cafes, all that and all. Yes or no? We are posting, we're hanging out, everything. So people will feel that we are not independent. Able to understand? So we had some sort of friendship or something. Yes or no? So an auditor has to maintain highest level of integrity, objectivity, competence in behavior. Yes or no? So independence in appearance means what? If you want to appear independent, avoid these situations. What situations? Situations that are so significant that an informed third party might conclude that your integrity, your objectivity, your competence, your professional skepticism gets compromised. So if a third party thinks that your integrity gets compromised, if a third party thinks that your skepticism is compromised, yes or no, those kind of situations you avoid. Then you appear independent in terms of appearance. That's it. Easy or not? Independence is something that must exist in fact, means in mind, and it should also be there in appearance. The relationship between the auditor and client should satisfy the auditor about his own independence. Any unbiased person should conclude independence is not compromised. This ensures confidence to the users of the financial statements. And this independence is even most important for listed entities. As a stat auditor, a stat auditor of listed company, you would cease to perform any useful function. You won't perform any useful function if at all independence and integrity have been compromised. So you have to be objective, fearless, capable of giving honest opinion. Independence depends on state of mind and character. One person may feel independent in circumstance, another person may not feel the same way in a similar circumstance. So it is the chartered accountant who should decide whether they are acting independently in the given circumstance or not. You should avoid any position that might compromise their independence. That's it. Okay. So how they can ask you this? So write about rules of professional conduct. They'll ask you write about rules of professional conduct, meaning of independence, perspectives of independence. This itself they can ask you as a 4 marks question. Correct? Understood? Independence is highly subjective. What is the duty of the accountant in this regard? 4 marks question. Like this they can ask. Sub questions. Now tell me, many a times we saw right now, independence has to be protected by you. You should ensure whether you are acting independently or not. First of all, when to the other person it appears that your independence is affected, when there are threats. When there are threats to independence, the other person, informed means knowledgeable person, a knowledgeable person might think that your independence is affected. So when independence gets affected, generally because of these 5 threats: self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. Intimidation means what? Bribing the auditor, blackmailing the auditor. Both bribing and blackmailing both comes under an act of intimidation. Okay, so bribing, intimidation threat occurs when auditors are deterred, when auditors are prevented from acting unbiasedly with professional skepticism. When auditors are deterred from acting objectively and from acting with professional skepticism, if auditor is prevented from acting like that, then that's an intimidation. How can I prevent you to act independently? I'll bribe you. So leave that matter. Just give me positive opinion. Don't verify all this. I'll give you more fee, or I'll blackmail you. So any of these two. If the client is so big, they blackmail. If the client is small, they bribe you. Depends upon the position of the client. So threats of replacement due to disagreement on some accounting principle. Example, pressure to reduce the audit fee. Sir, do less audit, sir, take less fee. Okay. Threats of litigation. These are all what ma? Intimidation threat. MCQ can come. Then familiarity. What is familiarity? This threat occurs when auditor became too close to the client, where they end up being too sympathetic to client's interest. No matter what, you always support your friend. Yes or no? No matter what, you always support your sibling. Yes or no? So because you have a sympathetic relationship with them. How that relationship establishes over a period of time. Long-standing association, long-standing relationship between the auditor and client. That's the reason rotation of auditors were introduced. The auditor has to be changed. Very recently, 2 days ago or some few days ago, just 2-3 days ago, Ministry of Corporate Affairs have given one more notification where they mention, rotation of auditors were there, right? Once auditor completed 5 years, they must change. They should not be reappointed. Okay, if it is a firm, one more term is applicable. But once that 5-10 years is completed, you should not be auditor for that company. What many big 4 entities are doing, many audit firms, what they're doing, 5 days they'll be acting as an auditor. Once audit position is over, they will take some other works in the company. Non-audit works they will take. 144 prohibited services are there, right? Sir, 5 years audit over, sir. That time I cannot provide 144. But after I withdrawn from auditor's position, I relieved from the auditor position. Now can I take up 144 service? Yes, technically yes. Can I provide 144 section services to the company? Yes, if you are not the auditor. So many of these firms, what they do, 5 years they will act as an auditor. Later they will convert into 144 services. Now 3 years MCA is banning that. Once you retire as an auditor, see, the very reason we are asking you to retire is why? You are familiar with the company. And why we are keeping 5 years cooling period? If you don't interact with the company for 5 years, your independence, everything again becomes normal. Yes or no? Everything will back to the normal level. Again, that time you are eligible to be reappointed. Now within this 5 years cooling period, you are providing 144 services. Again, you are interacting with the management. Familiarity is not going off. So MCA brought a notification saying 3 years after completion of 5 years, after completion of this thing, right? Block period is there, right? Block cooling period. In that cooling period, you should not provide non-audit services. So like that, they are bringing a rule now. I think it's announced already. Now next look at. So long-standing relationship. If the client and auditor are long-standing, independence gets affected. They become familiar with each other. Auditor accepting gifts and hospitality from the client. Significant gifts and hospitality are accepting from client. That's a familiarity. Former partner of the auditor, who is a director now in the company. In the company right now, there's a director, right? He's actually our partner only previously. Familiarity. Then close family member working in senior position, or a friend is working in a company. These are all familiarity threats. Me and client become so familiar. If I have to point out something, I cannot because of the relationship that we had. That's familiarity. Clear? Immediately he'll start questioning. I did so much to you. Can't you help me like this? Yes or no? Then advocacy. What is advocacy? You promote a client opinion. You promote client's decision to the point where your objectivity perceived as compromised. People think, array, he's supporting blindly the client. Yes or no? So if others feel that you're supporting blindly without a logic, that means advocacy threat. When generally examples are what? You're dealing with shares and securities of the company. You're trading in the shares and securities of the client. See, here in self-interest threat also, direct financial interest. What is direct financial interest? If I have shares in the company, that's a direct financial interest. Indirect financial interest means what? My relative has shares in the company. That's an indirect financial interest. Having interest in the company means ownership in the company shares. That is different. Dealing in shares is different. Dealing in the shares means what? I'm buying and selling the company shares. That's why SEBI prohibits insider trading. SEBI prohibits the auditor from trading the shares of the company. Companies Act prohibits the auditor to hold shares even for one day. You should not even buy the shares for trading purpose. Forget about being an investor. You should not even buy for trading purpose. Yes or no? So that's it. Now, when the auditor acts as a client's advocate in litigation or third-party dispute, now the client and some debtor and this client, or creditor and this client has some issue going on. Fortunately, that person also my client only. Now I'm saying, no, don't worry. I will act as an arbiter. I will be a mediator between you both, and I'll resolve the issue. Don't do that, because that's an advocacy threat. Why? You're providing audit. You just come, verify financials and see whether they're true and fair, and then give an opinion. That's it. Leave off. You don't have any other duty. Next, self-review. This threat occurs when auditor reviews their own judgment or conclusion from previous audit engagement or previous non-audit engagement. Previously you did some work to the client. Now you're auditing the same work. Last year up to 31st March or up to 10th July 2026, I'm actually a director of the company, finance director. Now I withdrawn from the company. 11th July, the company appointed me as an auditor. Until July, most of the transactions and all were approved by me only. Now I am only auditing them. If any fraud is there, which is done by me, I will not reveal it to myself. Exactly. So self-review threat. Maker and checker should be different. Correct? Maker and checker should be different. So when an auditor or team members were recently been a director, were recently been an officer of the company, then the self-review threat will occur. Or when auditor performs services which are subject to audit, you are providing some services to the company, they themselves are subject to audit, then that's a self-review threat. Then self-interest threat. This threat occurs when auditing firm or the partner benefits from financial interest in an audit client. You are having a financial interest in the client. You took a loan from the client. You gave a loan, dependence on the client fee, close business relationship with the client. Remember, close business relationship is different from long-standing relationship. Long-standing association. For a long period of time, you're acting as an auditor. That's a familiarity. Business relationship is like a self-interest. Suppose I'm a distributor for the company product. That's a business relationship. That's why under Companies Act, you see business relationship prohibited, disqualified. An auditor who has a business relationship with the entity is disqualified. An auditor who is a member, disqualified. You have taken a loan from the company more than 5 lakhs, disqualified. You have taken a guarantee for more than 1 lakh, disqualified. And why all these disqualifications? To protect your independence. Potential employment. Client is tempting you with some other offers. And contingent fee. All these creates some interest, because of which you might compromise your independence and support the client wrongdoing. That's it. Ethics topic is over. Now, by the way, safeguards. Definitely threats will be there. So just because a threat is there, you should not accept the auditor. Generally, you should evaluate threats. See, whenever a client is approaching you to accept the audit, you should first evaluate, are there any threats to independence? Yes, threats are there. What you should do? Evaluate whether these threats can be resolved. So auditor must always be independent, and you should also appear independent to the public. The key principles are integrity, objectivity, skepticism, all that. Before accepting, please assess whether it involves threat. If there is a threat, what you should do? You should either withdraw from the task or take actions to eliminate the threat, or at least put in place safeguards to bring the threat to acceptable low level. My relative is having shares in the company up to 95,000 rupee. I will tell the company, sir, my relative, please block the demat account for your shares. I put a precaution now. I put a safeguard now. Yes or no? So that they'll not buy further. I gave list of all my relatives, PAN numbers. I gave it to the company. Company informed it to SEBI, and SEBI blocked all those, demat accounts. Now I applied a precaution or not? Now I'll accept the audit. Able to understand? So all safeguard measures shall be recorded as evidence of compliance. If the auditor cannot apply safeguards, threats are there, but I'm unable to apply safeguards, then decline the work. Do not accept the engagement. What is it? Do not accept the engagement. Decline the engagement or decline the work. That's it. So with this, independence ethics topic is also completed. I hope you are clear on this. Okay, that's it. Yeah, let's begin. Audit report topic. Again, this has a weightage of 16 marks minimum. Okay, minimum worst scenario 12, 16, sometimes even 20 marks came. So this is a very big chapter in the entire syllabus, and also easy chapter, not so complicated. You need to understand the reporting correctly. Okay, simple. How do you know that you learned this chapter correctly? If you're able to draft audit report on your own, that means you learned this chapter correctly. How do you test whether you learned subject conceptually? So some students know, they think like, I learned everything, I understood everything, I can conceptually. If you do not understand how to draft an audit report, you didn't learn this chapter. Simple test, because the chapter name itself is audit report. If you don't know how to prepare audit report, then what is the point of learning this chapter? Correct, huh? That's it. Now, so look, so what are we discussing is audit report. This audit report chapter has basically two parts. Okay, part 1, where we are discussing about reporting standards, then part 2, we are discussing about reporting requirements. What is it? Reporting requirements. There is another term called reporting objectives. This is covered under SA 300 planning chapter. There is a question called, what are the factors that are considered while establishing overall audit strategy? There are 5 factors. 1 is characteristics of the engagement that define its scope. 2, reporting objectives. 3, matters that are important, significant for directing engagement team efforts. 4, nature, timing and extent of resources necessary. 5, results of preliminary engagement activities. So there is a topic, reporting objectives. May 25, this question was asked. May or September 25, this question was asked. Give any 4 examples of reporting objectives. Reporting objective is different, reporting requirement is different, reporting standard is different. I hope you understood now. Now, what are the reporting standards that we have? 700, 701, 705, 710, 720, 706, 570. What is it? 570. In this 720, we don't have in the syllabus. By the way, we are also going to discuss 299. 1, 2, 3, 4, 5, 6, 7. 7 standards now we are going to discuss. Okay. Then reporting requirements. CARO 2020. That's a reporting requirement. Now, look at the format of audit report. I have given a format here. Format of audit report. Elements of auditor's report for audit conducted as per SCA. Elements of audit report. Format of audit report. Generally, a question always comes in compulsory question, audit report. So 1, 2, 3 questions. Between 1 to 3 only, you will always find a question from audit report topic. So look at the contents of audit report. First, you should title it. Yes or no? Look at the Reliance audit report. There is a title to this. Okay. There is a title. I'll show you standalone financials of Reliance. Yeah. So this is the auditor's report of the Reliance company. What is the title they mention? Independent Auditor's Report. Correct? Then there is an addressee to the members of Reliance Industries Limited. Okay. So there will be a title, there will be an addressee. Addressee is influenced by what? It is decided in the terms of engagement or it is given in the law or regulation. Typically, audit report is addressed to whom? Shareholders or those charged with governance. So the title of the audit report must be what? Independent Auditor's Report. It should clearly mention that. Now, what is the next element? Opinion. Correct? What is the next element? Opinion. But actually, if you see, the real audit report is divided into two parts. The real audit report is divided into two parts. One is report on financial statements. One is report on financial statements. To the same continuation will be report on legal and other regulatory requirements. What is it? To the same continuation will be report on legal and regulatory requirements. Look at this. Report on, this is second part of the audit report. Report on other legal and regulatory requirements. In the book, if you see, up to, third point to 11th point. This is part 1 of the audit report. Then report on legal requirement is part 2. Within the audit report, 3rd point to 11th point as per the book, auditor's opinion, basis for opinion, MURGC, key audit matter, emphasis, other matter, responsibility of management, responsibility of auditor, other information para, until that it is part 1. We actually call them as what? Report on financial statements. What is this actually? Report on other legal regulatory requirement, is there, right? We actually call this as other reporting requirements. What is it also called as? Other reporting requirements. Now, what is another reporting requirement? It's a reporting requirement which is required under a law or under a regulation. What is other reporting requirement or other reporting responsibility? These responsibilities includes legal reporting requirement, regulatory reporting requirement. Like this section can be named as report on other legal and regulatory requirement. Suppose if other reporting requirements, this where it should be presented? It should be presented immediately after report on financials. In the audit report, you give a report on financials, right? Immediately after that, other reporting requirements should come. Okay. Now, I will show you the format, SAS 700 format. I will show you just a minute. Yeah, here it is there. So look at this illustration 1. I'll show you how the format looks like. Tell me, is this a big heading compared to this? Look at this. This is a small, this is a bigger letter. Do you agree? Do you agree? This font size is bigger. This font size is smaller. So no, this font size is 12. This font size is 11 or 12. Okay. Okay, 11 something. And this font size is some 13 or 12 probably. So report on financial statements, correct? Okay, it might be standalone, it might be consolidated. First of all, it's a report on financial statements. Then other reporting requirements. You see, other reporting requirements. Other matter. After that, what is there? Again, bigger heading, correct? This is small heading, this is a bigger heading. Do you agree? Yeah. So report on other reporting responsibility follows report on financial statements. That's the meaning there. Do you understand? So this is what there in the ICAI book also. So other reporting responsibility, if any other reporting requirement is there, it should follow report on financial statements. So exactly, it is following it. Reliance also following it. So report on financial statements means what? Report on financial statements means what? Reporting on financial statements means reporting as per standards on auditing on the financial statements. Reporting as per standards on auditing. Other reporting requirements are what? They are not as per standards. They are as per law. They are as per regulatory. So in audit report, I have to give report. I have to report on matters as per standards on auditing. I should also report on matters as per law and regulation. For example, CARO, that's not a standard requirement. That's a Companies Act requirement. I have to report on 143.3 checklist. That's a Companies Act requirement. I have to report on emphasis of matter para. That's a standard requirement. I have to report a key audit matter. That's a standard requirement. I have to report opinion, basis for opinion. That's a standard requirement. Able to understand. any reporting element in the audit report which is required as per standards on auditing. That's a reporting on financials. Under that part it will come. If I have to report anything else as per law and regulation, that will come under second part of the audit report, which is report on other legal and regulatory requirements. Do you understand the structure here? Accordingly, the subject also we are discussing in two parts, this audit report. Part 1, reporting standards. Part 2, reporting on legal and regulatory requirements, which is also called as other reporting requirements, which is simply called as reporting requirements. Reporting standards, reporting requirements. That's the basic difference. Clear? Now tell me, we give opinions, right? We broadly have how many types of opinions? 2 types of opinions, correct? Huh? We broadly have how many types of opinions? 2 types of opinions. One is positive opinion and negative. You see what opinion, I mean, first, actually, no opinion, basis for opinion, MURGC, key audit matter, emphasis of matter. These are actually called as para. Opinion para. Basis for opinion para. MURGC para. Emphasis of matter para. Other matter para. Key audit matter para. We can call them as para. We can also call them as section. We can also call them as what? Section. Opinion section, basis for opinion section, key audit matter section, emphasis of matter section, other matter section, management responsibility section, auditor responsibility section. You can also call them as sections. If you see the audit report, inside the audit report, they refer them as sections. They refer them as what? Sections. Fine. Now, first section in the audit report is what? Directly, opinion. What is the first section of the audit report? Opinion. What are the types of opinions that we have? Positive opinion, negative opinion, basically. But here we call them as unmodified opinion, modified opinion. Now, unmodified report, modified report, wrong. You should not use like that. There is a difference between modified opinion and modified report. Unmodified opinion, unmodified report, both are not same. I'm talking about opinion unmodified, that's fine. Opinion modified, that's fine. But don't confuse between modified opinion with modified report. Don't confuse between modified opinion and modified report. If you open ICAI study material, you see here audit report format I gave here, no? You see audit report format, I've given some black font, MURGC, key audit matter, emphasis, other matter para, other information. These points will not be there in the original 700 format of audit report. This is a comprehensive format of audit report. What format of audit report I gave in the GOAT notes is comprehensive format. That's not the original format. What is the format of audit report? 700. 700 only deals with that. What is 700 standard? Forming of an opinion, reporting on the financial statements. How to form an opinion, how to report. 700 format, if you see, you will not find emphasis of matter para. You will not find emphasis. You will not find other matter. You will not find MURGC. You will not find other information. Original 700 format, you will not find all this. If you give an audit report in a given scenario, you are doing audit of a company. In the given scenario, you are giving an audit report exactly as per following 700 format of ICAI. You follow you exactly copy paste, change the name, change the year, and you're giving that format as it is. That's an unmodified report because you're not modifying the report. Whatever report ICAI gave in the 700 illustration, as it is you're copying and then giving it to the client without any modification. That's an unmodified report. Sir, I want to include emphasis of matter para as per 706, sir. Okay, add it. Now we are modifying the report. Now what are you doing? You're modifying the report. Modified report is different from modified opinion. I'm not modifying my opinion, guys. I'm modifying the report. I'm adding emphasis of matter para. The report gets modified. Why report gets modified? You're not following 700 format. Simple. You're not following 700 format. You're modifying the format and then following. Therefore, you're modifying the report. If you are including emphasis of matter para, if you are including other matter para, if you are including MURGC, if you are including key audit matter, if you are including other information para, you are actually modifying the report. You have a question in 260 standard. What are the circumstances? Which auditor has to communicate to those charged with governance in case of modifications to the report? Under what circumstances regarding modifications to the report the auditor has to report it to, the auditor has to communicate it to those charged with governance? In the following circumstances, which affect in the following circumstances which affect the audit report, where audit report is getting modified, where auditor is adding additional information in the audit report, he should communicate with those charged with governance. If auditor is deciding to give a modified opinion, if auditor is including emphasis of matter, other matter para, if auditor is including key audit matter para, if auditor is including MERGC, if auditor is including misstatement in other information, then the auditor has to communicate with those charged with governance. So that is what there. 260 important question. Hello everyone, able to recollect something? Yes or no? That's it. Now opinion. So let's now look at, I hope you understood, right? So in the GOAT notes, I gave a comprehensive format. This format will not match with ICAI book format because this is a comprehensive format. Okay. Now opinion. What are the types of opinions that we have? Two types. Opinion I'm asking, unmodified opinion, modified opinion. For example, no, client prepared financial statements, okay, he prepared financials and I audited, I verified it. You know what I felt? They prepared financials completely true and fair. They don't require any modification. They don't require any modification. What do you mean by they don't require any modification? What do you mean by that? Are they free from error or are they containing error? Free from error. Only when they are free from material misstatement, I feel that they does not require any adjustment. Tell me, if the balance sheet P&L contains some mistakes, they require modification so that it will be free from misstatements. Am I right? If I have to make the financials error free, which contains errors, I have to tell management, please modify. But actually in the given scenario, they don't require any modifications. Everything was clear, intact, proper. They don't require any modification. Okay, I will also give unmodified opinion. Do you understand the terminology? Suppose I audited, I found out some mistakes. Inventory mistake is there. Inventory materially misstated. Inventory materially misstated. The inventory cost is 100 crore, NRV is 90 crore, but company valued inventory at 100 crore, not at NRV, which is 90. They are supposed to show inventory at 90, but they showed at 100. Now tell me, in the given scenario, balance sheet is showing 100 crore value. Is that correct? Is that correct? Should it require adjustment? Should it require modification? I went and requested company, sir, please modify the balance sheet, sir. It is containing 10 crore worth of misstatement. Management said, no, sir, not possible. Management said, not possible. Okay. You don't modify the financials so that it will be true and fair. You don't modify, fine. I'll modify my opinion. Do you understand the context? So I will give a modified opinion on the financial statements which require modification. But you know what? I will give modified opinion in two circumstances. I will give modified opinion in two circumstances. When material misstatement is found. When auditor identified a material misstatement, I will give modified opinion. Or I am unable to obtain sufficient and appropriate. Array, whether the financial statements are true and fair, you're not letting me. You're not letting me to give, you're not letting me to verify. First of all, I'm unable to do the audit. Then I will give modified opinion. I will give modified opinion in two circumstances. One, you made me verify and I verified thoroughly. I found mistakes. Yes or no? And you're not rectifying it. Then I will give modified opinion. And I'll give modified opinion when you're not letting me to verify. Simple. When I give negative opinion on a client, he's not cooperating me at all. He's not permitting me to do audit. Then tell me, will I give positive opinion on the client? Will I give a positive opinion on the client if at all he's not permitting me to give opinion? People send me to check the financials and then give an opinion. I have to check everything and then give my opinion. To give an opinion, you're not letting me to check. I'll give negative opinion. There I'll give a negative opinion. Modified opinion, nothing but. Or I verified, I found mistakes. Then also I'll give modified opinion. Now, when you want to give modified opinion, you can't simply modify just like that. Something is wrong. No, you have to specifically tell what exactly went wrong. There are three types of modified opinions. Modified opinion is again subclassified into three types. One is qualified opinion, adverse opinion, disclaimer of opinion. Disclaimer of opinion is not an opinion. Understand? We are disclaiming the opinion. I won't give an opinion is what I'm saying. When do we give qualified? When do we give adverse? When do we give disclaimer? That's the question. For example, simple example. Okay, there is a balance sheet. Okay, so some 500 crore, 500 crore, 500 crore and 500 crore equity, liability, non-current assets and current asset. Okay, so that's the balance sheet. In this 500 crore, I saw non-current assets completely true and fair. Everything pakka, properly accounted. Liabilities properly accounted. Equity also properly accounted. But in inventory, there is mistake. 500 crore ma. In this, no, there is one inventory worth of 2 lakh. One inventory is there which is worth of 2 lakh. Its NRV is 1 lakh only. But the company showed at cost to 2 lakhs. Where there is a misstatement by 1 lakh rupee. Now tell me, what should I do? Should I say entire balance sheet, don't trust and invest, lose money? No, I will not say this. Should I say people don't trust this company at all, they're cheating you? Arey, how much is the mistake here? 1 lakh. First of all, 1 lakh in 500 crore, immaterial. What is it? Immaterial. Yes or no? Since it is immaterial, I will ignore this. Rest all other fine. Yes, only this immaterial mistake I found. Immaterial mistake I found. Only when there is a material misstatement, you should modify the opinion. If it is an immaterial misstatement, you don't have to modify. Okay, apart from this, did you find any other mistake? No, only this mistake I found. Then do one thing, give unmodified opinion. Hello? Suppose the same mistake. Okay, 2 crore. 20, let us assume inventory cost is 5 crore. But the management, NRV value is 1 crore. Cost is how much? 5. NRV is how much? 1. 4 crore, they overstated the inventory. What is it? 4 crore, they overstated the inventory. I have evidence. NRV workings I saw. Literally, they overstated by 4 crore. Now tell me, is this 4 crore big mistake or not? In the company. Array 4 crore, 0.8% of turnover. Company turnover is 500 crore. 1% is 5 crore. 0.8% is 1 crore, which is more than 0.5% of turnover. Anything above 0.5% of turnover is material. Anything above 0.5% is material. So the company, big mistake they made. So now this is big mistake. I requested company, okay, please rectify, sir. 4 crore worth of mistake is there. That's not fair. Management is saying, no sir, I will not rectify. Already financials are approved, so we don't have another option also. Next year we will rectify it as a prior period item if you want. So they said they will not rectify now. Now tell me, rest all other items are fine. Debtors, cash and bank balances, sales value, everything is right. This 4 crore only the mistake. Can I say balance sheet is completely not true and fair? Don't believe it. Can I say this? If I say this, management will immediately say, sir, it's only 4 crore which is wrong. Rest of the item is right, no? Substantial portion of the financial statements is true and fair, right? Whereas there's only a minor portion. I agree this is significant. I agree this is material, but this is not substantial. This is not pervasive. This is material, but not pervasive. We will give which opinion? Qualified opinion. Qualified opinion is given in one circumstance. Qualified opinion is given in one circumstance where actually it is given in two circumstances. One of the circumstances, misstatement is found and the misstatement is material, but it is not pervasive. Suppose I found a misstatement, I have a proof for it, it is material and it is also pervasive. What is it? It is also pervasive. If the material misstatement is pervasive, then we give which opinion? Adverse. For example, non-current assets, 30 crore overstatement. In current assets, 40 crore overstatement. In debtor, in liabilities, 100 crore understatement. Okay, equity, some 50 crore overstatement or understatement, something. You're able to understand? Now can I say balance sheet is true and fair, except debtors 100 crore, except creditors 100 crore, except this 100 crore, except equity? What? How many exceptions you use? Yes or no? Is the bike condition good? Yes, extraordinary the bike condition. Just that engine is failed. Just that tires have to be replaced. Just that, all the seat is not, the seat and all was teared. Accelerator is not working. Clutch plates are gone. Then you are saying bike is good. Bike is good only. Exactly. Yes or no? So adverse opinion should be given when substantial portion of the financial statement is materially misstated. Yes or no? When substantial portion of financial is materially misstated, you should give which opinion? Adverse. Now Now qualified opinion, when do we give? When there is a material misstatement but it is not pervasive. When we give adverse opinion, when there is a material misstatement plus pervasive. Now qualified opinion is given in one circumstance. There is another circumstance. There is another circumstance where we give qualified opinion. Suppose I saw inventory, 5 crore worth of inventory. It is not lying in the godown. It is lying with a third party. 5 crore worth of inventory is lying with a third party. I'm already at the edge of the audit. I have to give day after tomorrow a deadline for the audit report. Now I want evidence for this 5 crore. I'm calling the third party, nobody is responding. I'm sending a mail, nobody is responding. Yes or no? So it's ultimately we found out that this 5 crore worth of inventory, are they lying with third party or not? We are not getting evidence. We are not getting any evidence. Third party is also not responding. Some reason, some top management, some issues are going on there. Okay, they're not responding. 5 crore worth of inventory lying with third party for which there is no evidence for me. Rest all other, do you have evidence? Yes, I have evidence. Are they true and fair? Yes, true and fair. Are they misstatements? No misstatements. What about this 5 crore? This alone I don't have evidence. Now tell me, because of this 5 crore, do you completely ignore the audit? I will give opinion that everything is true and fair except this 5 crore regarding which I don't have any evidence. So I am unable to comment on this 5 crore. Except this 5 crore, rest of the financials are true and fair. Can you say this? So if evidence is not available for a material item which is not pervasive, it's a material item but it is not substantial item. Pervasive means what? Substantial. So if evidence is not available for a material but not a pervasive item, still I will give which opinion? Qualified opinion. Sir, evidence is not available for material and guess what? That is also pervasive. Then I will not give an opinion. I'll straight away give which opinion? Disclaimer of opinion. Correct? Huh? Many students confuse between adverse and disclaimer. Remember, disclaimer of opinion will only come only in a situation when evidence is not available. Sufficient and appropriate audit evidence not available. For which portion of the financial statements? Material portion and pervasive portion. For substantial portion you did not get evidence. Then you give which opinion? Disclaimer. For suppose you did not have evidence, you did not get evidence for a material item. Is it pervasive? No, it's not pervasive. Only material evidence I did not get. Substantially I got it. Qualified opinion. Yes or no? That's it. Sir, evidence is available, sir. Material misstatement also found, sir. But it is not pervasive. Then I'll give which opinion? Qualified. Material misstatement I found. And it is also pervasive. Then I'll give which opinion? Adverse. Clear? So, circumstances of opinion. So, circumstances. Sufficient appropriate evidence obtained. Misstatement is found but not pervasive. Qualified. Sir, misstatement is pervasive also, sir. Misstatement is pervasive also. Then automatically adverse. Evidence is not obtained for a material item. Okay. But it is not pervasive. Then qualified. If it is pervasive, disclaimer. Substantial portion, if you don't have evidence, tell me how can you give an opinion? I'm asking you to give a new bike review. Okay, bring me the bike first. A bike is not there, you give me review. How can you give the review? Yes or no? Exactly. So disclaimer of opinion, when do we give? When substantial portion of the financial statements, if at all we did not get sufficient appropriate evidence. Yes or no? I will give opinion. Suppose if the bike or car is designed for off-roading basically. Okay, it's an off-road vehicle. Okay, you can take it to the forest, all that area. But right now you can't go there. So they gave you driving on the road. So substantially you checked all the features, everything, you drove, test drove everything, 2 hours you drove everything, all that. You give still qualified opinion. Okay, regarding off-road, I have not tried it, you will still. But rest of the part you still give opinion. Correct? So that's it. Exactly. Able to understand? So same way. So if major portion of the financial statements I verified and I have an evidence and I know that it is true and fair, but a material item I could not verify, qualified opinion. So look at the definitions of qualified opinion. When do auditor give a qualified opinion? The auditor expresses qualified opinion in 2 circumstances. Correct? One, you have evidence. Based on evidence, you concluded that misstatements are material but not pervasive. Suppose you remove this word but not and keep end. Material and pervasive, automatically which definition? Adverse. Sir, second scenario where we give qualified opinion. He is unable to obtain sufficient appropriate evidence but concluded that possible effect on financials of undetected misstatements, if any, could be material but not pervasive. But not if you remove and put earned, it automatically comes under disclaimer. So in qualified opinion, two parts were there, right? Two definitions. First part of the definition, you remove but not and keep end, automatically adverse opinion definition. Second part of the definition, but not you remove and keep end, it's a disclaimer of opinion definition. Now look at this wordings. Look at these sentences. Concluded that possible effect of undetected misstatements on financial statement. You see, we are not talking about the real effect. We are talking about possible effect. Why am I talking about possible effect? Inventory lying with third party, you said. But I don't know whether it is lying with third party really or not. No evidence is there. But management is saying it is there, sir, promise, sir. But I don't have any evidence for that. So here I'll think worst possible scenario. Worst possible scenario. What if this is really not there? This is a fake transaction. What if it's a fake? Possible effect of misstatement. I assume that that's a mistake. I assume that it's a mistake. See, I don't have a proof to prove that it's a mistake. But I assume that worst scenario, it's a mistake. Possible effect of misstatement. Tell me, did I discover any mistake right now actually? Undetected. Yes or no? The possible effect of undetected misstatements, if any. So if at all that's actually a mistake, which you didn't discover right now, but assume that there is a mistake, what is its effect going to be? Oh, if 5 crore mistake is there, that's material but not pervasive. Give qualified. If 5 crore worth of mistake is material but not pervasive, then give a qualified. But actually, is there a mistake? No. Is there a mistake? No. That's the reason I'm evaluating possible effect of the misstatement. Hello, everyone, all of you. That's it. You know, auditor disclaims in rare cases involving multiple uncertainties, interactions of uncertainties. Only in extreme rare cases only we give disclaimer of opinion. Which means there are two circumstances where we issue modified opinion. What are the circumstances we issue modified opinion? If sufficient appropriate evidence is obtained and you concluded financial statements are not free from MS, or financial statements are containing material mistakes, then you give modified opinion. Second one, you will give modified when the auditor is unable to obtain sufficient appropriate evidence to conclude that financials are free from MMS. Are the financials free from MMS? To conclude that, I don't have evidence. Are the financials containing MMS? Yes, I have evidence for that. In both these scenarios, you give which opinion? Modified opinion. Which type of modified opinion you give? Okay, you give modified opinion in these two circumstances, I agree. Which type of modified opinion you give? That depends on pervasiveness. That depends on what? Pervasiveness. Determining the type of modified opinion, 5 marks question. So, determining the type of modified opinion, it depends upon pervasiveness, correct? First of all, which type of modified opinion I should give? Why are you modifying? First know the reason. Why are you modifying? Nature of the matter giving rise to modification. What is the matter giving rise to modification? First of all, why you want to modify? Do you found a material misstatement? Do you not getting sufficient appropriate evidence? What is the reason exactly? Is it because whether financials are materially misstated? Or is it because you are unable to obtain sufficient appropriate evidence? Yes or no? What is the reason exactly? Tell me the reason. Okay. You are unable to obtain evidence? Okay, fine. What is the pervasiveness? Not pervasive. Give qualified. What is the pervasiveness? Yes, pervasive. Give disclaimer. What is the nature of matter giving rise for modification? Sir, I found a material misstatement. I found a material misstatement. What is its pervasiveness? Pervasive. Give adverse. It's not pervasive. Give qualified. Hello? Everyone? So, which type of modified opinion is appropriate depends upon nature of the matter giving rise to modification and pervasiveness of the effect or pervasiveness of the possible effect. When do I use the word effect? Sufficient appropriate audit evidence is available. When will I use the word possible effect? When evidence is not available. Hello? That's it. So determining which type of modified opinion depends upon these two matters. Nature of the matter, why am I modifying? 2, pervasiveness of the same. Correct? Now again, what do you mean by pervasive? I told you pervasive, simple way of understanding is substantial. Pervasive example is substantial. So pervasive means impact. What? Impact of what? Misstatement or undetected misstatement. It can be anything. Misstatement impact, when I will check, evidence is there, misstatement is proved. Undetected misstatement, when I will use the word, evidence is not there, but misstatement is possible. Hello, yes or no? So pervasive describes impact of misstatement or impact of undetected misstatement, where this mistake is there now, this misstatement is there now, they are not related to specific element or account. It is not something related to a specific amount, specific account, specific item of the financial. It is not specific to one. Not specific to one means what? Not confined to specific means what? There are so many mistakes. Correct? Huh? Or if so confined. If so confined means what? It could be related to one only, but that one item represents substantial portion. Hello? That one represent a substantial portion. You know what? I did not get evidence for investments. In the balance sheet, I got evidence for fixed asset, I got evidence for current asset, I got evidence for equity, liabilities, everything I got. Only one item I did not get evidence, that is investment. And guess what? That investment represents 90% value of the total assets. That investment represents 90% value of the total investments. Pervasive. So pervasive can be, it is like, it is not specific, not confined to specific items, or sometimes it may be confining to a specific item which could be substantial portion. Or third one, pervasive can be in relation to disclosures. It may be, a misstatement can be related to a disclosure where it is fundamental to users understanding. Fundamental disclosure, if you are misstating, if at all you are misstating something which is fundamental disclosure, that is also pervasive. Going concern, for example, it's a pervasive. If you made a wrong disclosure on going concern, we by default consider it as pervasive and we give adverse opinion or disclaimer of opinion as the case may be. Clear? Hello? That's it. So most of the standard 705 is over. Most of the 705 standard is over. Okay, so we'll do one thing, we'll continue in the next session. We have drafting discussion, slightly drafting may not be that important at CA Into, it's only important at CA Final. You can watch my previous marathons or my CA Final marathon for drafting idea, how the drafting will happen. And actually without discussing that, one important question is there that we can't discuss. So obviously drafting has to be discussed. Okay, fine, no problem. In the next session I'll discuss drafting and I'll also show you how tough the questions are being asked. Okay, right now whatever I discussed is easy questions, technically easy. The next version, when you are giving a modified opinion, how in audit report drafts changes will appear, what kind of changes will happen in audit report if you are giving a modified opinion, that we are going to discuss. Okay, so in the next session we'll be discussing. And so in the next, before you start the next continuation, before you continue, what you should do: nature, objective and scope, ethics and terms of engagement, one time revise, solve question bank and then attend. Okay, that's it. And don't forget to like and comment on the video. Yeah. So in the previous session, we were discussing about, the continuation, we are discussing about the types of opinions, and we understood there are two types of opinions. One is unmodified opinion and modified opinion. And I also told you there is a significant difference between unmodified opinion and unmodified report, modified opinion and modified report, right? So, 1 minute. Yeah. So, so modified opinion and modified report, both are different. Unmodified opinion and unmodified report, both are different, right? And we also discussed the context behind unmodified opinion and modified opinion, what circumstances they give modified opinion, deciding which type of modified opinion is appropriate, that we understood. Then we understood four types of, totally, ultimately the opinions are broadly four types. Unmodified, which is also called as unqualified opinion and clean opinion. Modified opinion is three types: qualified opinion, adverse opinion and disclaimer of opinion, right? And in which circumstance which opinion will be given, that also we covered, right? Now we need to discuss the drafting part of it. So how the opinions will be drafted. For example, if you see an unmodified opinion, how that looks like. This is very important because in Jan 25 a similar question was asked. Not similar, same question was asked, which I'm going to discuss in the next 20 minutes to half an hour. So in Jan 25, this question was tested. Okay, first look at. So anyhow, the main heading, first part of the audit report is what? Report on financial statements, where the elements below that, will be given as per auditing standards, right? The report on financial statements, below that the elements, opinion section, basis for opinion section, all this will be as per standards on auditing. Second part of the audit report is other reporting responsibilities, or we also call them as other reporting requirements. We also call them as report on other legal and regulatory requirements, correct? Now, so in that, the first section is what? Opinion section. Directly, I told you the elements are called as either paragraph, or you can also call it as section. So the first section is what? Opinion section. Now look at how many parts were there. Opinion sections, you see within the opinion section, how many parts were there? 2. So first part is there, right? This we call them as introductory para. What is it actually called as? Introductory para. This is actual opinion. This is the actual opinion. Look at how the opinion wordings are. In our opinion, to the best of our information, according to the explanation given to us, the aforesaid financial statements give information as per Companies Act and give true and fair view. You see here, there is no exception. Straight, clean opinion, right? So in our opinion, to the best of our information, according to the explanation given to us, the aforesaid financial statements are true and fair. That's a clean opinion, right? Now look at, so first introduction. What introduction? We have audited. The introduction starts with we have audited the financials of ABC, yes or no, comprising balance sheet, P&L, cash flow, notes, everything. This is an introduction. We have audited so and so. In our opinion, the aforesaid financial statements were true and fair view. Now look at how in case of modified opinion, how this paragraph affects. In case of modified opinion, how this paragraph affects. Now again, look at title constant, independent auditors report. Heading. What is the heading here? Qualified opinion. Whenever we are giving a qualified opinion, adverse opinion, disclaimer, the heading itself should reflect that. Means the reader, without even reading the actual content inside, should understand what opinion you give just by looking at the heading. So qualified opinion. Again, you see here also there are 2 paras. Am I right? Here also there are 2 paras. This observation is very important. Why? The question standard will be that level. The questioning standard will be at that level. So first you observe this. Okay. I don't know how many of you have actually learned the subject like this. So this is how you should learn, because I'll show you the advanced questions. What I'm telling you right now is nothing. The advanced question I'll show you. What question they tested in Jan 25. Right, Jan 25 paper CA Inter Audit is one of the tough paper. Toughest in fact. Why they felt toughest? It's not that something they didn't ask out of syllabus. What they asked is in the syllabus. But many don't understand that question. Many did not understand that question. That's the main drawback. Now look at. Yeah. So again, 2 parts, correct? In we have audited, same. Here you see, in our opinion, to the best of our information, according to the explanation given to us, correct? Again, the aforesaid financial statements give true and fair view. Is it a positive opinion or not? Technically, it's a positive opinion. But here they have used one exception. Except for the effect of the matter. Except for the effect of the matter. What matter? Like what is the issue? Described in basis for qualified opinion section of our report. Oh, in the same report, there is another section. Basis for qualified opinion section. In that particular section, a matter has been described. Except effect of that matter. Except that matter. The aforesaid financial statements give true and fair view. Qualified opinion is what? There is another name to it. Conditional positive opinion. There is another name for qualified opinion. What is the name? Conditional positive opinion. It's a positive opinion, but with an exception, but with a condition. So this is a conditional positive opinion. Understood now? Everyone, how a qualified opinion wordings appear? Now, look at how adverse opinion looks like. This is adverse opinion. Okay, I'm just showing you what opinion they gave. That's it. And I'm not explaining the reason behind it. I'll come to it later. Now look at again. Adverse opinion. The heading has been changed. And what is the basis for this adverse opinion? Basis for adverse opinion. The heading has been changed. Now again here we have audited. Same. Introductory price. Same. the introductory para within the opinion section, whether you give unqualified opinion, qualified opinion, adverse opinion, remains same, but not in case of disclaimer of opinion. Okay, now look at, in our opinion, same, to the best of our information and according to the explanation given to us, the financial statements do not give true and fair. Adverse means what? Negative. Adverse opinion is exactly negative opinion. Negative means what? They are not true and fair. Don't believe it. Why? Because of significance of matter discussed in basis for adverse opinion section of our report. In the same report, there is another section. Basis for adverse opinion section is there. In that section, some matter has been discussed. Because of significance of the matter discussed in basis for adverse opinion section of our report, because of that reason, because of that matter, the aforesaid financial statements the aforesaid financials do not give true and fair. I'm straight away saying no, they're not giving true and fair. Correct? Now let's look at how disclaimer of opinion wordings will appear. Tell me, when do we give disclaimer of opinion? When evidence is available, when evidence is not available. For substantial portion or just a material portion? Substantial portion. When evidence is not available for substantial, pervasive portion, when evidence is not available, we can't give an opinion, and hence we have to tell the same thing. We are unable to give opinion. Now look at how in disclaimer. By the way, in disclaimer of opinion, had we conducted audit or we didn't conducted the audit? You mean to say you are giving disclaimer, right? You are giving disclaimer because you are able to do the audit or you are unable to do the audit. Now in all these three opinions, introductory para starting line started with we have audited. Can I use that in disclaimer? That's it. Look at. So you see what they're mentioning here? We were engaged to audit. You understood the difference? So what are they saying here? We were engaged to audit. Why they are saying, why they are mentioning like that? Because we didn't audit actually. Why you didn't audit? You audited, no? Substantial portion I didn't audit. When substantial portion I didn't audit, can I say we have audited for minor portion? Minor portion they would have given me evidences. Some here and there, some evidences they would have given for sure. But substantial portion I did not get evidence. When for substantial portion we did not get evidence, I cannot use that the word that we have audited. We were only engaged to audit. And by the way, again, directly it starts with we do not express. In our opinion means what? You are having an opinion. Here we do not express an opinion on the accompanying financial statements. Why? Why you don't want to give opinion? Because of significance of the matter described in basis for disclaimer opinion section of our report. We have not been able to obtain sufficient appropriate evidence to provide a basis for an opinion. To provide an opinion, to have a basis for it, we do not have sufficient appropriate evidence. That's it. Clear? So again, basis for disclaimer of opinion. Understood until now? Now, so I hope you understood how the opinion wordings appears in four types. Now you know there is a discussion in our book, even in the ICAI book also. Suppose if you are giving modified opinion, suppose you are giving modified opinion, how basis for opinion section will be changed? How basis for opinion section will be affected when you give a modified opinion? This is one important concept. How basis for opinion para will be affected when you give a modified opinion. Now first of all, how the basis for opinion para looks like? Suppose if I give unqualified opinion, suppose I am giving unqualified, see which opinion I give, I can look at the heading and then tell. If at all the heading just contains the word opinion, that's an unqualified opinion. If at all I gave a qualified opinion, the heading will have qualified, adverse, disclaimer. Am I right? So if the heading does not contain any prefix to the word opinion, that means which opinion is that? Unqualified opinion. Now tell me, how many paragraphs were there within this? One. When you are giving unqualified opinion, how many paragraphs were there? One. Tell me, if I do not like a person, I'll have a reason for it. If I like a person, will I have a reason for it? Exactly. What is the heading name? Basis for opinion. You give unqualified opinion. You gave unqualified opinion. Like the aforesaid financials are true and fair. Why? It's not one reason. There are many reasons which I satisfy with that particular financials. Correct? See, if I give qualified opinion, what is the negative you ask me, I'll tell you. I gave financials are not good. I'll tell you what is the reason. If I'm unable to give opinion, I'll tell you what is the reason. But why you said positive opinion? Cinema, I mean movies lo solluvaangala. Yes or no? ஒரு பொண்ணு ஒரு பையன் காதலிச்சிட்டனா எதுக்கு காதலிச்சிட்டனா அதுக்கு ரீசன் தெரியாது, ஏன் இஷ்டம் இல்லைன்னா ரீசன்ஸ் தெரியும், அப்படி சம்திங் லைக் தட். ஐம் நாட் குட் அட் தமிழ், ஓகே ஃபைன். அதே மாதிரி சேம் சிமிலர் தான். ஸோ பேசிஸ் ஃபார் த ஒப்பீனியன், யூ வில் ஹாவ் எ பேசிஸ் வென் யூ ஆர் கிவிங் மாடிஃபைட் ஒப்பீனியன் பட் நாட் ஃபார் அன்மாடிஃபைட். பட் ஸ்டில் தேர் ஆஸ்கிங், no, you should tell me the basis. Tell me some reason. Okay, fine. You want reason why I gave an opinion. How do I give an opinion? You want a reason. Fine. I did audit as per standards on auditing. We conducted our audit as per standards on auditing. And we are independent of the company. We are independent of the company. We have fulfilled our ethical responsibilities in accordance with these requirements. We believe that. We believe that the evidence we obtained is sufficient and appropriate to provide a basis for our opinion. You asked me, what is the basis for the opinion? I gave unqualified opinion. You are asking me, what is the basis for it? The evidence which I obtained. Then the second question, have you obtained sufficient evidence? Yes, I obtained sufficient evidence, appropriate evidence I obtained, and I believe that it is sufficient and appropriate. We are independent of the company. We did our audit as per standards on auditing. Because we did our audit, because we are independent, and I complied with ethical responsibility, I even obtained evidences. Based on all these factors, I will give unqualified opinion. So if you ask me why I gave an unqualified opinion, I can't tell you a specific answer. I will only give generalized answers like this. Am I right? Tell me, we did audit as per standards on auditing. Is that a specific reason why you give unqualified opinion? So you're telling everything about something like you see here, they're not telling anything, clearly here. Why you give? What is the basis for unqualified opinion? Why you have a positive opinion? You're not giving specific reason. You're giving a generalized answer. We did audit as per standards on auditing. We are independent of the company. We complied with code of ethics. The evidence which we obtained is sufficient and appropriate. So generalized answer. Now look at in case of qualified opinion how it looks like. In case of qualified opinion how it looks like. Suppose you are giving qualified opinion. Yes or no? When you are giving qualified opinion, you must give reasons, right? Why you gave a qualified opinion? You see, that's why when you give qualified opinion, you see basis for qualified opinion have again 2 paras, correct? Second para you see same, whatever is there in unqualified opinion basis, no, the same thing is copy pasted. What is it? We conducted our audit as per standards on auditing. We are independent of the company. We fulfilled our ethical responsibilities. Yes or no? We believe that evidence we have obtained is sufficient and appropriate to provide a basis for our qualified opinion. Correct? Now this is common. This is there even in unqualified opinion. This will be there even in adverse opinion. Now you should give specific reason also. No, generalized answer I will not accept. I want you to give me specific reason why you gave qualified opinion. Okay, you want specific reason? Yeah, look at the company inventory is carried in the balance sheet at, let us assume the company inventory is 100 crore cost, NRV 90 crore, but company showed in the balance sheet at cost only, but they did not value at NRV. That is the misstatement, and the misstatement value is what? 10 crore. Okay, now misstatement value is 10 crore, right? The company inventories are carried in balance sheet at 100 crore. Management has not stated inventories at lower of cost or NRV, but mentioned only at cost, which is a departure from accounting standard. Okay, now you see they're mentioning, you asked me the reason, no, why I qualified the opinion. Company inventory was valued at cost. They should value at whichever is lower, but they valued at cost, which is a deviation from standard. Fine, you told me the reason. I want to know, you qualified, I understood. Because of this reason, you mentioned the reason, very good. And I want to know what is the impact of the mistake. You should also not only describe the mistake, you should also quantify the mistake. The second condition is what? You should also quantify. Look at how they are quantifying. The company records indicate that had management stated inventory at lower of cost or NRV. If at all management valued it whichever is lower, then an amount of rupee 10 crore would be required to write the inventories down to their NRV. Accordingly, cost of sales would be increased by 10 crore. Net income tax, shareholders funds would have been reduced by so and so. Now, what are they trying to explain here? See, company inventory is misstated. and this is the reason I'm qualifying. Fine, I understood. And what is the impact of the mistake? You should also qualify, you should also quantify. So quantification also you must do whenever you are qualifying. This is what it is mentioned here. Look at this. Misstatement in financial statements related to specific amount. You can sync it directly in ICAI book also, it will be there. Misstatement in specific amount. If material misstatement in financials is related to specific amount, yes or no, including some disclosure, the auditor shall include description of the misstatement. You describe what exactly, and quantification of financial effect unless it is impracticable. Suppose if quantification is not practicable at all, mention the same. If quantification is not possible, mention the same. Understood? So whenever you are qualifying, because a misstatement is there in amounts, mention the misstatement, quantify the misstatement. If you cannot quantify, say that it is not possible to quantify. Understood? Now look at disclaimer, sorry, adverse opinion. You know, here the auditor is giving adverse opinion. Here the financial statements are consolidated financials, and auditor is giving which opinion? Adverse opinion. Why he is giving? You know, one subsidiary will be there, they didn't consolidate it. When you did not consolidate one subsidiary, how come you call it as consolidated? First of all, am I right or not? There is a holding company, it has only one subsidiary, and the holding company prepared standalone financials, and it also prepared consolidated financials ignoring the subsidiary. Then how come it is a consolidation of consolidated financials? Hello? Yes or no? So they ignored one subsidiary to consolidate. Tell me, ignoring a subsidiary, which item in the balance sheet will be affected? Every item. Which item in P&L? Every item. Means here the misstatements are not confined to a specific element. Remember pervasive definition. Pervasive misstatement or impact of misstatement, possible misstatement that are not confined to a specific element, specific amount, specific, yes or no? So here the mistake is not confined to specific, multiple items are affected. So that's the reason auditor decided that it is pervasive. If it is material and pervasive, see, tell me, non-consolidation. Am I worried about evidence here? I'm not worried about evidence. Evidence I have. I know there is a subsidiary. I know there is a holding company, subsidiary company relationship. They didn't consolidate. I have evidence that they didn't consolidate. Here the question is not about evidence issue. Here the question is about financial reporting framework compliance issue. The company prepared consolidated financials, but not as per accounting standard. Because as per accounting, you should consolidate every subsidiary. They didn't consolidate one subsidiary. Since they did not consolidate one subsidiary, it's a deviation from accounting standard, which is a misstatement. Yes or no? And here the misstatement is going to be material and also pervasive. Therefore, auditor gave which opinion? Adverse. Now tell me, again, basis for adverse. Two paras will come. Whenever you are giving qualified and adverse, two paras will come in basis. One is common para. We conducted our audit as per standards on auditing. Yes or no? We are independent of the company. We fulfilled our responsibility. We believe that the evidence obtained by us is sufficient and appropriate to provide basis for our adverse opinion. Correct? Now, first reason, look at what is the specific reason. As explained, the group not consolidated subsidiary that they acquired. This investment is accounted on cost basis under the accounting principles generally accepted. You know, the company should have consolidated at least based on provisional amounts. Here the company has not consolidated. Now we mentioned the reason, but remember, not only reason, we should also quantify. What we need to do, we should also quantify. Because this consolidation does not happen, so many were affected, right? If at all this consolidation happened, what could be the amount? Tell me, can I quantify here? See, previous example, inventory alone, one mistake is there, so I can easily tell where it impacted. Non-consolidation, where and all it impacted, how can I quantify? It is impractical to quantify. That's what. The effect of the failure to consolidate have not been. That's it. Did they follow exactly the requirement as mentioned there? In the theory, what they mentioned, the same only they are following? Yes or no? Until now, clear. Everyone. Yes. Disclaimer of opinion. Disclaimer of opinion. Here they have not received evidence. That's the reason they are qualifying. Now, if you observe, disclaimer of opinion when you see, I'm giving disclaimer of opinion. Correct? So disclaimer. I hope opinion section you are confident until now. Look at basis for opinion. Again, single para. And if you see, we have conducted our audit as per standards on auditing. We are independent of the company. That is not there here. When you are giving a disclaimer of opinion, basis para, does not contain those elements, does not contain those statements. What statements? Generally, what statements will be there in basis para? We conduct our audit as per standards and auditing. Actually, there is second point. Our responsibilities as per the standards, they were described in auditor responsibility section of our report. In the same report, no, there is another section, auditor responsibility section. Inside that, what are all our responsibilities as per various standards and auditing, we describe it. So that fact we will mention generally in basis para. So how basis para will be like? First statement, we conduct our audit as per standards and auditing. Our responsibilities are described in auditor responsibility section. We are independent of the company. We complied with code of ethics. We obtain sufficient and appropriate evidence to provide basis for our opinion. These are the 5 points which we will make generally. These 5 statements you should not make when you are giving which opinion? Disclaimer. Where you should not make these statements? Under basis for disclaimer of opinion section you should not mention. See here, basis for disclaimer means what? Why are you not giving opinion? I want that reason. We conducted our audit as per standards. We are independent. We obtained evidence. That and all reasons for opinion. Here you are not giving opinion. Why are you not giving opinion? You should give reason only for that. Hello? The heading itself is what? Basis for disclaimer of opinion. Disclaimer of opinion means what? I won't give opinion. What is the reason? I want to know the reason behind why you are not giving opinion. That reason if you give, that's enough. Earlier you gave an opinion. For that I want to know the reason. You gave general reasons. Here I'm not giving the opinion. Now will I have to mention those general reasons here? No need. Hello? Jan 25, this question is tested. Able to understand? Now you can understand this part only when I give entire previous this part. Yes or no? Look at the Jan 25 paper. Look at Jan 25 question paper. Yeah. Look at this suggested answer. Jan 25 related one. Disclaimer of opinion. Disclaimer. First of all, is this Jan paper only? This Jan 26. Okay, Jan 25 I want. I told no, we already discussed that in just a minute. Yeah, look at just a minute. So here, yeah, so this is a descriptive question, 4 marks question, and that too question number 3. Look at what is the question that they have asked actually. 3C, no? Singh and Associates, while carrying out stat audit, observed debtors are not making payment invoice wise. As debtors constitute 60%, 60. Okay. So auditors requested management to provide external confirmation for all debtors outstanding for more than 1 lakh. However, management resisted and no external confirmations were made available. Non-availability of evidence. Auditor firm has decided to disclaim the opinion and seek your guidance on amendments that should be made in the basis for opinion section and elements required by 700 which need not be included in auditor's report. So they're asking you what will not be included. So look at the answer, what they gave. Simple answer again. When auditor disclaims the opinion, the audit report shall not include following. He should not mention a statement that whether auditor have obtained sufficient appropriate evidence, a reference to auditor's report where responsibilities are described. Actually, not only these 2, 5 statements you should not mention. You should not mention the statement that you did audit as per standards on auditing. You should not mention a statement that you are independent of the entity, complied with code of ethics. You should not mention about auditor responsibility section. You should not mention about evidence that you have obtained. That these are all you should not mention, but only 2 points they gave. Even in our book also we gave 2 points only. This is what In case of disclaimer of opinion, the auditor shall not include a reference to the section of auditor responsibility, a statement about whether sufficient and appropriate evidence obtained. These two statements you should not include. This part is tested for 4 marks. You're able to understand? Now, you can understand this point only when you understand what is included, what is excluded practically. You try reading this, no matter you try to read mug up, you can't understand. Many students, they come and ask me, sir, I'm understanding the subject conceptually, but I'm unable to remember. What I tell them, you're not understanding first of all. What is understanding? This is what understanding means. Sentence meaning, if at all you're able to understand, that's not understanding. Many had a confusion. Many confused between understanding the meaning of the sentence versus concept. Concept means this. You should understand how it will be drafted. When a disclaimer is given, why it is not drafted like that. Then syncing it with what is actually given in the book. This is the real understanding. I hope you're able to understand now like what exactly you're lacking. So many confuse. I'm conceptually learning the subject. No, that's not. Many I know very well would have never seen audit report first of all. And learning audit report chapter, there itself shows that you're not conceptually learning. So conceptual learning is not about knowing this meaning. Sentence meaning anybody can learn. The context behind it. You see this sentence? This sentence, exact example I showed. Adverse opinion, I'll give exact example there. Illustration is there in ICAI book. For every of this, illustration is given in ICAI pronouncements. Even in your ICAI study material, illustrations were there. So that if you are reading it, understanding it and able to sing here, that's when you're really learning the subject. And that is what even they are testing nowadays. Not just now, almost from past 10 attempts they are testing. Some students they ask again, sir, how many years question banks we should solve? Solve from May 2024 onwards, enough. Is that sufficient? This is the second question they'll ask. First of all, did you solve it? Did you solve from May 24 to Jan 26 or May 26 attempt? No. First finish that and then come back. You know how many were there? From May 24 to May 25, May 2026 attempt. From May 2024 to May 2026, you know how many resources were there? Can you guess the number? 29. 29 papers you need to solve. May 24, 2 MTPs, 1 RTP, 1 suggest answer, 4. September 4, Jan 25, 4, May 25, 4, September 25, 4, Jan 26, 4, May 25, 3. 4 6 24 plus 3, 27 approx. Plus what about model test papers? 8. You know model test papers? 8 model test papers were there. In that only 2 papers, empty model test paper in audit 3. That is something has new questions. So if you just just verify this itself is having 25 plus resources. First you finish that. Then think about number 23. Our students they won't think about this is the problem. So first finish this. Then you go back and then see the remaining. Okay. I hope I gave the answer, a solid answer. Okay, 25 plus resources you have. If at all you are writing September 26 attempt, another 3 more will add. If you are writing Jan 27 attempt, another 4 more will add. Every attempt you are increasing, 4 resources newly being added. How many MCQs were there? MCQ booklet is there. And many students participate in MCQ discussion in Telegram groups. First boycott that. Those MCQs are worst MCQs. Useless. You see that MCQ and MTP MCQ. First you solve MTP MCQ. You solve MTP. I told you these 25 resources are there, no? 25 into 15. How many MCQs? It will be close to 400. 350 to 400. These resources. Remove duplications. 100 you remove. 300 MCQs you can solve unique. See the scale at which you have resources. So you don't have to worry. Fine. So that's it. That's regarding opinion discussion. Clear everyone? How opinion paragraph has to be drafted, how basis for opinion will be drafted, like that. In one of the exam previously, they have asked this question. What are the points that we need to make statements in basis for opinion? Basis for opinion, what points we should say? State that audit is conducted as per standards on auditing. Refer to the section which contains auditor responsibility. Statement that auditor is independent. And state that auditor obtained sufficient appropriate. Correct? These are the statements you should generally make in basis for opinion. Suppose if you are giving disclaimer, don't mention these statements. That's it. In Jan 25, what question they asked? If you are giving disclaimer, what statements you should not mention? That only. So in that, they only mentioned about this point and this point. 2 points only they mentioned. But actually, I'm telling you, there are 4 or 5 points which you should not mention technically. Clear? Apart from this, in one more exam, they asked one more question. Okay, right now we understood basis for opinion section. Correct? Like what are the pairs that we understood till now? What are the pairs that we understood till now? Title, addressee, opinion, basis. Are you confident until now? Now let's understand auditor responsibility section. Auditor responsibility section. Look at how auditor responsibility section looks like. In Reliance company itself, I will show you. What are auditor responsibility section? Auditor responsibilities for audit of financial statements. Auditor responsibilities for audit of financial statements. Shall we do one thing? I'll just hold it for 5 minutes, because once the power is back, I'll take. Okay? Because you are just sitting only. I'm working hard. Okay? So I'll just take 5 minutes break, and then we'll see the power. Once power comes, we'll resume the session. Okay? In the meantime, what you do? Yeah, just revise it. Slow. Okay? Yeah, keep the fans on. Just revise it. Yeah, let's continue the discussion. Auditor responsibility section we are discussing, right? Now look at auditor responsibility section. What points were there here? I will just briefly explain you. So our objective is to obtain reasonable assurance whether financials are free from MMS. Reasonable assurance is a high level of assurance but not a guarantee. Yes or no? Misstatements can arise from fraud or error. As a part of audit, in accordance with standards, we exercise judgment, maintain skepticism. We also do risk assessment, get an understanding of internal control, appropriateness of accounting policies, going concern basis. These are the various responsibilities which auditor fulfills. He will do internal control evaluation, he will do risk assessment, he will do going concern evaluation, he will do accounting policies appropriateness, and he will also verify overall presentation structure content of the financials. This is in case of fair presentation framework. In case of fair presentation framework, the auditor has to verify this. Then materiality, meaning they are telling you. Then here they also talk about communication responsibilities. If you observe the auditor responsibilities section, it has 3 parts. 1, where we originally explained primary responsibilities. 2, additional responsibilities under various standards on auditing. 3, communication responsibilities. So what are auditor responsibilities? Primary responsibility to give an opinion whether financials are free from MMS, reasonable assurance. This is primary responsibility, right? Then additional responsibilities under various SCAs. I need to do risk assessment, I need to evaluate going concern, I need to evaluate appropriateness of accounting policies, yes or no, and we need to check fair presentation. These are all additional responsibilities. Communication responsibilities as per 260, 265. SA 260, 265. So all that they are talking. Now you see in your book also it is there. So what are auditor responsibilities? We have given auditor responsibility section. First you should talk about primary responsibility. Then you should talk about additional responsibility. Then you will explain about communication responsibility. Now where these responsibilities will be mentioned in the audit report. Okay, so generally within the audit report itself we will mention auditor responsibilities. Where do we describe in audit report? In the audit report only. Or you can even give it as an appendix, as an attachment, as an annexure you can give it if you want to explain, because auditor responsibility is so big, no, one of the big section. The section is so lengthy. So if you don't want to give within the body of audit report, you can attach it. Put audit responsibility section, refer annexure 1. You can refer it. Or third option, if permitted by law, you can give official website link of a lawmaker. Suppose if in any law or regulation, auditor responsibilities were listed, and these are publicly available on a particular government oriented website, government website, you can refer to that website link. So people can refer there. In India, we are following within the body of audit report. Just now I showed you Reliance auditors report where they give within the audit report itself. In one of the attempt, they have asked this as a 5 marks question. What is the location of description of auditor responsibilities? This question has been asked once. Now you see how big responsibilities. But when you are giving disclaimer of opinion, if at all we are expressing disclaimer of opinion, auditor responsibilities need not be this lengthy. When you are giving disclaimer of opinion, auditor responsibility section will be redrafted. We won't give this big. See, I want to know how you do the audit, basis for opinion. I want to know what are your responsibilities when you actually have done your job. Disclaimer of opinion means what? You didn't do audit. Then tell me, what is the point of knowing your responsibilities? That's why when we are giving disclaimer of opinion, when the auditor is explaining, when the auditor is expressing disclaimer of opinion, auditor responsibility section will be changed. Look at now auditor responsibility section in case of disclaimer of opinion. In case of disclaimer of opinion, how auditor responsibility section. You see auditor responsibility section so small. It is very small. You look at. So auditor responsibility, our responsibility is to conduct audit. However, because of matter described in basis per disclaimer of opinion section of our report, we were not able to obtain sufficient appropriate evidence to provide an opinion. By the way, we are independent of the company. See, we are not giving opinion, right? Don't think we are not giving opinion because we don't have independence. No, we are independent. We are not giving opinion because of matter described in basis per disclaimer of opinion. Please go and refer there. I am still independent of the company. We complied with the code of ethics, everything. Generally, we are independent of the company. We comply with code of ethics. This point, where do we mention? Basis for opinion section we mention. But now when we are giving disclaimer of opinion, we are mentioning the same point under auditor responsibility section. In one of the exam, long back, this was asked long back, okay? So this question has been tested. Write about auditor responsibility section. What points will be included in auditor responsibility section if the auditor has expressed disclaimer of opinion? Look, this question is different. This question is different. Be careful. What is this question? If auditor is giving disclaimer of opinion, what points he should not include in basis for disclaimer of opinion section? Basis for opinion section, is that right? When you are giving disclaimer, which points you should not include? Then you should not include these points. And auditor responsibility section will also be modified when you are giving disclaimer of opinion. How it gets modified? So when you are giving disclaimer, the auditor shall amend auditor responsibility to include only a statement that auditor is responsible to conduct audit as per SCA, a statement that because of the matters described in basis per disclaimer, we could not obtain sufficient, a statement on independence and other ethical responsibilities. Further, when you are giving disclaimer of opinion, key audit matters shall not be included. I hope you know key audit matter is prohibited in case of disclaimer. Simple reason why. I am giving disclaimer of opinion because I did not do audit. When I did not conduct audit substantially, where is the question of important audit matter? What is key audit matter? Important audit matter. Audit matter means what? The matters which are there in the audit, which I conducted. Disclaimer of opinion I am giving because I didn't do the audit. Why I didn't do the audit? Evidence is not available. That reason I already told. Yes or no? Since I did not do the audit, there is no question of disclaimer of opinion. Clear, everyone? Since I didn't do the audit, we give disclaimer. There is no question of key audit matter because I didn't do the audit. Anyhow, what is key audit matter? Why it is prohibited? We'll discuss when I'm discussing KM section. Clear? Easy until now? Now, next. So that is auditor responsibility section. So that's it. Auditor responsibility section is over, right? And other information also, I will put it in green because we don't have this in CA Inter. 720 standard we do not have in CA Inter. Okay, so that para also I will make it as complete. Then we have emphasis of matter para. By the way, responsibilities of management. You remember preconditions to audit? Same only will be there in audit report. Management is responsible for preparation of financial statements as per applicable financial reporting framework. They are responsible for designing and implementing internal control system, like that we mentioned so many. Then emphasis of matter, other matter para. Okay, let's now discuss emphasis of matter and other matter para. You know what is an emphasis of matter paragraph? Yes, this is very old audit report of Air India, somewhere belonging to 1819 year. or 1920 year. Air India's audit report of 1920. Okay. So later on, there are many companies which I saw where there is no emphasis of matter paragraph example. So this is very best example. Air India audit report is the best example to discuss about emphasis of matter para, going concern, MURGC para, and of course they have given qualified opinion here. Okay, that one. Look at this emphasis of matter para. You know what is, you know how many pages Air India audit report, you know? I'll just show you the index. I'll show you. So look at the financial statements of Air India. The financial statements, you know, balance sheet with this, you know, financial statement starts 112 page. Okay. And almost notes to accounts, everything will go up to close to 117, and of course up to 200 probably. It will go up to 100 pages. The notes to accounts of Air India will be how many pages, you know? 100. Again, consolidated financials were there. Again, consolidated financial statements related notes to accounts will be some 150 pages. First of all, tell me, does auditor has to read? Does auditor has to cover complete, you know, notes to accounts? Does he has to read entire notes, or can he read on sample basis? Notes to accounts and financial statements, tell me. 100% you should read. I'm not asking how much to audit. I'm asking, should he read entire balance sheet, P&L, cash flow, notes? Can he do sampling reading? Exactly. You're signing that. You should at least read whether accounting policies, whether accounting standard, whether Ind AS, Schedule 3, disclosure requirements, satisfied or not, presentation and disclosure of financial statements, 100% we should cover. So definitely, when we are reading the entire notes to accounts, we would have definitely come across some note points which are very important. Actually, are they free from MMS? Yes, they are free from MMS. No mistakes at all. For example, company has contingent liability. There are so many contingent liabilities which company has. List of all contingent liabilities they identified and kept at one place. I want every shareholder to read this. But it is somewhere in note number 55. Notes to account is 100 pages. 55th note point, contingent liabilities information is there. Or some pending litigation related information is there. I want every shareholder to read this particular point. How should I do? How should I tell them? First of all, if I have to highlight that point, nothing but I just want to highlight it. Okay, there are two ways to highlight. I will ask Air India management, open each and every notes to accounts, highlight with highlighter and then send it. This is one option. Okay, but still there is no guarantee that they will open and read. Even there is no guarantee that audit report will be read. Who will read audit report? Nobody. Do you and me only think audit report will be read by everyone? No. Shareholders will not read. They only go with stock market dynamics and then they just see if any qualification or adverse remark is there, if some sensitive remark is there, stock market analyst and all, everybody will alert people. But if nothing is there in audit report, technically I'll tell you honestly, audit report is most useless document. In reality. Only when auditor gave an adverse opinion, only when he gave a disclaimer of opinion, it becomes most important document. What opinion auditor gave? Are unqualified, obviously expected only. Why do we give unqualified opinion, you know? Because we can't give adverse opinion. You want to give adverse opinion, try your best. Management is challenging you. You try your best to give adverse opinion. Try to give adverse opinion, you should show substantial misstatement. First you should find no. Do you understand? So we end up giving unqualified opinion, not by choice, because we don't have a chance to give adverse opinion. You know audit risk concept? What is audit risk? Risk of expressing an inappropriate opinion when the financial statements are materially misstated. When the financials are materially misstated, you giving inappropriate opinion means you giving a positive opinion. Financials are materially misstated. That's there you should give negative opinion. But you are inappropriately giving positive opinion. That is risk for us. So audit risk definition, you see, when the financial statements are materially misstated, you are giving inappropriately some opinion. What is inappropriate there? Tell me, when financials are materially misstated, what is appropriate there? Negative opinion. Inappropriately what you are giving? Exactly. That's how meaning comes. If you are giving positive opinion on the financials which are materially misstated, that's audit risk. not vice versa. Financials are not free from, they're free from MMS, means there are no mistakes at all. Still you are giving a negative opinion. That's not a risk. When you give a positive opinion, you have a risk. Suppose I gave adverse opinion, zero risk. Why? I gave adverse opinion, still you invested in the company. Okay, ignoring my audit report. Tomorrow you lost money. Can you come and blame me? I told already that they are not true and fair. Adverse opinion means what? I told already that they are not true and fair. What else you can question me? Suppose if I give positive opinion, then you will come and question me. Mr. Auditor, I believed you. You gave a positive opinion. So I invested in the company. Now I lost the money. I want your explanation. They can demand at least. Do you understand where the risk is? That's why audit risk definition is drafted like that. Able to understand? Fine. So the point is, the notes to accounts, the financial statements of any company you take, it will be 70 pages, 100 pages, 150 pages, like that. The financial statements will be like 100 and above pages. I definitely know no shareholder will read 100 pages. But there are some important points which are there in that. I want everybody to read that. How can I make sure they will read that? Emphasize it, highlight it. That's called emphasis of matter para. Look at the emphasis of matter para definition. It's a paragraph in the audit report that refers to a matter. It's a paragraph in the audit report that refers to a matter appropriately presented or disclosed in the financial statement, which in auditor's professional judgment were of most significant for the users of financial statements. Look at EOMP. It's a paragraph in the audit report referring to a matter presented or disclosed in financials in the auditor's judgment is important for users' fundamental understanding of financial statements. It is fundamental to the users to understand financials. Who felt it is fundamental to the users? Auditor felt. So you please refer. Emphasis of matter para is a para in the audit report that refers to a matter presented or disclosed in financials. So if some important matter that is there in financial statements, which is important for the user, then you can highlight it through emphasis of matter para. Remember, you can highlight it only when that matter is appropriately presented. Appropriately means what? Rightly or wrongly? Correctly, rightly presented. Suppose I want to highlight note number 55, contingent liabilities. With regard to contingent liability, there should not be a misstatement. There should not be a misstatement. Only when the contingent liability data is correctly presented, true and fairly presented, you can highlight it under emphasis of matter para. Otherwise, you can't. Able to understand? That's why, what are the conditions? Conditions for usage of emphasis. You can use provided emphasis of matter paragraph can be used for a particular matter. Emphasis of matter paragraph can be used for a particular matter only when the auditor is not required to modify the opinion on such matter. Only when you don't have to modify the opinion on that matter, emphasis of matter can be used. On that matter, you should not have a modified opinion. Nothing but what? On that matter, your opinion is what? Unmodified on that issue. For example, we saw one illustration, inventory materially misstated. Can I highlight that in emphasis of matter para? No. Why? Because inventory is materially misstated. Next, and the matter is not decided as a key audit matter. Okay. Now look at emphasis of matter paragraph is not a substitute for modified opinion. See, if a matter is materially misstated, don't be clever. Qualify or give an adverse opinion on that. You can't cleverly highlight that in emphasis of matter para and say, I brought this issue to everybody's attention. No. Emphasis of matter para can be used only to emphasize. That too, what you can emphasize? Only something that is free from MMS. For that, you should have evidence for it. Yes or no? And emphasis of matter paragraph is not a substitute for disclosure in the financials. Emphasis of matter paragraph is not a substitute for MURGC para as per 570. It is not a substitute for modified opinion, not a substitute for disclosure, not a substitute for MURGC reporting as per 570. Then what is emphasis? Simple, highlight important point which is truly, which is fairly, which is appropriately presented or disclosed in the financial statements. That's emphasis. Now tell me, how did Air India presented here emphasis of matter para? How did Air India presented emphasis of matter para? Look at emphasis of matter para, how they presented. They put a separate heading called emphasis of matter. Correct? Huh? You see? So just like opinion para, just like opinion headings, yes or no? Emphasis of matter para also separate section they gave. And they are drawing attention to a specific note point in the financials. Correct? Huh? Then at the end of the para, what are they mentioning? At the end of the para, our opinion is not modified. People might think, Arey, why auditor is highlighting note number 26? Why is he highlighting note number? Is there any issue with that? No, I don't have any issue. Then why are you highlighting? Heading, you see, emphasis. I'm just highlighting because they're important for your decision making. Please go and read. I know 100 pages of the notes. I know you will not read. At least read these points. Are you clear? Tell me, is this para compulsory to use? It's auditor's judgment. It's auditor's professional. That's why you see Reliance audit report, there is no emphasis of matter para. You see latest Air India audit report, there is no emphasis of matter para. You see 1928 India audit report, there are so many points which they highlighted. Do you understand emphasis of matter para? Now what is the manner of presentation? In the last attempt or that before attempt, this was tested. What is the manner of presentation? What is manner of presentation? Include the para in a separate section. Yes or no? With a heading, emphasis of matter. Clearly express the matter and give a reference to the disclosure. Did Air India give, are they giving reference to the disclosure in the financials? Note number 26, note number 29. And state that opinion is not modified. At the end of the para, our opinion is not modified. That's it. Able to understand? So whatever is there in the book exactly is followed. Correct? Next. Now let's look at other matter para. Other matter para. What is other matter paragraph? I will give a classic example, which is a constant, same example I use every time. SBI, State Bank of India. First of all, what is other matter para? It is also a para in the auditor report. This is also para in the audit report that refers to matter not presented, not disclosed in financials. Okay, you want to talk about any other matter, but that matter is not discussed in, that matter is not there in financials. See, if you want to highlight about what is there in financials, highlight it through emphasis. You want to talk about something else that is not presented, not disclosed in financials, but something else you want to talk. What is that something else? About audit you want to talk, about auditor responsibilities you want to talk, or about auditor's report you want to talk. If you want to talk about audit, auditor responsibilities, auditor's report, you want to talk about these three, then explain them in other matter paragraph. Explain them in what paragraph? Other matter paragraph. Now look at, so how other matter paragraph can be used. You take this example, State Bank of India Limited, simple example, State Bank of India Limited. So this is a banking company, okay, which has multiple subsidiaries, You know Reliance Industries Limited? Okay, fine. SBI Limited, okay? It has subsidiary companies, associate companies, joint ventures. This SBI Limited also has branches. 24,000 branches they have across India. Subsidiary companies also, some 50 plus subsidiary companies, associates, joint ventures and all were there. Now this SBI will prepare two sets of financials. One, consolidated financials. Another one, standalone financials. Standalone financials is nothing but what? Head office of SBI plus 24,000 branches put together is what we call them as standalone financials. Am I right? This is also called as branch consolidation. This is also called as what? Branch consolidation, but not consolidation as per accounting standard 21. This is not that consolidation, correct? This is called combined financials of the entire bank. Now what is consolidated financials? Holding company financials plus subsidiary company financials. Entirely if you combine it, associate, joint venture, everything you consolidate it, then those financials are called as what? Consolidated financials. And you know what? You take Reliance. Reliance also prepared two sets. One is consolidated financials and standalone. You know, Reliance consolidated financials is a consolidation of 500 companies. 500 group companies put together. Reliance has totally 480 plus companies, subsidiaries, associates, joint venture, and the holding companies RIL. So consolidated financials of Reliance is nothing but the output of close to 500 companies. Close to 500 companies got consolidated and a single balance sheet, single P&L arrived. Understood? Now, in this, the question is, SBI Limited itself you take. Okay? Standalone financials you take. You know, first of all, there is an auditor called Mr. P. Principal auditor. We call him as what? Principal auditor. Mr. P. Who is a principal? Nothing but he is the entire SBI auditor. Now, standalone financials are nothing but what? Head office plus branches. This head office is audited by P only. In fact, P is the auditor for the entire bank. And this bank is preparing consolidated financials and standalone financials. P has to give an audit report on consolidated. P has to give an audit report on standalone, both. He should only give audit report on both. And that audit report only goes to the public. But he didn't do the entire audit. He did not do the entire audit. Now these branches, 24,000 branches were there, right? These branches were audited by branch auditors. These auditors were audited by, these branches were audited by branch auditors. Same way, he is giving an audit report on consolidated financials as a whole. But in this, holding company is there, subsidiary company is there. Subsidiary companies, P did not audit. Subsidiary companies were audited by those company auditors. Branches were audited by those branch auditors. But overall audit report on standalone financials, P has to give. Overall audit report on consolidated financials, P only has to give. And his audit report is only given to the public. What public will think? P only audited entire consolidated financials and all the companies. P only audited the head office as well as 24,000 branches. People think like that. Am I right? But actually, he did not audit branches. He did not audit subsidiary companies. He should tell this fact to the public, no. Okay, you didn't audit, no. Then how did you give your opinion? Without auditing 24,000 branches, how did you give an audit report then without auditing? No, I didn't audit. Some others have audited. Okay, they audited fine. But how did you give the opinion? I gave my opinion on the overall bank by using their audit reports. You know, head office, true and fair. Branches, branch auditors are saying true and fair. Mine is true and fair, theirs is true and fair. Merged, true and fair. Not true and fair square. Okay, so I felt head office, I audited, it's true and fair. Branches, they said it is true and fair. So we both together concluded overall State Bank of India financials are true and fair. So I gave opinion, but people think I verified everything and I concluded true and fair. No, it is concluded by branch auditors. Their audit reports were given to me. Based on those audit reports, I concluded overall financials are also true and fair. Tomorrow if something goes wrong in the branch, I am not answerable. You go and ask them. They are also stat auditors only. Not just like me, they're stat auditors. Just that my scope is entire company. Their scope is branches. I should show the division of responsibility like this, right? Here there is a division of responsibility, right? Where do I show it? Other matter para. You see other matter paragraph definition? Other matter paragraph is a paragraph in the auditor report that refers to a matter other than presented or disclosed in financial statement which in auditor's professional judgment were important for the users to understand auditor responsibility, auditor report. What is the second term? Auditor responsibilities. To make users understand auditor responsibilities, I can use which para? Other matter para. That's it. Do you understand example? You're able to understand the context behind it? That's it. Okay. So auditor responsibilities, if I have to make them understand, that's it. Now immediately you might get this doubt. Sir, what if branch auditors give negative opinion? What to do? That's there in CA final. We don't have 600 standard in our syllabus. That's there in CA final. Okay. So now regarding the branch audit, we have some discussion in our syllabus regarding branch audit. Some discussion is there. Look at. See, SA 600, some discussion is there. This standard fully we don't have. Only part of it we have. Okay. SA 600. Now who is the principal auditor? Tell me in our example who is principal auditor? Mr. P. Who is the auditor for the entire SBI Limited? Correct? SBI Limited, which includes the financial statements of SBI includes financial information audited by P and financial information audited by other auditors, nothing but. You know, SA 600 heading is what? Using the work of another auditor. Are you getting it? Other auditor means what? Branch auditor. For standalone financials. For consolidated financials, other auditor means subsidiary auditor, associate auditor, joint venture auditor. Do you understand? Now, from standalone point of view, branch is a component. Agreed? Branch is a component. Hello? From consolidation point of view, subsidiary company is a component. Can I say that? Who is other auditor? Component auditor. Who is other auditor? Component auditor. So look at other auditor definition. Other auditor, the auditor responsible for component financial information which is included in financial information audited by principal auditor. What is a component? A component can be division or branch, or component can be subsidiary, joint venture, other. So division or branch is from standalone financials, subsidiary is from consolidated financials. That is a point of view. Are you clear? So now component is nothing but a division or branch from standalone point of view, subsidiary, joint venture, other entity from consolidation point of view. This financial information is included in financial information audited by principal auditor. How the definitions were drafted, you see. Who is principal auditor? He is the auditor responsible for entity, not component. He is responsible for entity, financial information, which includes financial information audited by other auditor. Who is other auditor? He is an auditor responsible for component financial information, which is included in financial information audited by principal auditor. That's how it is drafted. Now, with respect to this, what are principal audit procedure? Principal auditor, no, simple. How principal auditor, SA 600 says, if branches are audited by other auditor, there should be clear understanding of their roles and effective coordination. So SA 600 gives guidance to principal auditor. If this question comes, till now they didn't ask, a 4 marks question can come. What are principal audit procedure? Simple. Principal auditor, what he need to do? He should inform other auditor how their work will be used. Inform other auditor areas require special consideration. I will tell other auditor, sir, please focus on this area, please focus on that area. I will review findings of other auditor. I will review procedures which he performed. If at all I want to review, I can review what other auditor did, and I can perform additional procedure based on circumstance. If necessary, I can even go and meet the other auditor. How much I will do this procedure, to what extent I will do this procedure, it depends upon circumstances, knowledge of competence of other auditor. How much according to me he is knowledgeable, other auditor, that decides to what extent I will monitor him. Generally, if other auditor is a chartered accountant with COP, I don't have to worry about it. I will not do all this. Sir, you directly give me audit report, fine, I'll take care. But if other auditor is not a CA, like how come, sir? Branch should also be audited by CA only, no? Who should be the branch auditor? Branch auditor can be company auditor, or branch auditor can be another qualified chartered accountant, or in case if the branch is outside India, the branch auditor can be the company auditor himself, or another CA you can appoint, or a person qualified as per law of that country. Suppose I have a foreign branch. The company where I am doing audit, no, it has a foreign branch. Now that foreign branch can be audited by a non-CA. Now if at all is a non-CA, to what extent I will review that branch audit, how he did branch audit, I will review more. If he's a CA, I will not review, because anyhow we know division of responsibility is there. His area, he is only responsible. My area, I am only responsible. Maybe like simple, I believe his report and then form my overall opinion. Just like how public will use my report and form their conclusion on the company. Just like public, how they will use my audit report and take a decision on the company. Same way, I will use branch audit report and take a decision on the overall company. If branch auditor colluded with management and did cheating, he is only answerable, I am not answerable. All I have to do is what? I need to prove I complied with all auditing standards. If I am able to prove that I did audit as per auditing standards, nobody can touch me. Clear? Everyone. So that's other matter paragraph. So when other matter paragraph can be used? So other matter paragraph will be used, first of all, other matter paragraph will be used first of all only when there is no prohibition in the law, and only when the matter is not decided as a key audit matter. Other matter paragraph will also be kept in separate section with a heading called other matter. Correct? Huh? That's it, over. 706 standard is over. Hello? One of the example I told. By the way, in other matter paragraph, there are 3 terms. So other matter paragraph is a paragraph which is used in the audit report that refers to a matter other than. Actually here instead of not know, you can use the word other than. Other than presented or disclosed in financial, but this information which I want to talk about, no, it is relevant for understanding of not financials. I don't want them to understand about financials. I want them to understand about audit. I want them to understand about auditor responsibility. I want them to understand about auditor report. For example, auditor report. You know joint audit? Joint audit. I'll discuss joint audit also right away. Okay. SA 299, joint audit of financial statements. By the way, right now we have completed 4 standards. 700, forming of an opinion and reporting on financial statements. 705, modifications to the opinion in the independent auditor's report. Modifications to the opinion in the independent auditor's report. 706, emphasis of matter para, other matter para in the independent audit report. Yes or no? Then 299, joint audit of financial statements. You might have seen one point. A joint auditor is not bound by majority. If a joint auditor has a disagreement, he can give his own audit report. Remaining joint auditors will give their own audit report. That time they should cross-refer. This joint auditor should give a reference to their audit report. Those joint auditors should also give a reference to this audit report. Where do they give reference? Other matter para. So in other matter paragraph, I will tell joint auditors 11. For example, State Bank of India has 12 joint auditors. How many? 12. As per latest financial year, they have 11 joint auditors. 11 auditors they have. So, okay. 11 joint auditors which are principal auditors. Who are principal auditors? Okay. 11 auditors were there. So when joint auditors were appointed, what the standard is actually dealing with? The standard is giving guidance. When joint auditors were appointed, how the joint auditors has to coordinate with each other. The guidance is given under 299 technically. First of all, tell me, is joint audit compulsory under Companies Act? No. There is no discussion about joint audit anywhere in the Companies Act. Only at one place. Rotation of auditors provision is there, right? 139 subsection 2. There one explanation was given. If shareholders want to resolve, if shareholders decided, they can appoint an auditor more than one. They can appoint more than one auditor. This point indirectly hinted the concept of joint audit under Companies Act. But in Companies Act is silent technically. Technically speaking, Companies Act is silent. I don't know how many of you know, now Companies new bill has been passed in 2026. It's not act replacement, don't worry. It was an amendment act. Companies Amendment Act, okay, 2026. One of the, I can say, historical milestone for the Companies Act 2013, where close to 100 sections are going to be amended. Close to 100 sections are going to be amended. This is not something first time happening. In 2002, when old Companies Act of 1956 was there, in 2002 also historical amendment happened. Substantial Companies Act has been amended because of SOX Act in US. Because of something called Sarbanes-Oxley Act passed in US. In 2002 in India, Competition Act was brought. FEMA Act has been regulated. So many changes were there. FERAR, so many changes were there. Companies Act, so many changes were there. That is one big incident for even proposal of LLP. So 2002 one historical amendment happened. Later in 2013, Act itself is replaced. For the first time, major amendments were made to the Companies Act 2013 is through Companies Amendment Act 2026. So the bill is passed. I think bill is introduced. I think now it will be passed very soon. Okay, winter sessions will be there, probably there. So that's it. So Companies Amendment. One of the major amendment I'll tell you, some companies audit will be exempted. Some companies audit will be exempted. I always tell in the class from almost 5 years I'm telling why audit is required for private companies. It's useless. What's the point of audit for private company? Me and my friend started business, a restaurant, roadside restaurant. Yes or no? We can run it without any registration, right? GST I will take it. Labor license I will take it. Why should I take company? Tell me what's the advantage of company? Tell me. Separate legal entity, don't take all this example. Okay. Substance over form. Lifting corporate will. Directors have full responsibility. Yes or no? So when two of us are doing business, I have an option. I can register under Partnership Act. I can register under LLP Act. I can register under Companies Act. Anywhere I can register. Or I can even register. I can do business without registration also. Who will stop me? I will register as an AOP. AOP means what? An association which does not register anywhere. If an association registered under Companies Act, that's a company. If an association registered in Partnership Act, that's a partnership form. If an association registers in LLP, that's an LLP. So I don't have to have company, right? By mistake, because some CA told me, I incorporated as a company. Company means what? Taking certificate of. That's it. Business is same place, same location, no change. Same, that restaurant, the person will wear a baniyan and then put those, same only. Yes or no? He'll not, there is no change, Company means what? Basically, piece of paper. You register your business with ROC and you get a certificate of registration. That's company. 12,000 rupees, maybe 20,000 rupees if you have, you can get a company in your name. You can be a CEO of the company overnight. That company business will not be there, no? Fine, anyhow. So that's it. Now tell me, why audit? Audit is compulsory, 139. Why audit is compulsory? Nothing. There is no reason. Because you are a company, audit is compulsory. That's why, see, people are hesitant to register under Companies Act because of these many regulations, these many compliances. Appa, I don't want Companies Act. I'll happily do business without a company. No. Please come and register company. It will be helpful for the country. Transparency will be there in the company. That's the reason small company definition has been introduced. Small company, why they put? So that to encourage more people to register as company. Hello, you come, I'll give you small company status. And what is the advantage of that status? I will give you some benefits, relaxations. You don't have to comply with these many rules and regulations like other companies. So you come and register. First of all, why government want people to register under Companies Act? First of all, why government? It's an administrative law. It's not a revenue law. Is Companies Act administrative, regulatory law or revenue law? Regulatory. Yes or no? You should understand like this. Fine, enough. Okay. I hope you got an idea. So Companies Act is basically an administrative law. Big change that is happening. So it's not compulsory for us to register as a company unless you want to go for public issue. You want to raise money from the public, then there is only one way you can raise money, by incorporating company, that to public limited company, then by having a proper prospectus, then you can go for public issue after complying with SEBI regulations. If at all you don't want to go for public money, me and my friend, we both want to do business with limited capital. I don't need a company registration first of all. I don't even need a partnership registration. I don't even need an LLP registration. But tomorrow if both of us have a dispute, how to resolve it? For that reason only we want a registration. Even with AOP, if there is an agreement, courts will take up the case. You don't have to register under partnership law like you studied in foundation or degree. Understood? That's it. This is reality. But what happens if companies' audits were removed? Opportunities will reduce. But don't worry. In India, the business is not happening. The practice, if you see the practice, Big Four and all, if you see, I even made one video already on that. A reel is made already. I made a reel. Big Four, Deloitte, PwC, KPMG. For example, you take Deloitte. They have turnover close to 12 to 15,000 crore in India. 12 to 15,000 crore, their turnover annually in India. 70% of the turnover comes from non-audit services, not audit. They get it from consultancy. 30% of their turnover only comes from statutory audit, tax audit, like that. So if audit is removed, nothing to worry, because that's a very minor portion of revenue. Anyhow, once you reach final, you just follow my channel regularly. I'll just tell you how to develop the practice, everything. In all holistic dimension, I'm giving guidance already. I started doing all that. So you can just get that guidance, how to build business, how to, develop practice if at all you want to come into practice. And if you want to go into job, what kind of skills and what sort of skills are required. I'm already doing a couple of videos. Already I'm posting it. I'll also post further. Okay. Fine. By the way, understood this? 706 over. 299. 299 we are discussing. Okay. 299, what is it? Joint audit of financial. So the joint audit is not, first of all, joint audit is not compulsory under Companies Act, first of all. Now, yeah. So what the standard gives? The standard is giving guidance on how joint auditors have to work. Predominantly, the standard is talking about two things. Three things actually. One, responsibility of joint auditor. Two, coordination among joint auditor. Three, reporting by joint auditor. Then there is another topic there, special considerations in joint audit. 4 topics were there in this particular standard. Responsibility. By default, joint auditors have divisible responsibility, separate responsibility. Yes or no? Joint auditors, know how they do work, how joint auditors do the work. SBA has 12 auditors, right? How they do the work, South zone related administrative affairs, you take care. East, they will take care. West, they will take care. North, they will take care. Like that, joint auditors divide the work between themselves based on assets and liabilities, based on period, based on units, okay, based on items of financials. So on any basis, they will divide based on geographical location. They divide the work and then do it. The very reason why joint auditors were appointed is to reduce the work burden. It is not like first auditor will go do entire audit and come back, then second auditor will go do entire audit and come back, then third auditor. No, that's not how joint audit happens. Joint audit happens by division of work, dividing the entire work into multiple parts, and joint auditors will take some parts of it. And each joint auditor is responsible, answerable only for the work allocated to him. He is not answerable, he is not responsible for the remaining work performed by other joint auditor. For example, Reliance company has 2 joint auditors. I verified purchases and expenses. Other joint auditor verified incomes and sales. He said everything is true and fair. I conclude everything is true and fair. Both of us put together gave a common report saying everything is true and fair. Tomorrow if in income point some fraud was discovered, he is only answerable, not me. You can question me, but I will tell you, go and ask him, because he did that work. Able to understand? Division of responsibility will be there in joint audit. However, in certain areas, division of responsibility will not be there. In certain areas, division of responsibility will not be there. What are the areas where joint responsibilities will be there? Many times this question got tested. In joint audit, one of the most frequently tested question is responsibilities of joint auditor. So where and all combined responsibility? When the work is not divided, or decisions were taken collectively on common area, or it is a matter which all joint auditors know it and all of them has agreed upon that. It's a matter of fact which is aware of by all the joint auditors and all of them agreed upon it, and later it was found to be a fraud. Then everyone is answerable equally. And ensuring financials comply with statutory requirement. Every joint auditor has to check whether, see, tell me, notes to accounts, you verify 10 pages, you verify 10 pages, you verify 10 pages. Can I give like that? No, it's impossible. How can you split balance sheet P&L? So every joint auditor has to verify entire financials. Yes or no? So for ensuring whether financials are prepared as per applicable framework, for verifying presentation disclosure as per applicable, so which means presentation and disclosures in the financials, all the joint auditors combinedly responsible. Whether financials are prepared as per applicable law, regulation, all the joint auditors are combinedly responsible. And for ensuring audit report complies with relevant statute. You know, in joint audit, all the auditors together give a common audit report. When they are giving a common audit report, all of them has to ensure whether the audit report is as per the law, as per applicable standard, yes or no? Suppose no, one of the joint auditors just simply signed the audit report. He didn't verify how the audit report format was. Another joint auditor copy pasted last year audit report and then changed the dates. This is what happens generally. They just copy pasted last year audit report and then changed the dates. Some mistakes happened in the audit report. Now department is asking, yes or no? I mean, so let us assume NFRA is asking, what Mr. Joint Audit, what you did when this mistake is there? No sir, I just signed it. He is only responsible for audit report. You can't, you signed it. So for financial statements and audit report, all of them are combinedly responsible. So audit reporting. What is audit reporting in case of joint audit? First of all, generally all joint auditors give a single audit report where they will have a common conclusion and they will also have a common opinion. However, a joint auditor is not bound by majority. In case of difference of opinion, disagreeing auditor can issue separate report. In such a case, each joint auditor should refer to other joint auditors report in other matter paragraph. Do you understand? So other matter paragraph audit report, one more example. Coordination, how they should coordinate. When I am doing my work, no, if I come across any important matter that is relevant to another joint auditor, I should communicate him. Same way, he should communicate me. By the way, he has performed his work. Sales audit he is doing, I am doing purchase audit. Whether he did sales audit correctly or not, should I verify? No need. A joint auditor is eligible. A joint auditor can rely upon the work performed by other joint auditor. Need not review the work. Why? If something goes wrong tomorrow, he is only answerable. Why you have to worry? Yes or no? The very reason we appointed joint auditor is to reduce the work burden. And again, now if you are reviewing each other work, then what is the point of joint audit then? Correct? Huh? So each joint auditor can rely on work of the other joint auditor and not required to review the other joint auditor. And if any matter is identified that affects the work of other joint auditor, it must be communicated to them before the audit report. Obviously, common sense. After audit report is given, what is the point of communicating them? You should communicate them before audit report is finalized. Correct? Huh? Then what are special considerations under 299? Simple. You know, SBI 11 auditors were there, no? from all the 11 audit firms, one person will be signing audit report. No, we call him as what? Signing partner, engagement partner. We call him as what? Engagement partner. So engagement partner and important team members from each joint auditor should be involved in planning. Joint auditors must jointly develop strategy. Then they should develop joint audit plan. All of them has to do risk assessment. Joint auditor should discuss and document nature, timing, extent of procedures for common areas, nature, timing, extent of procedures for specific areas. Joint auditors must obtain acknowledgement commonly from the management on engagement letter. In a joint audit, we will not send 11 engagement letters. We will send one engagement letter. Management has to sign and then send it back. And representation letter we get no. As per 580, written representations, no, we get common representations. For respective areas, they get specific representations. For commonly as a whole, common representation we get. And work allocation among joint auditors should be documented and signed. And it must be communicated to those charged with governance. How the work is allocated, entire plan will be there, right? It shall be in writing, it shall be documented, it shall be signed by all 11 auditors, and we shall communicate this to management also, those charged with governance also. That's it. 299 is over. Hello? 706, 299 over. Clear? Got an idea at least? Yeah. That's it. So advantages of joint audit. May 25 attempt they asked this. Nobody predicted. What are the advantages of what? Joint audit? Sharing of expertise, mutual consultation, lower workload, better quality of performance, improved service to the client, healthy competition, encouraging better performance, expertise of local firms helps in dealing with local laws and regulations in case of multinational companies. In case of multinational companies, no, joint auditors, one auditor will be from India, another auditor will be from outside India. Yes or no? That local firm expertise will be helpful for us so that as a whole we can give better opinion. That's it. Disadvantage, fees being shared. No. Generally fees will be higher. In case of joint audit, if one auditor is appointed, 1 lakh is the fee. If 2 auditors were appointed, fees will be 1.8 lakh for both of them put together. It won't be like 1 lakh will be shared between everybody. Psychological issues, when firms of different standings collaborate. Superiority complex, this auditor, nothing, you don't know anything, I know very well. So this kind of superiority complex. Challenges in coordinating work. Risk of neglecting common areas. Uncertainty in the liability for work performed. So who did exactly this work, especially common areas, uncertainty will be there. These are disadvantages. That's it. 299 is over. What is first of all joint audit? 2 or more than 2 auditors. 2 or more than 2 auditors. Auditors can be individual or a firm. So 2 or more than 2 individuals, 2 or more than 2 firms, or 2 or more than individual and firm. So then we call it as what? Joint audit. That's it. Clear everyone? That's it. So with this 706 and 299 is also completed. Now we need to discuss 701 and then 570. Okay. Just 5 minutes. We'll immediately continue. Yeah. Let's continue the discussion. Now if you see, there is one more discussion, 570 and 701. If at all we finish these two, then we have 710. In that brief overview I'll give you clearly. Then we'll go with CARO. This topic will be over. Okay. Now, so 570 topic. First we'll discuss 570. So SA 570, what is the topic? Going concern. Now here in going concern, there is one diagram. So this diagram is very important. Yeah. So fine, look at what is 570 going concern is completely about the standard. By the way, in audit report, the element name is, the section name is MURGC, material uncertainty related to going concern. Okay, that's the heading of that particular section. When that particular section comes into picture, we'll discuss it. But first we will see what exactly 570 is talking about. Management of every enterprise, they have to must and should, especially company I'm talking about, and that too listed company, must and should, they should assess about their going concern. You know, many big companies, they'll have something called risk management committees. Listed companies will have a committee called risk management committee. What is this committee? You will understand that in SPOMA. CA final, self-paced online module A. In that paper you will understand. Okay, so management of every company should do going concern assessment. What is a going concern assessment? I don't know how many of you remember CARO clause number 19. Uncertainty related to liability. Yes or no? Very simple. What is going concern assessment? You know, on balance sheet date, suppose I'm doing audit of 25, 26, 31st March 2026 balance sheet date is there. On that balance, in that balance sheet, there are liabilities, current liabilities. Current liability means what? These are the liabilities which has to be repayable, which has to be repaid within 12 months. They are liable on so and so dates. Within next 12 months, they are liable on so and so. Some are liable in April itself, some are liable in May, some are liable in June, some are liable in December. After March, they are liable. Some are liable within 1 month, within 2 months, within 3 months, but within 12 months. As and when the liability falls due, can the company honor? This is a question. Can the company honor? If the company has ability, to honor next 12 months dues, next 12 months what are all dues company going to incur? If the company has a capacity, if the company has ability to honor, we conclude that going concern is appropriate. We conclude that going concern is appropriate. If the company is unable to honor, if the company is doubtful to honor, then we conclude that there is a significant doubt. There is a significant doubt on the entity's ability to continue as a going concern. Able to understand? Then we conclude that there is a doubt on entity's ability to continue as a going concern. If at all in the next 12 months, if they are able to honor, then going concern will be there. Then we assume that going concern is fine. If the company cannot honor, then we assume that going concern is missing. Hello everyone? All of you? Yeah. Why this going concern is important? Only if going concern ability is there, you can take going concern assumption. Only when you have taken going concern assumption, you can show financial statements, you can prepare financial statements on historical cost basis. Only then you show fixed assets at cost minus accumulated depreciation. For example, Reliance Industries is there. Their fixed assets value is some 3.5 lakh crore. If you go and sell them today in the open market, you don't even get 5,000 crore. You don't even get 5,000 crore. Why? Those machines will not be useful for anybody. That's an oil refinery, Jamnagar factory. That's an oil refinery. So what is its open market value? If another refinery want to buy it, then fine, it will have a value. But no refinery has a demand. There is no demand from another refinery. So if I have to sell those assets in open market, it doesn't fetch me. For example, I bought a phone or I bought a car. 10% every year depreciation I am calculating. So first year, let us assume the car price is 10 lakhs. First year depreciation 15%. Then 15,000 I'll remove, and a second year opening value 85,000. But if I sell that car in the open market at the second year, I only get 40-50,000. I mean 4 to 5 lakhs. I may not get, so 10 lakhs minus 15%, 1.5 lakh, 8 lakh 50 is the WDV value. If I want to sell the car immediately right away, I may not get the 8.5 lakh. I may get less than that. But still in the balance sheet we are showing 8.5 lakh. Why? I don't have intention to sell. I don't have intention to sell. The plant and machinery, the buildings, furniture, everything I am showing in the balance sheet at cost minus accumulated depreciation, but not at market values, because we don't have intention to sell. You don't have intention to sell means what? You want to use them further. If you want to use them further, you should be able to run, no? You should be able to run when? Only when you have ability to run. That ability we should check. That's what 570 standard. What 570 says, the auditor has to obtain sufficient appropriate evidence on the entity's ability to continue as a going concern and obtain evidence whether there is any material uncertainty. Yes or no? Then report accordingly. Further, what the standard is saying? First to know who should do this going concern assessment. Primarily management. Ask management whether they did it or not. Sir, management they did, sir. They did going concern assessment. Going concern assessment means what? Whether I can successfully continue my business or not. Management did that assessment and they're very confident that they're successful. Then I'll ask them one question, sir. Are there any events? Are there any conditions? Nothing but, are there any symptoms you identified that may cast significant doubt on the entity's ability to continue as a going concern? I'll ask management, do you identify, you did your assessment, right? You did self-assessment, right? Your ability, going concern ability assessment, right? Have you found any symptoms? Management, I'll ask them. Suppose no, management said, yes sir, identified sir. Identified. Sir, what are the symptoms? Symptoms are named as here events or conditions. What are these events or conditions? Events or conditions that may cast a significant doubt on the entity's ability to continue as a going concern. This sentence is very important. So management identified symptoms. Management identified events or conditions that cast a doubt on going concern ability. They identified. First of all, what are these events and conditions? Three types. Financial events or conditions, operating events or conditions, other events or conditions. In May 25 attempt, one question was tested on this. Financial symptoms they tested. Any 5 financial symptoms or maybe 5 operational symptoms. And any one of this is tested. Look at what are the financial symptoms. For example, company has a net liability position. Company has a net liability position. That's a financial symptom. Negative. Negative. How can you run the business with negative position? Company loans are approaching maturity without any renewal or repayment. I have taken a loan 10 years back. Now I have to pay debenture holders the money. My bank balance is 0. So tell me, how can you pay? Reliance on short-term borrowing for long-term asset. Adverse financial ratios, operating losses, negative cash flows, discontinuation of dividends suddenly, non-compliance with loan terms, unable to pay creditors on time, credit to cash on delivery, suppliers and all stopped giving me credit. They're only giving me cash on delivery. Only if I pay cash, they deliver me. And failure to get finance for new products or for expansion. These are all financial symptoms. These are all financial symptoms. Auditor has to ask management, are there any financial events or conditions which may cast a doubt on going concern? Ask them. Management said, yes sir, there are some events. Okay, events are found, then do further investigation. What you should do further investigation? Will these symptoms lead to doubt on the going concern? Will these symptoms lead to material uncertainty? Will these symptoms lead to material uncertainty? You should question this, the second one. So symptoms are this is financial symptom. Again, there will be operating symptoms. What are operating symptoms? Management itself want to close the business. See, first of all, if management want to close the business in next 12 months, I told right, historical cost basis. If going concern is there, historical cost basis you can follow. If going concern is missing, what you should do, if going concern is not possible, if company cannot run smoothly for the next 12 months also, at least for next 12 months you can't run smoothly, you have to account financial statements on liquidation basis. How you should prepare financials? On liquidation. Even fixed assets has to be shown at recoverable values. Even fixed assets we will show at NRV, not just current assets. Even fixed assets will be shown at NRV. That's the impact of liquidation basis of accounting. When a company has to use liquidation basis of accounting, if going concern is missing. What do you mean by going concern is missing? They can't run the business for even next 12 months. If they can run the business for minimum 12 months from balance sheet date, then only you can choose going concern basis. Only when you choose going concern basis, whatever accounting principles generally accepted by the right, you follow them. If going concern is missing, GAAP is not applicable. You have to prepare financials completely using a different set of rules and regulations, that is liquidation rules and regulations. Hello? Everyone? Yes or no? So that is the impact of going concern missing. So loss of key management, labor difficulties, shortage of supplies, emergence of highly successful competitor, these are all operating indicators. Non-compliance with capital and regulatory requirements. Other indicators means what? Non-compliance with law and regulation. Pending regulatory proceedings that could lead to claims the entity cannot meet. pending litigations, pending cases, if at all they were unfavorable, that liability I cannot meet. Changes in laws and regulations or policies that affect adversely the business. Uninsured or underinsured catastrophe, some catastrophe, wartime, marine zone, Strait of Hormuz, yes or no? Right, Iran issue going on. Why ships are not passing through? Insurance is there, no? Why they are not passing through? Insurance companies will not support at the time of war. Yes or no? Insurance policies will be extreme high. The premiums are extreme high at the time of war times. Yes or no? Especially in marine transport, the extreme high. The premiums are the risk because the risk is very high for the ships. The ships are $1 billion cost. Each ship cost itself is $1 billion. The consignment will be $1 billion. Yes or no? So that's why. So uninsured catastrophe or underinsured catastrophe, changes in law, regulation, policy that will adversely affect the business. Pending litigations. Vodafone in 2020 or 21 year or 2018-19 year, Supreme Court passed a judgment on the Vodafone that they have to pay 60,000 crore to telecom regulatory. Already by then itself, Vodafone is at bankruptcy stage. That time there is a new order passed on Vodafone, 60,000 crore. Originally the case was pending in the Supreme Court. So this liability was pending. Finally Supreme Court told you have to pay. Pending litigation converting into real liability which company cannot meet. That's a going concern issue. Non-compliance with capital norms, solvency norms, liquidity norms. 2024 beginning, Paytm, best example. Their license was cancelled. Payment bank, Paytm is a payment bank. The license got cancelled. Understood? Changes in laws and regulations. Australia has introduced new social media regulation. Any children below 16, they should not have access to social media. They banned it. And if at all a children is able to access Facebook and Instagram or any other social media sites, yes or no? So the service provider is liable for penalty. Not even the parents, not even the children, the service provider. So it is the Facebook, it is the Instagram, it is the YouTube. They have to take responsibility to ensure that it is not used by a children below 16. They have to make sure. They'll ask, no, are you 18? Are you 16? They'll ask, no, you select something and then it will proceed. Yes or no? But there it cannot be. If at all the government finds this, they'll punish. So this regulation was brought. Soon in India also they were thinking to implement. So I don't know whether they'll implement or not, but they're thinking. Some states are thinking to adopt. Tamil Nadu is thinking to adopt. Andhra is thinking to adopt. Can we bring social media ban on the children? So funny, we introduce, we find everything and then we'll stop it. We found a nuclear weapon and brought a nuclear policy and then halted it. We brought AI and then tomorrow AI policy will come and then people will not use AI. There will be a ban on AI because it's question of humanity, right? So humanity will be in danger, because of AI. So that's the reason. Job losses, all this. Next, or whatever incident, robo movies there, similar incident also can happen because of this AI revolution, especially after Claude AI was introduced. It's so aggressive. Fine, next step. So I hope you understood now. If any events are there like this, what you have to do? You have to perform further audit procedure. Why you should perform further audit procedure? To know is there any material uncertainty. You want to know is there any big uncertainty. Material uncertainty related to going concern. Okay, suppose uncertainty is there. Let us assume uncertainty exists. What is the level of uncertainty? Still going concern appropriate or not appropriate? You should check out. Sir, going concern not appropriate, sir. Going concern not appropriate. Symptoms are there. I did further investigation. I concluded uncertainty is there and I even concluded there is no going concern at all. And how financial statements are prepared? Sir, financials were not prepared on liquidation. Actually, going concern is not appropriate. When it is not appropriate, financials must be prepared on liquidation basis. But the company has not prepared them on liquidation. They still showed going concern. They still used going concern. They still accounted on normal gap. Financials are misleading. You should give which opinion? Adverse opinion. Sometimes what happens, going concern is missing. Company will show clearly in the notes to accounts, company is no more a going concern. They clearly showed. But you saw balance sheet. Still it is accounted on historical cost. They disclosed the fact that going concern is missing. But they did not account the financials on that basis. When going concern is missing, what is appropriate accounting method? Liquidation. Only when you account like that, then your financials are true and fair. Going concern is missing, you're disclosing the fact that it is missing, but you accounted them on historical cost basis. Again, it is misleading. You should give which opinion? Adverse. Suppose, financial statements, they were prepared on liquidation. This point will not be there in the ICA book. This is something there which I gave. Okay, specifically, this was asked in CA final as question. Even in CA final material, it is not there. Okay, they asked this as a 5 marks question in May 24 attempt or number 24 attempt. In one of the attempt, they have asked. So that's the reason I even kept this here. So financial statements are prepared on liquidation. Are a company going concern missing? They also prepared on liquidation. They're true and fair. Am I right? Going concern is missing. They admitted it, and they even prepared financial statements which is suitable there. So tell me which opinion I should give. With respect to going concern, unmodified opinion. And financials are prepared on liquidation basis. They mentioned liquidation basis in notes to accounts. In notes to accounts, some note number 3 is there. Basis for accounting. They mentioned basis for accounting. Side heading they mentioned the financials were prepared on liquidation basis because of so and so reasons. They clearly mentioned that. Tell me, this is not normal gap. This liquidation basis, is it a normal generally accepted principle? No, it's something different. I want everybody to read that first. I can highlight that in emphasis of matter para. Remember, here it is what? Emphasis of matter para. In reality, you will not find these situations. Rare. Suppose material uncertainty is there, but guess what? What is the situation? Going concern is still appropriate. No problem at all. So going concern is still appropriate. For example, I'll tell you one thing, sir. Symptoms are there. I did further investigation. You know what? Material uncertainty is not existing. Every year company is having super profits, super reserves and surplus. This year some slight loss is there. The moment when I see loss, what happens? Some going concern issue, I thought. Then I went and further investigated. Company has huge reserves. This is also very negligible loss. Now tell me, symptom is there, but is there a material uncertainty? Exactly. See, tell me, when we go and visit a doctor, first question he'll ask is symptom. Yes or no? The same. Going concern assessment is like diagnosing a patient. Diagnosing the patient. Oh, you're coughing, sir, cancer, sir, pakka, you'll die tomorrow. No. You should ask the symptom. You should do further procedure. Then you should conclude, is there an uncertainty or not? If there is uncertainty, what should be done? If there is no uncertainty, then doctor will give you certain precautions and take it over. Same. So first, they'll ask you management, are there any uncertainty symptoms? And we will do further investigation. Symptoms are identified, we'll do further investigation. Upon further investigation, we may conclude that no material uncertainty. Sir, don't worry, sir, no, there is no life threat. It's just a common cold and cough, sir, no life threat. Okay, then fine. So there is no material uncertainty, but remember, there are symptoms. Yes or no? There are symptoms, but there is no material uncertainty. No material uncertainty means going concern is proper, right? If going concern is proper and company already prepared financial statements using going concern basis, which opinion I'll give? Unqualified opinion. But sometimes what happens, the framework might say, please show the symptoms. Disclose the symptoms. If the framework requires disclosure of events or conditions, and management is also disclosing. Yes or no? Management is also disclosing. You give unmodified. Suppose, you have symptoms. Framework says you should disclose, but management is not disclosing. Non-disclosure of information which is required as per applicable financial reporting framework. Non-disclosure is a misstatement. Misstatement means modified opinion. That's it. Suppose you did further investigation, you found out that material uncertainty exists, and when you found, right now no problem. Going concern is right now appropriate. Okay, you don't have to worry. Right now going concern is appropriate, but material uncertainty exists. Material uncertainty exists, but still going concern is appropriate. Fine. Sir, is it disclosed in financials, this situation? No. You should give which opinion? Qualified or adverse? Generally we choose adverse. Severity basis, we always choose adverse. First of all, what do you mean by going concern appropriate but material uncertainty exists? What do you mean by this? Air India situation is that only. It is like, is the patient going to die? No, he is alive, but he is about to die. Okay, fine. Operation is successful, but patient is dead. That's such a kind of situation. Material uncertainty in relation to going concern. Like what Air India said, you see, the company incurred a net loss of 7,700 crore. 77,000 million means 7,700 crore. The company current liability is more than current asset by 54,000 crore. And the company has an accumulated losses of 70,000 crore. See, I can have a pocket. Inside the pocket, I can have 0. I can't be negative in the pocket. Hey, how much you have? Minus 10,000 macha. You can't say that. Yes or no? Air India has minus 70,000 crore losses. Hurry, how come? Current liability is more than current asset. How come? First of all, how it is possible? They are bringing loans. How are they repaying money? They are bringing loans continuously. Who the hell are giving the loans? Government. Who is giving the loans here? Government is giving. Because Air India is owned by whom? Government. You know what? Because government is continuously, even though I have a loss, even though I have, Air India is operating successfully, the airlines. No problem at all. In spite the balance sheet has a big hole. Yes or no? 70,000 crore loss, accumulated loss, 54,000 crore. Net liability position, current year 7,000 crore loss. First of all, how can I do business with loss? Loss means what? I don't have cash, first of all. How can I do business? How can I pay salary? How can I pay fuel charge? How can I pay all this maintenance? How can? Government is continuously giving capital. Don't worry, Air India. Okay. You want money this month? Okay, fine. Take this 1,000 crore. Pay salaries. Take this 500 crore. Pay fuel bill. Okay. So they're giving. Government is continuously infusing the capital. Continuously they're adding the capital. And that's how Air India is surviving. I asked Air India management, sir, this is the position, right? Then how did you choose going concern basis if this is the position, sir? I know what you're asking. I have uncertainty. My business is completely uncertain right now. But remember, government is supporting right now. As long as government is supporting, my going concern is appropriate. You worried about next 12 months liability? Don't worry. Next 24 months also I'll pay. I may have loss. It doesn't matter. I'll get new capital every time. Owner will be adding capital. Yes or no? Government will be adding capital. So I'll be surviving. No problem. So material uncertainty. Is Air India have material uncertainty? Yes. But is Air India going concern appropriate? Yes, that also. Why? Because government is continuously supporting. My question is, how long they'll support? Right now they are supporting. How long they will support? This even we are doubtful, sir. Management replied, this we are also doubtful, sir, because every time opposition is bringing this topic, government is also thinking on this. So we are also doubtful. My director has a housing loan EMI. Next month he has to pay. He is also having this doubt. How long government will support? If at all government suddenly stops supporting Air India will not pay salary. My director will be defaulting the housing loan. So he is also having a doubt. So which means as long as government is supporting, Air India going concern is fine. The moment government withdrawal support, Air India going concern, the same day, every operation will come into halt. Which means right now your position is good, but there is a material uncertainty. Tell me, is this a severe situation or not? It has to be disclosed disclosed in the financials to the shareholders or not? Air India management clearly disclosed in note number 53. They clearly disclosed this situation in note number 53. Now tell me, there is a material uncertainty which Air India is facing, and management also disclosed it clearly in the financials. Can I give a negative opinion? Whatever worst situation that they're facing, they're openly admitting it. In the financials, they're admitting it. Clearly they're saying that. Clearly they're disclosing. I can't give any qualified opinion, adverse opinion on that. What opinion I should give on that? Unqualified. But tell me, this note number 53, which talks about life and death matter of Air India, is it important to the users? I must highlight this. Generally, where should I highlight it? Emphasis. But this is a life and death issue. I cannot highlight it with just like any other color. I should highlight it with red color. Yes or no? So I will highlight it with a separate heading called MURGC. So I will put a separate heading called material uncertainty related to going concern. So technically this is emphasis only. This emphasis only. Basically you are highlighting only. But if I put it already highlighted so many points, if I highlight here only that point also, people think everything is common only. Something is highlighting, some nonsense is highlighting. People think like that, yes or no? So that's why there is a separate heading for this MURGC. Highlight only MURGC issue there. Okay. Basically this is emphasis only. You see, presentation, our opinion is not modified on this matter. Emphasis also have the same presentation. Attention is drawn to note number 53. Emphasis also has the same way. Material uncertainty para is just like emphasis only. But we don't use the word emphasis, we use the word material uncertainty related to going concern. When you can use this para? When you are giving qualified opinion on going concern or unqualified opinion on going concern? Unqualified opinion on going concern. Hello? Sir, but here Air India gave qualified opinion, no? They gave qualified opinion not on going concern, something else. The qualifications relate to something else, not going concern. With respect to going concern, auditor has an unqualified opinion. With respect to going concern, there is no misstatement they made. With respect to going concern, they made the financials are free from MMS with respect to going concern. So with respect to going concern, they have given unmodified opinion. That's it. That's what even given here also diagram. So going concern appropriate, material uncertainty exists, and it is clearly disclosed in financials. Give which opinion? Unmodified, and highlight that in material uncertainty related to going concern para. Do you understand now? So this para will not come in case of qualified or adverse. This para will come only in case of unmodified. Unmodified opinion means on what? On going concern issue, not overall audit report. When I say unmodified, modified, you see there are many standards where they talk about qualified, unmodified, qualified, modified, qualified, adverse. They talk about that issue. Hello? Inventory I audited. Everything is true and fair. With respect to inventory, my opinion is unqualified. Debtors I verified. Mistakes were there. With respect to debtors, I have to modify my opinion. Then I verified creditors. Everything is true and fair. Unmodified opinion on creditors. Then I saw borrowings. Again modified opinion there. Now finally there are total 3 errors I found, 3 mistakes I found where I have to decide to give modified. Now total it and then see which modified opinion you should give. That time you should decide. So when I give modified opinion, I'm only modifying these 3 issues. I'm not modifying my opinion on the remaining issues. That's the meaning. Hello? Everyone? That's it. By the way, tell me, company has to do, whose responsibility to do going concern assessment? Management. They need to do this irrespective of requirement in financial reporting framework. Whether accounting standard says this or not. You know, management, no, I went and asked Air India, sir, have you done going concern assessment? Management replied, why I should do this? Where is the requirement? Show me. You must do the going concern assessment irrespective of requirement in financial reporting framework. Even if the financial reporting framework does not explicitly require, management must assess going concern. Understood? So management assessment is about what? Judgments about uncertain future. So what are the factors affecting management judgment on going concern? Degree of uncertainty and entity specific factors. Look at the size, complexity, nature, timing. Generally management assessment about going concern they made, right? They made going concern assessment and then prepared financials. That assessment might be true, and when the assessment was made, that subsequent scenario might invalidate the entire assessment. So no, Dubai is the safest country. Until when? Exactly. Yes or no? Only when the war started, entire real estate collapsed in Dubai. Yes or no? People then realized how important it is to have weapons. Understood? Dubai is protected by US only, no? All this Gulf, Middle East is entirely protected by US only. Now Iran is attacking not the US, but the Middle East. Yes or no? So because these are your friends, I attack your friends, then you'll control. Your friends are beside me. You may be far from me, but your neighbor, your relative is beside me. Yes or no? So by the time you throw a missile at me, I'll throw here. So deal. What is it? That's the reason US is unable to, target Iran directly, strongly. Because today or yesterday, some 2 days ago, they said in Dubai, Abu Dhabi, everywhere, all these IT companies quarters, all these IT companies buildings were there. Okay, if you try to launch a missile, I'll destroy all these buildings. Choice is yours. So literally US is in a position where they can't go forward, they can't go backward. If they go backward, de-dollarization happens. If they go forward, entire Middle East will be spoiled. So this is the situation, geopolitical scenario. Okay, fine. So now people are understanding how powerful India is. Yes or no? Because today we are undoubtedly a very powerful country. We have all the weapons, A-grade weapons we have. It's so powerful. America, China, nobody can touch that easily. So we have that defense budget. We have almost 30 to 35% of the entire budget goes for defense. So see, we should not spend on defense technically. But what if your neighbor is trying to attack you? Yes or no? No, no, no. Growth, development. Survival is most important than development. So people now understood how important it is survival than development. I'm not saying development is not important. I'm saying survival is important. There is a difference between development not important, survival is important. I'm talking about survival. So that's it. Fine. Next. Next. So going concern. That's also going concern assessment only. Next. I mean, it's not, we should not, I mean, it's not about joking about the scenario, all that. I'm just telling you how important it is to have this national security. Next. Now, what is the responsibility of auditor? You also should check. Auditor has to obtain sufficient appropriate evidence and conclude on appropriateness of management's use of going concern. Company will by default use going concern basis for preparation. Whether their usage is appropriate or not, you should get evidence. And now conclude, when you are getting this evidence, no, conclude whether material uncertainty exists. This is the auditor's objective. Do you agree? In Jan 25, this point is tested along with further audit procedure cash flow point. You know what they tested, you know? Further audit procedure, this point they tested. In Jan 25, I'll show you the question, you will surprise. When you see this question, you'll shock. Yeah, look at this. 3B, you look at how depth they asked this question, look at. Okay. Projects India Private Limited. By the way, all these questions we discussed in class then well before that also. Because I always tell in the class how a middle point can be tested in exam. How it can be tested. That before batch happened in 2024 beginning or 2024 ending. That batch I told clearly. Even in marathon it will be there. In 2024 my marathon will be there. That 2025 marathon will be there. 24 only, 24. You can see that this point will be there. The same is tested in Jan 25. Look at Project India Limited is engaged in manufacturing and trading disposable glasses, all that. Management had not taken any steps to increase the revenue or add new products. Also suppliers are demanding cash payment at the time of purchase. Means what? Credit to cash on delivery. Financial indicator. Yes or no? Before finalizing the audit report, audit in charge asked for cash flow forecast from management for the next 12 months from the end of the financial year. Keeping in view, answer, what can be the likely purpose of Z in the above situation? Why is he asking cash flow forecast? First of all, to check going concern. What he want to obtain? He want to obtain evidence on going concern. State any two audit procedures in relation to cash flow forecast. There are only two procedures only there, and they're asking any two. There are only two procedures. Okay. So what is likely doing? What is the purpose of him? What is the purpose? What is he asking? In the given situation, company business is so and so. The likely purpose of CAZ is to obtain evidence regarding appropriateness of management's use of going concern to conclude whether material uncertainty exists. Report accordingly as per 570. And the audit procedure related to cash flow forecast is evaluate reliability of data used to prepare the forecast and determine whether adequate support were there for assumptions behind the forecast. Forecast is prepared based on assumptions. Whether are there evidence for the assumptions? Check it out. Forecast is based on assumptions, and these assumptions are based on some past data. Whether the data used is reliable. These are the 2 points which you should verify. Look at that. Here only, this point only they tested. If entity prepared a cash flow forecast, evaluate reliability of underlying data used to prepare forecast. Whether there is an adequate support for assumptions. So what is the likely purpose? Why is he doing all this? Why is he doing all this? He want to verify the objective. What is the objective of audit? Obtain sufficient appropriate, whether going concern is appropriate or not, whether material uncertainty exists, then report the findings. So the objective of CAZ behind asking all this is to get an evidence on going concern basis. And cash flow forecast, what points you should verify? We saw these two combined and then they asked. See the depth of question. Hello, able to understand now? What you think that you understand about the subject is different from what actually the subject is. Many will have the common notion like, I'm understanding everything, I'm able to understand conceptually, but still I'm unable to remember. It's not about remembering, it's about understanding. You think you understand where it is actually not. Okay, this is how the question depth. How many of you sincerely tell me have solved question banks? In process, some question bank solving is most important. If you are skipping question bank, you're literally risking the attempt. 50% risk. 50. It's not 5% risk. 50% risk. Must and should solve question bank. Don't neglect it. My question bank already I told PDF is there. You please at least one time you read. Don't neglect it. Okay. Next. Now tell me, auditor should get this evidence on going concern. No, you must get it evidence whether financial reporting framework says it or not. Management should do going concern assessment whether financial reporting framework says or not. Auditor should get evidence whether financial reporting framework requires or not. Sir, there is no accounting standard which says this, sir. Why should I get evidence? No, you must get it whether or not financial reporting framework says it or not. This is mandatory as per 570. Hello, everyone. Next, by the way, in audit report, if I am silent about going concern, does it mean it's a guarantee about the future? Exactly not. So the auditor cannot predict future events. The absence of reference to material uncertainty in audit report should not be viewed as a guarantee. Correct? This itself can be asked as a question. This statement can be given as a MCQ. Remember, I may be forgetting to tell where MCQ can come, where descriptive can come. Every part, every line is important for MCQ. It is important for descriptive. I just showed a couple of questions in the single attempt how they asked. Yes or no? Then what auditor has to do? Risk assessment. First you do risk assessment related to going concern. What is risk assessment related to going concern? Check management assessment. If at all perform, no, discuss assessment with management. Yes or no? The auditor will be alert throughout the audit to identify events or conditions. First of all, what do you mean by events or conditions? Events or conditions are nothing but these only. Okay, if events or conditions identified, for example, if events or conditions are identified, what you should do? Perform additional procedure. Why you should perform additional procedure? To determine whether a material uncertainty exists. Sir, material uncertainty existing, sir, what should I do? If at all material uncertainty existing, what you should do? You should see whether financials are adequately disclosing it. If the financials are adequately disclosing it, finally come to reporting. Finally come to reporting. If financial statements are adequately disclosing the material uncertainty. Sir, right now, management, no, use of going concern basis is inappropriate. And management prepared financials on going concern. Array, going concern is inappropriate, but you prepared on going concern. You should give adverse opinion. Am I right? Suppose no, company just disclosed that going concern is inappropriate, but financials are not prepared on liquidation. Still you should give adverse opinion. Suppose financials are prepared on liquidation basis, then you shall express unqualified and also highlight emphasis of matter para. Correct? Then suppose if going concern basis is appropriate, but material uncertainty exists, then express unmodified opinion, put a separate section MURGC and draw attention to the note. And suppose if material uncertainty related to going concern is not disclosed adequately, then give a qualified or adverse opinion. Now, by the way, who should do the assessment of going concern? Auditor or management? Management. For how many months they should do? Minimum 12 months from balance sheet date or such higher period as decided by the auditor. If at all management did less than 12 months, what should I do? Request them to do for 12 months. If they don't do, that's absence of evidence. If going concern assessment workings, if they are not available, you will not sit and rectify the assessment. Rather, what you decide, you will give disclaimer of opinion. If management is unwilling to extend the assessment, or they didn't make at all. I asked the management, where are going concern workings? They said, we don't have to do under any law. We don't do that. They said, they replied like this. Or they did for 6 months and I asked them to extend it to 12. They are not extending. They are unwilling to extend. Then I will give disclaimer of opinion. Either qualified or disclaimer, depending upon the severity of the situation available. Hello. Suppose tell me, if there are no events at all, if there are no symptoms at all, if there are no conditions at all, I don't have to worry about all this. I don't have to worry about all this. Now, how different questions can come? 5 marks question. Use of going concern appropriate, but material uncertainty exists. 5 marks question. Management unwilling to make an assessment or unwilling to extend the assessment. 5 marks question. Understood? Adequacy of material uncertainty disclosure. Adequacy of disclosure of material uncertainty. What do you mean by material uncertainty? Definition of material uncertainty. How auditor will conclude uncertainty? 5 marks question. And further audit procedure, 5 marks question. If events and conditions are found, we should do further audit procedure. That itself can be asked as a 5 marks question. Or write about evaluation of assessment of going concern. What auditor has to evaluate? What? You will not evaluate. You will only evaluate management's assessment. Suppose management does not assess. Will you sit and evaluate it? No. Sometimes no. You can proceed going concern basis is appropriate. You can proceed with this understanding if at all there are no symptoms at all. So in some cases, even without a detailed analysis, the auditor can conclude on the appropriateness of going concern. Why? How can company has a profit? They readily have access to finance. In these cases, the auditor can conclude on appropriateness of going concern even though management has not performed detailed assessment on going concern. Sometimes entity will not do assessment at all. Directly will you go disclaimer of opinion? No. If entity had a history of profits, they have readily access to finance. In these scenarios, even though without a detailed assessment is there, you can still accept company going concern is appropriate. Correct? When detailed evaluation we should do in other circumstance. In other circumstance, when there is no history of profit, in other cases, the auditor has to evaluate process followed for assessment, assumptions used for assessment, management plans for future. For what period management should assess? It shall assess for the same period as mentioned in framework. If framework is silent, minimum 12 months. Generally, framework is silent. So automatically management has to do assessment for minimum 12 months. That's it. Almost 45 minutes I spent on this standard, yet I covered you overview of the standard only. Okay, in depth I told you what are all the points that you should see. Structure of the standard I told. Once again watch the video and then read it. It's one of the lengthy standard. We take at least 3.5 hours, 3.5 hours to understand this standard basically. Understood thoroughly? With this 570 is over. Then we'll cover 701 and CARO. 701, 710 and then CARO. Which will be 701, 710 put together some half an hour to 40 minutes. Then CARO will be some 40 minutes. Okay, then I will discuss documentation chapter. Until now clear? Hello? Yeah, let's understand what is key audit matter. We understood MERGC, emphasis, other matter, opinion, basis for opinion, auditor responsibility, management responsibility. Everything is over. Now we are still left with key audit matter in terms of audit report elements, legal and regulatory requirements, reporting requirements, nothing but CARO. Most important topic is CARO. So these are the two which are pending. Now, what is the standard heading 701? Communicating key audit matters where in the independent auditors report. In the September 25th they have asked, in Jan 26 they have asked a question on this key audit matter. Every attempt they are asking a question on this, or at least alternative attempt they are asking. See, there is no rule. I already told last attempt if at all a standard is tested, this time it will not be tested. No, there is no such rule. Okay, so maybe they tested different part of it. Understood? Fine. So key audit matter. What is a key audit matter? Look at first how in Reliance audit report key audit matter is communicated. Look at the Reliance audit report. Here there is something called, first of all, key audit matter is also presented in a separate section, correct? Where there is a subheading called litigation. Again there is one more subheading in Reliance audit report. There is one more subheading, fair valuation. There is one more subheading, information technology systems. So there are 3 key audit matters which they presented. Understood? Now what are they mentioning? Litigation. The company has some big litigations going on, matters relating to oil and gas. There is a claim against the company and disallowance of certain cost, arbitration matters relating to so and so, so and so. They just listed out what litigations company has. Correct? Right side, what they're doing. Auditor's response. What do you mean by auditor's response? You remember SA 330 standard? Response to assessed risk. Response means what? What auditor did to this? Litigation Caesar, what auditor did? Auditor, what he did? Our audit procedures include the following. Our audit procedures include the following. They tested internal controls. They assessed management position. They discussed with in-house legal expert. They discussed with management developments, and they rolled out letter of inquiry with company's external legal counsel. What are all they verified? Left side what they mention, what is the key audit matter? Litigations. Right side what they're mentioning, what are how auditors have verified that. That's it. What are they trying to communicate here? I'll give a classic example. You went to a restaurant. You ordered some biryani. Okay? The biryani was served you. The biryani was served. And you're about to eat. Suddenly, chef suddenly comes and stops you. Sir, wait. Let me first tell you how I made this biryani. There's a biryani. And right side, how I made this biryani. I'm just telling you. How important is that to you? Exactly, key audit matter also. You're reading audit report. See, don't think everything there is a purpose behind it. So sometimes common sense will be missing. I still don't understand why key audit matter. What is key audit matter you are telling? I'm asking why. Why this is important? Why this is necessary? It's unnecessary. How you do audit? Why I need to know? Okay, you do audit as per standards and auditing, I understand. Okay, just like in a restaurant, you know, like if a chef is explaining how he will make a particular dish, how he made, what steps he followed, how he responded when you place an order. Yes or no? How he responded to make the dish. How important it is for the person who is eating. The same level of importance for a shareholder about the key audit matter. Tell me, what are they trying to communicate? What are they trying to communicate here? Okay, fine, that litigations is okay. So next again, what is there here? Fair value instruments. As on so and so, company has so some 78,000 crore, some shares of Geo Digital, you know, all this. Accordingly, it is a key audit matter. Our audit process include like how they audited. What is a key audit matter? How they audited. Why it is necessary? Why are you explaining it to me? Why, how you audited? It doesn't matter. It doesn't matter to me. It's a key audit matter. It doesn't matter to me. So why? See, people can't understand. No. As a shareholder, typical shareholder, will they understand this? What auditor is trying to do here? In audit, no, there are so many matters he looked into. Correct? Huh? There are so many matters which auditor has definitely looked into. Out of this so many issues, some 3 or 4 critical issues you are selecting and then explaining to the shareholders in the audit report how you audited them. How you audited them. Again, they are not explaining in depth. Our audit processes include, but were not limited to the following. Means we did all this, but don't think only this. We did so many other. Yes or no? We did so many procedures for this. For this particular investments, we verified so many things. Out of so many things which we verified, what briefly we verified, I'm telling you here. Do you understand? So in key audit matter, auditor explains how he do audit of a particular item of the financial. It may be a financial item or it may be even non-financial item also. There is no necessity of financial element only should become a key audit matter. There is no necessity. For example, in this Reliance, so there is one of the matter which they highlighted is IT systems. IT system is key audit matter, and how they verified IT system, how they verified the IT system, that they are communicating as a key audit matter. So now let's see, emphasis. There is a purpose behind it. In financials, some important point is there which you must go in, which you must definitely read it. So I highlight that point. There is a purpose behind it. Other matter para. Look, other auditor is responsible for so and so and so. My opinion is based on his opinion. So there is a purpose behind it. MURGC. The company is a critical situation right now. They disclosed everything. So please go and refer that. MURGC. Correct? Key audit matter. These are the 3 important matters. This is how I verified. What are you trying to tell? Are you trying to tell they are right or they are wrong? Or you want me to see them? You want to highlight? No. I'm not highlighting here. Key audit matter is not emphasis. I'm not highlighting any point in the financials. Are you talking about responsibility? No, I'm not talking about responsibility. Are you talking about going concern issue? No, I'm not talking about going concern issue. Then what are you trying to tell? Simple. This I felt important, and how I verified that I'm telling you. That's it. Key audit matter is this only. Key audit matter. Purpose, you see. What is the purpose of key audit matter? What is the purpose of key audit matter? It enhances communicative value of the audit report by providing greater transparency in the audit report, by providing insights about the audit. Insights about the audit. How I do audit? Insights. You want to know how I do audit? See, in basis for opinion, no, I told you how I do audit. I do audit as per standards. Sir, don't tell me theoretical answer. Give me practical example. Okay, you want a practical example of how I do audit? Go to key audit matter section. There I took some 3 or 4 important issues and I told how I verify them in reality. So you want to know how I do audit? You want to know insights about my audit? Go to key audit matter section. Then you will get some insights. That's it. Is key audit matter relevant for decision making for the shareholder? No. This just gives an insight to the shareholder how audit is generally performed. By the way, in key audit matter section, am I giving separate opinion on them? Litigation's point is a Reliance. Are they giving a separate opinion on that? Are they modifying their opinion? Are they giving any additional disclosure which is missing in the financial statement? No. So key audit matter, communicating key audit matter is not a substitute for disclosure which is required as per framework. Communicating key audit matter is not a substitute for modified opinion. Communicating key audit matter is not a separate opinion. Communicating key audit matter is not a substitute for material uncertainty related to going concern. Then what is key audit matter? I told no. Important matter in my audit. How I do audit. That's it. Then people will realize, oh, it's useless para. That's it. And key audit matter, the point is it's compulsory for listed entities. It's compulsory for listed entities. That to which financials? General purpose financials, complete set. You don't have to communicate key audit matter on audit report given on interim financial statements. You must communicate key audit matter in the audit report which is given on complete set of general purpose financial statements which are given on annual basis. Only on that key audit matter is compulsory. Key audit matter, again, when it is required, if there is a law, if there is a regulation requiring it to communicate, then communicate it. Or you may communicate key audit matter at public interest. By the way, public is not interested. Yes or no? Why all this unnecessary information? Do you understand? Do you convince with me that this is a useless para? But important for exams. Okay? Yeah. Next. Now tell me, sir, how do auditor decide key audit matter? How the auditor will decide key audit matter? You remember there is a standard 260. Communicating significant matters to those charged with governance. Significant matters arise in audit. Significant matters are there, na? Significant, another meaning is material, another meaning is key. That's it. So whatever you communicate to those charged with governance or significant matters, from that you can select some points as a key audit matter and then communicate. Why Reliance auditors have communicated key audit matter? Because it is compulsory. Even they don't want to communicate. But the law made it compulsory. 701 says it is compulsory. So they are communicating. The person who is communicating don't know what is communicating. The reader don't know what is communicated. Both of them don't know why it is communicated. That's it. Reader cannot understand. Array, CS students itself don't understand what is key audit matter. Yes or no? They only understand the meaning. They don't understand why exactly key audit matter. What exactly? Now you understood the kitchen example which I told, restaurant example. That's how they are doing, no? If a chef comes and explains you how he made the dish when you're eating, exactly the key audit matter here. That's it. Next. So now, by the way, fine. But in exam it's important. Last attempt they asked this. Determining key audit matter, 5 marks question. How the auditor will determine key audit matter? Tell me, important audit matter. How to decide it? How to decide it? Simple. Will you select, suppose litigations is there. Reliance have selected 3 issues. One is litigation, one is fair value investment, third one information technology system. Why they selected only these 3? Why not about remaining issues? Key audit matters are selected from those matters which are communicated with those charged with governance. That too, if it involves high risk or if it involves significant management judgment, or it could be a significant transaction or event. If there is a significant transaction happened during the year, or significant event happened during the year, select it as a key audit matter. Or if a particular area involves significant management judgment which requires significant auditor's judgment, because it's a significant management judgment, you should also take a significant auditor's judgment. Then that matter can be taken as key audit matter. Or first one, it involves significant risk or it involves high risk of MMS. Then that can be the basis for key audit matter. So the auditor considerations include, areas of high risk, areas involving significant management judgment, impact of significant events or transactions arising during the audit. So key audit matter can be selected from these three types of areas. Generally, these are selected from those matters which are communicated with those charged with governance, which require significant auditor attention. Key audit matter, name, translate, important audit matter. Important means what? Auditor's attention is higher there. Why auditor attention was higher? Because of high risk, because of significant judgment, because it was a significant event, because it was a significant transaction during the year. Is key audit matter separate opinion? No. Is key audit matter substitute for modified opinion? No. Is key audit matter substitute for MURGC reporting? No. Is key audit matter substitute for disclosure in the financial statement? No. Clear? So that's it. So what is a key audit matter? Now look at key audit matters are those that in auditor's professional judgment were of most significant in the audit of financial statements of current period. Yes or no? These are selected from matters communicated with those charged with governance in auditor's professional judgment while doing the audit of current period. He felt these matters are important and those matters are key audit matters. You see, nowhere they say it is important for shareholder. Nowhere they say it is important for user. It is important for auditor. Auditor felt it is important. So that he is communicating here. That's it. 701 is over. 701 is over. How should you communicate key audit matter? Same. Key audit matters are described under appropriate subheading in a separate section. Separate section means key audit matter. Subheading means litigation. Another subheading is IT. Another subheading is fair value of investments. Reliance audit report I showed. Do you understand now the meaning of subheading? Yes or no? Now the introductory. You keep key audit matter, no? Introduction, you should talk like this. Key audit matters are those matters in auditor's professional judgment were of most significant in the audit of financials of current period, and these matters were addressed in the context of audit. Whatever key audit matters I'm saying, no, I already addressed it in audit. I already verified that in audit. And auditor does not provide separate opinion on these matters. Look at the Reliance audit report. Introduction is like this only exactly. Look at this. You see our book, you see here. Key audit matters are those matters in auditor's professional judgment were of most significant in audit of financials of current period. These matters were addressed in the context of audit of financials as a whole and in forming opinion. We do not provide separate opinion on these matters. Same. This is introductory language. In exam they can ask, what is a key audit matter? What should be the introductory language to the key audit matter? 5 marks question. Understood or not? That's it. You know, SA 701. And remember, whenever you are communicating key audit matter, whenever you are communicating emphasis and other matter para, whenever you are modifying the opinion, you must communicate this situation to those charged with governance. In 705, 706, common principle is you must communicate with those charged with governance. Clear? That's it, 701. Now, one point. If auditor is giving disclaimer of opinion, communicating key audit matter is prohibited. Why it is prohibited communicating key audit matter when you are giving disclaimer of opinion? First of all, where you did audit? To figure out key audit matter. Correct? Huh? That's logical. You don't have to mug up also. Very logical. Correct? Huh? That's it. You can still communicate key audit matter when you are giving adverse opinion. When you are giving unqualified or qualified, doesn't matter. You can use key audit matter. But when you are disclaiming the opinion, you should not communicate key audit matter, because simple reason, disclaimer you are giving because substantial portion you didn't audit. When you did not audit substantial portion, how do you know what is key audit matter? That's it. Clear? 701 is also over. Just a minute. Now, in exam, on key audit matter, anything they can ask. Okay? Manner of communicating 5 marks, or determining key audit matter 5 marks, purpose of key audit matter 5 marks, applicability of key audit matter 5 marks. Objective, the standard deals with auditor's judgment on what to communicate, how to communicate, form and content of such communication. Okay, anything they can test. 701, simple standard, yes or no? That's it. Even in emphasis I told how a question can come. You can check Jan 26, September 25, May 25, you know, Jan 25 also. From the questions which I am discussing in the marathon only, it will be. Even in the upcoming exam also, you will find every question that is asked in exam, a trace to it in this marathon, for sure. But I told you, it's not just about understanding the meaning, it's about understanding the context. For example, here, key audit matter, many of you would have, some students would have thought they understood, but do you understand the subheading means what now? Appropriate section means what? Separate section means what? That's it. Okay, you have to understand practically like that. That is what real learning. Now, shall we do one small exercise? 701 is one of the tough standard because many students will have a vagueness in that. I hope now I removed that vague ambiguity, whatever you have, I removed it. I will read it from ICAI material. Generally, we have a notion that ICAI material reading is lengthy, time taking. Okay, we'll put a timer and then I will read ICAI material on 701. Any standard you take, I will prove ICAI material reading is quite easy. Or 706 can I do? 706 can I do? Which is something you also have a grip on. Okay, yes, right away I will do ICAI material reading just for making you understand how easy it is to read ICAI material. Okay, yeah, a small change. 705 standard I will read from ICAI material. 705 is one of the lengthy standard, okay. Look at 705. Modifications to the opinion in the independent auditor's report. SA 705 deals with auditor responsibility. By the way, timer on. Okay, so auditor responsibility to issue an appropriate report in circumstances when the auditor concludes that a modifications to the opinion on the financial statement is necessary. When a modifications to the auditor's opinion is necessary, 705 is providing guidance on that. Introduction over. Next, this standard also deals with how the form and content of the audit report is affected when the auditor expresses modified opinion. Circumstances when a modification is required. We know two circumstances. What are the circumstances? The auditor concluded that the financial statements as a whole are not free from misstatement. How did you conclude that? Based on sufficient and appropriate evidence obtained. Second scenario, when do we give modified opinion? When evidence is not available, correct? Second scenario, the auditor is unable to obtain sufficient appropriate audit evidence to conclude that the financials are free from misstatements. In these two circumstances, I will give modified opinion. See, I'm not simply reading and going. I'm explaining and connecting with you what you already learned and then I'm reading. Next. Now, what is the objective of auditor? Simple. As per 705, yes or no? The objective of the auditor is to express clearly and appropriately modified opinion that is necessary when the objective is produced again. The two circumstances produced again. Okay. Now, types of modified. There are three types of modified opinion: qualified, adverse, disclaimer. Now look at qualified opinion. Two circumstances we give qualified opinion. Am I right? The auditor, yes or no, obtained sufficient appropriate, concludes that the misstatements are material but not pervasive. Yes or no? That is one circumstance. Suppose if the misstatements are material and pervasive, adverse opinion. There is second scenario where I give qualified. The auditor is unable to obtain sufficient appropriate but concluded that possible effect of undetected misstatement could be material but not, and if it is could be material and pervasive, disclaimer. Yes or no? Next, qualified opinion, same thing is given, just a repetition. Diagram first they give, then they're writing the matter as it is, correct? Illustration I'm not solving because illustration is not a concept discussion. Okay, now I'm only talking about the revision speed with which ICAI material can, how much fast I can revise ICAI material. Now, which type of modified opinion is appropriate? Which type of modified opinion is appropriate? Depends on nature of the matter giving rise to modification, pervasiveness of the effect or possible effect of the matter. Nature of the matter, pervasiveness of the matter. Nature of the matter, two types. What are the two types? Nature of the matter, whether financials are materially misstated or inability to obtain sufficient and appropriate. Are you modifying because of misstatement? Are you modifying because of inability to obtain evidence? What is the nature? First decide that. Then pervasiveness you decide. Over. Then the table illustrates below. This table they have given. I gave you much more better table in the book. All scenarios I listed out. Okay. Then, for example, this point I have not covered in the class. Okay. What is the consequence of inability to obtain evidence due to management imposed limitation? Okay, this point I did not tell in the revision. Now I'm not will tell you. Suppose management imposed a limitation, like they are restricting me, they are not cooperating me at all. Okay, first what I will do, if after accepting, remember in 210 we discussed one point. If management imposed limitation before accepting the audit, don't accept the audit. If after accepting the audit they imposed a limitation, auditor aware that management has imposed a limitation, on the scope of audit that auditor consider likely to result in a qualified or disclaimer, then the auditor shall request management to remove the limitation. If they put a limitation where you may have to give a modified opinion, then do one thing. Don't modify directly. First, request management to remove the limitation. If management refuses to remove the limitation, then communicate the matter to those charged with governance, unless TCWG or both management and TCWG both are one and same. Suppose it's a small company, there won't be separate management, there won't be separate top management, both are one and same. So if they restrict me, will I go and communicate once again to them only? No. And determine whether alternative procedures can be performed to obtain evidence. First, I'll complain to top management and I will try to get evidence alternatively. Suppose if all auditor is unable to obtain evidence from alternative sources, if auditor is unable to obtain evidence from alternative sources, if auditor concluded that evidence is not available, possible effect is material but not pervasive, then do one thing, happily give qualified opinion. Even though management is not cooperative, here the possible effect is material but not pervasive. Suppose if possible effect is material and pervasive, qualification would be inadequate, the auditor shall first one withdraw, resign. If at all management is imposing limitation and you are unable to conclude, then do one thing, first resign. If a qualified opinion is sufficient, then give qualified. Qualified is not sufficient, I should give disclaimer, then don't give disclaimer, first resign from the engagement. If resigning is not possible, if withdrawal from audit before issuing the audit report is not practicable, like in some listed companies, no, you can't resign just like that. You have to give audit report and then resign. Like that, some rules will be there. LODR regulations at CA final, we will discuss that. Okay. So in some companies, you can't resign just like that before giving audit report. Sir, you must give audit report, then you resign. Sir, I'm unable to do audit. You are asking me to give audit report. I'm unable to do audit. Then do one thing. Give disclaimer of opinion and then resign. If before giving audit report withdrawal is not possible, disclaim the opinion on financials. Suppose if auditor withdraws, okay, before withdrawing, you decided to withdraw. Before you resign, some audit you did know, at least some mistakes you found out, no, communicate it. Okay, the auditor shall communicate to those charged with governance any matters regarding misstatements identified during the audit that would have given rise to modification. Any material misstatements that you identify, no, just communicate to management and now resign happily. Understood? Consequences of management imposing limitation. This itself can be asked as a 5 marks question. In our notes also it is there. Next, same, inability to obtain evidence, diagram. No, nothing, this is not a theory. Okay, now form and content of the audit report when opinion is modified. Simple, you will use a side heading qualified opinion and then you will use a heading side heading adverse opinion, correct? And in case of disclaimer, use disclaimer. When auditor is disclaiming opinion due to inability, then the auditor shall not express opinion, state that because of so and so the auditor has not been able to obtain, and amend the statements which indicated that financials have been audited. I mean this point, nothing but basis for opinion. So basis for opinion, when auditor modifies the opinion, the auditor, in addition to 700 element, in addition to what is there in the main audit report, you shall amend basis for opinion heading. You shall amend basis for opinion heading. How you shall amend it? Basis for qualified, basis for adverse, basis for disclaimer. And within this section, description of matter giving rise to modification. Why are you giving modified opinion? You should mention the reason. So that is how you remember basis for opinion paragraph. In case of modified opinion, how it will be changed. Suppose if there is a misstatement in the nature of specific amount, please describe it and also quantify the effect unless it is impracticable. If it is not practicable, the auditor shall state that. This is what I gave in the book also. Now, some points I didn't mention. I didn't discuss also in the class marathon, okay? But still I'll discuss here. Suppose there is a misstatement where the misstatement is in the form of a non-disclosure. In the financials, they didn't disclose. Important issue, they didn't disclose. Non-disclosure is misleading, no? That's a misstatement, no? I will give modified opinion, no? In the basis for modified opinion, discuss first with those charged with governance. Discuss why they didn't disclose. Discuss with them because they might disclose it now. Still they didn't disclose. Describe in basis for opinion nature of omitted information. For example, they didn't disclose segment information. I discussed with top management, sir, segment information is missing, sir, in the notes to accounts. You please disclose. They said, no, I will not disclose. Fine. I decided to give qualified opinion. Now in the basis for qualified opinion, I am telling the nature of omitted information. What is the nature of omitted information? Segment information required as per accounting standard 17 is missing. And if possible, include omitted disclosure if it is practicable to do so. Whatever the management omitted, no, I will disclose it if it is practicable for me. Now, when auditor disclaims or opinion, the auditor shall not include following elements. If the auditor disclaims the opinion, the auditor shall not include the following element. This is only asked in Jan 25, remember. If auditor is disclaiming, in the basis for opinion section, you should not include a reference to auditor responsibility section and a statement whether you have obtained sufficient appropriate audit evidence. That's it. Here and there I'm leaving one or two small lines and paragraphs. That's not required. Okay, that we have already discussed it. Okay, very simple. Even if auditor expressed adverse or disclaimer, the auditor shall describe in basis for opinion reasons for any other matter which auditor is aware. Any other reason because of which you might modify all the reasons that you found out, you mention in the basis for opinion section. Now, auditor responsibility section, yes or no? When auditor disclaims the opinion, how auditor responsibility section gets amended when auditor is giving disclaimer? Generally, auditor responsibility section will have primary responsibility, additional responsibility, communication. So much we'll discuss. But when you are giving disclaimer, you don't have to give all that. You just straight away say that a statement that auditor responsibility is to conduct audit as per standard and give an audit report. However, because of matter described in basis for disclaimer section of our report, we were not able to obtain sufficient appropriate evidence to provide basis for our opinion. The statement that auditor is independent and has complied with other ethical responsibilities. That's it. Now, when auditor is disclaiming, you shall not include key audit matter. And when auditor expected to modify, whenever you think of modifying the opinion, please communicate the matter to those charged with governance. One of the lengthy standard, 10 minutes. I didn't read, I explained. There's a difference between simple reading and explaining. I explained. In fact, one topic I explained afresh here. It took how much time? 10 minutes. This entire chapter you can revise in 1.5 hours or 2 hours maximum. Now tell me, is size of the book matters? Grip is what matters. How much command you have on the book, that decides the speed. It's never the number of pages, it's never the bulkiness of the book that decides the speed. It's the command you have on that. You see, how many pages I covered, you see here? Almost 7 pages or 8 pages I covered. Correct, huh? Yeah, still it is there. You see, how many? Yeah. Almost 10 pages. I just covered in 10 minutes. This entire audit report, one of the big chapter, in fact biggest chapter in our CA Inter, biggest chapter is audit report. That entire chapter you can revise in 2 hours, productively, effectively. Entire syllabus can be revised in 15 hours from ICAI book. You have 20 hours day before exam, excluding sleep time, excluding other chores. Only for preparation you'll have 20 hours of time. Now tell me, day before exam, reading ICAI book is a foolish thing, a clever thing? Clever thing, obviously. People live in assumptions. This is the best example. People live in myths. They don't always look at the reality. I told again, CA course stuff, MBBS, all that example I told. One breakthrough, eye opener. There's another one. You give me another topic. You give me one full chapter. I'll revise it within 1 hour. Any chapter you give me, I'll revise it within 1 hour with the productivity. Not simply reading and then going. So if you are really having conceptual clarity and command, how do you know, how can you decide whether your conceptual is super strong? Speed of revision decides that. If you are unable to revise the entire subject within 20 hours properly, effectively, you're lacking a lot of conceptual understanding. Because when you're revising, you struck at certain places. For example, key audit matter subheading. If you don't process it, if you don't understand and just like that move ahead, that is not a proper revision. That is not a proper learning. When you're reading every word, you're able to think, okay, this is how, yeah, correct, subheading only, yeah, separate section only, correct. You need to acknowledge it. When you know that level of content, you can revise in just 10 minutes. In fact, this is 705, so big, no? I will show you 706. I will show you 706, which is just a 5 minutes. Look at this. Emphasis of matter paragraph and other matter paragraph in independent audit report. SA 706 dealing with dealing with additional communication in the audit report, when auditor considered necessary to draw users' attention to matter presented or disclosed in financials that are important for fundamental understanding of users. Now, he also want to draw attention to any matter other than those presented or disclosure in financials, which in auditor's judgment they are important for understanding audit, auditor responsibility, auditor report. Objective of 706. Objective of 706 is what? Draw attention when in auditor's judgment it is necessary to do so. Draw attention on matters which is necessary to do so by way of clear additional communication to a matter presented or disclosed in financial, or to a matter that is other than, yes or no, any other matter that is relevant to the user's understanding of audit, auditor responsibility, auditor's report. Now definition. Emphasis of matter paragraph is a para included in audit report that refers to a matter appropriately presented or disclosed in financials that in auditor's judgment is of such importance that it is fundamental to users' understanding of financial statements. Emphasis of matter paragraph. If auditor consider it necessary to draw attention to a matter presented or disclosed in financials, yes or no, the auditor shall include emphasis of matter paragraph provided you are not required to modify the opinion. The matter is not decided as a key audit matter. How to present it? Separate section. When auditor included emphasis of matter paragraph, include it within a separate section of the audit report with a heading emphasis of matter. Include the paragraph with a clear reference to the matter being emphasized that fully describe the matter. This paragraph shall only refer to any information which is presented or disclosed in financial statement. Indicate that opinion is not modified in respect of the matter. Some examples are uncertainty about future outcome, significant subsequent event occurred, early application of some accounting policy, a major catastrophe occurred which has a significant impact on the financial position. And inclusion of paragraph does not affect the opinion. Remember, emphasis of matter paragraph is not a substitute for modified opinion, not a substitute for disclosure in financials, not a substitute for MURGC. Over. Then other matter paragraph. Entire emphasis, 3 minutes is what it took. So reading ICAI material is not a lengthy, it is not a tough task. It is the assumption that we have without even trying it, without even learning properly. Clear? Any subject for that matter, this is the answer. That's it. That's why I always request every student to read at least once ICAI material. It won't take time at all. Okay, fine. By the way, 701 is completed. All this is completed. Now we'll discuss 710. Okay. Yeah, 710 I will discuss. Then I will discuss CARO. Okay. Then we will go to the bank audit topic. Yes. Now, if you observe the audit report, we understood all the elements of audit report. Right now, we have completed all the elements. Look at what are all the elements of audit report. By the way, there are many points which I could not cover because of it's a marathon. 700 has so many other factors. What are the factors that you should consider before giving an opinion? You should consider whether sufficient appropriate evidence is obtained. You should consider effect of uncorrected misstatements on the financial statements. You should consider evaluations. Within evaluations, there are 3 types of evaluations. Evaluations about entities accounting practices, evaluations about financial statements, evaluations about fair presentation framework, like the 3 evaluations were there. What do you mean by qualitative aspects of entities accounting practices? Some matter is there. You need to read all that. That and all are important. Okay. Next, if I discuss everything 100%, that's not a marathon. So I hope you understood. Next, now we completed MURGC, key audit matter. Now we are able to understand how to draft audit report. Yes or no? Now report on other legal and regulatory requirement. But before that, signature of the auditor, place of the signature, date of the audit report. What should be the date of the audit report? The date of audit report should be on or after date of approval of financial statements. Management will approve the financials, right? On or that later date. And it should be on or after the date on which you obtain sufficient appropriate evidence. Yes or no? Next. Now, then UDIN number. So the auditor will give something called UDIN number. That's not a big deal. Report on legal and regulatory requirement. Report on legal and regulatory requirement. So legal, we have a legal requirement. So as per the legal requirements, under Companies Act, we have the following reporting duty. 143 subsection 1, 143 subsection 3, 143 subsection 11. 143 subsection 11 is CARO 2020. Now 143.1 6 enquiries. 143.3 16 matters. CARO 21 matters. Total 43 matters were there. There are 43 variety of issues on which auditor has to specifically comment. Where in the audit report auditor will give his comment? Where in the audit report auditor will comment? In the audit report, second part of the audit report. What is the second part of the audit report? Report on other legal and regulatory requirement. In that section, all these 43 matters you should list out and then tell one by one. Hello? However, 143.1 you will comment only when it is negative. Whereas 143.3 you will comment whether it is positive or negative. CARO you will comment whether positive or negative. Yes or no? Now look at the Reliance auditors report. You know, they have given report on other legal and regulatory. 143.3 matters, they reported everything. Yes or no? And you see 143 subsection 3 as per 143.11 CARO 2020. So they are giving it as a part of audit report only, but they are giving it as a annexure. Annexure is like an additional sheet in exam hall. Annexure is equal to main report. Hello? Annexure is equal to main report. Schedule 3 to the Companies Act. Why Schedule 3 was given separately? You can't put entirely under one section, no. 129 subsection 1. Every company shall prepare financial statements as per Schedule 3. What is Schedule 3? They can put entire in the section itself, enter Schedule 3, no. But why they kept it later? Because entire section, if you put, the section length becomes so heavy. Audit report becomes so heavy. So they put it as annexure. So CARO is part of audit report which is given as annexure. I hope you understood. Okay. Now, to whom CARO is applicable? CARO is applicable for all companies. Every company's CARO is applicable. However, the following companies are exempted: banking companies, insurance companies, Section 8 company, small company, one-person company, private limited company, subject to 4 conditions. Correct? Hello? Now, small company means what? Small company means 4 crores and 40 crore. Correct? Paid up capital not exceeding 4 crore. Turnover not exceeding 40 crore. Then that company is said to be a small company. Are you clear? Now, here private limited company condition is there, right? There are 4 conditions. What are the conditions? Paid up capital plus reserves and surplus shall not exceed 1 crore on balance sheet date. Yes or no? Borrowings from banks and financial institutions shall not exceed 1 crore at any time. Yes or no? At any time during the financial year. Turnover including revenue from discontinuing operations shall not exceed 10 crore. And it should not be a holding company, not a subsidiary company of public limited company. Hello? Now, this private limited company conditions are the right. Now it is useless. Why? These now small company up to 4 crore paid up capital and turnover not exceeding 40 crore. By default, if a company satisfies small company definition, it's a small company, CARO is exempted. That is the answer you should write technically, which is actually the right answer. In the recent exam, Jan 26 or September 25, CARO applicability was tested for private company. Okay, reporting requirement. Sorry, not in inter, it's final. In final, it was tested. In CA final, it was tested. Okay, in CA final, they tested it where they applied private limited company logic and they said CARO is applicable, and they continued discussion about that. Hello? If you know, there is a guidance note on CARO. There is a guidance note on CARO. What the guidance note says, you know, exemption of CARO to the companies is in the order of this exemption. If a company is exempted here, you don't have to check the letter point. Able to understand? Above private company, small company is covered. So if a company comes under small company, private limited company logic, you need not check. You need not check private limited company logic. CARO is technically exempted. But in that attempt, they ignored the small company logic. They applied private limited company logic and they concluded the answer saying CARO is applicable, which is actually wrong answer. Next time if the same question comes, there is no guarantee that the same answer will be there. I told, next time an examiner, somebody who is reviewing, you know, somebody who has little knowledge, brain, sir, this answer is wrong, sir. Private company CARO is not applicable. First of all, this comes on a small company. Then institute committee, what they will say, exam committee, okay, change the answer, sir. But what student will do? Last attempt they tested small company logic, they didn't apply. Private limited logic they applied, and they will write the same answer this time, and again the answer is wrong. Last time he wrote right answer where the answer is wrong. This time he wrote right answer where the answer is wrong again. This time he wrote wrong answer where the answer was not right. Correct? Huh? Because it was rectified. So what is the solution? Two alternatives you should write. If a private limited company data is given, it is satisfying small company definition. It is also satisfying private limited company. Any one is failed. I mean, small company, as per small company, CARO is not applicable. But private limited company logic, they are failing. Means CARO is applicable to them. Both the alternatives you should write. First alternative, you write 4 conditions logic, private limited company. Second alternative, it's a small company, CARO is exempted. Now the second question is, sir, what if it's an MCQ? Choose small company. What is the answer you should choose? Small. Why? In case study booklet is there, na? In that one MCQ is there where they choose a small company answer. Understood? Audit, inherent risk. This is audit risk. Yes or no? So we can't do anything. This is the problem. Okay, people who are setting the paper not that much knowledgeable. People who are reviewing the answer, he is not even that much knowledgeable. All are important questions batch only. So they don't have all this understanding. Now again, next question. Now you know, right, small company, now the limits were revised. 1st December 2025. Hello, look at 1st December 2025. Limits were revised by MCO notification 10 to 100 crore. Now for May 26 exam, which limit is applicable for small company? 4 and 40. For September 26 exam, 10 and 100. Hello? Everybody? For May 26 attempt, small company means 4 crore, 40 crore. For September 26 attempt, 10 crore and 100 crore. Why? Any amendment which came 6 months before only relevant for the exam. December 1st to May 1st, 5 months only. Hello? So that amendment will not apply for May. That amendment will apply for September. That's logic. Understood? That's it. Amma. So that's it. So this introduction is what I want to tell regarding CARO. Okay, then continue watching the CARO related discussion, applicability, consolidated financials, standalone financials, CARO applicability or not, 20 clauses. 20 clauses are applicable for standalone financials related audit report. 21st clause is applicable relating to audit report on consolidated financials. Okay, that's it. So the continuation, whatever I'm going to discuss, I will add my CA final CARO discussion. In CA final, I discussed CARO recently. That discussion I'll add. Provisions are same. You don't have to worry. That's a final provision. No, not required. CARO is same. Are you clear? Yeah. Sometimes, some CMA students, they ask me, sir, income tax, can I follow CA interbook? No. You have a different income tax. For you, German income tax is applicable. Not in what income tax is same only, no? Yes or no? They'll ask me. I'll feel like replying like this. Some students ask me, sir, I'm a CMA. Some students, yes, sir, I'm a CS student, sir. Can I follow CA inter income tax? What should I tell? It is same, no? Income tax is same, no? Will there be a different act for CS students and different act for CMA, different tax for CA? No, right? Yeah. Don't stress your mind with so many confusions, okay? Common sense apply. Just sometimes, wherever you go, don't forget to take your common sense. Always take it. That's it. Yeah, one more clarification on CARO. Actually, if you see CARO 2020 order, if you see, paragraph 3 in the original order, that talks about clause number 1, clause number 2, clause number 3, clause number 4, like that. That's why in suggest answer you will see para 3. Some student messaged me saying long back, okay, many have said, sir, you said clause number 12, here they say clause number 2, clause number 3. It's not clause number, it's a para number as per the original order. Inside that para 3, clauses were there. So in exam, how should I present this? As per CARO 2020, para number 3, clause number 4, clause number 5, clause number 6, like that you can mention. No problem at all. Understood? Clause is always a small letter. So this you should remember. Okay, that's it. So this is a presentation with respect to CARO. Okay, in exams. So para 3 means you understood this is as per the order. Para 1 talks about applicability of the order. Para 2 talks about some clarification on consolidation. Para 3 talks about 21 clauses. Then para 4 talks about auditors, if at all any point is negative, Auditor has to give reasons. That is there in the para number 4. That's it. Yeah. Let's begin the revision of this one, completion and review chapter. The revision of completion and review chapter. Okay. The chapter name is completion and review. In this chapter, we have totally 6 standards. Okay. What are the standards that we have? SEA 260, 265, 450, then 560, 570, 580. And if you remember, 570 revision I already covered as a part of audit report topic, where we discussed MURGC para, material uncertainty related to going concern. That discussion, that time itself I covered this 570 standard revision. Now we need to revise these standards. Okay, the first one I'm going to revise is 570. Then I will be revising 580. By the way, this chapter weightage is 5 marks. Okay, and before watching further, don't miss to like the video. Like the video and then proceed further. Yeah. Then next. What is 560? 560 deals with subsequent events. Yes or no? 560 is dealing with subsequent event. Now, see, generally, accounting standard is already there, where auditor has to verify whether accounting standards are complied or not while preparing financials. Then why there is an auditing standard like this? The reason is simple. In auditing standard, if you see the subsequent event definition, it is much wider than accounting standard definition. In accounting standard, what is the subsequent event definition? Very simple. Events occurring after the date of balance sheet but on or before the date of approval of financial statements. Yes or no? For example, date of balance sheet is 31st March. Approval of financial statements is 10th June 2026. 31st March 2026 is balance sheet date, whereas approval of financial statements is 10th June. Between this, whatever events happened, we call them as subsequent. These events are again 2 types, adjusting event and non-adjusting event. Am I right? Now, what are examples of adjusting events? Adjusting events means the conditions already there, out of court settlement. Some examples and all were given. Debtor becoming insolvent and out of court settlement. 2 examples they gave. ICAI book also. Non-adjusting event, 3 examples they gave. Issue of share capital and fire accident. There is one more example which they gave. What is that example? Planned mergers and acquisitions. 3 examples they gave. Okay, so they are non-adjusting. I hope you are already aware of it. So adjusting events means those events for which conditions exist on balance sheet date. Non-adjusting events means those events for which conditions that arose after balance sheet date. Okay, fine. All these are called as subsequent event. But in audit SEA 560, what is subsequent event? Events arising between date of financial statements, events occurring after the date of financials but on or before date of audit report. In accounting standard is approval date, right? Whereas here it is audit report date is what used. That's why in reality approval of financial statements and audit report date are equal. And even we have discussed this point in audit report revision, where I mentioned that the audit report date shall not be earlier than the approval date. It shall not be earlier than the date of obtaining sufficient appropriate evidence. So it can be on the date of approval or later date. But we don't generally use later date. We use only the same date. Are you clear? So events occurring between date of financials and date of audit report, which is again in the given case, date of financial statements is 31st March. Date of audit report is 10th June. Same. Here in accounting standard they might have used the word reporting period or balance sheet date, whereas in auditing standard they use the word date of financial statements. Correct? Now between this and in auditing standard the definition is extended and events happened between that and fact came to the knowledge of auditor after date of auditor's report. How to deal with this scenario is what the standard on audit 560 is dealing with. Already you have accounting standard, then why again auditing standard on subsequent event? Auditing standard on subsequent event is not dealing with accounting content. It is dealing with, if at all, a subsequent event that happened between this period only. Remember the dates, 31st March and 10th June. That happened between these dates only. But that event information auditor does not aware. He got to know only after audit date, audit report is given. Then only he got to know about that event. Now what auditor has to do is what the standard is exactly dealing with. Now the standard divides. Suppose no, you got to know after audit report date, right? You got to know when after audit report is given, right? When you got to know, there is another date called date of financial statements issued. There is another date called date of financial statements issued. What do you mean by date of financial statements issued? Remember, date of financial statements means 31st March. Date of financial statements issued means notice of general meeting, financial statements, audit report. Together you will publish no annual report. I showed an audit report topic. Annual report, notice, yes or no? Date of financial statements issued will be there, right? So issued. Suppose no, you got to know. For example, what exactly happened is, between the date of audit report and date of financials, there are 10 subsequent events which auditor considered. All the 10 events he considered. Management also told auditor only 10 were there. But after audit report is given, auditor got to know there are not 10 but 12 events were there. 2 events knowledge auditor got to know after the date of audit report. Now what auditor has to do regarding these 2 events? By the way, when you got to know these 2 events after audit report is dated, means audit report is already prepared by you, where you might have given unmodified opinion or something. Now you got to know about those 2 events. When these events happened before audit report date, after the balance sheet date. But when you got to know after audit report is dated, means the event happened on or before 10th June, but you got to know after 10th June about that event. Are you clear? And the problem is these 2 are adjusting events only. Moreover, means financial statements are materially misstated. Now what auditor has to do? The standard divides this situation again into 2 types. Case number 1, case number 1, case number 2. You might be getting to know this event, right? For example, these financial statements, everything was made available to third parties on 20th June 2026. Audit report date is on 10th June. Immediately company published annual report on 20th June. Means on 20th June everybody got audit report, everything. Suppose luckily if auditor got to know about this event before 20th June 2026, before financial statements are issued to third parties, event happened during 31st March to 10th June. Event happened after the date of financials but on or before the date of audit report, and the fact came to the knowledge of the auditor after the date of audit report but before financial statements are issued. What auditor has to do? If at all that event information of 2 events, when these 2 events happened along with the 10 only, it happened between 31st March to 10th June. It happened between date of financial statements and date of audit report. But that fact auditor got to know after audit report date, and moreover after financials are made available to public. For example, in case number 1, auditor got to know about that event on 15th June itself. Just 10th June I prepared my audit report, signed it. 15th June, thank God, 20th company is planning to give this audit report to public. Before that itself I got to know. Or second scenario, I got to know on 10th July 2026, means after financials are already issued to public. Now I got to know. What auditor has to do? This is what the standard is dealing with. Now what auditor has to do in both the cases, case 1 and case 2? First, discuss with management. 2, determine whether financial statements require amendment. Check whether financial statements, in our example both the events are adjusting events, therefore financial statements require amendment. If so, inquire how management is going to amend the financials. Yes or no? How management is going to amend the financial statements? Just check out. Suppose no, option 1, management amends it. Happy. Perform procedures. What is it? Perform procedures. What is it? Perform procedures on amendment. Perform procedures on amendments to financial statements. Correct? Second, extend audit procedure. Remember, if the management is amending financials, means old financials which they approved on 10th June, they will be vanished, in the sense that validity will be over. Means those old financials which are approved by the management will be quashed. Now new financials came into picture, which they approved it, new financials. Now new financials approval date, when they performed amendment, right? Management is amending, right? Management amended the new financials on 25th July. 18th July. 18th July. Remember, not July, 18th June, in our example June. 10th June audit report date. 20th June financials are issued to the public. That is what they were thinking to. But luckily, on 15th June, you got to know about this. 18th June, management rectified the financials. Now, revised approval date is 18th June. Am I right? Now, you need to perform audit procedures, extend audit procedures up to 18th June. What audit procedures? Subsequent event related audit procedure. How to identify subsequent event audit procedures were there. We'll discuss it now. So all these procedures you should extend it up to 18th June. Extend the process up to 18th June and provide a new audit report. Provide a new audit report. Whose date? The new audit report date should not be earlier than amended financial statements approval date. Right now, amended financials, original financials approval date in our example 10th June. Amended financials approval date 18th June. Original audit report date 10th June. Now new audit report date shall be 18th June. That's it. Case number 1 over. Case number 1. Facts identified by the auditor after the date of audit report but before financial statements are issued to the public. Look at in the GOAT notes also it is given clearly. Not this. Yeah, here you can see it. Case number 1. Case number 1 you can see here. Just a minute, I'm opening it. Facts identified before the financial statements are issued. What auditor has to do? Discuss the matter with management and top management. See whether financials need amendment. Inquire how management is going to address the matter. How the management is addressing this matter. If management amends it, perform the audit procedure specific to the amendment. Extend audit procedure to the date of new audit report. Provide a new report on the amended financials and make sure the new audit report date is not dated earlier than the amended financial statements. Easy. Suppose auditor got to know about subsequent event after audit report date. 20th June financials are also issued to the public. Audit report also issued to the public. After everything was issued, people are planning for coming to AGM. Now I got to know about the subsequent event. Same procedure will apply here also. What procedure will apply? Again, if at all, that is case number 2 in our discussion. Facts identified after financial statements issued to public. Discuss the matter with management. Determine whether financials need amendment. Check whether how management is going to address. First, I will check whether financials require amendment or not. And I'll ask management, are they ready to amend? They said, sir, we already issued to public, sir. And still we will rectify, sir. Don't worry, sir. We will amend it. We will send a mail bulk to all of them. Don't rely on the old balance sheet P&L, old audit report. Please ignore it. Company is going to send a new balance sheet, new P&L, new audit report afresh again. So kindly wait for 1 week time. Company took measures. The company took steps to ensure recipients of previously issued financial statements and previously issued audit report are informed of the situation. So already previous audit report, previous financial statements which the company approved and which I gave an audit report, they were sent. And now in that 2 subsequent events were missing. So now management said we will amend it. And management immediately took steps. What? They informed people, whoever have received previously issued financials and previously issued audit report they were informed about the current situation first. Then management, they amended the financials. Management is amending the financials. Then I will once again perform audit procedure on amendment, because financials they amended two items also they adjusted. Whether 2 items they adjusted correctly or not, they prepared financials with amendments. I will verify the amendment. Again, I will extend the audit procedure to the date of new audit report, and new audit report shall not be dated earlier than the approval of amended financial statements. And finally, I will provide a new audit report. Easy. That's it. Suppose in both the cases, case number 1, that fact you got to know before financials are issued or after financials are issued, whatever it is, management said, sir, financial already approved on 10th June, sir. We can't once again change it. We don't want to amend the financials. But auditor feels financial statements require amendment. The auditor feels financial statements require amendment. But management is not ready. then what auditor will do if management is not amending? Suppose if at all you have not yet given the report, 10th June you signed the report, 20th June company want to release to the public, 15th June you got to know about an event, luckily case number 1, and if at all management is not ready to amend, luckily the audit report is with you. Don't give that audit report. Change the audit report with a modified opinion before issuing it. Suppose if audit report is already given to the management, hand over it, then notify the management that not to issue the financials and audit report until amendments are made. Sir, please don't issue the audit report or financials. Suppose if unamended financial statements and audit reports are issued, unamended financials and audit report is issued already without auditor consent, you have to take appropriate action so that people prevent reliance on that. Appropriate action means what? Legal opinion you have to take. You may attend the meeting, you have a right to attend the meeting. In the meeting you can tell that these financials contains 2 misstatements related to subsequent events which management did not rectify, and my audit report also given earlier. Later only we got to know that, so please do not believe that audit report. Modify my audit report with a modified opinion like this. I will talk in the AGM. Are you clear? Yes or no? Case number 2 also same. If management does not take necessary steps, yes or no, the auditor shall notify the management. That auditor will seek prevent on reliance. If management or governance does not take any steps, the auditor will take appropriate action so that people will be prevented to rely on the audit report, to rely on the financials which contains material misstatement. Easy or not? Now, what are the audit procedures for subsequent events? What are the audit procedures for subsequent event? What is the audit procedure? First of all, you should perform sufficient appropriate evidence that all events between date of financials and date of audit report are identified and adjusted. The auditor first have to obtain sufficient appropriate. Generally, what is the audit procedure generally for subsequent event? The auditor has to obtain sufficient appropriate evidence that that all events between the date of financials and date of audit report are identified, and for that what auditor has to do? Understand management procedures. First, what management is doing to identify subsequent events. Enquire management what events that they are aware of. Enquire them. And third one, read latest minutes of the meetings after 31st March. After the date of financials, some meetings would have been conducted, right? Read those minutes. In exam, they will test you MCQ. You should read minutes after the financial statements date, not the before financial statements date. Read the minutes carefully which are prepared after financials. Only then you get to know subsequent event. And read latest interim financials. Read, review accounting records, budgets and other information which is prepared after financial statements. You read all that, you will identify subsequent events for sure. And you identified subsequent events of which require adjustments. Check. If auditor identifies any events, verify that events requiring adjustments, events requiring disclosure, they are appropriately reflected in the financials. You found some events which require adjustment in financials, which require disclosure, see whether they were reflected in the financial statements. And finally, once you perform all this audit procedure, get a written representation. Get a written promise from the management. Written representation means what? Written promise. You may consider this as written promise. What is written representation? We'll discuss in the revision of SA 580. There I will discuss briefly about what exactly written representation. Get a representation that representation from management and those charged with governance confirming that all subsequent events that require adjustments or disclosure was adjusted or disclosed. Get a representation. See, you're not directly asking written promise. First you tried, you understood what management is doing for identifying subsequent events. You spoke to them what events are there. You saw latest minutes. You saw latest financial information. You saw latest books of accounts, records, budgets, all that prepared after the date of balance sheet. You tried your level best to identify subsequent events, and you also saw whether all the subsequent events adjusted or not. Finally, you're asking management, dear management, totally 10 events were there. Are the only 10 were there? Management also say only 10 is there. Give me a written representation that only 10 events were there, and all the 10 events which require adjustment, which require disclosure, were adjusted, were disclosed. Understood? They gave. And finally I gave audit report. Then I got to know 2 events. Do you understand the chain now? Then I got to know 2 events. Luckily I got to know before financials were issued to public, or I got to know these 2 events after financials were issued to the public. What I have to do? That is what I told. That is what entire the standard. Over 560. Hardly 20 minutes, you see. You got the clarity? Now, once again, watch the video. Okay. Now you got a decent idea. Now read this GOAT notes once and then go back and once again watch this video. You will understand tremendously. Confident? That's it. Now there are some points which I did not discuss in the revision, not required that much. Okay, but in revision everything cannot be covered, right? I tried my level best to cover 90%. I covered of the standard. That's it. Yeah. Now let's begin the next standard in completion and review chapter revision, written representation. Remember, this is very tough standard and there is a high possibility of 4 to 6 marks question on this chapter, direct descriptive question on this standard, or at least an MCQ can come sometimes. Okay, very important standard, very most frequently tested standard in this chapter. 570, 580, 450, 450, 265. I mean, if you ask me prioritize, 6 standards per there, right? 570, 580 first priority standards, 450, 265 next priority standards in this chapter. Third priority standards 560, 260. Do you understand? That's how the priority from exam point of view I can classify. Now 580, written representation. What is a written representation? What is a written representation? First of all, written representation is an audit evidence. Remember that. Written representation is an audit evidence. What is audit evidence? Audit evidence is nothing but information which auditor needs. Information which auditor needs to perform the audit. Information means what again? In the balance sheet, plant and machinery, they showed some 100 crore rupee. Now I want to know information behind it. Information behind it means what? Information behind it means what? You know, what is the, who is the owner for this plant and machinery? I want invoice, yes or no? And I want to see where the physically the plant and machinery present. What is the depreciation workings? All this is called as information behind the, you know, balance sheet. Nothing but plant and machinery. That information in audit we call it as what? Evidence. And written representation is also an audit evidence. Now what is first of all written representation meaning? It's a written statement. It's a written statement provided by management to auditor. Why management is providing written statement to auditor? To confirm certain matters, or to support other audit evidence obtained by auditor. Yes or no? The written representation is a written statement provided by management to the auditor to confirm certain matters or to support other audit. Written representation is not a main evidence. It's an audit evidence, but it is not the main evidence. It is not the sufficient appropriate evidence. Written representation will give necessary information which auditor want to know from the company management. So management will provide information to auditor through representation. This information will only confirm the matters that you already aware of, or this information provided by the management through written statements will support other evidence that you obtain. For example, just now we saw subsequent event 560. The auditor has to identify what are all subsequent events by reading latest minutes of the meetings, by reading latest interim financial information, by reading latest budgets, books of accounts, everything. By that auditor will identify various subsequent events, and finally he will also get a written representation from the company. What are all subsequent events which company knows? They gave a written statement. Now company is giving a written list of all the subsequent events. This will support the events that you already identified. This events identified, this events whatever company is giving a list, no. That list whatever you get from company in writing, no. Written representation, no. That will support the, that will confirm what are all events that you already identify. This written statement will support what are all events that you already identified, the other audit evidence that you obtained by performing other audit procedures. To support that, management will give you a written statement. Are you clear? So this is called written representation. Can I use written representation as an audit evidence? Yes. Audit evidence means any information used by auditor to form the opinion. Written representations you can consider as audit evidence, which is just like a response to inquiry. You might have seen, no, in audit evidence chapter, what are various audit procedures? One of the audit procedure is inquiry, asking questions, talking to people. That's an audit procedure. What is audit? Verification. How do you verify? By talking to people. Now what do you get when you talk to people? You get some evidence. How do you get the evidence? Response. Response is an audit evidence, right? Written representation is also an audit evidence. Yes or no? Written representations are necessary source of audit evidence. And if at all written representations are not, if at all by the way, they are audit evidence, right? But in subsequent event standard we saw, can I directly take management written confirmation? Suppose no management gave in writing, sir, these are all subsequent events at 10. Can I blindly take that management statement and go with the logic? In the year only 10 events are there. There is no other event because management told in writing. You can't. For example, management itself is giving financial statements by signing. Yes or no? They are signing that everything is true and fair. Does it mean you will not do audit? Since management said everything is true and fair, since they approved everything is true and fair, I will also give opinion which is unqualified. No, not for that. Management is giving written statement about subsequent event is no doubt helpful for you, but you should try your level best to identify, are there any other subsequent events? Yes or no? Means management written representation will give you necessary evidence, but that do not provide sufficient appropriate evidence. That is why written representation, meaning you see, written representations are provided by management to auditor to confirm matters, specific matters, or to support other audit. So written representation is an evidence. This is only a supportive evidence, corroborative evidence, but it is not the main evidence. Are you clear? Now this standard, by the way, why I request in writing? Management is giving me orally answers, no? Why I request them in writing? Why I want in writing the statements? If I ask them in writing, they take the concern, they take the request seriously and give right information. Yes or no? If I ask them orally, sir, what is your intention behind investment? Suppose I asked management, company has long-term investment, short-term investment. Long-term investment 100 crore, but its market value 80 crore only. But the company showed it cost 100 crore only long-term investment. I asked management, sir, you said long-term, right? Market value 80, right? Why you showed it 100? Company immediately replied me, it's long-term, sir. Sir, why it is long term? Our intention is to hold it for more than 12 months, sir. That's why it's a long term investment. Now I will ask them, sir, please give me representation that your intention is for more than 12 months. Orally they may say more than 12 months, but in reality they may sell within next 6 months only. Yes or no? So I will ask management behind their intention. I want management a statement, written promise that their intention is more than 12 months. I want. Now they will take seriously. Then they will come. Sorry sir. Not all investments long term, sir. In this, 50% of the investment we wanted to sell in the next 6 months, sir. Remaining we will sell after 12 months, sir. So only 50% of investments are long term. Remaining are short term. Now you see, when I ask them in writing, they are very serious about it. So written representations prompt management to consider matter more rigorously, thereby the quality of representation will be higher, enhanced. Remember, written representation is nothing but written reply. It's nothing but written statements. It's nothing but written promise. It's nothing but written affirmation. Are you clear? Now what are types of written representation under this standard? The standard divides written representations into two broad categories. Okay, two broad categories. Written representation related to fulfillment of management responsibility. Written representation related to fulfillment of management responsibility. Other written representations. What is it? Other written representation. Again, these are subdivided. Written representations regarding fulfillment of management responsibilities again divided into two more categories. One is for written representation for fulfillment of management responsibility for preparation and presentation of financial statements as per applicable financial reporting framework. And there is another responsibility of the management, for completeness of information provided to auditor and completeness of transactions recorded in books of accounts. Are you clear? Now what is it? Management has to give written representation. This is the first type of representation. In fact, this is the main representation, for which in the ICAI study material they have given management representation letter format also. By the way, written representation is generally received by us when at the end of the audit. Whereas we have seen ethics and terms of engagement. Letter of engagement is given at the beginning of the audit. In letter of engagement, management will acknowledge, management will agree their responsibilities. Whereas in representation, they give a confirmation that whatever we agreed now in letter of engagement responsibilities, now they will give a confirmation in writing that we fulfilled it. What responsibilities they agreed? They agreed responsibility for preparing, presenting financial statements as per applicable framework, for providing complete information to auditor, and for preparing financial statements completely with all transactions and events recorded in books of accounts. Now, at the end of the audit, I am asking, please give me a confirmation letter that you fulfilled it. Written representation is nothing but asking management to give me a confirmation letter that you fulfilled it. Other representations. What are other representations? Other representations are again two types. Other representations required under a standard on auditing, or other representations required by auditor. Other representations required by auditor on relevant matters, of financial statements or specific relevant matters of financial statements or specific assertions in financial statements. The auditor will get representation as required by a standard on auditing. If a standard requires, he will ask that representation as per the standard, or he will also ask a representation when it is required by auditor for the matters relevant to financial statements or specific assertions therein. For example, specific assertions therein. No, for example, investment example I told. Company showed long-term investments, non-current so much, 100 crore. The reason behind non-current is management intention is to hold them for more than 12 months. No, I want to know why they classified as non-current, because management intention is more than 12 months. Give me a written statement that your intention is more than 12 months. Give me a written statement that your intention is more than 12 months. Nothing but now I am asking a written representation to support a specific assertion made in the financial statements. Management showed inventory non-current, long-term classification assertion. They classified it as a non-current rather than current, which will affect its valuation principle. A non-current investment is valued at cost unless there is a permanent decline in the market value. A short-term investment is valued at cost or market value, whichever is lower. But they showed at cost, naming it as non-current. They classified it as non-current. Behind that classification, there is an intention of the management. Your intention is more than 12 months. You told me orally. I want in writing. So here auditor is asking representation not related to fulfillment of responsibility. He is asking other representation. What is other representation? That too here he is asking representation because he feels it is relevant for specific assertion in the financial statement. Are you clear? Or the auditor can also get representation when there is a requirement in other standards on auditing. If some other standard says you to get representation, get it. For example, we saw in 560. First, auditor understand management process for subsequent event. Inquire management, do they ever of subsequent event. Read latest minutes of the meeting. Then we saw read interim financial information. Read latest accounts, budgets, all that. And finally get a representation that all the events happened between the date of balance sheet and date of audit report, which require adjustments, which require disclosures, were adjusted, were disclosed. Get a representation that management did everything right. So since SA 560 is asking you to get a representation, get it. That's what 580 says. 580, what 580 standard says, when you should get, for what you should get representation. You should get representation related to management fulfilling their responsibilities, related to preparation of financial statements, related to completeness of information provided to the auditor, related to completeness of transactions recorded in books of accounts and reflected in financial statements, and get other representations when it is required by other standards on auditing or when it is required by auditor. Like this, 4 types of representations for their sub-classification. Then there is one more type. The auditor, the management may give auditor, the auditor can get additional written representation related to some other information provided to auditor. Example, weaknesses, deficiency in internal control system. Management may give nothing, but here representation I'm getting is related to non-financial matter. So the auditor can get written representation not only for the item related to financial statements, he may also get a representation related to a non-financial matter. That is called as information prepared presented to auditor. Written representation on information provided to auditor regarding non-financial matter. Though heading is not given like that, below they gave example of internal control in the ICS study material or even in the GOAT notes. Are you clear? These are the various types of representations. Understood? Now let's open the GOAT notes and then see what are all the points were there. Okay, so look at, so objective of the auditor is what? Obtain written representation from management that they have fulfilled their responsibilities. What are the responsibilities? Preparing financials and providing complete information to auditor. Then obtain written representation on matters decided by auditor or when there is a requirement in a standard on audit. Correct? So if determined necessary by auditor or if it is required by SES, determined necessary by auditor related to matters dealing in financials or specific assertions therein. That's what the meaning. Yes or no? Next, from whom you should get the representation? You should get representation from the management, okay, who are having responsibilities for financials. So you can get representation only from the management who have responsibility for financials and who have the knowledge of the matter that you want to ask. Why investments are shown as non-current? 100 crore worth of investment. That knowledge of the matter is known only to the CFO. Only to him you should ask representation. So representation will be asked from the management who has responsibility for preparing financials and also having the knowledge of the matter. Namely, these representations related to 1. Category 1 representation, fulfillment of responsibilities. Category 2, other representations related to an item in the financials or specific assertions. These are all called as other representations. Am I right? These other representations when auditor will get, when auditor decided to get it, or when auditor when other standard is requiring. Am I right? So now there is something called informed representation. What does it mean? When management is giving representation, they may inquire others within the entity who have a specialized knowledge. For example, I asked CFO, sir, with respect to investment, same example I'll take. Why you classified it as non-current, sir? 100 crore worth of investment, you classified it as non-current. So the cost is 100 crore, you valued it cost, but its market value 80 crore. But it is not a permanent decline. But since you classified it as non-current, it is shown at a cost. This is the logic. And I'm asking CFO, your intention decides the value, sir, here. I want to know why, I want to know, please give me a written representation that your intention is to hold more than 12 months. CFO told, sir, I agree. I am the one who is responsible for entire financial statements. And I also have a knowledge on this matter. But the point is, this entire investments is taken care by entire our finance director. There is a finance team in the company. The finance team will look into all these investments, everything. I will come back to you. I will give you written statements. Don't worry. I'll give you in writing our intention. But before that, I will talk to my finance team and then get back to you. Then the auditor told the CFO that, sir, whomever you consulted in the organization, please mention their names and why you consulted, what they told to you. That also mentioned in the representation letter, so that your reply is an informed reply, not a casual reply in writing. I know you are giving in writing, but I want it to be very informed. Informed means what? You consult with concerned person, include their names, and then give me an informed representation. Are you clear? Now, so management may seek input from specialist. Like this itself is wrote in IC book as what? Management may inquire others within the entity before they give a representation to the auditor. Who are the others? Who have a specialized knowledge of the matter which auditor is asking. Who, for example, who are they? Example, right now I told finance director, but here they gave 3 examples: internal counsel, staff engineer, nothing but engineers, or actuaries. Why you consult? Why CFO will consult actuary? He is the one who is determining actuarial liabilities, or engineer is helping the management to determine environment liabilities. Internal counsel is helping the management to determine provision for legal claims. So I am asking some representation to the management where the CFO may not directly reply me. He has to consult somebody else and then give me. In that case, the CFO may inquire others within the entity and then get back to you. Now in exam they can ask you, when management is making representation, they may inquire others within the entity before making representation. They will give one case study kind of question, but this is the actual question that they are testing. Comment in light of that. You need to write this. Are you clear? Now in this case, the auditor may request management to include in the representations what confirmations they got in inquiries. They're inquiring with others, what confirmations they got. Include those confirmations in the written reply and then give me, sir. Like that the auditor can ask. Are you clear? Next, written representation. This is about what? Written representation about fulfillment of management responsibilities regarding financial statements. Here it is written representation about fulfillment of management responsibilities regarding financials. Management must represent that it fulfilled responsibility for preparing financials, including fair presentation. Okay, that's it. Now, written representation about completeness of information. Primary representation only. This is first type of representation. Inside that, subtype 2. The management shall represent the auditor that they provided auditor a complete information and access to all the records as agreed in terms. Okay, in the terms of engagement, they agreed that they will provide me access. Now I'm asking, did you provide me complete information? Management is saying, yes sir, we provided you. Mention it in writing. So in writing, management is giving auditor, dear auditor, whatever we promised in engagement letter, that we will give you complete information, we gave you. Whatever access we gave you, I promised in engagement letter, you can access anything in the company, we gave you that access. Okay, I'm giving in writing. Second one, management must also represent that all the transactions have been recorded in the books of accounts and are also reflected in financial statements. That's it. Now with this, first part of the SA 580, representations related to fulfillment of management responsibilities over. Now, by the way, why representation about management responsibilities needed? First of all, you know, audit evidence alone is not sufficient. You perform audit, you try identifying subsequent events, how many, no matter, you found some 9 or 10, but is there any guarantee only 9 or 10 is there? There may be more than 9 or 10. More than me, who is better to know the situation? Management. So better ask representation from management. What are all, how many subsequent events were there? Are you clear? So your audit evidence that you obtained in audit procedure, that alone is not sufficient to confirm that management fulfill responsibilities for preparation of financials, for providing information, for ensuring completeness of transactions accounted. So auditor cannot judge solely based on other audit evidence. I reviewed latest minutes, I reviewed latest loans and terms and conditions agreements, I reviewed latest financial statements, all that I reviewed, and I found out that 9 subsequent events. Based on this, I cannot say only 9 were there. Only when I ask management, they will tell me how many were there. When I ask management, they told 10. But of course, after audit report is given, I found 2 more again. That's a different story. But until and unless management confirm it total subsequent events, will I be aware of total subsequent events knowledge? No. Are you clear? So the auditor cannot judge solely on other audit evidence whether management prepared and presented financial statements properly and whether they provided complete information to you. How do you know they provided complete information to you? Only by asking them. Ask them in writing that they gave you complete information or not. Next. Now, you know, when you're asking representation, see, management should give representation that they fulfill their responsibilities. Along with that, sometimes you ask a specific representation. Sometimes you ask a specific representation regarding reconfirming their responsibilities. Remember, management acknowledged and agreed their responsibilities in engagement letter already. You are the auditor from past 3 years. You already gave in first year engagement letter where management agreed their responsibilities. Now, there are some circumstances where you want to reconfirm the terms, where you want to reconfirm management's responsibilities once again. Okay, now you can reconfirm. The auditor may ask management to reconfirm responsibilities through representation. Through written representation, you can reconfirm. One way to reconfirm management responsibilities, issue new engagement letter as per 210 standard. Another way to reconfirm management responsibilities is through written representation. Example, those who signed engagement letter is no longer the relevant person. Earlier, the person CFO who signed, he resigned from the company. Now new CFO came. Better I will ask him in writing, sir, please give me in writing that you agree with the responsibilities. The terms of engagement for preparing, where last 2 years ago I prepared that. Now I'm not sure whether management still remember the responsibility. So I'll ask them in writing, sir, please give me in writing that you reconfirm that you have all these responsibilities, that you fulfilled all these responsibilities. There is an indication that management misunderstands or circumstances have been changed. Same reasons is what in SA 210 also similar reasons were there. Under what circumstances we have to reissue engagement letter? Similar. Next. Then second type of written representation. What is the second type of written representation? Written representation related to other than management responsibilities. This is what I call it as other written representation. When other representation, when there is another other SCA requires it. Like for example, 560 standard requires. At intro of this standard I told. Or if necessary, auditor may request additional representation related to a specific assertion in financials. These representations are supplementary representations. In May 25 exam, This question was asked for 5 marks. Okay, May 25 exam. These representations are called as supplementary, and they do not form part of management representation. General representation is there, first representation regarding fulfillment. No, this supplementary are additional representations, where these representations we may get related to accounting policies, whether they are appropriate. We may get representations on management plans, management intentions, which will affect assets and liability classification and valuation. We may get representations regarding liabilities, whether are they actual or contingent. We may get representation from management regarding ownership documents, encumbrances and assets pledged with bankers as collateral. We will ask representation from management, supplement representation regarding whether they complied with law, whether they complied with regulation, whether they complied with contractual terms. Are there any non-compliances? If I want to ask specifically anything, any specific item I want to ask, those representations are called as other representations. If I want to ask them whether you fulfilled responsibility for financial statements as a whole, then I will ask first representation. Do you understand? Then written representation, date. Then finally, one more important topic, date and period covered by representation. What is the date? Written representation. First representation, is there, right? Written representation about fulfillment of responsibilities, that must be as near as practicable to audit report date, but should not be after audit report date. Why? Written representation is an evidence, is what we thought. At the beginning of the class, I told you written representation is an evidence, I told. When it is evidence, without obtaining evidence, can you give audit report? Audit report chapter also we saw, date of audit report shall not be earlier than the date of evidence obtained. So written representation is evidence. Once you get representation, then only you can give audit report. So get written representation about fulfillment of management responsibilities as near as possible. Written representation about subsequent events also as near as possible to practical to audit report date. Written representation about specific assertions, all that. Whenever you want it, get it. But all must be obtained as near as possible to practical to audit report date. Preferably, it should not be later than audit report. Okay. When I should get it, I understood. For which period I should take written representation? You are doing which year audit? 25-26. Then get representation for 25-26. Sir, I am giving audit report for 3 years, sir. Same balance sheet, but in the balance sheet 3 years were there. Comparative financial statements were. They were comparative financials, restated financials. Then for all the 3 years, you get the written representation. So written representation shall be, written representation must cover all periods mentioned in audit report. So understood. Sometimes current management, right now latest whoever CFO is there, when I'm asking him representation, he's saying, sir, I joined 3 months back only, but you're asking 25-26 full year management responsibility letter. How can I give you, sir? He cannot excuse like that. It does not reduce his responsibility. Right now, you are the one. I asked him this question. Who is going to approve the latest balance sheet, sir? No. Sir, I'm only approving. Then you only give me. Simple logic. You are the CFO right now. So, if current management was not present during earlier period, they might claim that they cannot provide representation for that period. This fact will not reduce their responsibility for the financials. Okay, just because they are not there, they still have the responsibility for financials as a whole. Therefore, the auditor can request representations from current management. They must provide representation for entire period, even though they were not the management, they were not part of the management during that period. Are you clear? Finally, conclusions and reporting. For example, if requested representation they didn't provide, I'm asking, they're not providing, then I will discuss the matter with management and those charged with governance. Add here also those charged with governance if you want. Okay, I will discuss the matter with management and those charged with governance. Now they're suddenly not giving. All these days I thought, when I'm doing audit from past 7-8 months, I thought they're good, cooperative, honest. Now since the moment they say they won't give, I have to evaluate management's integrity, and I have to evaluate the impact on reliability of other audit evidence and other representations in general, and take appropriate action, including disclaimer. Suppose they gave representations, and guess what? The representation I got is inconsistent with other audit evidence I obtained. If the auditor has concerns about competence, integrity, or written representations are inconsistent with other audit evidence, I got a doubt on management competence. I feel they're not competent to prepare financials. I feel they don't have honesty. I feel they're not careful. They're careless. So if auditor has a doubt on competence, integrity, ethical values, and diligence and commitment of the management, or written representation they provided, they're not matching with other data which I had, means whatever representation they provided, I got a doubt. I'm doubtful of them. I'm not trusting it completely. Then perform procedures to resolve the matter. You try to resolve it first. If it is not resolved, check their integrity and competence and integrity, competence, ethical values, diligence, everything. Determine what is its impact on reliability of other representations and evidence in general, and take appropriate action, including disclaimer of opinion. That's it. Major standard over. 90% of the standard I covered, except some 1 or 2 issues. Okay. You're confident the written representation must be as near as practicable to audit report, but not after the date of audit report. So auditor has to consider events up to the date of audit report that may affect the financials. So summary is what? In this standard, there are 2 types of representations. Written representations about management fulfillment of their responsibilities related to preparation of financials and relating to completeness of information provided to auditor, relating to completeness of transactions accounted in, reflected in financials. 2. Auditor has to obtain management representations regarding other items. As I know, for example, when there is a requirement in other standards on auditing, or when there is a requirement when the auditor feels necessary to obtain related to a financial statement matter or specific assertion therein. Am I right? That's it. That's what entire like top down. Clear? So 1 or 2 points only. I'm not just covering it. Okay. So rest all major predominant standard from exam point of view I have covered. Correct? Everything I covered almost except 1 or 2. That intention, management intention, judgment, that point I'm ignoring. But you should read that. This is one more representation. What is one more representation? Representation about, in our book, obtaining information, obtaining evidence about judgments and intentions, plus written representation about specific assertion. These 2 together you should read. In exam, sometimes they'll ask you, write about written representation about specific assertion. They'll ask you. First you should write this matter. Then you should write this matter. Are you clear? Okay, in our regular class I discussed clearly. Okay, but since it's a marathon, it's sufficient. Whatever I discussed is sufficient. Unless the paper want to be really tough, they will ask these kinds of questions. Otherwise they will not ask. Okay, mainly from exam point of view, whatever revision is required, I did for 580. Confident or not? Once again, those of you who did not watch, once again go back and watch. But before that, read once the standard, and then again come back and watch this marathon. You will really connect it to it. Because 580 standard is so big, you can't understand it one time. You can't understand it by one reading. So that's why first read the standard, come back and listen to the structure which I told. What is most important in the 580 discussion I did, the structure of the standard is, the structure at which I discussed the standard. That structure is very important. If you do not understand the structure, okay, there are 2 types of representation. First type has again sub 2 types. Second type has again sub 2 types. There is a 5th category altogether. If you do not understand the structure, you feel like reading the same and same again and again. You feel like, whatever is there in the first point, there only in the 5th point also same is there. No, you feel like that. Am I right? So first time when you read the standard, you feel like the standard is repeating itself every time. No, each point is different from each other. Correct? That's it. 580 is also completed. Confident? Yeah. Now let us revise SEA 260 standard. Communication with those charged with responsibility. There are 2 communication standards that are dealt in this chapter. One is 260, communication with those charged with governance, and the second one, communicating deficiencies in internal control with those charged with governance. Now first let us look at what is there in SEA 260. So SEA 260 says the auditor has to communicate with those charged with governance certain matters. What auditor has to communicate? 5 things auditor has to communicate. First one, auditor responsibilities. What auditor has to communicate? Auditor responsibilities. Responsibilities means what? That auditor is responsible for forming and expressing opinion on financial statements. Yes or no? Whether they are free from material misstatement. The auditor has to communicate this responsibility. By the way, just because he communicated this responsibility, does it reduce management responsibility and those charged with governance? Can they evade from their responsibilities? No. Two. Second thing this auditor has to communicate is planned scope and timing of the audit. The auditor has to communicate the planned scope and timing of the audit. Correct? Even you can see in our material also. So what auditor has to communicate? Matters to be communicated. Yes or no? First thing, auditor has to communicate their responsibilities, that they are responsible for forming and expressing opinion which are prepared by on the financials prepared by management under the oversight of those charged with governance. The auditor will provide an overview of planned scope and timing of the audit, including significant risks identified. Many students will miss to write this point. Keyword, including significant risks identified. That is most important keyword. Third one, the auditor has to communicate significant findings. Yes or no? The auditor has to communicate significant findings. What are significant findings? First one, what is the auditor's view on qualitative aspects of entities accounting practices, including significant, what is it? Including significant accounting estimates, including significant accounting assumptions. Yes or no? And accounting disclosures. Yes or no? Further, sometimes no, auditor will identify in the entity some accounting practice which is permitted as per applicable framework but not suitable for this entity. Yes or no? Maybe the company is following a weighted average method of accounting for inventory, but it is not suitable for the company, because for the company FIFO method is suitable. Weighted average is permitted as per standard, but it is not suitable for the company. Tell management, explain management why an accounting practice that is suitable and that is acceptable in the framework but not appropriate in this company, explain them. So communicate all your findings on accounting practices. Second one, you communicate significant difficulties that are encountered in audit. I told you, like GST, for example, the auditor has to prepare GST reconciliation, which management should have supposed to prepare. Significant difficulties you communicate. Third one, significant matters. This you will communicate first to management. If at all those charged with governance are different from management, once again you communicate significant matters to those charged with governance. Then written representations auditor is requesting. So what are all written representations auditors want? That also auditor has to communicate. Then the last one, circumstances affecting form and content of auditor's report. Many students here, they will write auditor's opinion. What circumstances are affecting the auditor's report form and content? I told you in the reporting chapter, I revised and I told you modified report is different from modified opinion. Yes or no? Here circumstances affecting report modification means emphasis of matter para you are including, other matter para you are including, other information para you are including, comparative information, disclosure you are including. Any reason when you are modifying the report, that circumstance should be communicated to management. And the last one, any other significant matter, yes or no, which auditor feels it is important for those charged with governance. It is important for them. Any other matter which auditor feels. These are all matters the auditor has to communicate. Now in exam, they may straight away ask on significant findings in audit. That's it. This entire matter you have to write. Clear? Now what are significant findings? Qualitative aspects of entities accounting practices, significant difficulties account in audit, significant matters and written representations auditors required, modifications to auditors report, circumstances affecting form and content of the auditor report, any other significant factor. And most important in the standard, communication of auditor's independence in case of listed entity. If at all you are an auditor for listed entity, regarding independence, you should communicate with the management a statement. You should give a written statement about compliance with ethical requirements on independence by the firm, by the team and by the network firms. So that firm and the team and network firms, they should give a communication in statement, in writing to the company that we complied with independence and ethical requirements. For example, one of the ethical requirement which we will come across in CA final is the fees charged for audit should not be less than fees charged by the auditor for providing consultancy services, other services. That's an ethical requirement in Code of Ethics of ICAI, which we will be covering in CA final. So that is one of the ethical requirements. Suppose you are acting as an auditor for listed entity and you are providing audit services. You are also providing some consultancy services to the company. Okay, and consultancy service you are charging 2 crore. For audit you are charging 1 crore. It is a non-compliance of ethical requirement. So auditor has to give a statement to the management, to those charged with governance. Auditor has to confirm through a statement that they complied with ethical requirements. Who complied? The firm, the team, and the network firms. They all complied. That they need to. And the next thing what they need to communicate, the auditor has to communicate details of relationships and other matters that may impact independence. What are all the relationships I had with this company and any other matter which will affect independence, including how much fees I'm charging for audit, how much fees I'm charging for other non-audit. With categorization I should report, with the categorization I should communicate, so that it will help those charged with governance to assess my independence. Not only independence threats I will communicate, I will also communicate safeguards I applied to eliminate the threat and to reduce the threat to an acceptable low level. So all these I should communicate. What I should communicate? Tell me. The auditor has to communicate matters to be communicated. First one, auditor responsibilities related to financial statements, please communicate. Second one, planned scope and timing of audit including significant risks identified by the auditor. Third one, significant findings in the audit. Fourth one, auditor's independence related communication in case of listed entity. Significant findings below, qualitative aspects of entities accounting practices. 2, significant difficulties encountered on audit. 3, significant matters arisen in the audit which are not communicated to the top management but may be communicated to management. 4, circumstances that affecting form and modification of opinion, written representations the auditor is asking for. And last one, the auditor has to communicate any other significant matters that are relevant to oversight of financial reporting based on professional judgment of the auditor. This is the most important thing in this entire standard, matters to be communicated, which is most frequently tested question. Then in order to communicate, you should establish a communication process. What do you mean by establishing communication process? The auditor shall communicate with those charged with governance. In what format you communicate? Writing, oral, phone, WhatsApp, mail. Timing, when generally you communicate, what you communicate, general content of the communication. And remember, all significant findings you must communicate in writing wherever oral communication is not sufficient. Again, having said that, you don't have to communicate each and every matter in the audit, am I right? And the auditor has to ensure that there is always a two-way communication and is adequate. The auditor has to ensure adequacy of the communication process. If at all auditor is feeling the communication between auditor and management, top management, is not appropriate, not adequate, it definitely leads to risk of MMS. It definitely impact in obtaining evidences that we want. Therefore, auditor has to take an appropriate action. Now, under SCA 260, what auditor has to document? The auditor has to document any matters communicated orally. When you communicated, with whom you communicated, what you communicated, document. And whatever you communicated in writing, no, the auditor shall retain a copy of it as a part of documentation. Suppose you communicated over mail, take a print of the mail and then keep it in your working paper file. That's it. Are you clear? Then finally, what is the objective of auditor? The objective is very simple: to clearly communicate auditor responsibility, to clearly communicate planned timing and scope of the audit, and to clearly communicate timely observations, yes or no, that are significant and relevant for their role. To those charged with governance, timely observations I'll communicate which are significant for them to discharge their oversight responsibility, yes or no, and thereby by communicating with them, what I will get? Evidence. And therefore the standard is promoting an effective two-way communication. Tell me, why an effective two-way communication is important in this standard? Why an effective two-way communication is important? For those charged with governance, this communication is important to reduce the risk of MMS. For auditor, this is important to obtain information about the entity and environment, to obtain sources of evidences. For both of them, it is very important for maintaining a constructive relationship while still maintaining independence and objectivity. Now, who are those charged with governance? What do you mean by those charged? These are persons, or it may be an organization, who have three functions. What are the three functions? Who are responsible for strategic direction, who are responsible for accountability, which includes financial reporting responsibility, financial reporting process. So no, in some entities, no, those charged with governance will also include management personnel. So those charged with governance is based on governance structure, and governance structure is dependent, those charged with governance is ultimately based on governance structure, and this governance structure is different for different entities based on culture, legal background, size, ownership. For some entities, no, there will be supervisory body separate from board of directors, separate from board, executive board, supervisory board will be there, executive board will be there. In some entities, no, both will be performed by single board. In some entities, no, those charged with governance is a legal position. For example, board of directors in a company. And in some entities, no, governance and management will overlap with each other. Means they will be one and same, or they may be different. And ultimately, governance is a collective responsibility of the governing body, like a board of director, like a partner, like a LLP. In case of LLP firms, for small entities, no, governance will be with just one person. Because of this diverse structure, auditor may not always identify. Correct? It is not possible for the auditor to identify who exactly is those charged with governance. It is not possible for him. Sometimes, no, family businesses will be there. Yes or no? Non-profit entities will be there. In these businesses, formally, there won't be any structure formally. So what is the best way to know who is exactly those charged with governance? It is advisable for auditor to always discuss and agree. It is advisable to discuss and agree with engagement party on who are the relevant persons to communicate. For this purpose, you do risk assessment, right, at the beginning of the audit, where you understood the entity and its environment, right? When you're understanding the entity and its environment, you would have already understood who are the persons in the organizations, all that, right? That understanding will help you to decide what matters to be communicated to who. That's it. This is what those charged with governance, communication with those charged with governance, communication to those charged with governance. Are you clear? That's it. The standard is over. 260. Simple. Got confidence? Now once again read this, you will be mastering it. 450 standard, we are beginning that. Yes, one of the small standard, but the level at which a question can come from that standard is in depth. Even in CA Inter, even in CA Final. CA Final also we have the standard. And guess what? In the recent Jan exam, in CA Final, this question was tested. In CA Final, and this question was tested. In the recent Jan exam of CA Final Audit, this question, communication and correction of misstatements identified, is tested for 5 marks. Now, anyhow, I'll directly begin SCA 450 first. Now, what is this SCA 450? You know, typically, I told, right, 3 topics that we are going to discuss right now in this particular live. One is 450, 265, risk assessment, audit program planning, and then audit strategy planning and program. Now, by the way, these 2 are 2 different chapters. Whereas 450, 265 is explained in completion and review chapter. This is there in ICA book in which chapter, ma? Completion and review. In that chapter, we totally have, in that particular chapter, we totally have 6 standards. What are the standards that we have? 260, 265, 560, 570, 580, then 450. These are the 6 standards that were there in completion and review chapter. Within these 6 standards, in the chapter, 570, 580, most important. The next best and most important standards are 265, 450. In completion and review chapter, these 4 standards are extremely important. Then of course, 560, 260 is also equally important. Okay, anytime, any question can come. But if you ask me to prioritize, this is how I prioritize. Now, first one, SCA 450. What is 450 standard? Evaluation of, what is it? Evaluation of misstatements. You see, they are not using the word material. Some students by mistake use the word material here. Never, never. Here, for the first time, we are evaluating mistakes. The first time we are evaluating mistakes. Evaluation of misstatements identified. Evaluation of misstatements identified during audit. Evaluation of misstatements identified during the audit. Sometimes in exam and MCQ can be tested where heading itself will be tested. You know, in headings, no, options will give you. Option number A, evaluation of material misstatements identified during the audit. Option B, evaluation of trivial misstatements identified during the audit. Evaluation of misstatements identified during the audit, and some other option they'll give you. You should be very clear. It's only evaluation of misstatements identified during the audit, guys. It is not material misstatement word. Only in this standard we evaluate whether it is material or not. Now, what the standard first it is saying, what are all the topics first of all were there in the standard? First one, the standard talks about, actually in this standard there are 3 topics only. Accumulation, first topic is in the standard, first subtopic is accumulation of misstatements. Accumulation of misstatements. You see, again, I'm not using the word material here. Accumulation of misstatements. Second one, communication and correction of misstatements. Communication and correction of misstatements. 3, documentation. That's it. Only 3 topics were there in the standard. In this 450 standard, we only have just 3 topics. 1, accumulation of misstatements, communication and correction of misstatements, and documentation of misstatements. What this accumulation of misstatements says. First of all, before I proceed even further, there is one definition which is given in the standard. There is only one definition given in the standard. Uncorrected misstatements. What is it? Uncorrected misstatements. There is a definition for uncorrected. Now, if you want to understand what is uncorrected, first of all, you should understand what is a misstatement. I hope every one of you know, you would have seen this misstatement meaning. Misstatement means what? It's a difference between amount, classification, presentation, disclosure. It's a difference between amount, classification, presentation, disclosure of reported financial statement item and amount, classification, presentation, disclosure that is required as per applicable financial reporting framework. If there is a difference between what is reported and what is applicable as per framework, the difference is called as what? Misstatement. Amount, classification, presentation, disclosure of reported financial statement item versus applicable financial reporting framework. What is required in the framework and what you reported in the financial statements. If there is a difference, that is called as a misstatement. And this misstatement can either happen in amount, classification, presentation, or disclosure. Okay, so that is misstatement definition. Now, in audit, definitely in audit, we identify some mistakes. Yes or no? We definitely identify some misstatements in audit, right? When we are doing audit, we would have come across for sure certain misstatements. Now, those misstatements are called as identified misstatements. Those misstatements are called as what? Identified misstatements. Tell me, we all know that we do audit in a sampling. We do audit on a sample mechanism. As or no? We take only sample of transactions and we verify. And based on that only, in the sample only, we find mistakes. Am I right or not? So those mistakes are called as what? Identified misstatements. There are some other misstatements which might be there in the books of accounts, which might be there in the financial statements, which auditor did not identify. There might be some other misstatements which auditor did not identify. Those misstatements are called as undetected misstatements. Those misstatements are called as what? Undetected misstatement. By the way, what is the definition given in the standard 450? Uncorrected misstatement definition is given in the standard 450. What is uncorrected misstatement? It is something auditor identified. It is something auditor identified, and he communicated to the company also. He communicated to management and those charged with governance. But guess what? These people did not correct them. Means the misstatements communicated by the auditor to the management is not corrected by the management yet. Finally, those mistakes which auditor identified, communicated, and not corrected in the financial statements were remained uncorrected, and those misstatements are called as uncorrected misstatements. And those misstatements are called as what, ma? Uncorrected misstatements. Those misstatements are called as uncorrected misstatements. Now, what auditor has to evaluate? What auditor has to evaluate? This standard has 2 objectives. This standard talks about 2 objectives. Auditor has to evaluate. The auditor has to evaluate impact of misstatements. You see the word, they are not using the word material once again here. Impact of misstatements identified. The auditor has to evaluate impact of misstatements identified on audit. You see, I'm using the words very clearly. Second objective of the standard, the auditor has to assess. The auditor has to assess impact of uncorrected misstatements on, look at the word, financial statements. This is what the auditor objective is. SA 450, what is the objective of the auditor? An MCQ can come. They can ask 4 options. Impact of misstatements identified on financials. Here they'll put the word in MCQ financials, whereas here they'll replace the word with audit. Wrong. They will use impact of uncorrected misstatements on audit, or impact of unidentified misstatements on financials, or impact of uncorrected misstatements on going concern. Like that, some words and all they'll use. That's not the right answer. By the way, I just want, are you all with me? Are you all with me? I'm telling you guys, you are going to get enormous clarity and enormous grip and enormous observation with respect to answering MCQs. That I can assure you by the end of this live session. So tell me, everyone, just comment whether are you all with me continuing. And also, I request you to like the video, because I know you're liking the content, but you're not liking the video. So just request you to like, and then pass on your comments also. So that's a very good, that is what the appreciation that makes us continuously hook and make us to do live videos. If at all there is no appreciation or likes that we receive, obviously it will not motivate us. Okay guys, just like the video. Fine. Now so look at SCA 450. The objective is assessing impact of misstatements identified on audit. See, the moment you identify mistakes, what is its effect on audit? Generally when we identify mistakes, we revise our audit procedures, we revise our audit strategy, we revise our audit planning. Okay, and finally we revise and we do audit as per revised plan, revised strategy, and we still try to identify a level based all the mistakes. And once the mistakes are identified, we communicate to the management on a timely basis. Why we communicate them? Because we in the sample only we identified these many mistakes. In population, how many will be there? So for that reason, we communicate management and we request them. What is it? We request them. Just look at this entire introduction, what I'm giving, this entire background. Then if you see the book, nothing. That standard is nothing. So the objective, why are we communicating? Sir, in the sample only we identified these many mistakes, sir. In the population, how many mistakes were there? We don't know. So it is so high. So we communicate the management about identified mistakes so that they investigate. We ask them to perform additional procedure. We ask them to perform procedures to identify actual misstatement in the financial based on projection of the misstatement by the auditor. For example, the auditor, based on the mistakes identified, we analyze the mistake. Generally, when we identify mistake, what we need to do? We need to analyze it. What we need to analyze? Nature of misstatement and circumstance under which it occurred. Circumstance of occurrence we need to analyze. Two things we need to analyze. One is nature. And the second thing that we need to analyze is circumstance under which it occurred. Nature of the misstatement. Is it intentional or unintentional, or fraud or error? Circumstance of their occurrence. Is it occurred at the end of the period or during the period? Anyway, you can call it as anyway. Okay, so nature of misstatement and circumstance of occurrence. So this we will look at. And we need to, in the standard 450, they told you two circumstances. They told you two circumstances where we have to revise our audit strategy and plan. Under 450, they told two circumstances. One, if the nature of misstatement identified and the circumstance of misstatement identified indicates some other potential misstatements, some other potential misstatements might exist. Potential misstatements might exist. Some other potential misstatements might exist. If based on the nature of the mistake identified and the circumstance under which it occurred, if you see that, if you look at the observation, they are repetitive in nature. You found that these mistakes are repetitive in nature. Repetitive mistakes are called as non-anomalous. Repetitive misstatements are called as non-anomaly. They are not anomaly. You have this anomaly, non-anomaly terminology in SA 530, which is very important discussion in SA 530 sampling. Okay, fine. So there is no misstatement, or the nature of misstatement and circumstance. Like when you observe the misstatement, suppose if it is error. For example, an employee, instead of typing 10,000 by mistake, they typed 1 lakh rupee in a particular transaction. That's a very rare. It won't repeat. So can I say just because of this mistake, everywhere all 1 lakh transactions are wrong only? I cannot say that. Yes or no? So based on the nature and circumstance, if at all I feel some other potential misstatements might be existing, then that is one circumstance. Or the misstatements identified, the misstatements accumulated, approaching materiality under SA 320. If at all the misstatements identified by me is approaching materiality under SA 320, then under these two circumstances, the auditor has to modify audit strategy, audit plan. The auditor has to revise the strategy and plan under these two circumstances. Not only revising, once you identify the mistake, you generally get it out. How much mistake is there in financials? Apart from revising the strategy and plan, you also request management to do an in-depth investigation of the class of transaction. You might have found a mistake in one class of transaction or one class of account balance, right? In that class of transaction, in that account balance, you request management to identify actual misstatement, yes or no, based on, why you ask the management to identify actual misstatement? Based on projected misstatement by the auditor, based on projection of the misstatement by the auditor. So you will ask management to identify actual mistake, because only when the actual mistake in the purchases, total purchases means population, for example, only then we can correct it. We cannot pass entry in the books of accounts based on projection. We cannot ask management to pass a journal entry, sir, in 100 samples I found this much mistake, 1 crore. Whereas total purchases are 10,000 transaction. So in 100, 1 crore means 10,000 transaction, 100 crore mistake. So you can't project just like that. And you can't ask company 100 crore you rectify. What? How they will rectify? Where they will rectify? So you ask management to identify what actual mistake is. Then, so this is what the accumulation of misstatements concept. Accumulation concept is this. By the way, what mistakes you should accumulate, what mistakes you should accumulate, the standard says very clearly, those misstatements which are clearly not trivial. The standard very clearly says auditor has to accumulate all the misstatements that they are identifying which are not clearly trivial. Now remember, here I'm giving you somebody is asking Hindi translation. No guys, you're writing exam in English, and the very reason why audit paper feels tough, the very reason why you feel not connected to the subject is you're listening in Hindi, you're listening in regional languages. If you listen in regional languages and understand, you need to translate to English, and again when you're reading the content in English, it is very tough for you to get back the connection. That's why right from the beginning, initially only it will be difficult, but once you habituated to it, you will understand the subject like anything. The grip that you get, the observation you get is like anything. Fine. Now accumulate those misstatements which are not clearly trivial. By the way, what do you mean by not clearly trivial? Just a minute. Yeah. So now trivial, there is a new word called trivial. Now what is this new word? Triviality means what? First here I'm giving you an introduction to materiality concept, guys. This introduction, once again, I will not give in 320 because we are discussing 320 standard in risk assessment internal control topic. There once again I will not give. Look at, there is a concept called overall materiality, performance materiality, triviality level materiality. Triviality level means what? Triviality level means negligible. You can call this as what? Negligible. Triviality can be referred as negligible. Now what is this? For example, the overall materiality is 0.5% of turnover. For example, if you take Reliance company, they have a turnover of 10 lakh crore in the consolidated financial statements. Their turnover is 10 lakh crore. 0.5% means what? 5,000 crore. What is it? 5,000 crore. 0.5% means 5,000 crore. Okay, 5,000 crore. This is overall materiality. But what is overall materiality meaning? If at all the total aggregate of the misstatements in the financial statement is exceeding 5,000 crore, which auditor identified, the aggregate of mistakes, total of all the mistakes that we identify, if it is exceeding 5,000 crore, we assume that yeah, this live session will be available in the channel even after end of the live, no doubt. Fine. So the total of the misstatements identified is crossing 5,000. We assume that the financials are materially misstated. And we give a modified opinion on those financials. But remember, when we are doing audit, this materiality level directly we can't use it. For performing the audit, we keep a lower level of materiality. Let us assume 3,000 crore I'm keeping performance materiality. Why? Because I'm doing audit only based on sample. I'm not verifying 100% population. If at all the mistakes I identify in sample, the misstatements I identify in sample, if at all they're reaching this level, only in sample, if at all they're reaching my performance materiality level, definitely what I assume is total real misstatement in the financials is much more than overall materiality. Performance materiality is like an early alert. It's like a early warning to the auditor. Dear auditor, you found so many mistakes in the sample itself. Definitely remember, in the overall financials, the actual misstatement which you did not detect it because you're doing audit on sample would be much more higher. So it's like an early warning system for the auditor. Early warning level materiality, I can call it as. Okay, warning level materiality, performance materiality. Then there is another thing called triviality. What is this triviality? Triviality level, like 5,000, 3,000, right? Triviality level can be 10 crore. Substantially trivial. Trivial means what? Negligible. Trivial means what? Negligible. Are you clear? By the way, some students think that trivial is equal to immaterial. That's wrong. Trivial is equal to immaterial. That's wrong. You cannot say it is immaterial, trivial. What is triviality level? Necessity. Suppose no, we are doing our audit. No, in audit, no, we'll be finding some mistakes. For example, one of our article found a mistake of 1,000 rupees in voucher, some 2,000 rupees in voucher, and he is adding all these vouchers in his list. He, whatever the mistake is finding, he is adding. There are negligible. Look at the size of the company. 10 lakh crore. What is this? 1,000, 2,000 rupees? Petty mistakes. Ignore that. So I should tell my articles and all, you know, below a particular amount, don't even bring it to my attention. That amount is called as triviality level. So any misstatement that you identify in audit which is below trivial, don't accumulate. If it is trivial level and above trivial, accumulate. If the mistake you found is 10 crore and above 10 crore, all those misstatements you should accumulate. Accumulate means what? Take a note of it. Later on, total it and then compare it with performance materiality. If at all it is reaching performance materiality, revise audit strategy and plan, ask management to do further investigation, communicate to the management, ask them to correct it. If they do not correct it, assess the impact on the financials and take a call to give a modified opinion or unmodified opinion. Over. This is what the standard is. Now let's look at what is given in the book. I told you uncorrected misstatements. It refers to misstatements that auditor accumulated during the year but not been corrected. What is the objective of the standard? You know, before forming the opinion, the auditor has to evaluate effect of identified misstatements on audit, effect of uncorrected misstatements on financials. You see, nowhere we are using the word material. Effect of uncorrected material misstatements. We are not using the word material here. Understood? Next, first, accumulation. In exam, this itself can be asked as a 5 marks question, guys. Accumulation of misstatements. What do you mean by accumulation of misstatements? Accumulation means what? The auditor shall accumulate misstatements which are identified in the audit. Which mistakes? Only those misstatements which are above trivial, except those that are clearly trivial. Except those that are clearly trivial means what? Trivial and below trivial mistakes don't accumulate. Only trivial and above trivial accumulate. Then examples, misstatements, omission of transaction, recording a capital expenditure or revenue expenditure. These are all examples of misstatements. Overvaluation of inventory, undervaluation of inventory. Then once the auditor once auditor identifies, the auditor will determine based on misstatements accumulated by him whether overall strategy plan need any revision. If nature of mistakes and circumstance indicates other mistakes or aggregate misstatements accumulated approaching materiality, in these two cases, that to which level of materiality? Performance materiality level, then automatically the auditor has to revise the materiality and not only revise the audit strategy plan. Not only this, auditor will also, based on accumulated misstatements that we identify, we also request management, please review that entire purchases and sales, to understand the reason behind the misstatement. I already know some reason. You also investigate and let me know what is the exact reason. And if management has identified and corrected misstatements, like, we requested them, right? We request them. By the way, we also request one more. We also request management to perform procedures to identify actual mistake and make adjustment to the financials. How we request them? Based on projected misstatement that we have. Based on projected misstatement that we determined as per 530 standard, the auditor has to request management to perform procedures to identify actual mistakes and make adjustment to financial statements. How we will request this? Based on, for example, projected misstatement. Now, if management, as per our request, they identified total mistake and they corrected the financials, then once again auditor has to ensure there are no misstatements in the financials. This is what accumulation of misstatements concept, guys. Please remember, this is what accumulation of misstatements concept. Whenever in the exam 5 marks question accumulation of misstatements is asked, this you should write. Then communication and correction of misstatements identified, not only accumulation. You communicated management and asked them, right, how you should communicate, what you should communicate. First of all, you should communicate on a timely basis. The auditor shall communicate timely all the misstatements accumulated during the audit to appropriate level of management. And for this communication, what management can respond, how management, this enables management to evaluate what the mistake you communicated, or, sir, it's not a misstatement, sir, you felt it's a misstatement, management will disagree, or they may take corrective actions. Okay, now why are you communicating? What is the purpose of communicating? Ask them to correct, request management to correct. Why you need to ask them to correct? Why? What is the necessity? This correction helps to maintain accurate record and reduce risk of future misstatements caused by these cumulative uncorrected errors. If at all errors are not corrected cumulatively in future, all these current errors, if at all not corrected in future, they will have a huge impact. So to avoid that scenario, you ask them to correct the misstatements so that financial statements present true and fair view. Then suppose if management is refusing, sorry sir, we will not correct because we already freezed, we already closed the books of accounts, we are already starting another financial year, it's tough for us to close, it's tough for us to correct the financial statements, and they are saying this is not a mistake also sir, you are thinking it's a mistake, this is not a mistake. Understand management reason why they are not correcting and take that understanding in evaluating whether financials are free from misstatements, because you might think it's a material misstatement, but company might have a different perspective, sir. That's an accounting treatment, sir, which is right in our company. Maybe in another company the situation is not there, so they might give us a reason. So look at that reason, then evaluate. Now management have not corrected some mistakes, right? Uncorrected misstatements means some mistakes were not yet corrected. Evaluate, confirm whether materiality is still appropriate. Now uncorrected misstatements were there, right? Before you evaluate, that one important point is there. See, materiality level I told, right? Performance, overall, triviality, that we decide at the beginning of the audit based on estimates. But at the closure of the audit, right now I'm concluding the audit. Before concluding the audit, before forming the opinion, I'm evaluating the uncorrected misstatements impact on financial statements, right? So the uncorrected misstatements impact on financials before I evaluate. Once again I will check materiality, whether is the materiality which I calculated correct or not, because original materiality is calculated by me was based on estimates. Now actual figures were there, so whether materiality is still appropriate, decided based on actual results prior to once again evaluating uncorrected. Then determine whether uncorrected misstatements are material or not, yes or no, considering size of the amount, size of the mistake, nature of the mistake, and circumstance at which it occurred. Further, prior period uncorrected misstatements, if at all you notice prior period, take that also into account and communicate with those charged with governance. Guys, ask them to correct. The auditor shall communicate those charged with governance uncorrected misstatements and what is their impact, and request them for correction. Also communicate them effect of prior period misstatements on current year, and obtain a finally written representation. What representation? Uncorrected misstatements. Top management, once you communicated misstatement, they will give you a reply. Sir, yes sir, we will correct some mistakes, sir, but some mistakes we don't require any correction, sir, because they are immaterial. Get a representation that uncorrected misstatements together are immaterial. So management is saying, top management is saying that they're immaterial. So get a representation. And what is the list of mistakes that they have not corrected? Get a list also. Then finally, auditor has to document 3 things here. Auditor has to document 3 things here. Yeah. Auditor has to document 3 things. What auditor has to document? The auditor has to document what is triviality level. Documentation must include amount below which misstatements are clearly trivial. Clearly trivial means clearly negligible. And document all misstatements accumulated. Whatever mistakes you identify, accumulate it. And also write the status of correction, whether it is corrected or not corrected. And the auditor's conclusion. Some mistakes were not corrected, no? What is your conclusion of uncorrected misstatements? Are they material or not? And what is the basis for the conclusion? In exam, when a student is writing documentation, this basis point they'll ignore. And some students will ignore, auditor's conclusion on uncorrected misstatements. This entire conclusion point they'll ignore. And here, the auditor shall document all the mistakes identified. This they will write. But which are clearly considered trivial, this point they'll forget. Okay, amount below which misstatements are clearly, auditor must document, the audit document must include the amount below which, means triviality level you should document. That fact they will forget to write. And even in communication, the audit, many will forget to write reevaluation point. If at all a question asked on communication and correction, many students will forget on reevaluation point. See why people don't score full in audit? Because their answer is not complete. Many students often ask me, sir, how to present in paper, how to present. It's not about how to, it's very clear what to present in paper. You should write, for example, a question, communication and correction is asked. First you should write importance, timely communication, why it is important. Then you should write about requesting management to correct. Then you should write about if management refuses, what to do. And if management refuses, mistakes are there uncorrected. You need to evaluate what is its impact on the financials, right? But before assessing the impact, decide materiality, then you should finally communicate to top management. These are all uncorrected misstatements. Please, if possible, correct it. If you don't correct it, it will impact the audit opinion. Tell them, get a representation, and finally documentation. See how structure is there. Are you writing all these points in exam? That decides whether you score full score or not. That's it. 450 standard is over. That's it, guys. 450 standard is over. Just give me a comment below. Just comment below. Have you learned something new in the 450 standard? Have you got the clarity on the 450 standard? A decent clarity. I have given I have given a very decent idea. 40 minutes I spent almost only on 450 standard. Just give me just 2 minutes, guys. Just give me in the meantime. Yeah. Yes, guys. We'll proceed now discussing 265. Yes, let's continue. Let's continue. SEA 265. In every attempt between 450 and 265, either both the standards are being tested or any one is pakka tested. Now 450 standard, I showed you how simple it is. Now 265, this is also one of the simplest standard. In this particular 265, there are 3 topics that are mainly there. By the way, what is SEA 265? Communicating deficiencies in internal control to those charged with governance and management. Many students are forgetting in exam to write the heading completely. They are missing the word management. Okay, missing the word management. That's it. Somebody is asking in 450 standard a doubt, the amount below which, very simple, triviality level is there, that you should document. That's why watch full video. In between I clearly told what is triviality level. So what is triviality level, you decided. Triviality level means what? By the way, in 450 standard, below that level, any mistake you identify, you ignore it. Once whatever the trivial level is there, right, above that value you will document it, you will accumulate it, and you will document also, and you will also record the status of that mistake, corrected or uncorrected. If it is uncorrected, you will evaluate the impact of it on the financials. You will communicate to management to correct. You will communicate to top management if at all management does not correct. You will communicate to those charged with governance and you ask them for correction. If they also do not correct, ask them a written representation that why they are not correcting it, and if at all they feel that it is immaterial, ask that. So that is the impact of the entire standard. Fine. So communicating deficiencies in internal control to those charged with governance and management. By the way, some students are watching at a higher playback speed. Never do that. Just watch at standard speed. I'm telling you, you get a very good clarity. See, it's not about finishing the video, it's not about the finishing the lecture, it's about observing it, understanding it, absorbing it. What is most important when you watch a video? Observing. You should absorb some content. If you want to absorb, you have to watch at standard speed for a best exposure, best clarity. The way you understand things is different. Fine. Now 265 standard, communicating deficiencies in internal control to those charged with governance and management. So in the standard, you have to communicate deficiencies in internal control to 2 people. 1, those charged with governance, and 2, management. You know what? This standard divides deficiency in internal control into 2 types. What are they? Significant deficiency, other deficiency. Significant deficiency, what you should do? You should communicate to 1, those charged with governance, and you should also communicate first, at a first level, the moment we find any significant deficiency or deficiency in internal control, first we will communicate to management. This point many will miss. Further, what you should communicate to general management, other deficiency, you should communicate to management, which means as per the SEA 265, you should communicate to those charged with governance. You should communicate with those charged with governance only significant deficiencies. Whereas to management, you should communicate 2 types of deficiencies. What deficiencies? 1, you should communicate first type of deficiency. You should communicate, of course, significant deficiencies that auditor identified. He should communicate. Other deficiencies also he should communicate. Now, fine, sir, we understood significant other briefly. What is first of all a deficiency, sir? What is first of all a deficiency? Deficiency in internal control. What do you mean by that? Internal control deficiency means what? Either control is ineffective. Either the control is ineffective or the control is missing. The control is missing or the control is ineffective. Either of this. Either the control is ineffective or the control is missing. Both will be treated as what? Deficiency. Control is missing. Okay. Now, once the auditor identifies the deficiency, he should analyze whether it is a significant deficiency or not. How do I analyze whether it's a significant deficiency or not? Significant deficiency means what? What is likelihood of occurrence of misstatement? What is the likelihood of occurrence because of the deficiency? What is the likelihood of occurrence of misstatement? And magnitude of the impact. And because of this deficiency, how much it will impact in the financial statements? One is likelihood of occurrence, another one magnitude of the impact. Remember, these two sentences, they are important factors for analyzing. These two are important factors for analyzing whether a deficiency is a significant deficiency or not. Okay, these are important factors. Now, same wordings, similar wordings, likelihood of occurrence, magnitude of impact. These the same wordings were there even to decide material uncertainty related to going concern under SA 570 MURGC. Material uncertainty related to going concern, there it is used. In SA 315, significant risk analysis is there. Significant risk discussion is there. There also it is used. So significant deficiency, these wordings are used. Significant risk, the wordings are used. Material uncertainty related to going concern, also the same wordings were used. So likelihood of occurrence and magnitude of the potential of the impact. So these are the two sentences which are important everywhere. Fine. Now, so I understand. So deficiency, significant deficiency, meaning we understood. And now what exactly in the standard it is there? These are the topics that were there. First one, factors influencing significant deficiency. What are the factors based upon which auditor will decide whether a deficiency is a significant deficiency or not? This is one of the important questions. There is another question in this standard. There is another important topic. Indicators. What is it? Indicators of deficiency. This is second one. And third one, communication of deficiency. That's it. Only 3 points are there in the standard. One is factors influencing significant deficiency, indicators of significant deficiency, communication of deficiencies. Here it is not significant. Communication. How to communicate, what to communicate. Okay, what points to be included in communication. That's it. Only 3 topics are there in this 265. If you are good at these 3 topics, you are sorted. You are done with 265 standard. You can damn sure score 5 out of 5 on that particular paper. That's it. Now look at. So what is SA 265? The standard deals with how to communicate deficiencies in internal control to those charged with governance and to management. Yes or no? Now look at. So the auditor must understand, first of all, how you will identify controls related loopholes only when you understand the internal control. So why you need to understand control? To identify and assess risk of MMS. By the way, you are checking internal control. Does it mean your objective of audit is to give opinion on the effectiveness of internal control? No. Your objective of audit remains same. Your objective of audit is to give opinion on financial statements. It is not for the purpose of giving opinion on internal control. Then why are you checking internal control? Because my time available for audit is very limited. Within the limited time, how can I check this much voluminous transactions? So I can't check every transaction. I can only check those transactions where mistake is possible. Correct? So now how do I know which class of transaction, which class of account balance mistakes are possible? How do I know that? I can only know the misstatements possibility only when I do risk assessment and internal control evaluation. Am I right or not? So now what do you mean by that internal control evaluation? Why are you doing it? I am doing internal control evaluation to identify deficiencies. If deficiencies are there, I will focus more in that area. Not only that, since I found deficiencies, it is better for me to communicate to top management whatever deficiencies I found. It is better for me to communicate deficiencies to management or significant deficiencies to those charged with governance. Better. Am I right or not? Now look at. Now, identification. So, deficiencies in internal control will be identified by the auditor either at the time of risk assessment process or at the other stage of audit. There is no, see, in exam they can twist all these as in the form of MCQs. Auditor will identify deficiencies in internal control only at the time of risk assessment process. Wrong. The auditor can identify at some other times also. Now, finally, the auditor has to communicate. That's it. Then deficiency means what? Ineffective control is a deficiency. Missing control is also deficiency. But you should not write like these keywords in exam. Okay, you should write if a control is designed, implemented and operated. If a control in a company, control means what? Some process in the company. It's a process. For example, DMart. You take DMart example. DMart, I hope every one of you know DMarts, right? DMart store. Yes or no? There is a control in DMart. What control? You know, once a customer brings trolley for the billing counter, all the goods in the trolley has to be, you know, kept on the table. Okay, before the billing. Okay, kept on the table, so that each and every item will be scanned and then passed on to the other table. Again, you have to move the trolley there, and then once items are built, again you can put it on the trolley and go to exit. Security guard will check the items and then put a stamp, go to parking and pick up the car and then go. That's what, right, you do in DMart. Yes or no? This is a control. But guess what happened? You know, I went and observed in DMart. I'm just observing in DMart. What I found, you know, the customer is bringing trolley and he's putting all the items in the trolley on the table. But guess what I noticed? In the trolley there were 4 small nail polishes. Okay, small nail polishes and small items, pen packet, like that were there. This he didn't keep on table. Okay, even the salesperson who is billing, no, he didn't observe that, and he billed all the goods, again dumped into the, you know, in the trolley. All this ground floor, whatever is there in the bottom, right, they were not billed. Security guard, I saw whether he will detect it. He just took the customer bill and then stamped and sent. Arey, control is there. They have to check whether all the items are billed, but they're not checking. Control is there, but ineffective. The control fails. Control fails to prevent misstatement. Misstatement, one of the reason is fraud or error. So control is failing to prevent. So first of all, salesperson who should prevent it. If he fails, at least security guard should detect it. Control is failing to detect. Nobody is correcting it on a timely basis. That's a deficiency, or the control itself is missing. I asked the sales manager, don't you check all that? Sir, management did not give any instruction to us, sir. We don't have any such rule. Means control should be there where to check in the trolley whether all the items are billed or not. That control itself is missing. Able to understand? So this is a deficiency. Now you understood deficiency, right? Then what is a significant deficiency? Significant deficiency is a deficiency according to the auditor's professional judgment. This deficiency knowledge, so and so mistake, so and so weakness is there, so and so problem is there, internal control, top management should know. If according to me, top management should have the knowledge of a significant deficiency, then that deficiency is called as what? Significant. It's a deficiency or a combination that in auditor's judgment merits those charged with governance attention. And now, what factors you take into account to determine significant deficiency? Here they just give 2 factors, but in-depth question is given here. Two primary factors are what, you know? Likelihood of their occurrence, magnitude of the misstatement, potential magnitude of the misstatement, likelihood of their occurrence of misstatement. And by the way, tell me, just because significant suppose now I did audit, I did not find a single mistake, does it mean significant deficiency is not there? So there is no guarantee that just because significant deficiency is there, you will identify mistakes. See, there might be so many mistakes, but you didn't identify. Significant deficiency can exist even if auditor has not identified misstatements. Are you clear? Important for MCQ. These statements are important for MCQs. Next. Now look at matters or factors that decide deficiency. What are the factors that decide deficiency, significant deficiency? Likelihood of deficiencies leading to misstatements. That is what I told. Likelihood of their occurrence of misstatement. That is one. Yes or no? And the financial statement amount exposed. This is nothing but magnitude. How much amount is exposed? Now for the amount exposed, no magnitude, there is one more point. How much activity happens in that particular account balance or in that transaction? For example, right now I found a deficiency in DMart billing. You know, there is a process, there is a fraud, there is a misstatement in the financials closing stock valuation. This affects entire sales and closing stock. Volume of the class of transactions affected is one is closing stock balance and sales. Both are affected. Yes or no? Next. And susceptibility to loss or fraud of the related asset and liability. Because of this incident which I found in DMart, there is a high possibility of inventory loss to the company. And I can also find significant deficiency in accounting estimates. I can also find in accounting estimates, including fair value accounting estimates, wherever subjectivity and complexity is involved. Higher the subjectivity, higher the complexity, higher, there is a high possibility of a significant deficiency in that. Next. And what is the cause and frequency of exceptions arising? Like I saw in the DMart, no? I saw one day I stood and saw that very clearly. 10 customers took like that. So it is more frequently. People know that this deficiency is there in the internal control. More people are exploiting. Every day, how many are exploiting this? We don't know. Next. How the deficiencies interact with other deficiencies. Here, salesperson is weak. And even security system is also weak. Security guard is also not working. So this deficiency, by interacting with other deficiencies as a whole, significant deficiency. Are you clear? Suppose if at all salesperson, prevention he failed, but security guard detected it, means detective control is effective. Even though this deficiency is there, by interacting with other deficiency, as a whole, there is no mistake in the financial statements. There is no fraud happened. Therefore, you can consider this situation as an example that though there is a single deficiency, a combination of other, there is no deficiency there. So as a whole, it's okay. Suppose salesperson deficient, security guard is also deficient. This deficiency plus combination of that deficiency put together might constitute significant deficiencies. And importance of controls, the control that you're checking, right, there you found some deficiency, right? How important this control in the financial reporting, that is also decides. If it is so important, for example, it's a control relating to fraud prevention and detection, in that control you found a deficiency, or it's a control related to application of accounting policies, or it's a control related to transactions with related parties, or it's a control related to outside normal course of business, or it's a control relating to financial reporting process, year end, period end financial reporting. If at all these controls, if at all in these controls, if there is a deficiency, you may consider it as a significant deficiency. That's it. Now likelihood of deficiencies leading to misstatement, I already told. Getting it? These are all factors or the matters which auditor consider while determining whether a deficiency constitutes a significant deficiency or not. That's it. These are the factors to decide whether a deficiency is significant or not. You know what? When we are doing audit, we sometimes find symptoms. By the way, are you all with me now until now? Just comment below. Also comment where are you watching from. Just comment below where you are all watching from. Yeah, nice. Fine, let me continue. Yeah, thank you Coimbatore, Hyderabad, everybody, almost Chennai, yeah, Bangalore. Fine, next, indicators of significant deficiency. You know, there will be some symptoms. Okay, so first of all, if I find a deficiency, I should decide whether it's significant or not. For that, factors is above, like likelihood of occurrence, amounts exposed, frequency and costs, yes or no, importance of that particular control to financial statements, yes or no, all that. That's a factor for deciding significant. But there are some cases where there will be symptoms for me to know that there is deficiency. Some symptoms will be there, risk factors will be there, risk indicators will be there, symptoms I call it as. Yeah, what are they? First symptom, you found a mistake. If auditor found a material misstatement, if an auditor detected a misstatement, you found a misstatement, that itself is a proof that somewhere something went wrong. Am I right? Misstatements found during the audit that were not prevented, detected or corrected by internal control, you found a misstatement, that itself is a proof that somewhere something went wrong. So misstatements found by auditor is an indicator for significant deficiency. And misstatements due to error or fraud, there is a misstatement in the financials due to error or fraud, but disclosed as prior period item in the financial statements, which is again, you know, a significant deficiency. Evidence, you know, actually generally if at all there is an error or omission related to prior period, then in the current year we account it as prior period, but accountant of the company, no, some error is there, he recorded directly as a prior period item by misinterpreting it. So that's a significant deficiency. Management's inability to oversee preparation, management is not at all monitoring preparation of financials, or ineffective control environment. Control environment is ineffective. What is control environment? There are 5 components of internal control. In risk assessment chapter, the coming discussion is risk assessment, right? In the risk assessment chapter, I will discuss 5 components of control, 5 components of internal control system. What are they? Control environment, 2 control activity, 3 risk assessment process, 4 information system, 5 monitoring activities, total 5. In that first one is control environment. Ineffective control environment, in exam they can directly ask you this particular thing as a 4 marks question, or they can directly ask you indicators of significant deficiency as a direct question. Even in CA final, guys, I'm telling you, these questions were asked in CA final also. The same syllabus is there in CA inter also with respect to this particular standard. Now, ineffective control environment. So what do you mean by ineffective environment, sir? Management is not doing risk assessment process at all. They're not doing risk assessment in the company. If a company does not do risk assessment, how do they identify risks and mitigate it? Only when the company is robust in risk assessment, they will identify the risk and they put a control there. Company itself is not doing risk assessment. That's a big indicator. So many deficiencies will be there. Or risk assessment company is doing, but ineffective. Evidence that entity's risk assessment process is ineffective. Formality. Company is not doing risk assessment, or they're doing it formality. Like they're failing to identify risks. Or suppose ineffective response to significant risks such as absence of controls over identified risk. Last year when we are doing audit, we communicated them, sir, these are the risks that are there, but they're not responding at all. Absence of response, ineffective response to significant risk. Like in the company also, some internal audit team have communicated top management significant risks. Top management is quiet. They're not putting any actions. Yes or no? Ineffective response to significant risks communicated. Another one, management fails to implement remedial action for reported significant. Last year when we are doing audit, we reported management, sir, in DMart, in the store, customers are taking goods without billing, sir. It's a significant deficiency. A salesperson is not working correctly, security guard is not working correctly. Almost in 5 DMart locations we found the same, sir. Management did not put any remedy now also. Last year I told, this year also the same thing is happening. And management fraud you found top management fraud. That itself is a significant deficiency in internal control. Significant deficiency in internal control. And management interest. Management is involving significant transactions which involves management interest, which are not scrutinized by those charged with governance. Like management, the company is transacting with some vendors, some customers, where in that vendors and customers, one of the management person is having ownership and top management does not. See, that's why you have section 177 in Companies Act. What it says, the audit committee has to approve related party transactions. The audit committee has to approve related party transactions. Why they need to approve? Because they need to scrutinize what the transactions are for. That's it, guys. So this is indicators of significant. Remember, indicators means what? Symptoms. Control environment weak. Okay, auditor found a mistake or some frauds and errors, they showed it as a prior period item, and management is not able to oversee. Management's oversight is not there on the financial reporting process. All this indicates, indicators of significant. Now again, ineffective control environment means what? You found a management fraud. Management does not take any remedial action for previously communicated significant deficiency. There is no risk assessment process in the entity, or the risk assessment is ineffective, or the response to significant risk communicated to the management is very, very ineffective, and significant transactions were there where management interest is involved but not scrutinized by top management. That's it. Then communicating. The last step in this audit is what? Communication of deficiencies to the management. To whom you should communicate? Tell me. To top management, what you should communicate? Significant deficiencies you should communicate on a timely basis. Whereas to normal level of management, what you should communicate? By the way, sir, who is those charged with governance? Who is top management? I will take one more live, where on SCA 260, communication to those charged with governance, one more live I will take. There inside that live you will get complete clarity. Okay, now to management, what you should communicate? Significant deficiencies as well as other deficiencies. Means significant deficiencies you will communicate to 2 levels of management. First, middle level of management, and then you will communicate to top management. Suppose if TCWG and management both are one and same, means there is no such hierarchy in the company. You communicate to management, that itself is deemed to be a communication to those charged with governance. By the way, what you should communicate? You should communicate in writing. Communication should be in writing. Okay, all significant deficiencies, other deficiencies, okay, all that you should communicate. Now what you should communicate in writing? You should communicate it through a letter, and that letter is called as what? Letter of weakness. That letter is called as what? Letter of weakness. It is also called as management letter. Look at it. Letter of weakness is also called as management letter, but it is not same as management representation letter. Management representation letter is a 580 standard requirement, whereas management letter of weakness is a 265 standard. Management letter or letter of weakness is something that auditor communicates to management, whereas management representation letter is something that management communicates to auditor. Yes or no? Apart from all this, there is one more letter of engagement, that is auditor communicating to management. Am I right? Yeah. Now what auditor has to communicate? The auditor has to communicate what are the deficiencies he identified. And not only communicating deficiency, explanation of their effect. What is the effect? You should tell, sir, in DMart no store, no customer is taking extra goods with him, no billing is happening. Telling that is of no use. Tell the management, because billing is not happening, they are not reflected in sales, sir, and our closing stock is completely automated calculation. Since these items are not coming under sale, closing stock value might show higher. Impact also you should tell. Potential effect also you should tell. Further, sufficient details, so that those charged with governance and management will understand the context of communication. You should tell that we are the auditors of the company, we are giving opinion on the financials. As a process of our audit, we are verifying internal control, we found these weaknesses. Yes or no? So sufficient details. And by the way, we have visited 5 DMart stores. At 5 DMart stores on so and so dates we found these observations. You should give entire this. So you need to clearly further you need to give the following points. You should clearly tell that your audit purpose is to give opinion. As a part of the audit, you considered internal control, internal control you considered just to find deficiencies, but you considered internal control not to give opinion on them. You considered to plan the audit. So tell that fact also. And whatever the reported matters are limited to deficiencies identified. Whatever you reported, right, they are only related to deficiencies identified. That also you communicate. What do you mean by this third point? Sir, we are giving you list of deficiencies below. 10 deficiencies. These 10 only we found, sir. This is not exhaustive list. So that fact also you should communicate. That's it, guys. So with this communication of, letter contents of written communication over. So 3 points. What are the factors to determine whether a deficiency is significant or not? What are the indicators of significant deficiencies, and how to communicate it? That's it, guys. 1 hour we spent solidly. We finished 450, 265. 2 wonderful and fantastic standards we finished. Are you clear? So audit documentation. See, what is documentation? Collection of evidences. Simple. Audit documentation is a record of audit procedure performed, audit evidence obtained, conclusions reached by the auditor. 3 things we need to document. Whatever procedures that you are performing, physical verification, external confirmation, inquiry, inspection, whatever you are performing, that procedure you should document. Evidences that you are collecting, confirmation from debtors, confirmation from creditors, bank balance, bank certificate, evidences that you are collecting, and conclusions that you are reaching. Okay, purchases are true and fair, sales are true and fair, like that you take some conclusion. Okay, that conclusions that you're reaching, all these 3 you should document. So audit document refers to a record of procedures performed, evidence obtained, conclusions reached. This documentation is also called as working papers, or is also called as work papers. Why you should document? This is an evidence. It's a sufficient appropriate record which is a basis for the report that you gave. And it's an evidence that you did audit as per standards on auditing. It's an evidence that you have done audit in accordance with applicable law and regulatory requirement. Now, what is the purpose of documentation? In exam they can ask you, what is meaning of documentation? 2 marks. Purpose of documentation, 3 marks. Here you have to write any 4 points. What is the purpose of documentation? Simple. Only because of documentation, engagement team can plan and perform the audit in a better way. Because strategy will be documented, plan will be documented, team discussions will be documented. So based on the documentation, they can perform ongoing audit much more effectively. It will help to direct, supervise, review work effectively. How do I know as a partner, as a principal, my article is working correctly? Suppose he completed one work and came and told me everything is completed. How do I know he worked correctly? I will look at the documentation. I will direct him how to do. I will supervise him what he is doing. I will review what work he performed. And since they have to document every work that they do, naturally principal will review tomorrow definitely how I perform. So they become accountable for the work. And it's a record of matters important for future audits. This documentation will help in future audits. And most importantly, documentation will help in quality control review. Remember, there is a concept called EQCR, Engagement Quality Control Review. There is a concept called Engagement Quality Control Review. This should happen mandatorily for listed entities before audit report is given. EQCR should happen. It is like a second opinion from a doctor. It is like a second opinion from a doctor. Suppose me and my articles, I am the partner, and there are some 3 articles, 3 paid assistants. We all have been formed into one team and conducted audit of one company. Before signing audit report, I will call one of my partner, or I will call another firm related CA. Please check my entire working papers and tell me how I did the audit, whether I did audit properly or not. Just I will ask him and then check it through him. That's a quality control review. What is it called as? Quality control. Now, how can he review whether I performed work correctly or not? Through documentation. So documentation helps to perform quality control review. Documentation not only for quality control review internally, external inspection also it is possible. Documentation facilitates external inspection as per legal regulatory, peer review, like that some external inspection happen, NFRA review, quality review, board review, like that some external inspection. For that also it will help. These 2 points are must. Documentation helps quality control review. Documentation helps in external inspections by legal and regulatory authorities. Documentation helps teams to direct, supervise, review the work effectively. It will make the team accountable for the work performed. See how easy? Now tell me, what is a manner of documentation? How you should document? You should document in such a way, another CA, he is not part of your team, but he should understand how you planned the audit, how you performed the audit, what evidences you gathered, what conclusions you have taken. He should understand all these issues just by looking at your documentation. In such a way you should make documentation. Look at what is the manner of documentation. You must prepare documentation so that an experienced auditor, no connection with the audit, shall understand nature, timing, extent of procedures performed, result of the procedures, significant matters identified, and professional judgments made. By looking at your documentation, how you planned and performed, what evidence you gathered, what conclusions you reached, what is the result of the audit procedure, what are the significant matters, where and all you applied significant professional judgment, all that he should understand. Correct? Who is experienced auditor, by the way? He is a person who knows FR. He is a person who knows accounting standard. He is a person who knows auditing standard. He has knowledge of client business, but he is not part of your team. That's it. Now, what you should document? You should document everything. What everything? Nature, timing, extent of audit procedures performed. You should document nature, timing, extent. What do you mean by that? What do you mean by that? Just a minute. Yeah. So, documentation of nature, timing, extent of audit procedure. So, what test to be performed? Physical verification of inventory, physical verification of fixed assets. Okay, who performed it? Mr. A, Mr. B, senior article, junior article. Who reviewed that work? Audit manager reviewed that work. What are the significant matters identified? Remember, significant matters are the matters which are communicated with those charged with governance as per 260, and from those matters only key audit matters will be selected. So significant matters you should document. Whatever you should document discussion of significant matters, including what is the nature of the matter, when it is discussed, with whom it is discussed, and documentation. You should document inconsistencies. One, for example, our team, no, they did external confirmation procedure. In our books, no, one debtor value 10 lakhs is there. Our team sent for confirmation to the debtor. Debtor replied saying 12 lakhs. Inconsistent. But do we directly leave it? We will resolve it, no? Why inconsistency were there? Why in our books 10 lakhs is there? Why debtor replied 12 lakhs? Inconsistency will resolve, no? Inconsistency you should document. How you resolved it also you should document. So information about inconsistency and document how the inconsistency was addressed. In exam they can ask you 5 marks question or 4 marks question. Write about documentation of NTE. Write about documentation of nature, timing, extent of audit procedures. Now tell me, fine, we understand we should document nature, timing, extent. What should I document? Each and everything that I discuss with everybody? What extent I should document? What I should document exactly? It depends on various factors. First of all, what to document, what not to document is a professional judgment. By the way, how I should document? Should I document in a paper form or can I document electronically? So can I document can I save it electronically, the files, or should I take a printout and then keep it? How should I document? The form of document, the content of the documentation, to what extent I should document. For example, no, we are doing purchase verification. We selected 200 purchase documents. Should I take a Xerox copy of all the 200 documents and then document it? Or should I only take 1 or 2 purchase invoices where I have some observation? What should I document? To what extent I should document? It depends on various factors. It depends on size and complexity of the entity, nature of audit procedure performed, identified risk of MMS, nature and extent of exceptions identified. Exceptions means what? For example, right now I told external confirmation. In my books 10 lakhs is a third party reply 12 lakhs. That's an exception. It depends upon exception that you identify. Yes or no? The audit methodology and tools, significance of the evidence obtained. How significant that information is. Depends upon the significance, depends upon the risk, depends upon the size, depends upon the nature, depends upon the methodology, depends upon the exceptions. These are the factors which will influence you whether to document or not. Understood? This itself, what are the factors affecting documentation? 4 marks question. Now tell me examples. What are documentation? Give me some examples. Array, what examples? Checklist. Yes or no? Checklist is a documentation. Correspondence, WhatsApp messages with the client. mail messages with the client, email communication. Audit program is a documentation. I mean, audit program you should document, a memoranda regarding significant issues, some important issues I'll be communicating to the management through some letters. That one, summaries of significant matters, confirmation letters which I'm getting, letter of representation, written representation. These are all various examples. Should I document entity records? That's your choice. The auditor may include copies of entity records as a part of documentation. What do you mean by copy of entity record? Entity, some purchase invoice, sales invoice, e-bills and all were there. Should I document that? That is your choice. Yes or no? Generally, what you document? Significant contracts and agreements. Audit documentation does not replace entities record. Just because you're documenting important contracts and all, can the company scrap them? Because auditor has a copy of it. So documentation is not a substitute for entity records. Remember, what documentation does not include. In the recent Jan exam, this was tested. What audit documentation does not include, either Jan or September in one exam. What does not include? Duplications, yes or no? Superseded draft. What documentation does not include? Superseded draft. What is a superseded draft? First I took one paper and then I started some working. Something went wrong. I striked off and then I took another paper and then there I wrote correct workings. Now previous working paper is there, right? That was superseded by latest one. So old one which is superseded, remove it. So documentation excludes superseded one, notes showing preliminary thinking, previous versions of papers which are corrected for typographical errors, duplicate copies of various other documents. If the same copy, multiple copies, multiple prints were there. For example, my team, instead of printing one, they printed 3 copies. So duplicate copies, I'll remove it. So what is not included in documentation? Superseded draft, notes showing preliminary thinking, previous versions of papers corrected for typographical errors, duplicate copies of documentation. These 4 will not form part of documentation. What are the examples of documentation? What do not come under documentation? Like that they can ask you 5 marks question. Clear? Hello everyone. Yes or no? Here I'll write like this. This is what preliminary thinking. Some students will ask me this notes also. I myself won't understand this. After 2 days, what you will understand? Yes or no? I'll never give my running notes which I use in the class. No. Not that something is there in this. The chance of you misunderstanding is higher than the chance of you understanding from this. It's useless. You see what I will scribble? You see? Look at what I wrote. Tell me what I wrote here. This is some video related one. No, not this. See here? Something I'll write. You can't understand anything later on. I myself don't understand. I just scribble something randomly. Some students will message me, ask, sir, can you give me running notes which you used in the class? They'll ask me. I'll straight away politely say, sorry, pa, I can't give you. You can't understand anything. No, sir, I want it, sir, definitely. I lost it already, the notes. Where it is there also, I don't know. Because I use only one notes for all my, every even for tax class I'm taking. I'll scribble here itself sometimes. Tomorrow I'm doing some general video. I'll scribble here itself. Yeah, next. Until now clear. Next, what do you mean by audit file and documentation you should prepare on a timely basis? What do you mean by assembly, retention, ownership? Correct? What is an audit file? First of all, see, documentation means what? Process of gathering evidences collected, procedures performed, conclusions reached. So you need to document everything, right? That's conceptual meaning of documentation. Where you document it in a paper format or electronic format, you document, and that's an audit file. Are you getting the point? Note taking. When you're listening to the class, you're taking the notes, no? That note taking is a process. That's documentation. The notes is the file. Able to understand? So the output of documentation is called as audit file. So what is audit file? It is one or more folder or a storage media which contains documentation for a specific engagement. Correct? We maintain documentation per client. That too for every EO. For every engagement. Suppose I'm doing company audit for a particular client for financial year 25-26. I'll have a separate documentation file for that. To the same client I'm doing tax audit. I'll have a separate file for it. To the same client I'm doing 26-27 year audit. I'll have again a different file for it. Yes or no? So audit file is nothing but a folder that contains documentation for a specific engagement. Clear? Next. So documentation has to be prepared on timely basis. You must prepare documentation on a timely basis. Remember, there are some good questions in question bank. Please go and read it. Don't neglect it. I'm telling you, in every topic, question bank reading is very important. After you finish this chapter, go and solve the question bank, then go with the next chapter watching. Next. Timely preparation. Tell me, running notes, no? After the class is over or while the class, you should write running notes. When you're listening, you should write. Correct? First of all, I prohibit running notes. I will never tell students, first focus on listening. So no? Anything that you want to note, when I give a pause, that time you have to note it. If at all you want to make a note of it. Generally, I tell students to scribble here itself if at all you want. Anything. Don't have a separate running notes for this. Not required. Everything is clearly given in the book. Why it is required. Okay, fine. Generally, documentation, tell me, I'm doing audit of purchases, I'm doing audit of sales. Once I finish 20 days work, then I will sit and document all the papers, or then and there when I'm doing the work I should document. Exactly, then and there when I'm doing the work, then and there I should document. That's called timely basis. So documentation must be on a timely basis. The timely preparation enhances audit quality and supports effective review and evaluation before finalizing the audit report. When you prepare documentation on a timely basis, quality of audit will enhance and it will be helpful for effective review also. When they're reviewing, they can understand whether you did documentation correctly. Documentation prepared after the work is completed is likely to be less accurate than the documentation prepared during the audit. Understood? Because no, after 30-40 days I will forget all the issues what I identified in audit. So better whenever I find an issue, a related point, I should document immediately. Okay, next. Assembly. What do you mean by assembly? You know, once audit is over, no, audit report is also given, over. Now folders will be there. So many papers and all will be there, zigzag manner arranged. Soft copy files will be there. In computer, folders will be there. They are also arranged in zigzag manner. We should retain it for 7 years, correct? Audit documentation, we should retain it for 7 years. Before you retain them, first assemble them properly. See, assembly process is not something different. This is something you do right from your school days. You maintain a separate book for every subject. Side of the book, you write social or science, like that. Yes or no? You arrange the book so neatly. You'll have an index in the book. That's called assembly. So working papers you selected, no, you gathered so many purchase, sales, inventory, fixed assets, so many documents you gathered and then kept in the file just like that. Now arrange it. First to opening balance verification, then purchase workings, then sales working, then receipts, fixed assets workings, then inventory workings, then GST workings, then TDS workings. So the moment you open the folder, there is a folder arrangement that is there. How you open, how do you write in the notes? You just open the book randomly and then start writing? No. You will maintain some page numbers. Some students, they maintain page numbers, you know, so they will write in a particular order. Yes or no? Rough notes will maintain in whatever the way we want, but a fair notes we always properly maintain in a structured manner. That's called assembly process. What is it called as? Assembly. So the auditor shall assemble the audit file. So that assembly process has to be done on a timely basis. The final audit file must be assembled and completed on a timely basis after the audit report date. Once audit report is given, immediately on a timely basis assemble it. You know what is the best time? What is the time limit as per SQC? The time limit to complete final audit file is usually not more than 60 days after the date of auditor's report. So within 60 days from the date of audit report, assemble the file, everything. Okay, what should I do after assembly? Just keep it. How long? 7 years you should keep it. From the audit report date, you should retain it for 7 years. Why you should assemble it? I told previously, manner of documentation. Even an experienced auditor who is not part of your team, by looking at your documentation, it was neatly assembled, everything. I will understand how you plan, how you perform, significant matters, professional judgments. I should understand all this. In such a way your documentation should be. How can I understand your documentation? Only when you assemble it properly. Correct? Hello? Yeah. Next. So SQC1 requires firms to establish policies for timely completion of assembly. Firms should have a policy on assembly mechanism. Getting it? If a firm does not have assembly process, people will not assemble it. So first of all, firm should have a rule internally that once an engagement is over, related documentation has to be assembled. Clear? So like that, firm should have a policy. That point is mentioned where SQC standard is talking about that. Next. Tell me, Assembly, we are assembling, no? Is it an audit procedure? Audit is already over. What is audit procedure? Procedure performed by auditor to obtain evidence. That's called audit procedure. When do we perform audit procedure? Before giving the audit report. Right now I am assembling. No. Is that an audit procedure? No. That's an administrative procedure. What is it? Administrative. Like what I do basically in this administrative assembly, I will delete useless documents. I will sort them. I will collate them. I will cross-reference them. Yes or no? Signing of checklist related to final assembly process, signing of purchases work, all the purchases working was scattered. Now I group them at one place, all documents, and I will call junior article. He is the one who performed on this purchase. I'll tell him to sign on every paper that he is the one who gathered this. Okay, I'll call respective team members and then tell them to sign off. That's called signing of checklist. Okay, documenting audit evidence obtained, discussed and agreed upon before the auditor's report. So assembly process is nothing but documenting the evidence which is obtained. Documenting means what? Retaining it. That's it. The final assembly price is the final assembly is an administrative process and does not involve any audit procedure, does not involve any audit conclusions. It's not about anything related to audit. It's just an administrative mechanism. Are you clear? MCQ important. MCQ. By the way, this entire assembly itself can be asked as a 5 marks question. Timely basis can be asked as a 3 marks question. Now retention. Once a final audit file is assembled, once you freeze the file, you should not delete any one paper in that. You should not discard a paper. You should not delete any file. You should not change it. You should keep as it is intact for 7 years. From which date? Audit report date or group audit report. Nothing but consolidated financial statements audit report date will be there, right? That's called group audit report date, whichever is late. Okay, that's it. That is 7 years. Tell me, whose property documentation? You know, we have taken hard copy, is there, right? Whatever our workings and all, we have taken print on client paper. Does it mean documentation belongs to client? Paper is nothing, that negligible. Paper is not the point here. The content in the paper is what most important. Yes or no? So the documentation is ownership of the auditor. The auditor is owner for the documentation. Can he share to somebody else? If he wish, he can share. Yes or no? Provided it does not undermine the validity of the work performed. It does not affect the independence in case of assurance engagement. If these two are not affected, auditor can share it to third party. Are you clear? Ownership, this itself can be asked as a 3 or 4 marks question. So as per SQC1, audit documentation is property of the auditor. Yes or no? The auditor at his discretion may share portion of documentation with the client or may share extract from it. A paper you can extract and then give it to the client. That is auditor's choice, provided that does not undermine the work performed, that does not affect the independence auditor. If you share this, what happens? You know, client might get to know how you work tomorrow. So it might affect your independence, it might undermine the work that you perform. So that is the reason generally we don't share our working papers to the client. Sir, we worked on some methods using our own methods. Based on the information you provided, we work with some methods through which we can find frauds. If you ask my documentation, my methods will be revealed to you. So I will not share it. So this is the reason why audit documentation may or may not be shared by auditor with the client. Clear? Next. Documentation of significant matter. You should document what, ma? Every significant matter. First of all, what is a significant matter? Significance of a matter requires a professional judgment and an objective analysis of case to case. Unbiased analysis. Look at judging significance of a matter require objective analysis of facts and circumstances. What are the examples of significant matters? Anything that gives rise to significant risk or circumstances causing significant difficulty in applying procedure. Significant difficulty. What is a significant difficulty? The company has 30 states, 30 registrations under GST law. 30 registrations they have. And in each state, they are filing 2 returns every month. 24 returns every year. 30 into 24, 700. 24 into 3, how much more? 720. 720 GST returns they filed with the various authorities at various points of time. Now GST reconciliation I should do. Basically I should do GST verification because I have to report in CARO clause number 7. What I have to report is the company paying GST on time. But the company does not have one GST. They have 30 registrations. Now in 30 registration, each registration wise, every month are they paying on time? The company should have done big statement. They didn't do that. Now I have to do. It's a significant difficulty for me in audit. Significant difficulty, I'll communicate to those charged with governance. Significant risk I identified, I'll communicate to those charged with governance. Significant risk, significant difficulty, results that indicate financials could be materially misstated, results that indicate revision, need to revise, auditor risk assessment and response, findings that could result in modification of opinion, inclusion of emphasis of matter para, nothing but findings that modify your report. Circumstances causing significant difficulty, matters that give rise to significant risk, result which indicate financials might be materially misstated, results that might indicate revision of your risk assessment or response to the assessed risk, nothing but results that indicate revision in the plan, changes in the audit strategy, any findings that changes your audit strategy, audit plan, that's a significant matter. All these significant matters you should document. 4 marks question they can ask. What is a significant matter? Give few examples of significant matter. Remember, this question is different from what is significant risk. Give few examples of significant risk. This question, significant risk question, is right? That is there in risk assessment chapter. What is a significant risk? Give few examples of significant risk. Fraud risk is a significant risk. Related party risk is a significant risk. Yes or no? So like this, one answer is there in risk assessment chapter. That is different. What is significant matter? What are the examples of significant matter? Matters that give rise to significant risk is a significant matter. MCQs and all these are important. Understood? Then you should not only document significant matter, you should also document related professional judgment. You should also document what? Related professional judgment. So documentation of professional judgment explains the auditor's conclusions and reinforces their quality. At the time of audit, you might have felt 100 samples are required for purchases. How do you felt 100 samples are required here? How do you felt 100 samples? Some thought process will be there behind that. Write it as a para and document it. That is called as what? Professional judgment. Okay. So situations requiring documentation. The auditor must document professional judgment in the following cases. Document the logic, rationale, when requirement asks the auditor to consider information that is significant. Document the basis for conclusion on subjective judgment such as reasonableness of accounting estimate. How did you, for example, Reliance have revised useful life from 30 years to 50 years. Some plant and machinery useful life, Reliance have revised it from 30 to 50. You verified whether 50 years is correct or not. Which, see, first of all, this 50 years or 40 years or 60 years, it's a subjective, highly subjective. Yes or no? How do you concluded that this is fine? Some logics and workings would have been there, right? Document that. So document the basis for conclusions on subjective judgments, such as example, how do you concluded reasonableness of an accounting estimate which is significant? Yes or no? Document the basis for conclusions on authenticity of the document. For example, originally you thought a document is not authentic. Later you investigated and found that it is original and authentic. How did you conclude that? Document it. So this is bit tough. Regarding this we have discussed more in depth in regular. This is enough for you. Just this point alone you have to sometimes mug up. Okay, just try to understand and try to mug up. This is what I tell. Okay, so if it is a regular class, I would have discussed much more in depth. That's it. Over. Documentation chapter. Over. Clear? And by the way, one more important question. Audit summary memorandum. What is audit summary? This is also called as audit completion memorandum, audit summary memorandum. Generally in big audits, there will be so many issues which will be there. Audit will be conducted by 30-40 team members. Audit will be conducted for 100 days. 2000 to 2500 man days will be there. Everybody will have some 10s and 20s of issues. So we always have one summary memorandum where all the issues will be recorded. This summary memorandum will be helpful for making discussion with the management before we finalize the audit report. And that memorandum is called as what? Audit summary memorandum. 5 marks question, important question. Getting it? Everywhere I told you how a question can come. The auditor may prepare a summary as a part of audit documentation. What the summary memorandum will contain? All significant matters identified and how these significant matters were addressed. Summary, I will summarize only significant matters and how they were resolved. Getting it? What is the summary? It will help in effective and efficient review and inspection of audit documentation, especially for large and complex audit. For big audits, no, whether all significant issues, whether they were properly looked into or not, a summary memorandum will help you. Yes or no? Then it also helps the auditor in considering and addressing significant matters. So the summary will help the auditor to evaluate whether each and every standard objective is achieved or not. Okay, this is important to ensure that overall objectives of audit has been achieved. That's it. So a summary will help you ultimately to achieve the overall objectives of various standards on auditing. That's it. So what is a summary memorandum? Significant matters arising in audit and how they were addressed. This is particularly important for large and complex audits. It will help the auditor to evaluate whether overall each and every SEA objective is complied or not complied, achieved or not achieved. That's it. Easy. So with this, documentation topic is completely done. Clear? That's it. Yeah. So let's revise the audit evidence topic. So in this, we have totally 8 standards. Okay. What are the standards that we have? 500, 501, 505, 510, 520, 530, 550 and 610. Totally we have 8 standards. But in this, I give high priority to these standards. 501, 505, 510 and 550. Then the next priority will be for 610. Then analytical procedure, that next priority. That next priority is 530. Last priority I will ask you to give 500 because 500 is the lengthiest standard in this entire. Next lengthiest standard in this chapter is 530. But 530 is relatively easy compared to 500. Fine. Anyhow, first we'll do revision of 505. Always when you are preparing for the next time, when you are reading the subject next time, first always observe the structure of the standard at first. First always, whenever you are revising, observe the structure first. Don't directly start read from the first page and first line of the standard. First observe the structure of the standard, what standard briefly tells you. For example, if you see the SEA 501, it first talks about definitions. What is external confirmation? What are the methods of request for external confirmation? Like that, some definitions were there. I'll come back to it. Then we have external confirmation procedure. What is the procedure for external confirmation? Then we have what if management refuses to do external confirmation. Then we have evaluation of evidence obtained, or evaluation of result of external confirmation. See, once we do external confirmation, we get some information, some evidence. So evaluating that evidence, nothing but evaluation of evidence obtained in external confirmation. That's it. Only 4 topics were there. Understood? Now, first let us look at the second topic, steps for external confirmation. What are the steps involved for external confirmation? Now, there are multiple ways through which we can get evidence. One is inquiry. We can ask, what is audit evidence? We already understood many a times what is audit evidence. Information required by audit. Whatever information the auditor is asking for, that is audit evidence. So inquiry is one method through which I get evidence. Inspection, another way is inspection. Physically I'm going and verifying or checking the documents. That is another way through which I get required information. Then we have analytical procedure, recalculation, reperformance. Then we have external confirmation. So external confirmation is one of the method to obtain audit evidence. For example, whether sale happened to a particular customer, is it genuine or not? I can obtain evidence by looking at sale document, transit challans, GST bill. All that is enough for me. All that will give me evidence that yes, sale happened or not. Not only this, I can directly contact with the party and ask a confirmation whether sale happened or not to him. Yes or no? So that is external. So what is external confirmation? So external confirmation is a direct response to the auditor. Even the standard first and foremost important definition is definition of external confirmation. What is external confirmation? External confirmation is a direct response to the auditor in writing. It's a direct written response to the auditor in writing by the third party. We also call the third party as conforming party. We also call them as what? Conforming party, either in paper form or electronic form or some other medium. So this is the meaning of external confirmation. So directly third party has to conform to the auditor. Suppose if the third party is conforming through mediator, suppose if the company is asking third party, getting the data and then giving it to me, that is not external confirmation. Able to understand? See, in audit, we have SA 500. Inside that, evidence is based on source two types: internal evidence, external evidence. Evidence is two types: internal evidence, external evidence. If evidence is generated outside and that evidence we are using, that is external evidence. External evidence need not be external confirmation. We need to be clear. External evidence, for example, GST paid. What is the proof for GST paid? Challan will be there. GST challan will be there. Who will give the challan? Is our organization prepare the challan? GST department will give the challan. GST department will give the challan. That's an external evidence. Suppose I have a doubt on the challan, is it original or duplicate? Is it a dummy, forged document or real document? I have a doubt. I will open GST website and type the challan number and see whether this challan is original or not. Now what I am doing is external confirmation. Are you getting the point? So external evidence is different, external confirmation is different. Fine. What are the steps involved for external confirmation? So first of all, generally in any organization, for what and all auditor can get external confirmation? For liability items, loan balances, loan outstanding amount, any borrowings from related parties, there we can do trade payables, debt, creditors. Then coming to asset side, investments made in various entities and trade receivables, debtors, inventory lying with third party, for loans and advances given to related parties or third parties. For all these cases we can get external confirmation, right? Yes or no? Now what are the steps involved in that? First to know, determine the information. Determine the information for which you want confirmation. First identify the information. Determine what information you want. Then identify appropriate conforming party. Identify appropriate conforming party. So who is the conforming party in the third party? For example, the information I want is debtors. I want confirmation for debtors outstanding balance as on balance sheet date. As on balance sheet date, debtors were there in the organization. I want confirmation for outstanding balance how much. So debtors I decided. Now I will decide about, in these debtors, I selected 20 debtors. In these 20 debtors organizations, some accountant or finance manager, somebody will be there in that organization who is knowledgeable about this matter. We call him as conforming party. Determine the appropriate conforming party. Who is the right party in that organization? 3, design the request. What is it? Design the request. Now see, how do you get the confirmation? Only when you send the request. Am I right or not? Step number 4, you need to send the request. You need to what? Send the request along with follow-up request. Now you need to send the request, right? Before sending, first you need to design the request, right? While designing, we have some points to consider. First of all, you can design in 2 format external confirmation request. One is positive confirmation request, negative confirmation request. One is positive confirmation request and negative confirmation request. What is a positive confirmation request? Where I write the letter like, I am the auditor of so and so company. We are at the conclusion stage of the audit. We found that in our books of accounts, you are a debtor for our organization and the balance outstanding is 10 lakh rupee. We mentioned that, and we will ask the third party, please confirm whether you agree or disagree. We will ask him whether you agree or disagree. Now third party has to reply me within 3 days. Whether he agree, he has to reply, or even if he disagree also he has to reply with the information provided by me in the request. Request I am sending, right? In that request I mentioned some information. With that information, either he has to agree or disagree. Both he need to reply. Whereas negative confirmation request, he will reply only when he disagree. In a negative confirmation, I clearly mention, reply only if you disagree. Ignore otherwise. I will mention like that, and that is called negative confirmation request. Now, no, so that is designing of the request. Now, in the actual GOT notes, we have given some points for designing of the request. No, we have given certain points. You know, when you are designing the request, there are some points that you should keep in mind. You know, assertions. What assertion you are addressing? Are you checking existence of the balance? Are you checking rights and obligation of the balance? Are you checking completeness of the balance? Remember, external confirmation will give evidence only for rights and obligations. It will give evidence regarding existence and completeness. But external confirmation will not give evidence about this assertion. Valuation, you don't get any evidence on external. Okay, and what is the risk of MMS involved, including risk of fraud? Generally, when we are designing the request, we also consider how much risk is involved. Layout and presentation of the request, what format you are using, presentation. Sometimes we mention the amount and send. Sometimes we ask them to mention. In a positive confirmation request, again two types were there. We mention the amount and then ask them to confirm just yes or no. Sometimes we put a blank and ask them to fill it and send. This is called layout and presentation. And past experience on similar audits, method of communication. This is also one of the important matter. When you are designing the request, are you sending through a mail? Are you sending through a WhatsApp? Are you sending through a post? What exactly? Then management's authorization for the conforming parties to respond. Another important factor is how management is pushing them. Because without management's authorization, they will not reply. That is why when we are sending external confirmation, we will not send directly from our mail ID. We will send it through company's mail ID, and we will ask them to reply directly to the auditor. And ability of the confirming party. In the third party organization, we are asking him to confirm some data, right? He has that authority. Suppose we are asking to accounts manager of the debtor. In the debtor organization, accounts manager don't have this power to confirm. So look at that also. All these factors you need to take into account when you are designing confirmation request. Are you clear? Then you need to send the request. Send the request, including follow-up request if it is necessary. And further, make sure the request is properly addressed. Means in the request, you are sending the request, right? Mail ID should be correct. If at all you are sending by post, address should be correct. But before even dispatching, before sending, validate the address. And further, additional request you send, follow-up request you send, if at all reply is not received. Generally, where we will wait for the reply? Positive confirmation request, we wait for the reply. Yes or no? If they do not send the reply within the time mentioned by us, we will have to do a follow-up request, right? Then, and use positive confirmation request for more reliable evidence. Use positive confirmation request where you do not mention the amount outstanding, but requiring the confirming party to fill the details. In a positive confirmation, if you are following, to make sure it is more reliable, send request asking him to give the details about the transaction, about the balance, like that. Yes or no? You don't put the amount and ask him to confirm yes or no. Better ask him to give the details. But this will reduce response rate because extra effort is involved. If at all you mention the amount, everything, and ask him to confirm yes or no, it is easy for him. If you ask him to fill the details and send you, it's little time taking for him. Are you clear? That's it. So these are the 4 steps involved. And remember, the auditor, the external auditor, shall maintain control over external confirmation request. Are you clear? And information, first information we need to decide, right? First, which information? Generally, we all think that external confirmation, we use it only for account balances and their elements. We generally think that external confirmation is used only for balance sheet items, balances, outstanding balances as on balance sheet. That's what we think. No, you can get confirmation even at some other date also, not an issue. You can get confirmation even for non-financial data. Non-financial means what? We can also use this to confirm terms and conditions, terms of the contract, terms of the transactions. We can also use external confirmation whether any terms are missing. Absence of condition. Suppose we gave a loan to some party, or we took a loan from a related party, they are not charging any interest. Even in the loan agreement, interest point is not there. I am doubtful whether they are really charging interest or are they giving exemption. Clear? These are the steps involved. Now tell me, what if positive confirmation request? Positive confirmation request is a request where the third party respond directly to auditor. Either agree doing it or disagree with the information I requested, or third party will be providing the requested information. Negative, he will respond directly to auditor only if they disagree with the information in the request. Sometimes, they won't respond. There is another definition. Totally 5 definitions are there in this particular standard. All the 5 are very important. There is a non-response. In non-response means what? Suppose I sent a request to him, he responded, but not fully whatever I am asking. Failure to fully respond, or a failure to respond. So he didn't respond at all, or he didn't fully respond. Both are non-responses, but there is third point. Suppose your request was undelivered, means it didn't deliver him. It was returned to you, or may not returned to you, doesn't matter. It was not delivered. Even that is also treated as non-response. This point they can ask as an MCQ. Because many students, non-response means third party is not giving response, only that they will think. But you sent a request, right? It returned to you without delivery. Even that is also forming part of non-response as per the SA 505 definition. Are you clear? Now tell me, once I do this external confirmation procedure, generally what I get, once I sent a confirmation letter, third party will reply. Suppose I mentioned in our books of accounts, debtors outstanding balance is 10 lakhs because of so and so transaction. I mentioned also. And the third party replied, sorry sir, in our books of accounts as on 31st March, outstanding balance is only 5 lakhs, is it? He said only 5 lakhs, whereas in our books it is 10 lakhs. He replied 5 lakhs. Can I directly conclude my client books of accounts are materially misstated? Can I directly conclude, in our books it is 10 lakhs there, in third party books it is only 5 lakhs. He told it is 5 lakhs. Just he told, sorry sir, in our books it is showing 5 lakhs. Can I straight away say, hey management, you are completely wrong. Your books of accounts are materially misstated? Can I directly say that? No. Now, when the confirming party replied, there is a difference between amount to be requested. There is a difference between the information to be requested and the information provided by third party. There is a difference now. You can't straight away call it as misstatement. That is actually called as what? Exception. What is it actually called as? Exception. Exception means what? It's a response from third party, correct? Where there is a difference between information requested by auditor and information provided by confirming party. If there is a difference between information that we requested and information that is provided by the confirming party, and that is called exception. When exception is there, what auditor has to do? Analyze it and assess for its impact on the entire population and financial statements. Assess it, check it, see whether there is a misstatement in our books of accounts or maybe third party books of accounts, or who knows. Are you clear? Then sometimes, and by the way, finally, and there is one more element, I only told four elements. Negative confirmation request where you can use, that also I'll come back. Okay, now for example, he sent a reply. Finally, how to evaluate the result of external confirmation procedure? Evaluating the evidence obtained, this itself can be asked as a 5 marks question. Steps for determining external confirmation request, this itself can be asked as a 5 marks question. External confirmation procedure, the procedure can be asked as a 5 marks question. Now look at, how to evaluate the evidence. See, ultimately, once you perform external, you need to check whether you got evidence that is reliable and relevant or not. Auditor has to evaluate whether he got reliable and relevant evidence through external. If at all you are not getting it, perform further procedures. Now tell me, what are the results? How external confirmation, when you perform, you get some result, right? You can classify the results into following categories. For example, there are 1,000 customers for the company, 1,000 debtors. To all the 1,000 debtors, some 30 of them we sent positive confirmation. Remaining 70 we sent a negative confirmation. Yes or no? Now the result is there, right? Once after 1 week is over, I will categorize the result of confirmation to following categories. 1, agreement. Third parties replied saying, yes sir, everything is matching. Another one, exception. Third party is replying saying, sir, in our books of accounts the balances are different, sir. In your books of accounts the balance is different, sir. Exception. This is 2 categories of result. Or there may not be response at all. Third party might not have responded, or third party responded where the response is unreliable. For this, one simple example I'll tell you. We sent a confirmation request. Third party replied also. But when I see the GST number, it should have 15 characters, but there 14 characters only were there. Immediately I got it out and I started researching about the client GST number, all that, the third party GST number. It was not found at all. Somewhere I felt this particular debtor is doubtful. In the sense, it is not reliable. Some dummy transaction is there behind that. So we have to investigate that. So a response indicating, unreliable response. 4 categories. External confirmation result will be categorized into 4. Exception, agreement, response, non-response, doubtful response. Are you clear? Finally, suppose if management is refusing If management is refusing external confirmation procedure, the auditor inquire reasons and also ask evidence for those reasons and try to obtain, try to perform, and also check how the refusal impacts the risk of MMS, including risk of fraud. Is the refusal leading to a risk of MMS? Is it because of, is there any risk of fraud involved? Because of this refusal, I may not discover a fraud. Generally, why management refuse? There might be some legal dispute going on or some negotiations going on. Untimely, if at all at wrong time, if auditor is sending confirmation, that might affect the negotiation proceedings. Clear? Next, perform alternative. Since, see, one of the objective why you are sending external, you want to get an evidence whether third party is really owing us this much or not, whether are we owing him this much or not. We want to get an evidence. Try to obtain it to alternative route. Suppose if management refusal, no, it's completely illogical, unreasonable, and you are not getting reliable evidence through alternative methods, okay, then the auditor must communicate the matter to those charged with governance and see whether there is any fraud risk factor. Consider the implications, including modified opinion. See whether modified opinion is required as per 705 or not. That's it. Easy or not? Then there is one more aspect. At the beginning I told you. So what are the external confirmation? Definitions over, procedure over, management refusal over, evaluating evidence is over, right? Then negative confirmation request. Now, by the way, I told you, right, negative confirmation request means only third party will reply only when he disagree. Now, between positive confirmation and negative confirmation, which is superior? Straight away, positive confirmation. Because in a positive confirmation request, third party will reply at least. Even whether he agree, he'll reply. If he disagree also, he'll reply. If at all he didn't reply in the time limit, I will follow up until he reply. So in a positive confirmation request, I will not take any conclusion without his confirmation. Whereas in negative, what confirmation I will take? If at all he reply that he disagree, well and good. If he do not reply within next 3 days, suppose we sent a confirmation. In that we mentioned, we sent a confirmation request. In that we mentioned, we will await for 3 days. Non-receipt of reply within 3 days, we assume that you are agreeing with the balance. We assume that you are agreeing with the balance. Here, if the third party do not reply, you take an assumption that everything is matching. But here there is a flaw. For example, third party, the mail that you sent in external confirmation, it went in spam box. Third party mail ID, it went in spam box. It detected our company mail address as a spam and it went in spam box, and third party have not seen it. And that is the reason he didn't reply within next 3 days. But actually, with that data, there is a difference between what is there in his books of accounts and what is there in our books of accounts. And if you investigate, if at all you investigate, it's actually big mistake in our books only. But this entire incident, we cannot discover through NCR. Why? Because we used NCR, he didn't reply. What we assume after 3 days? Everything is matching. Is there any explicit confirmation from third party that everything is matching? No. Is there any explicit receipt by the third party? No. Do we know whether he received it actually or not? There is no evidence. That is why negative confirmation request is dangerous. It's not suitable everywhere. So negative confirmation request is less persuasive than positive confirmation request. So can we use negative confirmation request as one of the substantive audit procedure? No. Unless 4 conditions are satisfied. Unless all the following 4 conditions are satisfied. Many a times this was also asked. Remember this management refusal point, they can ask even directly as a 5 marks question. Negative confirmation request, 5 marks procedure, 5 marks. Clear? Negative confirmation request as an audit procedure, 4 conditions has to be satisfied. The risk assessed is low. Low risk is assessed, and you have an evidence regarding operating effectiveness of controls. Second one, population includes many small homogeneous balances or transaction. You can also call it as large small items. Large number of small homogeneous transactions or balances. Low exception rate. When you are expecting low exception. Exception means what? The difference between our information and third party information. If there is a difference, that's called exception. The possibility of exception is low. Exception rate is low. For example, I am sending confirmation with one debtor, right? Last week only our organization already confirmed with him. Everything is matching and there is no new transaction entered. Even if I send now the confirmation as an auditor, the amount is going to be same. There won't be any difference. Low exception rate. If there are no conditions where recipients will disregard. Suppose third party 100% will reply if something is mismatching. Okay, he will for sure see the mail. He will for sure see the mail which I am sending. So if I have that certainty, you can happily send the NCR also. So generally, suppose in a client, if 3000 external parties were there, for example 50 are very material. For 50 we will send PCR. For remaining 2950 we send NCR. So that all 3000 were covered. To these 2950 customers and suppliers, we send NCR. If at all anything, any of them want to disagree, they'll reply for sure. So that's it. Are you clear? With this 505 standard is over. That's it. Hardly 23 minutes. Entire standard we covered. So what is the structure of the standard? We need to cover definitions, 5 definitions. External confirmation means what? Positive confirmation, negative confirmation, exception, non-response, 5 definitions. Then steps for performing external confirmation procedure. Then we have when negative confirmation request can be used as an audit procedure. Then we have this one, management refusal. Finally, how to evaluate the result of the external confirmation procedure. By the way, sometimes to negative confirmation we didn't receive any response. How will you interpret it? Generally what we assume, everything we assume it is matching. If third party do not reply, we assume it is matching. But remember, he is not explicitly confirming it. He is not explicitly confirming. A non-response does not explicitly confirm receipt by the confirming party or accuracy of the information, yes or no. Accordingly, they provide less persuasive evidence than positive. In a positive, I will get more convincing factor. I will have more satisfaction because he will reply that yes, agreed sir, matching. In a negative, I will have a less satisfaction. Persuasiveness means what? Convincing. Less satisfaction or more satisfaction. NCR will give you less satisfaction in terms of reliability of evidence than positive confirmation request. Over. Are you clear? Yes or no? That's it. Predominant main standard, main theme of the standard we completed. 505 over. Confident? Easy? Yeah. So now let's discuss SA 501 revision. What is SA 501? This 501 standard also talks about audit evidence, but there is an extension to the heading. It's not just audit evidence, it is specifically dealing about 3 items. So specific considerations. What is the standard heading? Specific considerations about selected items. Specific considerations about selected items. What specifically auditor has to consider regarding selected items? What are the selected items? They selected 3 items: inventory, litigations and claims, and third one, segment information. So they have selected 3 items. One is inventory, litigations and claims, and segment information. What auditor has to specifically consider? Inventory, existence and condition you should consider. You should consider 2 assertions, existence and condition. Whereas litigation, you should consider the assertion called completeness of accounting and disclosure. Completeness of accounting and disclosure of litigations and claims. Third one, segment information, presentation disclosure as per applicable financial reporting framework. What auditor has to specifically consider? Existence and condition of inventory, completeness of accounting and disclosure of litigations and claims, presentation and disclosure as per applicable framework of segment information. These are the 3 items that we need to select, and for these 3 items we need to consider these items. Are you clear? Now, exactly. Now, what is segment information? We all know segment information means a company dealing with different products or services at different geographical locations. That is what segment information. First, we will understand segment information. What auditor has to perform here? What auditor has to perform audit procedure? First, understand methods used by management for identifying and reporting segment information. What methods management is using? Test those methods. What is it? Test those methods whether they result in applicable financial reporting framework compliance. What is it? test those methods to know whether the management methods, will they give segments, reportable segments in the same way as per applicable framework. See, you have in accounting standard some testing methods to identify segment reporting. So management here in the company that you are doing audit, they did some segment reporting. Now they used some methods of testing. So some methods to identify, you take the same methods and test whether you are getting same reportable segments as per applicable framework. Also check it out, cross check with applicable framework. As per applicable framework, if I apply those methods, how many reportable segments coming? For example, 6. Management also used testing methods, use those testing methods, you are getting 6. So that means the testing methods used by the management are resulting in segment information same to applicable framework. See, with respect to segment information, what auditor has to get evidence? Auditor has to get a sufficient appropriate evidence that the segment information presented and disclosed by the management is appropriate. We need to get an evidence that segment information presented and disclosed by the management is appropriate as per applicable financial reporting framework. That evidence we want. For that reason, what am I checking? What methods management use? We are trying to understand. We are testing those methods. And third one, we do analytical procedure, like we compare with prior period, all that. Are you clear? Now the standard also talks about one more element. When you are making that understanding, suppose you are understanding the methods used by management, for that we'll look at the book. For understanding the methods used by the management, you see, the auditor has to obtain sufficient appropriate evidence regarding presentation and disclosure of segment information. Is it in accordance with applicable framework? Understand the methods of the management, test those methods, perform analytical. You don't have to give any opinion. By the way, just because you're doing this, there is no requirement for you to give opinion separately on segment. You have to give opinion on the overall financials only. Now, when you're understanding those methods, there are some matters that you should take into account. Now, when you're understanding segment information, is it presented and disclosed correctly? What methods management used? Pay attention to, are there any sales and transfers happen between segments? Sales transfers happen between segments. Compare with budgets and expected results. Segment information as per budget, how much is there? As per actual result, how much is there? How assets and cost is allocated between segments. Compare how far the allocation methods, everything is consistent with prior period, and if at all there is any inconsistency, there is a changes in asset allocation, there is a changes happened compared to last year, whether the changes were disclosed correctly or not. Are you clear? This is the audit procedure. Now in these two put together, a 5 marks question can come. Even when they ask understanding of management methods, first you write audit evidence about segment information, then understanding of methods you write. Sometimes in exam they will only ask this point, but it's a 5 marks weightage question. You should write both. Are you clear? That's it. One of the element is over. Then second selected item. What is the second selected item? The second selected item is audit procedures regarding litigations and claims. What is the second selected item? Litigations and claims. Correct? Litigations and claims. What auditor has to check in this litigation and claims? In the litigation and claims, auditor has to check completeness of accounting and disclosure. The company that we are auditing is facing with so many litigations and claims, whether the company, nothing but management, whether the management accounted all the litigations wherever our client is involved, and sometimes it requires accounting in the balance sheet and P&L, sometimes it just requires disclosure. For example, if the litigation and claims involves in a real liability, there might be a outflow for sure, then that might be a real liability or a provision. No, it's a remote liability, there is a remote possibility, then it at least requires disclosure as contingent liability. The auditor has to check whether the organization completely accounted or not. For that, what auditor has to do? First, auditor has to inquire management. What is the audit procedure for litigations and claims? They'll ask you straight question, 5 marks question. First, inquire management and legal counsel. Inquire management and internal legal counsel. More specifically speaking, internal legal counsel. Company might have internal, their own lawyer, their own, like lawyers will be there. Retainers, we call them as legal retainers. The company will have own retainers. So ask them, internal legal counsel, are there any litigations? 2, check minutes of meetings of those charged with governance, and meetings of legal counsel, meetings of management, meetings of shareholders. Look at the meetings, look at various minute books of various meetings. Through that minutes, you will understand, is there any discussion about litigations and claims? Third one, review. Company will have legal expenses account, right? Legal expenses ledger account, right? Review that ledger account. You might get data about some litigations and claims. Now look at some litigations and claims, you might get evidence. Then use risk assessment insights. Management might have performed risk assessment, auditor also would have done risk assessment, right? Use that insight. Okay, whatever you understood about risk assessment, use that. And sometimes you may have to even communicate directly with external legal counsel. Sometimes you also have to communicate with external. By the way, we also check correspondence with external legal counsel when we are doing audit procedure to identify litigations and claims. First, we should try to identify our level best what are all litigations are there. For that, we need to inquire management, internal lawyers. We need to look at the minutes of the meetings. We need to check the discussion happened between our company and external lawyers. Yes or no? And we need to check the legal expense account. We should check risk assessment. We should take the data that we obtained in risk assessment. All this you try. You will identify where and all pending litigations are there, pending claims are there. There are some circumstances where you may also have to do 505 with external legal counsel. What is 505? External confirmation. Nothing but direct communication, direct confirmation. So do a direct communication with external lawyers to know what are all the litigations. Now, direct communication with external lawyers. When you will seek this? When you will go for direct confirmation? If at all audit procedures indicates some other litigation might exist. Company disclosed you already 20 cases, pending cases against the company, but you felt there might be more cases involved. So that time you communicate with lawyers. And also risk of MMS is identify. If you feel that some material misstatement risk is possible, suppose in the company, when I ask them the question, what are the litigations and claims that are dealt with the external lawyers, they are doubtful answering. Yes or no? So I felt definitely some risk of MMS, risk of fraud, risk of error is there. Communicate with them, external lawyers. Are you clear? Or if you think external legal counsel is dealing with some peculiar cases which is not recorded in the books of accounts, which is not recorded to you, which is not disclosed to you, you know that you feel that external lawyers can give you some additional data, communicate with them. So two circumstances, risk of MMS exists. Two, audit procedure suggest, indicates some other litigations might exist. In these two cases you communicate. How do you communicate? You communicate through letter of inquiry. First of all, you try to ask them through a general letter of inquiry. Sometimes general letter of inquiry, third party lawyer may not reply. That time you use specific letter of inquiry, letter of specific inquiry. What is letter of general inquiry? What is letter of specific inquiry? Suppose, look at general inquiry example I'm telling you. So we write a mail to the lawyer. External lawyer will write a mail like this: sir, we are the auditors of so and so company. We as a part of audit, we found that you are dealing with some cases, litigations and claims relating to our entity. Can you please give the list of litigations that you are handling related to our company? What is the status of the same? How much amount involved? I'm asking him to give complete information about what he is transacting with the company. This is general inquiry. Now, some lawyers know it is unlikely that external legal counsel responds in case of general inquiry. If external legal counsel does not respond or they are unlikely to respond, then auditor shall use letter of specific inquiry. Suppose I sent a general mail like this, then the lawyer office replied us, sir, we will not reply to this general mail, sir. If you want to know about any specific case, please mention that. We will confirm what is the status of the case. So that's how they replied us. Then now I will send a letter of specific inquiry. Then I will write, sir, we are the auditors of so and so company. We found that your legal firm is handling the following cases as per the information given by management. You are handling 7 cases. And the amount involved is this. Management's assessment is this. Management is saying 2 are real liabilities, sir, 5 are contingent liability. This is what management assessment is. So please confirm whether the information as shown above is complete and correct, and management's assessment is complete and correct. Please reply if at all this is incorrect or incomplete. I will ask them. Now specifically I'm mentioning the cases and then asking them, which will be easy for them to reply. Look at now, in case of specific inquiry, mention the list of litigations, what is the management's assessment, what management is saying on that, and request the lawyers, request the external legal counsel to confirm management assessment and provide further information if the list is incomplete or incorrect. This is specific inquiry. Are you clear? Now this direct communication, this itself can be asked as a 5 marks question straight away. It was tested once. Next, what now, there are some occasions where forget about direct communication, we want to meet them. So under what circumstances auditor will meet with external legal counsel? The auditor in some circumstances may judge to meet. So what are the circumstances? When the matter is a significant risk, when the matter involves significant risk, or the matter is complex, or management and legal counsel, they are disagreeing on certain issues. I want to know exactly what further. When they're disagreeing with each other, what I have to do? I'm doubtful. So I want to know what exactly the lawyer is saying. Next, suppose if management refuses, management is refusing to directly communicate with them, management is refusing the auditor to meet them, or they permit it, but they are not responding. External ELC does not respond, and in all these cases you try to obtain evidence through alternative method. If you are unable to obtain evidence through alternative, which means I'm unable to communicate with them, I'm unable to meet them, they are not responding, I'm not getting evidence in alternative methods also, regarding litigations and claims I am doubtful, I do not have proper evidence, then I will modify my opinion as per 705, where I will give qualified or disclaimer of opinion. Am I right? In the audit report we have seen clearly, evidence not available means either qualified or disclaimer. Some students will think adverse here, wrong. Are you clear? That's it. Next. So that's it regarding audit procedures regarding litigations and claims. There is a 5 marks possibility on this. Then we have inventory. The first item is what? Inventory. Okay, the first item is inventory. The auditor has to obtain sufficient appropriate evidence regarding existence and condition of inventory. Now here, inventory means, the moment when you think of inventory, there are two circumstances broadly: inventory lying with third party and inventory lying with the entity. Correct? Inventory lying with the entity or inventory lying with the third party. First we will look at how to obtain evidence, sufficient appropriate evidence regarding existence and condition of inventory lying with third party. How do you get the evidence? One, request confirmation. Yeah, request confirmation as per 505. Ask him to confirm regarding quantity of inventory and condition of inventory. Request the third party directly to confirm to the auditor directly regarding quantity of inventory, how much is holding, what is the condition of holding. If possible, you inspect the inventory. Second, if at all you're not okay with confirmation, you're not ready for confirmation, you directly inspect or perform other audit procedures. What is it? Perform other audit procedures as appropriate in the circumstance. Either you inspect directly or perform other audit procedure. Sir, what do you mean by other audit procedure? What do you mean by other audit procedure? There are 4 circumstances they told. Other audit in exam they can ask you, an MCQ they can ask you, what do you mean by other audit procedure? They'll give you options and then ask you to select, or they will ask you direct descriptive question, 5 marks question. What do you mean by other audit procedure? If inventory is lying with third party, one option is request confirmation, second option you directly go and check it, or other audit procedure. What do you mean by other audit procedure? What do you mean by other audit? Look at this revision, look at this material. So if inventory is lying with if the inventory is under the control of third party, if the inventory is under control of third party, if the inventory is under custody and control of third party, which is material to the financials. Remember, we should obtain evidence only when it is material to the financials. In the recent Jan 26 CA final audit exam, they tested one MCQ where inventory is not material, and audit also could not get proper evidence. What auditor has to do? They gave 4 options: disclaimer of opinion, qualified opinion, something like that, and one option is unqualified opinion. The answer is unqualified opinion. We should ignore this, because in the question which they tested, inventory is not material to the financial statements. It is immaterial inventory. We don't have to perform this procedure. Are you clear? In SA 501 applies only when inventory is material to the financial statements. That inventory point is applicable only when it is material to the financials. So we should give unmodified opinion if the inventory is immaterial and we are not getting evidence on that. It's immaterial item first of all. So no need to worry about it. Are you clear? So fine, if inventory is material and lying with third party, auditor has to do two key procedures. What are they? Request confirmation or inspection or perform other procedures. What do you mean by other procedure? Look at the documentation such as warehouse receipts regarding inventory held by third party. Third party received inventory, right? What is the proof that we have? And attend third party physical inventory count. Third party will do physical inventory count, right? Periodically he will do, just like our organization they will also do, right? Whenever they are doing, try to attend or arrange another auditor. If you are not able to attend, arrange another auditor or obtain report from another auditor. Like for example, you sent another auditor, right? Get a report of him or obtain service auditor report. Service auditor report, best example I told, you know, Amazon example you can take. What is Amazon example? For example, Hindustan Unilever is there. Many of the goods that they manufacture, they are not storing in their warehouse. Now they are storing in Amazon warehouse. Yes or no? Directly they are listing their products in the Amazon website and Amazon is selling it. And Hindustan Unilever will get back the money after commission. Now the goods they are storing in Amazon warehouse. Now here Amazon is service organization. Okay. Now whether Amazon is maintaining the inventory correctly in proper condition, whether their inventory management is proper or not, Amazon will appoint one service auditor. He will give an audit report called service auditor report. That audit report, as an auditor of HUL, I am an auditor of HUL. I am checking inventory of the HUL. Some of the HUL inventory is lying with Amazon. Now I want to know whether inventory held by Amazon is properly held, condition proper or not. I want to know. Understood? So how do I get? One way is I can ask confirmation with Amazon, request confirmation with Amazon. That is one option. Second, I will directly go and verify with the Amazon. Second option. Third option, I will inspect what is the proof that Amazon is having, and I will attend if possible Amazon physical accounting, or I will obtain Amazon's service auditor report, where the auditor is talking about control set third party inventory management. In the Amazon, how the controls regarding inventory, service auditor is giving me a report. That report I can use. These are other audit procedures. Sometimes inventory may be held as, pledged as collateral, then request confirmation from other party, where inventory is held as collateral. These are all other audit procedures. Are you clear? When the inventory is lying with third party, you got it reasonably? Next, then now what if inventory, I told, right? Again, the other inventory is what? Inventory lying with the entity. What auditor has to do if the inventory is lying with the entity? Very simple. When the inventory is material, the auditor must obtain sufficient appropriate evidence regarding existence and condition. Remember, an MCQ can come. SA 501 is dealing with existence and condition only. It is not dealing with valuation. SA 501 is only focusing on existence and condition. When inventory, suppose if auditor is visiting godown, if an auditor is visiting inventory physical verification, what auditor is primarily concerned about? He is concerned only about existence and condition. Valuation is not worried. He will anyhow check valuation as per accounting standard too. He has to check valuation anyhow. I will check, but I am concerned about existence and condition. Are you clear? Now, if inventory is lying with the entity, with our management, what auditor has to do? You attend physical inventory count performed by management. Management will do physical inventory count rate periodically. You attend there. What you will do there? After attending, how management instructions and procedures are? What are the management instructions for inventory physical taking? Remember, you are not performing physical count here. Management is performing. You are only going there just to observe how the management is performing. If possible, check the inventory to know its condition, and test count you perform test count means what? For example, management, one of the person, he says he just climbed that one particular rack and says 40 items are there in a particular box. You just go and check whether that box really has a 40. Here what are you trying to test? You are testing the test of the management, whether management counting is properly doing or not. That's it. So these are the 4 procedures auditor has to perform. 1, evaluate management instructions on controlling and recording the inventory count. 2, observe how they are performing, inspect the inventory, test check. test count, test count, perform test count. And there are some matters which are most important you should keep in mind whenever if the inventory lying with third party is the question, you should write third party answer. So request confirmation, inspect and other procedures examples, that entire answer you should write. If there is no third party indication, they are asking you existence and condition, you should write this entire matter, then you should write this matter also. When you are doing inventory counting, keep in mind what is the nature of inventory that you are looking at. Okay, is it raw material, is it work in progress, is it finished good? That is one example. Another example of nature of good is type of inventory. Is it crude oil, is it so and so, is it so and so, what product it is. Nature of inventory, keep in mind. Is the entity maintaining perpetual inventory system? Check it out. Is the company maintaining perpetual? If the company is maintaining perpetual inventory system, you can do physical verification. Management can do physical verification whenever they want, not an issue. But when they maintain periodical inventory system, periodical means once in a while they'll update. They don't update every moment. 31st March it is compulsory. If it is periodical maintenance system, 31st March compulsory physical verification they need to do and update the records on 31st March for closing stock valuation purpose. Next, location. Keep in mind when you are going for physical verification, keep in mind where it is held, and also depending upon the location where it is kept, risk and materiality will also influence. Yes or no? Then is there any expert requirement? Check out, is there any expert requirement? Suppose you are going for crude oil checking, you are not expert in crude oil measurement. Yes or no? Take an expert along with you if required. Yes or no? Then what is the stage of completion? In case if the nature of inventory is work in progress, look at the stage of completion. That decides how much inventory is in progress. Are you clear? That's it. And when they are counting it, timing. If at all perpetual inventory system they are maintaining, they can do whenever they want. But if it's periodical system, timing is most important. 31st March compulsory they should count. Are you clear? These are the points which auditor will take into account. Suppose if inventory counting is performed at other than balance sheet date. If it is performed on balance sheet date, whatever above they told, as usual I will perform. Suppose if it is performed at other than balance sheet date, same things. Even management is doing inventory counting on 20th April. After 31st March, they are counting 20th April, they are counting. Same procedures. When I go, I will just keep these factors in my mind as usual. In addition to this, I need to perform additional procedure. What additional procedure? I need to see changes in inventory between count date and balance sheet date are properly recorded or not. Exactly what you will verify. What exact procedures? Very simple. Is the company adjusted perpetual records correctly or not? First of all, I should see reliability of perpetual inventory records, and if there is any differences between the physical count result and perpetual record. Inventory record is maintained in perpetual inventory system records. If there is a difference between that record quantity and physical count quantity which is counted on 20th April, if there is a difference, I'll ask for the reasons. So 3 points I will have to verify there. If at all inventory counting is performed at other than balance sheet date, I have to verify 3 points. Are perpetual inventory records were properly updated? Are they reliable? If there is any difference between the records and physical count, what is the difference? That I need to check. Yes or no? Suppose the auditor is unable to attend inventory count. Management is planning to perform. First they planned on 31st March, you didn't attend. 20th April they are planning, you didn't attend. Every time something is happening, you try to attend on some other day. Take your team and you do the counting. Ask management assistance also. So if auditor is unable to attend physical inventory count due to unforeseen, then they should conduct or observe. They should observe physical count on an alternative day and perform procedures on intervening transactions between management count date and your date. And suppose if inventory counting is impractical, it's impossible for you to do inventory counting at all. It's not possible at all because of various reasons, okay, which is out of the control of the auditor. It is not in the auditor's control. It is completely impractical. Then try to perform alternative procedures and obtain sufficient appropriate evidence regarding existence and condition of inventory. You can't leave it. Just because you are unable to attend physical inventory count, you can't leave it. Yes or no? Perform alternatively and try to get evidence on existence of the inventory. Is the inventory physically there? Condition, is it in good condition? Get evidence on existence and condition by performing alternative. Modify the opinion if alternative procedures are not possible. See, if alternative procedures are not possible means ultimately regarding inventory, you don't know whether they are existing physically. You don't know in what condition they are existing, which means you do not have evidence. So you should give modified opinion, which means either qualified or disclaimer of opinion. Am I right? And impracticality. Why impracticality? That may be due to nature of inventory or that may be due to location, such as safety concerns at the site. For example, you are an auditor for national defense. Our national defense department, you are the auditor. At Siachen, some defense equipment is there, and it is very tough for the auditor to go there. Unless the auditor is super fit, extreme fit, it is not permitted for him to go there. Yes or no? And when the fitment check they did, you failed in that, for example. So you are unable to go there. It's impractical for you to go and check the inventory that is lying at so and so particular location. Are you clear? So that's it. Next, what is not impracticability? If auditor is feeling inconvenient to go, that is not impractical. If auditor is feeling, oh my god, their AC will not be there in the godown, that and all is not impracticality. Are you clear? Remember, even in SA 200, difficulty time cost is not a valid basis for you to omit audit procedure. Next, what are the example of alternative? I told, right, if at all impractical, you should perform alternative procedure and obtain the inventory. What is alternative procedure? Look at the sales documents of subsequent sales. Suppose as on 31st March inventory is there, you are unable to attend physically, but from the same godown, sales are happening from April 1st onwards, and deliveries are also happening. 1st April, 2nd April, 3rd April, delivery happened means 31st March inventory is lying in the godown. That's one way. And perform other alternative procedures. Are you clear? If at all, ultimately you are unable to obtain evidence, modify the opinion, because there is a limitation on the scope. Because you are unable to obtain evidence, so modify the opinion. That's it. Are you clear? Inventory, two things: lying with third party, lying with the entity. Lying with the entity, attend management count procedure, observe how management is counting, evaluate management instruction, inspect the inventory, test count the inventory. And matters relevant: nature of inventory, location of inventory, whether they are maintaining perpetual records, timing of inventory, and whether there is a need for expert, stage of completion of work in progress. If inventory counting is at some other date, 3 items you need to verify. Verify perpetual records are properly updated, are they reliable or not? Yes or no? And then third point, if reasons, ask reasons for any significant difference. If at all inventory counting is impractical, try obtaining audit evidence through alternative procedure. If alternative procedures are not possible, if alternative procedure is not possible, you are unable to obtain sufficient appropriate evidence, give modified opinion as per 705. That's it. If inventory is lying with third party, request confirmation, perform directly go in and inspect or perform other audit procedure. Other audit procedure means what? Below. Inspect documentation for inventory held by third party. Third one, arrange another auditor to physically count the inventory at third party location. 4, obtain other auditor report or service auditor report regarding controls related to inventory management at the third party location. If inventory is pledged at security, get a confirmation for that. These 4 procedures will come under other audit procedures. That's it. With this, 501 standard is also over. That's it. Confident? In a regular class, we discussed almost the standard for 2 hours. 2.5 hours. So 2 hours above we discussed, 2.5 hours with all questions, exceptional questions, how to draft, everything we discussed in depth. But here, we briefly covered within half an hour. Actually, we covered almost 70-80% of the standard. That's it. Yeah, clear? So, now let us do a quick revision of 550 standard, which is related parties. Okay? See, related parties, you have an accounting standard already. What accounting standard is dealing with related party? Related party disclosures. So accounting standard that is predominantly dealing with disclosure requirement of related parties. And anyhow, as a part of your audit, you have to verify whether the financial statements are prepared in accordance with accounting standards or not. You have to anyhow verify. Yes or no? Now, then what auditing standard 550 related parties is talking about? The auditing standard has 2 objectives. One, whether there is a risk of material misstatement, especially due to fraud. The auditor has to identify and assess risk of material misstatement, specifically through fraud in related party relationships and transactions, RPRT. Every time whenever you are writing an answer in 550, please mention the word RPRT, not shortcut, full form. Related party relationships and transactions. Okay, so SA 550, whenever there is a risk of MMS, the auditor has to identify risk of MMS in related party relationships and transactions. So this is what the objective of the standard. Then secondary objective is also there for the standard. The secondary objective is disclosure requirements, whether disclosure requirements as per applicable financial reporting framework is satisfied or not. This is the secondary objective. But in CA Inter 550 standard, we do not have objective discussion at in depth. Just a brief scope of the standard only they discussed. So in accounting standard, we primarily focus on verifying disclosure requirements, whereas in auditing standard, the focus point is different. The focal point in auditing standard is identifying risk of MMS, because when you're transacting with related parties, sometimes it may carry high risk. It may carry high risk because, you know, a company can create a dummy company. Simple. A company which is actually a loss-making company can create a dummy company and can sell the goods at a higher rate to the dummy company on credit basis and show higher profit and get a loan. This is just a very simple transaction, I'm telling you. Like this, multiple group of companies we create, a complex structure a company can create and do manipulation of financial statements, books of accounts, all that. Coffee Day is the best example. There is an NFRA which have taken action on the Coffee Day auditors, KPMG. Okay, KPMG is the auditors for Coffee Day in 2024. That to which financial year fraud, you know, it is 18-19 year. It's a fraud related to 18-19 financial year, and that action was taken by KPMG. That action was taken by NFRA in 2024 year. So 24 or 25, in one of this year it happened, this incident. 10 crore penalty was levied on the KPMG and 50 lakh penalty was levied on the partner. 25 lakh penalty was levied on the quality control reviewer. What Coffee Day has done, they have created multiple entities and diverted the funds, and they manipulated funds. This is what the actual issue is. Okay, so related party study is very, very crucial when you are doing audit of financials, because the fraud risk is very high in related parties. Are you clear? Now, what are all we are going to study in this standard? We are going to revise in this standard. First of all, who is a related party? Then we will be understanding what is the nature of related party relationships and transaction. What is the nature of this relationship? What is the nature of the transaction? Then we are understanding risk assessment procedure related to related party relationship and transaction. Then we are understanding how this point we need to apply to smaller entities, how we need to apply to smaller entities, and what are the records and documents, what are the records and documents to identify, what is it? To identify related party relationships and transactions. Remember, any of this can be tested. Related party, this definition, this particular concept is important for MCQ, and all these points, either MCQ can come or a descriptive question can come. Related party relationship, 4 or 5 marks question. Risk assessment procedure related to related party, 5 marks question. Smaller entity considerations, 5 marks question. Related party records and documents, 5 marks question. And remember, all of this have been tested in the past. Do you understand the standard overview? Now, who is a related party? Who is a related party? What do you mean by related party? The standard divides related party definition into 3 parts. First of all, the standard says related party means the related party defined under applicable financial reporting framework. If at all accounting standard is there which defines related party, then take related party meaning as per accounting standard. Suppose if applicable financial reporting framework is silent on the related party aspect, then SA 550 gives the definition of related party. As per SA 550, who is a related party? Related party is a person, or it may be entity that controls or significantly influences the reporting entity. Remember, we are the auditor of reporting entity. If a person or entity is controlling or influencing us, then we call this other person, whoever is controlling us, whoever is significantly influencing us, we call them as related party. Or related party can be another entity which is controlled or significantly influenced by reporting entity. Suppose the client we are auditing, right, the company, if it is controlling another entity, if it is significantly influencing another entity, then that is also related party. Then third relationship, another entity. What is it? Another entity that is under common control. That is under common control. Common control along with reported entity. Nothing but we are one company, there is another company, for both of us common parent is there. Parent is anyhow related party. For parent, I am related party. For the subsidiary, parent is related party. Not only that, there is another co-subsidiary, is there, right? Co-subsidiary, we call them as sister concerns. We call them as what? Sister concerns. Sister concerns are also treated as related party. Sister concerns are also treated as related party. Are you clear? Easy or not? Sister concerns. Remember, so which means, for example, you take Tata Group. Tata Sons is controlling Tata Motors. Now, we are the auditors of Tata Motors. Tata Sons is related party. Now, you know, another entity where Tata Motors has a subsidiary company called Tata Motor Passenger Vehicle Limited. For passenger vehicle, they have incorporated a separate company. Tata Motors is holding company for that. For example, now for Tata Motors, we are the auditors of Tata Motors. Tata Passenger Vehicle is also related party because Tata Motor is controlling it. Are you clear? And another entity that is under common control. For example, Tata Consultancy Services, Tata Chemical, Tata Beverages, all these companies, Tata Power, all these companies are subsidiaries of Tata Sons. We are also subsidiary of Tata Sun. These are all, which means me and other companies, for all of us, common parent is there. We are called as sister concerns. We are all related parties. Are you clear? However, the most important part in the definition is the exception for common control. Any entities under, I will show you directly the book. Entities, look at the exception. Entities under common control of a state. State means what? It's actually government. Central or state, doesn't matter. Entities that are under common control of a government, they are not treated as related party unless they are transacting with each other significantly or they are sharing resources. Otherwise, they are not related party. Are you clear? Now, what do you mean by control? What do you mean by significant influence? Control, the key word is power to govern. Governing. Whereas significant influence, participate. The keyword is what? Participate. The power to participate is the keyword in the significant influence. Are you clear? How do I know whether somebody is controlling, whether somebody is influencing, or we are controlling somebody, or we are influencing somebody? How do we know? Very simple. Look at the equity holdings. Look at the company equity capital, who is holding. Look at the key shareholders. Look at the holdings in other entities. Look at our company investment register. Look at the key management people and governance people who are part of key management in our company that we are auditing, who are those charged with governance, and who are their close family members. Are there any business relationships with the key management? By looking at this, you can understand who are all related party indicators. These are all indicators of related party. Now, sometimes there will be some related parties who are having dominant influence. Auditor has to pay attention to these related parties because related parties with dominant influence is one of the source of risk of fraud. One of the significant source for risk of fraud. Related party with dominant influence. Are you clear? Next, special purpose entities. Sometimes our company will control some other company just with the limited shareholding. We may have less than 5% shareholding, less than 10% shareholding. We are very limited, but we can significantly control it because we are the major supplier for the company. We are the major customer for the company and we are having very minor shareholding, but we can control the entire business operations because we are a major buyer or major supplier. So this is one more example of special purpose entity. Are you clear? Next. Now the second aspect. So first part, related party definition is over. The second one, nature of related party relationship and transaction. The second thing auditor has to study is nature of relationship. Generally, related party relations and transactions are no different from transactions that are happening with unrelated. Okay, so generally related party transactions will not carry, they may not pose higher risk, just like compared to unrelated party transactions. But there are some transactions, sometimes related party transaction may result in higher risk of MMS. Example, 3 circumstances higher risk is possible. For example, first one, related party transactions may not follow normal market terms and conditions. Suppose we are selling goods to one company on credit where the credit period is 120 days. Generally we sell it to credit period is 30 days, but to this company we are giving 120 days. That too, the sale happened at year end. Okay, this is a possibility that this is a dummy sale, but since auditor will question where the collection, we give 120 days credit period time. so that auditor will not question the credit period point, because subsequently when the amount is collected, nobody will look at. So we sold dummy good, we sold to related party at a higher price and manipulated the financial performance of the company and showing very good performance. So sometimes related party transactions may not happen at normal market terms and conditions. That is one of the area where high risk is there. Second one, our company information system, we are doing audit of company systems, right? We are doing audit of company financials, right? The company accounting software is failing to identify related party relationships, related party transactions. So the company, whatever transactions they are doing with related parties, no, our software is not identifying it. Our software is not summarizing it. Whatever transactions, whatever outstanding balances with related parties, we do not have any proper, software. Information system is weak. Information system fail to identify them. That is, if the company do not have a formal process to identify related party, then we will consider related party risk is high. We consider related party risk, related party relationship, related party transaction risk is higher. Third one, the structure. The related parties, related parties have extensive, the structure is so extensive, so complex, the transaction is so complex. This is third factor that will give us an idea, that will give us an indicator that there is a high risk involved in related party. This itself can be asked as a 5 marks question. Next. So therefore, you understood related party relationship carries sometimes high risk. That's why you need to pay attention to related parties. What you look for in related parties, what you understand for, what exactly you ask. Risk assessment procedure related to internal party. First, understand the related party relationships. So inquiry management, the auditor shall inquire. The auditor shall inquire. The auditor shall inquire. Who are the related parties? And compared to last year, prior year, what changes happened? Is there any relationship between, what is the relationship between them? Is there any transaction? If so, what is the type of transaction? What is the purpose for which the transaction happened? Check it out. Further, the auditor has to do risk assessment procedure, control evaluation. What evaluation? Get an understanding of controls established. Controls means what? The company should establish some system to identify, account, disclose related party relationships. Second one, the auditor has to check. Controls for authorizing and approving significant transactions. For example, you take any listed company, audit committee will approve all the related party transactions. There is a process for it. Also, ask a company whether they have a control for approving transactions which are outside normal course of business. So auditor has to look for 3 things in risk assessment procedure. First, understand what controls company established to identify, account and disclose related party relationships and transactions. Second, auditor has to assess the controls related to approval and authorization of related party transactions. Auditor has to look for controls for approving transactions that are outside normal course of business. Remember here, outside normal course, it may be with related party, it may be with unrelated. So we want to first identify, is there any transaction happened unusually? And if so, with whom it happened? So auditor has to do risk assessment. So before doing, inquire about the company first, who are all related parties, what relationship they had, what transaction they had with them, and you also check the controls in the company. This is called risk assessment procedure related to related party. Then smaller entities, you just read it later. Okay. Now, verification and existence of related party. How do you verify whether company has, even smaller entity point I'll cover, don't worry. Even how do you verify and identify related parties? Fine, you understood what controls company established, you inquired management, everything is fine. You know nature of related party transactions sometimes carry higher risk. You know what is meaning of related party, all that is fine. How do you identify? By looking at various records and documents. What are the records and documents? Best document, shareholder register. Another best document, entity investment record. Another best document, agreement with key management and those charged with governance. I verify them, yes or no. And I will look at life insurance policies which the company has taken, key man insurance policies which the company has taken, who are the nominees in that. And I will look at big contracts which are renegotiated during the period. I will look at income tax returns, and I will verify statement of conflict interest. Directors, board of directors and top management, key managerial persons, they should give a statement of conflict statement. They need to give a conflict statement regarding some transactions. That statement documents I will look at. I will look at minutes of the meetings to identify related party. All that. Are you clear? So the auditor has to be alert throughout the audit to identify related party relationships and transactions. Especially you have to be alert when you are verifying records and documents. Now, suppose if at all you're doing an audit of a smaller entity, if at all you're doing audit of a smaller entity, how do you verify related party relationship? Just like a larger entity, first I will inquire management. I will observe how management is reviewing the activities. I will observe how they are monitoring and reviewing, and I will inspect various documentation, some relevant documentation I will verify. Remember why smaller entity point is discussed separately? Because in small entities, control environment is different. It is not like a bigger entity. Like a bigger entity, control environment won't be there. Further, control activities in smaller entities are less formal. In a big company like Reliance, all the control processes is well documented, rules and regulations well documented. If a new employee joins, he first to follow that. In a smaller entity, formal documents will not be there. Imagine a supermarket, grocery store, there won't be any rules and regulations manual. Yes or no? Then here the owner himself, the manager, if at all in the absence of owner, manager will be there. The manager himself can mitigate the entire risk. They can prevent every fraud, they can prevent every error by effective oversight, or they can easily make fraud potentially because only one person is involved. Yes or no? Since only one person is managing or two persons are only managing, they can easily do a fraud or they can easily prevent a fraud. This is the reason why auditor has to pay special attention in case of smaller entities, because the control environment is not documented, control activities are less formal. That's it. Are you clear? With this, related party standard 550 is over. Easy. Am I right or not? Confident? Yeah. Let's revise now another standard 510, opening balances. The actual heading of the standard is initial audit engagement and opening balance. You know, this standard specifically deals with initial audit engagements but not recurring audit engagements. But we apply the principle stated in this standard even in recurring audits also in reality. But the standard main focus is in respect of initial audit engagement. The auditor has to be very careful about opening balances. Now, first of all, what is an initial audit engagement? We are discussing, by the way, 510 initial audit engagement hyphen opening balances. Okay. What is an initial audit engagement? There are two types of engagements which are called as initial audit engagement. For example, I have accepted audit of a company where prior period financial statements were not audited. They were not audited. Then that's an initial audit engagement. Or prior period financial statements were audited by predecessor auditor. Prior period financial statements were audited by predecessor auditor. Who is a predecessor auditor? Predecessor auditor is an auditor from different firm. Am I right? Suppose if my partner, last year he did the audit, this year I am doing the audit, but both are belonging to same firm. This is not predecessor audit scenario. Predecessor auditor means there is a change of auditors happen. So last year the auditor was different, now the auditor was different. So this particular engagement is called as initial audit. Very simple. My audit firm was appointed as an auditor for the first time to this client. This is initial audit engagement. Are you clear? Predecessor auditor means what? An auditor from a different audit firm who conducted the audit of financial statements of prior period. Now, opening balances. Why auditor has to worry a lot? Very simple. You don't know anything about the company. Yes or no? Opening balances, accounting policies, what are material balances, what are significant transactions in the companies, nothing you know. So they are telling you, you should obtain sufficient appropriate audit evidence. You should obtain sufficient appropriate audit evidence on opening balances, whether it contains material misstatements affecting current period financial statements, whether opening balances contain material misstatements which affecting current period financial statements. This evidence you should obtain. The standard objective, if you see, it is also dealing with another objective. It is also talking about accounting policy. The auditor has to check whether accounting policy is consistently applied in the current period, which is taken from last year, nothing but which is taken from opening balance. Is it consistently applied? Suppose if changes were there, whether these changes were properly accounted, whether the changes were properly disclosed. The auditor has to check the auditor has to obtain evidence whether accounting policies were consistently applied. If not, whether changes were accounted and disclosed correctly or not, we should get evidence. So this is the audit objective. Clear? By the way, we should obtain evidence on opening balances when they're material in the current period and prior period was audited by some other auditor, or prior period were not audited at all. Further, if financial statements includes prior period information, nothing but comparative information, the standard scope, SA 510 scope clearly says apply 710 guidelines also. Apply 710 guidelines also. So scope of the standard. What are the responsibilities of auditor in relation to opening balance in an initial audit engagement? Further, it is alerting you if the financial statements that the company which prepared, if it has last year information also, then 710 requirement also you follow. This is scope and objective. Are you clear? Now, what is the audit procedure for opening balances? What is the audit procedure for opening balances? First one, perform procedures whether last year or prior period closing balances were correctly carried forwarded and brought forwarded. Verify whether prior period closing balances were correctly brought forwarded. Yes or no? Now, perform and verify whether accounting policies, they'll ask you straight question, 5 marks question, what is the audit procedure for opening balance? Verify whether accounting policies, second procedure, whether accounting policies were consistently applied, whether accounting policies were consistently, accounting policies reflected in, where it is reflected in opening balances, accounting policies reflected in opening balances, were they consistently applied? Third procedure, perform one or more of the following. Perform one or more of the following. 3 procedures they stated. 1, last year closing balances, were they correctly brought forwarded? This you should verify by checking books of accounts. Generally, by default in books of accounts, some accounting software they will use, it is an automatic brought forward, so no need to specifically check on that. Second one, check accounting policies, whatever they shown in the last year, were they currently applied, same consistently applied or not, check it out. Third one, perform one or more of the following procedures for opening balances. What auditor has to check? One or more. What auditor has to check? The first one auditor has to check is review audited financial statements of prior period. Generally, last year financials were audited by somebody, right? Review audited financial statements and relevant documents. Review audited financial statements and relevant document. Review the documents and audited balance sheet, compare with the last year. You will easily understand. Yes or no? Then current year audit procedures you performed, right? Current year you do some audit procedure, right? Current year you do some audits. For example, current year you verify collections from debtors. Current year you verify payments to suppliers and all. This collections and payments, current year procedure will provide evidence for opening balance. Verify whether current year procedures provide evidence for opening balances and perform a specific audit procedure for opening balance. The standard says perform a specific audit procedure. Specific procedure for opening balance means what? Example, what is example? Take current year opening trial balance, you take current year opening trial balance. You are the auditor for current year, take opening trial balance. Match it with last year signed balance sheet, you match. Last year signed balance sheet you match. If you do this specific procedure, you will get an evidence whether opening balance is correctly brought forward or not. And so 3 procedures. Okay, 1, last year balance correctly brought forward or not, check books of accounts. Check whether accounting policies are consistently applied. Perform one or more of the procedures. Now look at it. Look at this. So what is the audit procedure for opening balance? In the book it is in 510 standard. Okay, this itself can be asked as a 5 marks question. Verify prior period closing balance or correctly brought forwarded. Ensure opening balance reflect application of accounting policies. Perform one or more of the following, like 1. Review financials and relevant documents, evaluate current procedures, provide evidence for opening balance, conduct specific audit procedure. Specific audit procedure means what? Comparing trial balance, all that. Now, to what extent I will perform? This itself can be asked as a 5 marks question. What is the nature of procedure? To what extent do you perform? It is influenced by so many factors. Suppose if last year auditor gave a modified opinion on the last year balance sheet, auditor has to be very, very serious on the opening balance. So the nature and extent of audit procedures for opening balance, to what extent I will involve in opening balance, depends upon predecessor auditor's opinion, whether it was modified or not. And it also depends upon how significant opening balance to current period. Sometimes if last year company was newly incorporated, now no transactions happened last year much, that means in the current period opening balances are not much significant. Able to understand? Then what is the nature of account balance? Are they current assets, are current liabilities, are non-current, or liabilities are non-current assets? What is the nature of account balances in the opening? And what is the nature of transactions that they did in the last year? Nature of disclosures, what they did, and risk of MMS that you identified, and also focus on what accounting policies that they are following. Depending upon the complexity of the accounting policy, depending upon the significance of account balance transaction disclosure in the last year, depending upon the significance of opening balance in the current year, depending upon whether prior period auditor modified or not, these factors will influence the nature of audit procedures that you perform on opening balance. The extent of audit procedure that you perform on opening balance will decide. For example, generally nature of audit procedure, opening balance, what nature of procedure we perform, we simply check, we simply cross check the trial balance and this, that's it. We don't obtain external confirmation for opening balance. We generally get confirmation for closing balances. We don't get external confirmation for opening. But if opening balance I feel some risk is there, I will get external confirmation even for opening balance. Are you clear? Then generally predecessor audit report, suppose if at all prior period financials were already audited, you can happily, if the prior period financials were audited, you can obtain sufficient appropriate evidence on opening balances by reviewing audited financials, by reviewing supporting schedules in the notes to accounts, by reviewing relevant documents. Example of relevant documents: board of directors report, annual report will be there, yes or no, all that, opening trial balance will be there. By looking at all this, you can get evidence. Further, ordinarily you can rely upon closing balances. You can trust closing balances because audit is already conducted. You don't have to doubt it unless in the current year you found some evidence contrary. For example, opening debt or 1 crore is there. In the current year, collections were not made. There is no collection. In the current year, since collection was not there for the debtor, I will obviously have a doubt whether the debtor value is correct or not. When now, if at all I investigate further, since collection was not there in the current year, in the opening debtor, I found an evidence that it is doubtful. And in the opening, they have not made any provision. I found a material misstatement based on current year audit procedure. Are you clear? For example, for current assets and liabilities, no collection or payment provides evidence. In the current year, opening debtors you collected in the current year, opening creditors you paid in the current year. This collection and payment provides evidence regarding existence of the debtor. You get an evidence on rights over the debtor, obligation to the vendor, and you get a evidence about valuation. So in the current year, collections and payments provide evidence for existence, rights and obligation, and value. Inventories, I'll come back. For non-current assets, how do you get evidence for non-current assets? Examine accounting records and other underlying. Look at the books of accounts first, whether PP, non-current assets and all correctly recorded in the last year, and also verify fixed asset register, other records, and use confirmation with third parties in case if it is a long-term debt and all. For opening balance, you can ask confirmation, not an issue. In case if it is a loans and borrowings from banks, look at the internet banking, you can get evidence, and any other procedures if necessary you perform. By this way, you can get evidence regarding non-current assets and liabilities by performing procedures in the current period. See, one procedure is I will verify last year balance sheet values carry forwarded correctly. I will compare with last year's signed balance sheet. That is giving me evidence about opening balance numbers correct or not. Is the values and all, are they genuine or not? Are they genuine? Are they existing or not? Balance sheet audit, that other earlier procedure is giving me evidence. Are they genuine or not? Current year I will verify collections. Current year I will verify payments. Current year I will verify external confirmation I'll get. No, this will provide me evidence about their genuinity. Are you clear? For inventory, how do you get inventory? How do you get evidence for inventory? Opening stock, how do you get inventory? Very difficult. Audit procedures in the current year will not provide evidence for opening balance of inventory. Therefore, we need to perform additional. What I will do, opening balance of inventory, that much is there or not, I don't know. But I will go for physical verification now. And right now, based on the stock I observed in the godown, I will do backward reconciliation to opening balance. I will do backward reconciliation to opening balance, and I will perform procedures on valuation of opening inventory. Already company opening stock workings are there, right? That workings I will compare with my reconciliation. Are you clear? And I will apply analytical procedure, gross profit testing, cutoff testing. I will apply. Cutoff testing means what? I only see whether current year sales are recorded in current year. Current year purchases recorded in current year correctly or not, I will see. If current year purchases and sales correctly recorded and current year closing stock is correctly recorded, if I reconcile these, I will get opening balance. That's why I need to perform cutoff testing. Are you clear? Once you perform this audit procedure, finally you will have a conclusion, right? What conclusions? You can conclude on two things. You have to conclude on two things as per this standard. First, conclude regarding accounting policies. What should I conclude? If accounting policies are not consistently applied, means changes are there in accounting policy, but guess what? They were not properly accounted or not adequately disclosed. Accounting policies consistency is missing. Changes happened. These changes not properly accounted, not properly disclosed, which is a violation of accounting standard, qualified opinion or adverse opinion. Same way, opening balances. What is it? Opening balances. If opening balance of material misstatement, for example, just now I told one example, one debtor value is there 1 crore, last year closing balance sheet shows 1 crore, current year also same 1 crore is there. Where is collection? Collection is not there. When I investigate, when I perform additional procedure, I discovered that this particular debtor is outstanding from so long years. In the last year, no provision is made. In the current year, no provision. Fine, current year, I'll tell the management to make a provision. But in the last year, the provision was not there. Opening balance contain material misstatement. If I find the opening balance contain material misstatement, I will ask management to properly account it and disclose it. If they do not account it and disclose it, I will give a qualified opinion or adverse opinion. But before I talk about opinion, before I give an opinion, first I should communicate. If at all auditor concluded that material misstatement is existing in the opening balances, the auditor shall communicate them to management and those charged with governance. First, whenever you find a misstatement in opening, understand the impact on the current year audit. Once you understand the impact on the current period audit, if it is having a high impact, inform it to top management and tell them to correct and rectify. If they do not correct and rectify, give modified opinion, qualified or adverse. Suppose you are not getting evidence at all. Opening balances, you are not getting evidence at all. Opening books of accounts and all destroyed by fire. Last year financials were not audited. Books of accounts are also destroyed by fire. And they are material to current year. Opening balances are very impactful in the current year. It is not possible for me to give opinion on current year. So I will either give a qualified or disclaimer. Generally we give disclaimer. If at all we do not have evidence for opening balances which are material, that too, then we give disclaimer of opinion. Are you clear? That's it. 510 standard is over. Easy or not? So in 510 standard, audit procedure 5 marks question, nature and extent of procedure 5 marks. In this nature and extent, they may specifically ask you, how do the auditor can obtain evidence regarding current assets and liabilities? How do auditor can get evidence regarding inventory? How do auditor can get evidence regarding non-current assets and non-current? 2 marks they can ask you. 6 marks question they can ask you, or a 5 marks question they can ask you like this. Conclusion and reporting they can ask you. Nature and extent of audit procedure they can ask you. Are you clear? That's it. Now last point, opening balance means what? Account balance that is at the beginning of the period, correct? Whatever account balance is there in the beginning, which is nothing but last year closing balance. And it also includes matters which require disclosure. In the last year balance sheet P&L in notes to accounts, we gave segment information, related party disclosure, contingencies. They are also treated as opening balances. So opening balance means don't just restrict yourself to balance sheet items only. Opening balance also includes notes to accounts item as well. Are you clear? Further, opening balances reflect. What do opening balance reflect? It just reflect last year business. Last year business means what? Last year transaction, last year balances, last year accounting policies. All these three put together is nothing but today opening balance. That's it. Over. 510 standard is over. Easy or not? So we already revised 501, 505, 510, 550. Now let us revise two more standards. One is 610, another one 500. Okay. Now let's begin 610 standard. What is 610? Using the work of internal auditor. Using the work of internal auditor. Okay. Yeah. Now just a minute. So what is internal audit? What is internal audit? Internal audit is a consulting activity and assurance function. It's a consulting activity and assurance function where they evaluate and improve. They evaluate and improve the organization's governance, the organization's risk management, the organization's internal control system. So internal auditors, they provide assurance and consulting. You know, in a company, internal auditors, they don't give opinion like we give. We stat auditors give opinion on the financials, right? Internal auditors will not give such a kind of opinion. They provide assurance on how controls are working. They evaluate risk management systems. They evaluate governance. Infosys has a big internal audit team. Reliance has a very big internal audit team in the company. In fact, in CARO, as a stat auditor, we have to comment in clause number 14. Yes or no? Point A, point B. Whether company has internal audit commensurate with the size and nature of the entity. Whether internal auditors reports are considered by you as a part of your audit. You need to comment in CARO clause number 14 in audit report. So internal audit, what internal auditor do? They provide assurance to the company, they provide consultation to the company on these three matters: governance, risk management, internal control. Now, what are activities related to internal controls? What are activities related to internal controls? Look at it. You know, in our book, you can just come to SA 610. Below that, activities related to internal control. What internal auditors relating to internal control focuses on? 4 elements. They review compliance with laws and regulations. They review operating activities. They review financial and operating information. They evaluate controls to know whether they are operating effectively or not. And they will provide assurance on the controls which are relevant to audit to the management. Okay, just 1 minute. So look at, so they evaluate controls and recommend improvements into it. They provide assurance on operating effectiveness of controls. They verify financial and operating information, how the entity identifying, measuring, classifying, all that. And they review economy, efficiency, effectiveness of operating activities. They review compliance with laws and regulations and how management policies are complied by employees, how management directives, internal directives are complied. This is also called as compliance audit. This is what internal auditors do. But actual standard is what? Using the work of internal auditor. Using the work of internal auditor can, first of all, for example, in the company, there is an internal audit department, very big department. See, what we do as a part of external audit, we know our objective is to give opinion on the financials. For that, we have to verify the balance sheet P&L, whether are they prepared as per accounting standard, whether they are prepared as per applicable framework. Then we should verify underlying books of accounts. We should verify underlying transactions. Yes or no? We should verify statutory duties. We should verify purchases. We should verify sales. We should verify employee benefits. So much we should verify. But all this is already verified by internal auditor. Yes or no? For example, in CARO, we have a point. 7th clause is there. Inside that first subclause, undisputed statutory dues. Is the company paying them regularly? And is there any undisputed statutory due that is in arrears as on 31st March, which is in arrears for more than 6 months, outstanding for more than 6 months? We need to report it. Now, is the company regular in paying the taxes correctly on time? I want to know, for example, this company where I am doing audit, suppose the company where I am doing audit, they have 24 states. They have registrations for GST in 24 states. Okay. Now, you know very well, right? In GST, the registration is state-wise. So obviously the company single, it's only a single company, but they have 24 GST registrations. And in each registration, they have to file monthly 2 returns, yearly 24 returns, 24 registrations into 24 returns. Almost you see 480 plus 48, 528, almost some number. Okay, 500 returns, close to 500 GST returns company filed. Only when I verify entire this 500 returns, I will understand is the company paying taxes correctly, especially GST correctly or not. I can understand is the company paying and filing GST returns regularly. I can comment only when I verify this 500 return. Now tell me, is there a significant difficulty or not? It's very tough, very lengthy process. But luckily, company internal auditors have already performed that reconciliation. The GST reconciliation of these 500 returns, the company internal audit department has already performed. Now the question comes in my mind as a stat auditor, can I use that work? SCA 610 says happily you can use, but it gives one precaution. It says one important rule. Even though you are using internal auditor's work, the sole responsibility for the opinion expressed is with external auditor only. The standard says you can take the help of internal auditor. Remember, we saw branch audit. In SA 600, we discussed something about branch audit. 706 other matter paragraph, we discussed about other auditors, branch auditors. We discussed about joint audit in 299. There I told you, when joint auditors are there, responsibility is divided. When State Bank of India auditor is giving opinion on State Bank of India, where 6,000 branches were audited by branch auditor, we mention in the other matter paragraph, these branches were audited by them. My opinion is based on their opinion. I will tell them specifically to the public that for the branches, they are only answerable, not me. Such a kind of reporting you should not do if you are using the work of internal auditor. If you are using the work of internal auditor, you can't use such a kind of statement in audit report. In audit report, can I say GST, well, company is regular? In CARO, I want to write like this, sir, the company is regular in paying GST based upon the information received from internal auditor. You can't mention like that. When you are using internal auditor's work, it is your choice whether to use or not. There is no requirement in the standard also. The external auditor is not required to use. There is no compulsion for you. It is your choice whether to use it or not. Suppose you are using it, you are only having 100% responsibility. You cannot refer his name in the audit report. You cannot refer internal auditor's name in the audit report. It is not permitted at all. Are you clear? 100% responsibility for the opinion expressed by you is with you. If at all internal auditor has done mistakes in GST and you believed that everything is true and you said everything is true and fair, thinking there are no mistakes, and tomorrow it was discovered as a big fraud, you should only answer to the regulatory authority why you couldn't discover it. You may say you used internal auditors work, all that, but you are only primarily responsible. He is not responsible. He is part of management. Able to understand. So accordingly, the 610 standard is giving you guidance, because ultimate responsibility, even after using internal auditor work, ultimate responsibility is with the external auditor, right? So the standard 610 gives guidance on when to use the internal auditor work. If so, where you can use his work, all that. And this standard divides internal auditor's work usage using the work of internal auditor. This standard divides using the work of internal auditor into two parts. The standard divides using the work of internal auditor into two parts. Type 1 and type 2. Type 1, using the work performed by internal audit function. Type 2, using internal auditors to provide direct assistance to external auditor, using internal auditor to provide direct assistance to external auditors, where internal auditors will work under the direction, under the supervision, under the review of external auditor. This is type 2. These are the two types how the standard divides the. Now how you can take the help of internal auditor? You can take either in the type 1 or type 2 format. Type 2, what is direct assistance? For example, if I have insufficient team, where company is expecting me to finish audit quickly, in a short span of time, which is possible also, provided I have additional team members. but I don't have sufficient of in my organization, where management told an option. Don't worry, I have internal audit team 200 employees, we have 10 members you take into your team. Next 20 days, you take this 10 members into your team. They will help you. Just like how your articles, your managers work, no? Same way, my internal auditors will work with you for the next 20 days and I will not interfere with them. Now, company's internal auditor, or they are directly working for me. They are directly working as an assistant to me. Are you clear? And that's called direct assistance. This is one way we can use. Another way, GST example I told, right? Internal auditors have already prepared entire GST reconciliation. That work I can take. Now, what are all the guidelines that I should follow in this particular scenarios? This is what SA 610 standard talks about. And remember, whether you're using type 1, whether you're using type 2, the ultimate responsibility for the opinion that you are giving is only you. Nobody else is responsible. Are you clear? Now, let's now discuss about type 2. Type 2, using internal auditors to provide direct assistance under the direction, supervision and review of external auditor. What points I should consider? First question, can I take direct assistance? This is the question. Evaluate two things. You know, in exam they can ask you 4 marks question. What are the points, or an MCQ can come. What are the points or what are the factors the external auditor shall evaluate before using internal auditors to provide direct assistance? What factors you will evaluate? First factor, objectivity. First factor, objectivity. Second factor, competence. You evaluate two things here. What is the level of objectivity these internal auditors are enjoying in the organization? What is the level of competence? If the answer is yes and yes, you will use internal auditor to provide direct assistance. Suppose if internal auditor is lacking objectivity or they are lacking competence, you will not use internal auditor to provide direct assistance. Clear? Now look at. So under what circumstances external auditor will use? Look at it. In our book it is K. Okay. So what is direct assistance? Use of internal auditor to perform audit procedures under the direction, supervision, review of external auditor. When you can use, assess the competence of the internal auditor. You know, assess threats to objectivity. For that, how do I know whether there is a threat to objectivity? Objectivity means what? Working in an unbiased attitude. See whether internal auditor can work unbiased. See whether they are competent. How do you know whether they are unbiased? Inquire. What relationships they have? What interest they have on the entity? In the entity, what sort of relationship they have? They are just employees. Nothing else is there. Then they are more objective. Yes or no? So check the objectivity, check the competence. If at all there are significant threats or they are lacking sufficient competence, don't use internal auditors to provide direct assistance. Suppose you verified and you concluded that yes, objectivity is there, competence is there, you decided to use them. But don't delegate the following works. Don't delegate them following works. Remember, at the end of the day, they are company staff. They are not your staff, they are company staff. If some severe issue they identified in audit, as a part of your team, they identified some severe issue, they will not report. They will not report to you. They will be favorable to management always. So when you are allocating works to them, when you are allocating works, now those 10 members are part of your team. Now you need to allocate them work just like how you allocate your audit team. So you need to allocate them the work, but don't allocate the following works. External auditor shall not use internal auditor for procedures that involve significant judgment, procedures that involve higher assessed risk of MMS, procedures where work is already performed by them or they are planning to perform. To avoid duplication, let's not use them. Or it related to, if at all I want to take their help relating to 610 decisions. Under SA 610, under this standard, I should decide whether can I use his work or not. Can I ask him whether can I use his work or not? You should decide. Under SA 610, there are some decisions the auditor has to take, stat auditor, external auditor. That decision making process, don't delegate them. You delegate any other work. So these 4 activities, external auditor shall not delegate to internal auditor. Further, once, okay, I understood. When I can use, I understood. For what works I can use, for what works I will not use, I understood. Now, there is a formality that you should perform. there is an activity. What are the activities? What are the activities external auditor shall perform before using direct assistance? Two things, two agreements you need to enter. One agreement with management, one agreement with internal auditor. What with management you will enter? That management will allow internal auditors, to work under external auditors instructions without intervention. Management should not intervene. As on 20 days they are providing me, they should not intervene. From internal auditor who are coming into my team, not 10 members, with each of them I'll enter into a written agreement that they maintain confidentiality. Whatever I tell them, they should not go back and tell management as it is on the same day. Yes or no? And they should inform me what are the threats to objectivity. Once they part of my team, 20 days, management will be poking them from behind. Hey, tell me what happening. They should not inform anything to management. And if something like that incident happen, they should first communicate and tell me. So like that, I enter into an agreement with internal auditors who are providing direct assistance. This is type 2. Are you clear? Now type 1. So what is type 1? Again, type 1 is what? Using work performed by them. Work is performed by them and that work we are using. What are the questions the standard is asking? First of all, can you use the work evaluate before using type 1? Before using type 1, what evaluations you should make? And when you shall not use type 1. Are you clear? Suppose you decided to use type 1. If so, nature and extent of work, nature and extent of type 1 work that can be used. Again, some works you cannot use under type 1 method. Are you clear? And fifth one, discussion on type 1 usage. You need to discuss with internal auditor when you decided to use type 1. And sixth one, coordination. There are totally 6 concepts that are there. Now look at similar. First one, what you need to evaluate? Before using type 1 work. Tell me, in type 2 what we need to evaluate? Is he objective? Is he competent? Same points here also. Whether internal audit function has a sufficient objectivity. Whether internal audit function has sufficient competence. Type 2 we saw it, same. But here there is a third point. Here I am not using them directly. I am using their work. They already performed the work as per their own guidelines, their own policies, their own regulations. Yes or no? They have their own approaches. They worked as per their approach, their policy, their procedure. Whether their approach is systematic, and disciplined and including quality control, I will evaluate whether internal auditor is having a systematic and disciplined approach, including quality control, because I am not using him directly, I am using his work. So how he performed that work? Do he has a systematic approach? These 3 points I will check. Suppose if internal auditor is lacking objectivity, if internal auditor is lacking competence, or if they lack a systematic and disciplined approach, including quality control, I will not use them under type 1 category. I will not use their work for type 1. For example, they are objective and competent, but they don't have a systematic approach. I will not use for type 1, but I can take their assistance for type 2. Are you clear? In type 2, no, the systematic and disciplined approach is not relevant. MCQ can come. Which of the following is not a factor while evaluating direct assistance? Systematic, disciplined approach, quality control, that's not a factor. Able to understand? Now, what do you mean by objectivity? What do you mean by competence? What are the factors for objectivity? What are the factors for competence? What are the factors for systematic approach? That we need to discuss. Now, objectivity. Now again, go back to type 1. Type 1. Evaluations. Okay, before using type 1, what is the first evaluation? First evaluation is what? Objectivity. Yes or no? So how far IAF's status in the organization? What is the internal audit status in the organization and policies? Are they supporting their objectivity? Objectivity means what? Do internal auditors working in an unbiased manner? Is the organization supporting that? Look at that. Organization's objective, internal auditors objectivity based on their status in the organization. Second one, what is the level of competence? Competence means what here? It's a knowledge. Competence means it's about skills, where you perform the task diligently as per standards, as per benchmarks. You do work as per benchmarks. So knowledge and skill is required for you to work in a way to comply with benchmarks. Then you are competent. So third criteria is what? Do they have a systematic and disciplined approach, including quality control, where internal auditors know they should plan systematically, they should perform these systematically, they should supervise the works. Internal auditors has to supervise their work systematically, they should review systematically, they should be documenting systematically. If they have a systematic planning, performing, reviewing, supervising, documenting, then I assume that they have a systematic and disciplined approach, including quality control. Then I can use their work. 5 elements here: planning, performing, supervising, reviewing, documenting. And all this should be in a systematic manner. Only then I feel that they have a proper quality control, they have a disciplined and systematic approach. Third criteria, satisfied, for example. Then I will come back to second criteria, competence. I will see. Competence means what? How internal auditors are hired, how internal auditors are trained, how companies assigning them the tasks. Do they have technical training in audit? Do they have exposure in audit? Do they have knowledge of entity financial reporting framework? How far internal audit is resourced? Means what is the size of the team? Remember, competence is useless. No matter how competent you are, if resources are not there, your competence is useless. How far resources are adequate for the internal auditor? Adequacy of resource, hiring and training policy, exposure, technical proficiency of internal auditor in auditing, and knowledge of financial reporting framework. These 4 factors will make me understand whether internal auditor is competent or not. Then objectivity, I will see his status in the organization. Is he at a superior level or is he at a subordinate level? Okay, whether he has an authority and accountability, so that he can be free from bias, he can be free from conflict. Yes or no? No. Whether employment decisions are overseen by top management. Internal auditors' employment decisions top management should oversee, which means they will have a direct reporting with top management. Are there any constraints and restrictions? I'll ask him, do you have any restrictions and constraints? Suppose you find some severe issue, will you report it to management? You have a freedom to report us. I'll ask him. And I will see whether internal auditors have any operational duties, whether do they have any managerial duties. That's a conflict. You are an auditor. Internal auditors should not involve in operations. Internal auditors should not involve in managerial roles. I will see these 4 factors to assess their objectivity. See whether I can use type 1 work or not. 3 factors I will evaluate: objectivity, competence, systematic and disciplined approach. How do I know whether he is objective? Organization status, governance, restrictions, all that. This itself can be asked as a 5 marks question. Or competence, this itself can be asked as a 4 marks question. And sometimes they will ask you this part, objectivity and competence put together. They'll ask you entire objectivity and competence. This itself can be asked as a 5 marks question or 6 marks question. Entirely they can ask you. Now, objectivity and competence, they both are complementary. They both shall be viewed as one to each other. Continuum, complementary. Objectivity, internal auditors are very genuine, honest, unbiased, but that cannot compensate lack of competence. Competence cannot compensate lack of objectivity. Higher the objectivity, higher the competence, the more likely we use their work. Just because they are objective, you can't say they are competent. Just because they are competent, they are objective. You can't say they are objective. Objectivity should be there, competence should be there. Are you clear? These are the factors I evaluate. Indirectly, IAF work, his work, you should not use. Type 1 work you should not use when objectivity is not adequate, when they lack sufficient competence, when they does not apply systematic disciplined approach, including quality control. There you should not use it. Suppose in the client that you are doing audit, you found a positive circumstance everywhere, like objectivity is there, competence is there, systematic disciplined approach is there. Now you decided to use his work. Which works you can use, which works you should not use, that also you must know. You know what the standard says? The standard says external auditors shall perform work more directly, use the internal audit function less. The standard gives you guidance in such a way you don't depend significantly on internal auditor. You should not unduly depend on internal auditor. You can depend on him, but it should not be unduly. Management should not feel like you are totally depending on internal auditor only. What are you doing then? So the external audit shall perform work more directly in the following aspects. When internal auditors lack competence, you have to do the work directly. When internal auditors have lacking objectivity, then don't use their work. You do work directly. Or they are objective, they are competent, but there is a high risk of MMS at assertion level. At assertion level, high risk is there. Internal auditors have performed NRV workings verification, valuation, NRV, net realizable value in case of inventory workings, they verified. But company stock is completely crude oil. Okay, that crude oil is highly subject to price fluctuations. So NRV workings involve high risk of MMS. Able to understand? There, don't ask internal auditor to verify it. You verify directly. Clear? Or when more judgment is required in an area where more judgment is required, the more judgment required in planning and performing the audit, or more judgment is required in evaluating evidence. So if at all more judgment is required in planning the audit, performing the audit, evaluating judgment, don't use their internal auditors, don't use their work. Type 1 work don't use. You perform that work directly. Are you clear? Indirectly, where you can use internal auditors work, which works of internal auditors you can use, any substantive procedure, limited judgment is involved. Use them, use their. You can use their work where they did compliance with regulatory requirement. For example, GST reconciliation they did, compliance with GST law verification they did. It is just a factual verification. There, that workings you can take. You can ask them in tracing transaction through information system. You can ask them audit trail exception report. Okay, you can ask them trace some journal entries in the books. You can ask them for observing inventory physical count. You can ask them regarding testing operating effectiveness of controls audit they did. You can ask there, you can take their reports. So the external auditor consider what nature of work internal auditor is doing, what scope of work he is doing or he is planning to do, and I will see how far it is relevant for my audit. So what works is planning, what is he doing, and is it relevant to my audit? I will consider these points and decide which works of internal auditor I can use. So nature and extent of work of IAF can be used by external auditor. It depends upon nature and scope of the work, relevance of the work. Examples are this. This itself can be asked as a 5 marks question. So nature and extent of IAF work to be used by external audit depends upon following factors. Examples of various works that can be used is this. But there are some works where you should not use their workings. What are they? Suppose you decided, okay, I will use GST reconciliation, his working, TDS reconciliation, his working, sales and purchase workings and all, I will use internal auditor's work. You decided. Discuss with him. So external auditor, when he planned to use internal auditor's work, you decided to use certain works. What you should discuss, what are the procedures you should perform when you are planning to use internal auditor. Discuss the planned usage, tell him what works you are going to use, and when you are discussing with him, you have a meeting with internal auditor. When you're discussing with him, you will address the following points: timing, when are they going to do that work, how are they going to do, how much they are going to cover, what is the materiality level for financials, what is the sample size and selection methods that they are going to follow, documentation, how are they going to do, how are they going to review and report. And if at all any of them, if I feel something is not enough for my point of view, from my audit point of view, maybe for him it is okay, for internal audit purpose it is okay, I will request him, can you do in-depth audit, can you do, so that for me that work can be more useful to me. And I will read internal auditor's report, I will read internal audit reports and find and see what are the findings they made. Yes or no? And whatever the work they are giving, type 1 work, for example, GST reconciliation, they did all 24 branches, 24 returns in a month, almost 500 plus returns related single reconciliation statement they gave. Will I blindly document and say GST is proper? I should verify whether GST workings are properly done or not. So the external auditor shall perform sufficient appropriate procedures on internal auditor work to know whether it is adequate for the purpose of audit, and make sure there is a proper coordination. External auditor and internal audit function should have a proper coordination, like they must discuss at appropriate intervals throughout the audit, because you are using his works and his work is again influenced by the way you are using it. Yes or no? So discuss at appropriate intervals frequently, and any matters that you find which is important for him, communicate. and any matters he finds important for you, he should inform you. The external auditor is informed of significant findings by internal auditor. External auditor has access to internal auditor's report. So internal auditor should coordinate with external auditor should coordinate with internal auditor. They should frequently discuss. Coordination, 4 marks or an MCQ can come. That's it. Standard 610 is over. Easy. Now you read the standard thoroughly once again. It will be very easy for you. Yes. Now let us discuss SA 500. This is exactly now dealing with the topic called audit evidence. Okay. We have seen at so many parts of the place that auditor has to obtain sufficient appropriate audit evidence, like that, right? Yes or no? What is audit evidence? We know, we have discussed even in our previous sessions also that audit evidence is nothing but information obtained by auditor. This audit evidence is 2 types. One is information contained in accounting records. Information contained in accounting records. And audit evidence also includes other information. One is information contained in accounting records, and another one is other information. Accounting records, this is one discussion in the standard. Okay, fine, let me first give you an overview of the standard. And we all know, right, we need to obtain sufficient and appropriate audit evidence. What do you mean by sufficient quantity? What do you mean by appropriate quality? Now, appropriateness is dependent upon 2 things: relevance of the evidence and reliability of the evidence. We have a topic on relevance, we have a topic on reliability, and we have a separate topic on sufficiency, and we have a topic on what is information contained in accounting records, what is information, other information. Okay, these are the main topics in audit evidence 500 standard. Apart from that, we have testing, selection of items for testing. We have selection of items for testing, This is one where they talk about 100% testing, they talk about specific testing, they also talk about audit sampling, This is one topic. Then we have another topic, using audit evidence prepared by management expert. Using audit evidence prepared by management expert. When you are using that audit evidence, what matters you should consider as an auditor, what matters you should consider when you are using this evidence, and how do you evaluate reliability? How do you evaluate real reliability of management expert? Can you rely upon him? What factors to evaluate? Here answer is there, here answer is there. Both are different. Again, often students confuse between these 2. Clear? This is one topic. Apart from that, we have in audit evidence general simple topics. What are simple topics? Sources of audit evidence. Okay, we know internal, external. See, I'm just giving you overview of the chapter, then I will enter into the chapter. Okay, internal, external. Nature of evidence. Nature is what? Oral, documentary, yes or no, and visual, yes or no. This is one. So this is one topic. Briefly, that only. Then at the end of the chapter, we had at the end of the standard, they even discussed the concept of audit trial. And there is most important topic, assertions. There is a most important topic called assertions. So now what is assertion? That we will discuss. First we will revise assertion means what. For example, in the balance sheet, there is a plant and machinery. They showed a breakup: 100 crore gross block value, 50 crore accumulated depreciation, 50 crore net block value they showed. Okay, this is how the plant and machinery is shown. You know what it is representing? You know what it is asserting? See, there is no specific, explicitly it is not saying anything, but impliedly it is saying some points. What? Since PM plant and machinery appearing on the asset side of balance sheet of the company, it means company is owning it. Means it is talking about company right over the asset. Yes or no? And they are saying specifically 100 crore is original cost, 50 crore depreciation, 50 is the balance value of the machinery. So the company is talking about its valuation. And they are showing this as on 31st March. Indirectly, the company is saying that is existing physically. What is it? It is existing physically on the balance sheet date. It is asserting about existence. What is it asserting about? Existence. It is asserting about existence. So simple, plant and machinery, 100 crore minus 50 and 50. This is what balance sheet is disclosing. But it is asserting about ownership of the machinery. It is asserting about existence of the machinery on the day. It is asserting about valuation of the machinery, and it is also asserting total plant and machinery is just 100 crore. Completeness assertion. Every item of the balance sheet, every item of the P&L will assert something, will explain you something impliedly. You know, when a person draws this, when a person sees that plant and machinery in the balance sheet, he will say, oh, company owned this much. Another person might say, oh, value is this much. Another person might think this much machinery is there physically on the day. So people get different meanings based on the item you shown in the balance sheet. Auditor has to try to identify. What auditor has to do? Auditor has to try to identify what are all it is asserting, explicitly or impliedly. It is explicitly, they are saying the asset is plant and machinery. This and explicitly they are saying that it is plant and machinery. Impliedly they are saying it is owned by them, it is existing physically, it is valued at so and so, all the plant and machinery put together is this much. Impliedly they are saying this. Auditor has to draw, auditor has to identify what are all it is asserting impliedly, explicitly, and get evidence for everything. Now since it is asserting ownership, is it asserting ownership, right? I will ask original title deeds, whether it is really owned by the company. It is showing 100 crore minus 50, right? I will say depreciation workings. And it is saying on 31st March they are saying plant and machinery. I will go and physically see whether it is physically there or not. And I will see whether all the plant and machinery is put together, accounted correctly or not. Completeness. So audit evidence is what we need to obtain evidence about various assertions. See, again, many confuse between assertions is not equal to items of financial statements. Elements of financial statements or items of financial statements means plant and machinery is one element, inventory is another element, cash and cash balance is another element. Assertion is different. Assertion will be there for all of this. What are the assertion for liability, existence, obligation, okay, and completeness, and obligation, existence, and valuation of liability. For assets and liabilities put together, nothing but assets and liabilities are nothing but balance sheet items. In audit, we call balance sheet items as account balances. We call them as what? Account balances. What are the assertions for account balances? Look at. Let's see the assertion discussion. What are the account balance? What are the assertions for account balances? Look at existence, rights and obligation, completeness, valuation. So again, for P&L items, transactions and events, what are the assertions? Occurrence, completeness, accuracy, cutoff, and classification. What is occurrence? To know whether the transaction is recorded in the right, whatever the transaction recorded, did it really occur? So when I am checking overstatement, remember this particular concept is even most important in items of financial statements. In items of financial statements, every topic we have this discussion. Okay, so if you want to understand items of financial statements thoroughly, if you want to revise it quickly, you need to understand this thoroughly. So occurrence, to check overstatement, completeness, to check understatement, cutoff, whether it is accounted in the right accounting period. You need to check classification, whether it is recorded in the proper ledger account, yes or no. And accuracy, you need to check whether it is recorded at right amount. In a P&L item, purchases they show, is it really happened? All purchases accounted? Is it rightly accounted at right amount? And is it correctly classified under purchases? And is it accounted in the right accounting period? All these points I should check. Sales, all these 5 points I should check. Employee benefit expense, all these points I should check. So for transactions and balances, auditor has to obtain evidence for these 5 assertions. For balance sheet item, auditor has to obtain evidence for these 4 assertions. For presentation and disclosure, he should obtain assertions for these 5. So what is the nature of assertion? Tell me, what is the nature of assertion? Assertions in financials can be either explicit or implied, but mostly they are implied. Generally, assertions are not specifically stated, but they are implied. Sometimes explicitly also they will say, for example, secured loan. We are explicitly saying loan is secured, but we are not conveying to whom the loan is given. We are not conveying that. Explicitly we are saying loan is secured. Are you clear? Assertions can be negative. Negative assertion means what? Saying that we don't have that. Saying we don't have contingent liability. Specifically, if you state that you don't have contingent liability, that's an explicit negative assertion. So negative assertion is again 2 types: explicit negative assertion, implied negative assertion. Explicit negative assertion means what? Saying that you don't have a contingent liability, you directly state it. Implied negative assertion is what? For example, there is a asset schedule, plant and machinery point is missing. Indirectly we are saying we don't have plant and machinery. We didn't say plant and machinery 0. We deleted that. There is no plant and machinery name itself in the asset side of the balance sheet. It is an implied assertion that we don't have plant and machinery. Negative assertion means we are saying we don't have it. Assertion means saying we have it. We did that. That's an assertion. We didn't do that. That's a negative assertion. Able to understand? Next. So ultimately, the auditor has to verify, the auditor has to base his opinion on overall representation of financial statements considering various assertions. All specific assertions you test. Balance sheet, 4 assertions for each item you test. P&L, all the items, for each item 5 assertions you need to test. Get evidence for all of it. Inventory, get evidence for valuation, whether valued correctly. Inventory, get evidence whether they are physically there. Inventory, get evidence whether complete inventory accounted. Evidence, inventory, get evidence for ownership. When ownership is with the company, valued correctly, physically existing, completely accounted, then you will assume that inventory is true and fair. Like this you do for fixed asset, like this you do for liabilities, payables, creditors, everything, receivables, everything. P&L items, you do the similar one. And that's how you do audit. You obtain audit evidence by testing various assertions in the items of financial statements. Are you clear? So that is assertion topic. Now again, going back to the audit evidence topic, I told you there are many topics in audit evidence. Now first of all, what is audit evidence? 2 things. Information. Audit evidence is nothing but information used by auditor. Based on that he will take a conclusion, and that conclusion is the basis for the opinion. Now this evidence is 2 types: information in accounting records and other information. Accounting records means what? Invoices, entries, journal entries, ledgers, important contracts. Contracts is also part of accounting record. Remember, MCQ can come. And worksheets and spreadsheets for cost allocation, this is also accounting record, and MCQ can come. And it also, audit evidence also includes other information. Remember, evidence is not just accounts. Only books of accounts is not we depend on. We also focus on other minutes of the meeting, external confirmations, internal control manuals, like non-financial documents. This is also audit evidence. Now based on nature, we get evidence by observation, we get evidence orally. When we ask questions, when we inquire, they respond. That response is in oral, that's an evidence. Or they may give us a response in writing, that's documentary. Then again, evidence is 2 types depending upon source. One is internal evidence, another one external evidence. Which is, which we should obtain? We should obtain both. Both are complementary in nature. But remember, most of the evidence is internal, and substantial external evidence is also available. Yes or no? So internal evidence generally is in the control of the client management and staff. There is a chances of manipulation, so be careful. External evidence is usually more reliable because it's coming from third party. He don't have to impress you, so he will give you whatever is their right figure. But if at all there is a doubt about third party independence, be careful. Especially this point is applicable in case of related parties. When you are getting external confirmation from related party where you feel that related parties may not give right information, be careful. So as an ordinary rule, what they are giving you from outside and what is there inside, you should try to match it. They should match with each other. So as an ordinary rule, the auditor should match internal and external evidence. Further, there is one more source for audit evidence. Not only in the current year. See, we do audit procedures in current year, we get evidence internal, external, visual, documentary, oral. We can also get evidence from another source, some other source, and that is, for example, previous audits. Are you clear? Then, and remember, evidence must be sufficient and appropriate. Appropriate means what? Quality. Quality means what? The evidence that you are getting must be relevant. One is relevance of the evidence. For example, when I go to inventory physical verification, I get evidence about whether inventory physically there or not. I will not get evidence for ownership. If I want to get evidence for ownership assertion, I should check title deeds. I should check invoice documents. But when I check invoice documents, I will not get evidence whether they are physically there or not. If I want to get evidence on existence, I have to perform audit procedure called physical verification. If I want to get evidence on inventory ownership, I have to inspect invoices. If I want to get evidence on whether inventory valued correctly or not, I have to verify documentation, inspect documentation. So what assertion you are verifying, what evidence you are gathering, there must be link, and that link is called as relevance. Are you clear? So relevance means logical connection between audit procedure performed and assertion tested. The relevance of evidence is influenced by direction of testing. For example, I want to know whether recorded sales, are they genuine? Did they really occur? Same recorded sale, wherever invoice you have a doubt, check in depth. Recorded sale you check, you will understand is it a dummy or real. So if you want to check overstatement, check recorded item. Suppose I am skeptical, like there might be company recorded all the sales, but I am also thinking some other sales also would have been there. So I want to know whether all the sales are recorded or not. I am not worried about recorded sales, I am worried about unrecorded. What I should verify there? I should verify stock register. I should verify sales orders, copies that the company received, orders received by the company, order booklet I will verify. This will give me an idea whether company accounted all the sales or not. So if you want to test understatement, unpaid invoices, supplier statements, order books, these are all the documents you should verify, not the recorded sale. So what assertion are you testing? Are you testing occurrence or are you testing completeness? Depending upon that, relevant evidence will change. Are you clear? Now, so audit procedure, they provide evidence only for certain assertions, but not for everything. For example, when you go and physically verify the existence of inventory, it will give you evidence about existence, but it will not give you evidence for valuation. It will not give evidence for ownership. Yes or no? That's it. Then reliability. Reliability means what? First of all, an evidence is reliable or not, it depends upon where you are getting from. It also depends on in what format you are getting it. So it depends on nature, visual, oral, written, or it also depends on internal, external. It also depends on what circumstances you are getting it. Are you getting it year end, during the period, or are you getting it in surprise visit? All that. Generally, there are some rules, there are some principles on reliability. Generalizations we call. Generalizations are what? Original evidence is more reliable than duplicate. Documentary evidence is more reliable than oral. Evidence obtained directly by the auditor by physically going and observing is more reliable than through inquiry. Yes or no? And if controls are effective, internal evidences are also reliable, and evidence obtained from external source, independent source, is more reliable. Remember, there can be exceptions. There can also be exceptions to this, but even though some exceptions will be there, generally can I say these are the principles of reliability? That's it. This is reliability. Next, when the evidence is appropriate, you understood now sufficient and appropriate. Appropriate means sufficiency and appropriateness means relevance and reliability. What is relevance? We saw. What is reliability? We saw. Are you clear? Now, what are various audit procedures? What are various audit procedures? If the question is what are various audit procedures, actually audit procedures are two types: risk assessment procedure and further audit procedure. Audit procedures are two types: risk assessment and further audit procedure. How do you perform these procedures? Inquiry, inspection, observation, confirmation, recalculation, reperformance, analytical. how I perform them. I may be performing them as a part of risk assessment. I may be performing them as a part of compliance procedure. I may be performing them as part of substantive audit procedures, substantive procedures. I may be performing them as a part of substantive procedures. Anyway, I can perform. In all these procedures, I can perform as a part of risk assessment, as a part of compliance, as a part of substantive. Now, what do you mean by inquiry? Inquiry means what? Inquiry means, just a minute. Yeah, below it is there. Methods of obtaining audit evidence. Yeah, here it is there. So, inquiry means what? Seeking information from knowledgeable person, maybe within the organization or outside. You are asking either in oral or written format. Because of inquiry, what you get? What you will get? You will get new information, or you will get information that is different from other information, or based on inquiry you get some response, right? That may help you to modify the audit procedure, or that may make you to perform additional audit procedure. Yes or no? And auditor can also sometimes ask written confirmation for inquiry. When you ask question, management gave orally, you may insist on them, no sir, please give me in writing. And that is called, when management is giving in writing, we call it as written representation. Are you clear? Then now inquiry. What is inspection? Inspection means what? Physical verification of an asset, or inspecting documents and records. Example, what you will inspect? You will inspect authorizations, examples. You will inspect contracts, whether company is recognizing correctly or not. Revenue, you will inspect tangible assets. Inventory, for physical verification, you will inspect inventory items. So these are all examples of inspection. Observation means what? You know, in SA 501, I told you, the auditor has to plan attending physical inventory count performed by management. And when you attend there, first understand management methods to observe whether those methods are properly implemented. Observe means what? Looking at a process. By looking at a process, you can get evidence. Example, DMart example. I went and stood at one corner of the store and observing how sales person is billing the goods. And I noticed that customers are taking some small tiny items in the trolley without billing. And I thought, I'm waiting whether security guard will figure it out or not. He is also just taking the bill and stamping and going. Now I got an evidence that controls implemented by the company are weak. Are you getting it? Here I got evidence through looking at the process, observation. So observation means what? Looking at the process. But in observation, one downside is what? You know, only the point in time when you're observing, evidence will be there. Once you left the store, what is happening, you don't know. Yes or no? Then external confirmation. We already discussed one standard. We already revised it thoroughly. 505, external confirmation. Then another way you can get evidence is recalculation, depreciation, stock valuation. You recalculate and check once again whether they are correct or not. Reperformance. Reperformance means what? You know, for example, no, I want to know whether control is effective or not. Whether all the goods in a DMart, customer is bringing goods in the trolley, whether all the goods are billed or not, I want to know. One is I can observe and see. Another one is what? You know, I will ask security guard to sit aside, sit for a few minutes. I will check there. You know, when the customer is bringing out the trolley, I will open all the goods and I will take the bill. I will see whether each item is billed or not. In this way also I can know whether control is effective or not, whether employee is working correctly or not, whether employee is billing correctly or not. I can get evidence through this also. That's called reperformance. Example, a control which already performed by management. Once again I am performing the control to know whether control is effective or not. That is reperformance. Then analytical procedure. Analytical procedure means analyzing relationships. P&L account shows profit. Cash flow statement shows negative cash flow. Why? Why it is inconsistent? I investigate. And to know, you know, when I investigate, I may discover there are a lot of credit sales and collections from debtors is very poor. So that is why profit P&L account shows super profits, but cash flow statement is negative. The reason is credit sales and slow collections. Now I will see whether management made provision for debtors. I will cross check. Through analytical procedure only I will get to know that. Are you clear? Next. Now again another important question. Timing of audit procedure when information is in electronic form. In almost today every company, books of accounts are completely in electronic form. Yes or no? The audit procedure's nature and timing will affect if the accounting data is in electronic. Tell me, the way you do audit, the time at which you do audit will be different if at all books are in manual format and if the books are in electronic format. Because sometimes information will be there only at specific points of time. Information may not be there later on. For example, you want to know DMart sales invoice breakup, you want to know. It will not be there after 10-15 days. The company will delete the data, but they will retain invoice number, invoice date, amount, at what time it is sold, whether customer paid to card or cash, that time that data will be retained. Breakup of the goods sold will be deleted. You want to verify breakup of the goods sold in DMart. Suppose you are an operational auditor, you want to verify breakup of the goods sold. You have to go within 1 week period only. If you want to verify sales related to 10th March, you have to go by 17th March and verify. Only then 10th related sales you can figure out. Then some electronic information you can't retrieve, either because files were changed or backup files were not there. And due to various retention policies, it is advisable for the auditor to visit the company at the time when the data available, or request the company to retain it for auditor's review for certain period of time. So when the data is available electronic form, it is influenced by company's data retention policies. At that time, you request the company to retain it for some more time so that auditor can review, or at the time when the data is available, you go and review. So this is how the nature, timing of audit procedures are influenced when the data is in electronic form, when the accounting records are in electronic form. Are you clear? Yes or no? Now sufficiency means what? What do you mean by sufficient appropriate evidence? You know what, in September 25 attempt they asked this question. Here you just add size and characteristics of population. Please add size and characteristics of population, if at all any of you are following my 25 notes or 26 notes, whoever, please add it. Now sufficiency means what? Quantity. The quantity of evidence is affected by directly 2 points. One is risk involved and quality. Higher the quality, lower the quantity. Lower the quality, higher the quantity. Risk, higher the risk, higher the quantity. Lower the risk, lower the quantity. Further, it is affected by 3 more factors, where risk of MMS is repeated here, where with detail. Risk of MMS, the risk that financials are materially misstated prior to audit, which includes inherent risk, which includes control risk. Inherent risk means what? Obviously, in any business, in any process, some mistake will happen. To prevent that risk is inherent risk. To prevent that risk, company implemented a control so that that risk will not happen. But this control is not working effectively, and that is control risk. Are you clear? Next, materiality. Higher the important, higher the more evidence is required for more material assertion. If the assertion is less material, least evidences. Size and characteristics. Smaller population, less evidence. Homogeneous population, less evidence. Larger population, more evidence. Heterogeneous population, more evidence. Heterogeneous means what? Different variations in the population. Are you clear? So these are the factors will affect sufficiency. Appropriateness is influenced by relevance and reliability. Are you clear? Then next almost I am covering almost all the points I'm covering. Suppose if at all you are using audit evidence, which is information prepared by management expert. Before you use that, you first evaluate reliance on the management. Can you trust him or not? You should evaluate first. Because management expert period. First of all, who is a management expert? Lawyer is a management expert. Architect is a management expert. Actuary is a management expert. Company's internal chartered accountant is there. He is not management expert. Why? Expert definition says any person used by management who has expertise in any field other than accounts and audit. Accounts and audit, from our point of view, they're not experts, because that's our field only, our domain only. From our point of view, experts means what? Experts in some other field other than accounts and audit. If it is accounts and audit issue comes, I am there to verify it. But if it's some other issue, actuarial liability, environment liabilities, yes or no, and contingent liabilities, whether it's a contingent or real, lawyer only can tell you that. So experts assistance is required at so many places, yes or no. So if the evidence that you want is prepared by expert, before using that evidence, you first see whether you can place reliance on the expert or not, whether you can trust him or not. For that you can check, is he competent, is he capable, and is he independent from the company, unbiased, objective. Then check understanding of the work, what work he is doing. Is that work appropriate for your audit checkout? Once you understood, yes, expert work is relevant to me, you decided to use the evidence given by him. Expert gave report on inventory valuation, you decided to use. Now your nature, timing, extent of audit procedure will be affected. Your nature, timing, extent of audit, because now you are deciding to use experts work. No, which means now you need to interact with expert. All that means your audit procedures might change, yes or no, because of various matters: complexity of the matter, risk involved, whether he is employed by the entity or engaged as an outsider, whether management is having a control or influence, is he following technical standards or not, what is your knowledge on that field, what is your experience with that expert work. All these matters are relevant when you are using information prepared by the auditors, by the management expert. See, there is another concept called auditors expert. This auditors expert concept is there in CA final 620. So this expert related discussion in depth will be there in CA final. Clear? So this is regarding expert. Then finally, how do auditor will select items for testing? It may be controls testing or it may be details testing. There are three selection methods. One is selecting 100%, means of selection. These are means of selection. There are three means of selecting. Select 100% or do specific testing or audit sampling. So audit sampling means what? Drawing sample from a population on a random basis and forming a conclusion on the population based on the sample result. What is selecting 100% items? Either you select 100% of class of transactions, 100% of account balance, or 100% of a stratum. Stratum means what? You might have heard in stratified sampling, like, entire population, I divide them into subparts. For example, all the expenses of the company, I divide into three types. Example, operating expenses. In a bank, you see, the expenses of a bank are divided into three types: operating expenses, provisions and contingencies, and interest expense. In a bank, the expenses are broadly divided into three types: interest expenditure, contingencies and provisions, and operating. And select from each of this sample, that is stratified sampling. Suppose now you are selecting only one item fully, that is stratum. So verifying 100% of stratum, that's called 100% testing. Verifying 100% of class of transaction, entire interest expenditure, that is 100% testing. Are you clear? 100% testing is suitable when when there are small number of transaction of large value items, or when there is a significant risk is there, or these calculations can be performed with systems automatically, which is cost effective. That time you can do 100% testing. Specific item testing. Specific item means what? Judgmental selection. Auditor will, based on his judgment, he will select. I will test these transactions, I will not verify these transactions. Judgmental selection, which is based on understanding of the entity, assessed risk, and characteristics of the population. Remember, judgmental selection is subject to non-sampling risk. What is a sampling risk? What is a non-sampling risk? In sampling topic, you will understand. Okay, sampling risk and non-sampling risks are reasons for detection risk, which is a reason for audit risk. In my YouTube already there is a full chapter on risk assessment. You can watch that to understand what is detection risk, what is sampling risk, what is non-sampling risk. All that, there is a session. You can watch a full-fledged, my proper regular course is uploaded. It's just 6 hours that chapters. Next, so judgmental selection means what? Selecting all high value items. I will ignore low value items. I will select items above 1 lakh rupee. Selecting specific item, selecting items over a certain limit, or selecting an item to understand the entity or transactions. This is called specific item testing. Are you clear? That's it. So that's it. Audit evidence topic is over almost. Then trial, audit trial topic. This also I will briefly discuss. What is audit trial? In a company today, accounting softwares are designed in a way where when a person enters a transaction, who entered, at what time they entered, what they entered, at what amount they entered, everything will be captured. Later, if the same person modify the transaction, he modified at so and so date, right? At so and so time he modified, right? That also will be captured. Later, this fellow deleted the transaction. This fellow deleted the transaction, right? The fact that he deleted will also be recorded. Which means anything you do in the software, everything is recorded. A log is maintained. A log is maintained. So this is called audit trail. For example, in all of your phones, you can track your usage of the phone. How much time you spent on Instagram, how much time you spent on YouTube, how much time you spent on so and so app, you can track. That's a tracker. That's an audit trail. Audit trail is like an audit track. It's a tracker. Are you getting it? So audit trail is a documented flow of transaction. See, accounting software records all the transactions. The flow is recorded in audit trail, okay, which will help to trace a source document to a journal entry, from journal entry to financials. Remember, in audit report topic, we might have seen 143 subsection 3. Yes or no? At the end, last 16th matter inside that, the auditor has to comment whether the company is maintaining accounting software that has a feature of audit trail, and the software and the feature is not tampered, and the audit trail is retained for the record retention period of 8 years. We need to comment. Auditor has to give an opinion. Now, what is audit trail? That is what they're saying. Audit trail is a flow of transaction that helps source document to journal entry to financials. The purpose is, it is an audit evidence to establish authenticity and integrity of the transaction. Audit trail is a step-by-step record that traces accounting, trade, financial data to its source. Audit trail. See, I told at the beginning example, right? Why a transaction is deleted? I want to know why a transaction is deleted. Okay, first of all, if audit trail is not there, I don't even know that during the year there is some transaction entered and the transaction got deleted. That item, that information I will not get to know if audit trail is not there. If audit trail is there, I will open audit trail option and I will generate a report. It will directly show me give me a big report where and all original transaction what, revised transaction what, original transaction what, deleted transaction what happened. I mean, what they deleted, everything they will show me. Then I can ask management why you changed it, why you deleted it. So I will understand the effectiveness of internal control system. Are you clear? So audit trail documents evidence of every event that is happening to reduce frauds and errors. But remember, maintaining audit trail is costly because lot of data accumulates in the system. Storage expenditure is very high. Yes or no? Time required, it takes lots of time to analyze data. But nothing to worry, there are some automated tools which will analyze this audit trail data. What are the benefits of audit trail? It will enhance internal controls. Now accountant knows that everything what he do in the system, everything is recorded carefully. So it is a control, it's a preventive mechanism. And audit trail helps to identify reasons for a problem. For example, some debtors account shows debit balance. Sorry, debtors account shows credit balance. How come a debtor account shows credit balance? I will go back into the system deep down. So where and all it resulted in credit balance. Why debtor account shows credit balance? I can see, I can trace out the error easily. And systems where audit trail feature is there, auditors will have a confidence. I will have a confidence that okay, whatever they recorded, they are not manipulating later. Okay, then they will verify whether transaction was performed by authorized person or not. I can see who passed this entry, name of the person who passed the entry is recorded, his employee ID is recorded, everything is recorded. And it will enhance data security and reliability of evidence obtained during the audit. That's it, audit trail. So 500 major topic is covered. Audit trail topic also briefly covered. Clear? Almost we spent 40 minutes on 500 standard. This entire chapter we spent almost 2.5 to 3 hours on revision till now. Okay, there is still 530 standard, 520 standard, but I just kept them under 1/4 priority, which I will discuss in the revision later. Clear? Confident? That's it. With this, in audit evidence, predominant topics we revised. This whatever 6 standards that we revised, they will have a weightage of 20 marks, 50 into 20 marks. That's it. Yeah. Okay, fine. Let's begin audit of banks. We have this chapter. We have a similar chapter in CA final also, bank audit, where the syllabus is more or less same. But in CA final, we have additional discussion about assets and liabilities of a bank. How to audit assets and liabilities. There is something else also called concurrent audit. Okay, there is something called concurrent audit. You know, right? Bank is liable for multiple types of audits. One is statutory audit, another one concurrent audit, another one internal audit. So stat audit, concurrent, internal. We have in CA Inter only stat audit related discussion and P&L items discussion. There is only one balance sheet item which we have in CA Inter is advances. How to audit advances of a bank. Apart from that, so that which means P&L items how to audit, advances how to audit. Then we have overall procedure for bank audit. What is the overall procedure for bank audit? That we have in the syllabus. How to appoint the auditors, that we have. Audit report regulations, audit report guidance related to banks, that we have. That's it. Technically, this is what exactly that we have in the syllabus. Now, first I will straight away discuss about advances. Audit of advances. Advances is nothing but loans given by the bank. These loans can be multiple types. These loans can be term loan, OD and cash credit, or it can be a guarantee. You know, the banks give 2 types of loans. One is funded, another one is non-funded. Funded means what? Where there is a amount outflow will happen from the bank to borrower account. So the bank will transfer some funds to the borrower. That's a funded advance. Non-funded advance means what? There won't be any transfer of funds that happens. There won't be any transfer of funds. That's a non-funded. For example, letter of credit. Letter of credit. Generally, this letter of credit is popular in import and export transactions. Guarantee. These are all non-funded advances. Funded means what? Term loans, OD, cash credit. These were all called as what? Term loans. Now we have NPA norm discussion. Major thing that dealing with advances. Major thing that we need to discuss about advances is what? NPA norms. Okay. Now, directly I'm entering into the NPA norm, income recognition norm, all that. So what is an NPA? Banks know loans given by them is their right, advances given by them is their right. These advances again they classify into two assets, performing assets, which is actually called as standard asset, and non-performing assets. Non-performing assets are divided into three categories again: substandard asset, doubtful asset, loss asset. Okay, doubtful assets were again three types: D1, D2, D3. Doubtful 1, doubtful 2, doubtful 3. The standard assets are again two types: standard assets regular, standard assets SMA. What is SMA? Special mention account. Now these SMAs are again three types: SMA 0, SMA 1, SMA 2. Standard assets, I am talking about standard assets. Now first of all, when a loan will be treated as NPA, when it is treated as NPA, simple. If the amount is overdue, for more than 90 days, this is a general norm which is applicable. However, if you see NPA norm, they have given clearly bills purchased or discounted, term loans. These two will become NPA if the amount is overdue for more than 90 days. However, in case of overdraft and cash credit, NPA norm will be applied only when they were out of order. What is it? Only when they were out of order. A cash credit or OD will become an NPA only when they were out of order. Whereas a term loan, bills purchased discounted, they will become NPA when they were overdue for more than 90 days. OD and cash credit will become NPA when they became out of order. When they were classified as out of order, automatically OD account, term OD account and cash credit account becomes NPA. What do you mean by out of order? What do you mean by out of order? Now here there are two terms that you need to understand. Fine. First of all, when out of order will become, if the outstanding balance in OD account and CC account, if the outstanding balance in OD account and CC account is more than sanctioned limit or drawing power. It is more than sanctioned limit or drawing power. Now, first of all, okay, this is one criteria. For out of order, one criteria is outstanding balance in the loan account or OD account or CC account is more than sanctioned amount or is more than drawing power. Or let us say, second scenario, outstanding balance is less than or equal to sanction limit and drawing power. It is less than only. However, there were no credits for 90 days. There were no credits continuously for 90 days in the borrower OD account and CC account. Continuously for 90 days. No credits at all happened. What do you mean by continuously no credits happened for 90 days? Continuously for 90 days, there is no repayment from the borrower. You know, when you are withdrawing OD amount or CC amount, whenever you are utilizing it, every month interest will be debited in your account. For a bank, debit means what? They need to receive from you. Okay. Now when you pay to the bank, what happens? It gets credited. In the loan account, what happens? It gets credited. Continuously for 90 days, there is no credit means, what do you mean by that? Continuously for 90 days, you didn't pay any amount. Automatically overdue concept again applicable for more than 90 days. Yes or no? Automatically overdue concept applied more than 90 days. So there are no credits at all continuously for 90 days. Means 90 days continuously there is no repayment happened in the borrower OD account, borrower CC account. There is no repayment that happened. Automatically that becomes out of order. Or credits were there, but the credit amount that happened is less than debit amount. The credits amounts were there, but the credits are not sufficient to cover the debits. The credits were not sufficient to cover the debits. Debits were there, right, in borrower account. 90 days we saw. In the 90 days some credits happened, but they were not sufficient for the debited amount. Able to understand? Interest amount, nothing but, see, what is debited in OD account, what is debited in CC account? Interest amount. The interest amount debited in OD and CC account is not sufficient. The interest amount debited is something, but what is credited is not sufficient. Three incidents will make a CC account, OD account out of order. 1. The outstanding balance is more than sanction limit or drawing power. Outstanding balance is less than sanction limit, less than drawing power. However, continuously for 90 days, there were no credits in that account. Third one, credits were there, but not sufficient to cover debits. In these three incidents, we classify the account as what? Out of order. A term loan and bills purchased or bills discounted, for that NPA norm is directly overdue concept 90 days. Whereas OD account, CC account, out of order is the concept. Out of order means these three, correct? Now, first of all, okay, this is what mainly. Now, what do you mean by sanction limit? What do you mean by drawing power? Generally, term loans and bills purchased, sanction limit will be equal to drawing power. However, for OD accounts and CC accounts, sanction limit and drawing power will be different. Sanction limit is based on loan repayment capacity. Suppose I have a repayment capacity of, let us assume, 5 crore per annum. Bank will sanction me 5 crore loan based on my IT returns, based on my credit worthiness, based on my business track record, everything. If I can repay 5 crore, banker will give me a credit worth of 5 crore. Sanction limit will give me 5 crore. But only repayment capacity is not sufficient for the banker. They also look for security. They also look for what? Security. So, suppose bank sanctioned me 5 crore. I went and asked the bank, sir, please give me 5 crore. No, sir, you need to give us some security to release the fund. I went and gave 5 crore worth of security. What I gave? 5 crore worth of gold. For example, I gave a gold worth of security. 5 crore worth of gold I gave a security. Now I'm asking the banker, now give me 5 crore. No, sorry, sir. You are giving gold which is 5 crore. Our margin is 30%. What is it? Our margin is 30%. So 3.5 crore. We will give you withdrawal power worth of 3.5 crore. Means drawing power is calculated how? Drawing power is, see, for sure, drawing power cannot be more than sanction limit. It cannot be more than sanction limit. And the drawing power moreover is calculated based on security that you provided, value minus margin. Margin is for fluctuations in the prices. Market prices fluctuations will happen, right? Some other interest related provision also I should maintain, right? So I'll keep some margin based on the asset value that you gave. Excluding the margin, balance amount I'll give you withdrawal power. I may give you 5 crore sanction, but you can only withdraw 3.5 crore because your withdrawal power is decided by security value that you provided. Clear? Suppose customer came and gave 10 crore worth of security in the same case, 10 crore security he gave, minus 30%, 7 crore. Can I give drawing power 7 crore here? No. I cannot give drawing power 7 crore here because sanction limit is only 5 crore. So, first limit is sanction limit. Then immediate second limit will apply is drawing power. Now, how to calculate this drawing power? Most important question. How to calculate this drawing power? How do we calculate drawing power? Generally, ODCC businesses, they take overdraft and cash credit, right? What they give as security basically? They give security as trade receivable plus stock. They give what as security? Trade receivables and stock. They hypothecate. What is it called as? Hypothecation. Hypothecation of current assets. These people give current assets as security. Now, okay, for example, now I have debtors worth of 10 crore and I want to give 10 crore worth of debtors as security. Okay, you give it 10 crore worth of debtors. Now, if you see the debtors worth of 10 crore, generally, if within this 10 crore, no, there are debtors who are overdue for more than 90 days. Let us assume 3 crore worth of debtors were outstanding for more than 90 days. Balance debtors were 7. Bank will only consider this one. If any debtors were outstanding for more than 3 crore, generally they will ignore. Sometimes in exam, what they will tell you, debtors outstanding more than 120 days shall be ignored. Sometimes they will tell you that, which means up to 120 days worth of outstanding debtors, no problem. So in exam, if they specifically tell you some different number of days, then follow that. If they don't tell anything, but they give breakup of debtors, more than 90 days this much, remaining debtors are this much, for drawing power calculation, which debtors you will take into account? Exclude more than 90 days. You should take only which debtors? 7 crore. In the given case, debtors whose outstanding period is less than 90 days. Overdue period is less than 90 days. 7 crore minus 40%. In exam, they'll give you margin for debtors is 40%, 30%, 35%, like that they'll give you. So now, even though the total debtors are 10 crore, in that ineligible debtors are 3 crore, balance debtors are 7 crore minus 40%. Therefore, you will get 4.2 crore. Do you understand? So drawing power with respect to debtors securities 4.2. Plus, the borrower even gives stock. The borrower gave stock also as a security. So stock, how much stock he gave? You went and saw his godown. There were 15 crore worth of stock is there. 15 crore worth of stock. But if you analyze the stock, 5 crore worth of stock is still outstanding for payment. 15 crore stock is there, right, left side, yes, liability side. 5 crore trade payable is there, creditor is there. Trade payable means what? He has first right on that stock. So it is not own stock of the borrower. So what is the own stock of the borrower? 10 crore. I cannot give loan based on credit purchased goods. I can only give you loan based on your own inventory. Yes or no? Own inventory means what? The liability in respect of that inventory is cleared. Yes or no? 10 crore is your own inventory. Again, when I pay attention, out of this 10 crore, 1 crore worth of goods were slow moving, damaged, obsolete goods. That also banker will not consider. Therefore, how much is good stock which is paid already completely? 9 crore. Banker said 30% margin. Banker decided 30% margin. So, 2.7 crore. So, balance will be 6.3 crore. Therefore, total drawing power here how much? 6 plus 4, 10. 10.5 crore. This is the drawing power. However, in the given question, sanction limit is 8 crore only. Then the drawing power will be 8 crore. That's it. This is how you should compute drawing power. Able to understand how you should compute drawing power? Stock, they will give information. Debtors information, they'll give you. First, remove ineligible items. Then eligible items you will get. From debtors, no, eligible debtors minus margin you remove. Then debtors drawing power you will get. Stock, eligible stock minus unpaid stock. Nothing but creditors amount, letter of credit amount, that and all you remove. Then you will get paid stock value minus margin is equal to drawing power. Total it, total drawing power. Compare it with sanction limit. If it is less than sanction limit, then that's the drawing power. If it is more than sanction limit, then sanction limit will be the drawing power. MCQ can come or a direct descriptive question can come. In the question bank also we have given enough problems on that. That's it. So this is drawing power computation with respect to advances. Confident? Now tell me how to audit these advances. What points I should check generally in advances? Look at advances are major assets, correct? These are nothing but loans and credits given by a bank. All loans will have interest. Auditors need in-depth knowledge of banks, including regulation, processes, internal controls while auditing advances. Generally, how many advances I should audit? Suppose I'm doing audit of one particular branch. Okay, it has so many loans which they gave. How many I should verify? Large advances, 100% you verify. Remaining advances, verify them on a sampling basis. What do you mean by a large advance? At a branch level, large advance means an advance where the outstanding amount is how much? More than 10 crore, or the outstanding amount is matching with 10% of the total total branch outstanding, whichever is lower. For example, there is one branch, okay, where the branch outstanding itself is 50 crore. The branch outstanding is how much? 50 crore into 10% is equal to 5 crore. Any loan where outstanding amount is more than 5 crore in this branch, all those loans are called as large advances. Suppose you went to a bigger branch, very big metropolitan city, one big branch is there where 5,000 crore is the total outstanding loans of that particular branch. Into 10%, 500, no. 500 or 10 crore, whichever is lower, 10. So any loan having outstanding balance at year end exceeding 10 crore, that's the large advance by default. Sir, but in my bank, no, total loans itself is 50-60 crore. 10 crore loans and all not at all there. That means I don't have large advance. No, you have large advance. 10% of outstanding amount in the branch. If any one particular loan is exceeding 10% of the total loans, then that is also large advance. Clear? Again, I told funded, non-funded. Correct? Again, advances, term loan, cash credit, OD, demand loans, bill discounted and purchased, risk sharing participation, nothing but syndicate loans. We call them as what? Syndicate loans. We also call them as consortium loans. Then interest bearing staff loans, nothing but to the staff, any interest bearing loans. Next, types of advances. If you see, this is nothing but in balance sheet we classify advances into 3 types: bills purchased and discounted, cash credit, OD, term loan. Like that we decide, we divide. Again, the loans are divided into secured by tangible, covered by guarantee, and unsecured. Again, loans we will show within India, outside India. Within India, priority sector, public sector, banks, others. Remember, this priority sector, public sector, this breakup will be shown only for loans given by the bank, not borrowings of the bank. Bank will have borrowings, no? For that, this breakup is not required. Hello? Next, again, classification of advances. Banks will follow certain guidelines for lending to priority sector. What is priority sector? Agriculture, MSME, education, housing loan. All these are priority sector. So RBI has set certain lending targets for these particular sector. Every bank should lend 30 to 40% of the total loans that they are giving to priority sector. That's a minimum criteria. Okay. Then classification of advances based on security. Now banks know you have to give security, right? What should be the nature of security? What is the nature of security? Security is 2 types: primary security, collateral security. Okay. See, collateral is a general word again. Collateral means security. For security, there is another meaning, collateral. Collateral security is different again. Primary security, collateral security. Collateral means here secondary security. What is the primary security? For example, no, I gave my stock, I gave my debtors to the bank and I asked for OD. Banker told based on the debtors and stock, no, 10 crore OD they are releasing. They said 10 crore OD drawing power will give, sir, they said. But they put one condition, sir, your stock and debtors is very high fluctuating values. I'll give you, I don't have a problem, I'll give you 10 crore, but I want one extra security from you. Collateral I want. In the event, if primary security fails to fulfill my need tomorrow, I want additional security so that I can protect my loan. Give me your immovable property also as a security, but not primary. It's a collateral purpose, only secondary. I will not touch that at all. I will only touch debtors and stock in the event of default. I will not go with the collateral. But if the primary security value becomes insufficient because of so and so conditions, then only I will look at your collateral security. So primary security, collateral. Collateral security is very rare. Okay, so primary security is nothing but the principal security. For example, you want to take a gold loan. Gold is a primary security there. Able to understand? Gold loan you want to take. Gold is the primary security. Collateral security is nothing but what? Additional security provided by borrower. Commonly, what kind of securities will bank will accept? You may give stock, debtors, you may give gold, you may give immovable property, you may give crops, nothing but plantations, insurance policy, securities, shares and securities, anything you can give it as a security. Next, how banks will create security? How banks will create security? If you give immovable property, it's mortgage. If you give stock and debtors, for example, you see bike loan, car loan, how do they give? You are still using, even after taking the loan. That process is called as hypothecation. Gold loan, you see, gold you have to pledge with the banker. That's called pledge. Insurance policy, that's called assignment. Insurance policy, if at all you are giving as a security to a banker, that's called as what? assignment. Okay, so mortgage, pledge, hypothecation, assignment. Set off is typically not a kind of security. Basically that's an approach, that's a procedure. What is a set off? Suppose you are a student, you want to get a credit card, you will not have income proof, you will not have any track record of repayment, everything. So how do you get the credit card, student? There is one way. You open a fixed deposit with a bank. Go and open 1 lakh fixed deposit with a bank. Sir, I'll keep a fixed deposit with you. Now keep this as a security and give me a loan. Nothing but CC, credit card. A credit card against fixed deposit. Banker will absolutely give you, because first you give cash to them and now against that credit card. Suppose banker gave you 90,000 credit limit credit card. You spent 90,000 but you're not repaying. What banker will do? With the banker already your 1 lakh is there, and with you his money of 90,000 is there. He'll just apply set off and balance 10,000 he'll pay you. Set off, where security is created in such a way bank can set off in future. If at all I do not repay, that's called set off. So that's why you see set off means what? It enables the bank to combine two accounts of the same person. One is deposit account, another one is loan account. Accounts must be in the same name and capacity. Right of set off applies even for time barred debts. All branches of the bank will be treated as one for the purpose of set off. I may have FD with branch 1, but I have taken credit card with another branch. Still bank can apply set off. Able to understand? Lien is not at all a type of security, first of all. Clear, everyone? Now again, within the mortgage there are two types of mortgages. One is registered mortgage, another one equitable mortgage. Equitable mortgage, what happens, I will have, for example, housing loans. Generally there are two types. One is I have housing loan. House deed will be there, right? Sale deed will be there, right? Registration document. The registration document I'll keep with the bank, and then he gave me loan based on that. That's equitable mortgage. Registered mortgage means what? I got registered my house in my name in the register office, right? I'll go to the register office. I will register the mortgage in the register office with the bank. Tomorrow if I have to sell the house, okay, without banker's knowledge, I can't do, because when I go and sell the house, when I want to go and sell the house at the register office, he will ask, call the banker also, because he has to sign authorized person. So only then the house can be sold by me. That's a registered mortgage. So in a registered mortgage, the mortgage agreement will be registered with the sub-registrar office. In an equitable mortgage, mortgage deed will not be registered with the registrar office. So registered mortgage is very powerful. Able to understand? Next. Now audit of advances. I told no already. NPS, we classify them as substandard, doubtful and loss. Whereas standard assets, standard, regular, special mention accounts. Special mention accounts are what? SMA, SMA1, SMA2 and SMA0. What is SMA1, SMA2? Very simple. I gave a loan to a customer. He defaulted. EMI date is 1st December. He did not pay on the 1st December. 2nd December onwards. In fact, 1st December evening, once a day end process is completed in a bank, day end process will happen somewhere around 6 o'clock, for example. In the system, by evening 6 o'clock, if at all EMI amount is not credited, okay, generally morning at 10 o'clock itself, automatically customer account will be debited automatically. But to debit like that, customer account does not have balance. Okay, fine. At least by evening 6 o'clock, did customer transferred manually the EMI to the bank? No. Even evening at 6 o'clock, it was not transferred. The moment 6 o'clock turns over, evening, once day end records are updated, default is recognized. Now default is recognized. But tell me, does it become NPA directly? When it will become NPA? Continuously for 90 days if you do not pay. So 90 days time is there for treating that as NPA. But default happened, no. I will treat it as specially from hereafter. I have to call him, I have to remind him, please pay, all that. Special mention account. It's a standard asset. It's a standard asset, but indicating problem. It is indicating problem. That's why it's called special mention, indicating stress signals. It is indicating stress signals. Loan stressed means what? Loan is not repaying me. So SMA 0 up to 30 days default, SMA 0. 31st day onwards, SMA 1. 61st day onwards, SMA 2. 91st day once it comes, NPA. Clear everybody? That's it. Now, what is an NPA? An asset becomes NPA when it stops generating income. Term loan, when it becomes NPA, overdue for more than 90 days. Bills purchased, overdue for more than 90 days. CC account, OD account, if it remains out of order. Correct? What is out of order? Outstanding balance exceeding sanction limit and drawing power. Balance is less than sanction, but there were no credits for 90 days. Credits are insufficient to cover the debits. Easy or not? And again, remember, NPA classification is always borrower wise. NPA classification will happen in a bank borrower wise. What do you mean by borrower wise NPA classification? See, I gave you 10 lakhs, car loan, some 1 crore housing loan, some 5 lakhs personal loan I gave you. You repaid car loan on time, housing loan on time, but 5 lakhs personal loan you are not repaying me. Okay? In 5 lakhs personal loan, more than 90 days default happened. I classified this personal loan as NPA. But remember, if I remove these names, I totally gave you 1 crore 15 lakhs. And in that 5 lakhs amount, you stopped repaying. Very soon, I know prudence. You will even stop repaying remaining 2 also. Can I say customer only unwilling to pay personal loan alone? Can I say like this? Yes or no? The moment he stopped repaying 1 loan, I will treat remaining loans also as NPA. If 1 account of a customer becomes NPA, even though the remaining loans, he is paying EMI on time, that doesn't matter. We will still treat it as NPA. This is what RBI tells, RBI prudential norm. Okay, we call them as IRAC norms. What do we call them as? IRAC. What is the meaning? Income recognition and asset classification norms. What is it? Income recognition and asset classification norms. The shortcut is IRAC norms. As per IRAC norms, NPA classification is borrower wise. It is not facility wise. It's not car loan NPA separate treatment, the personal loan separate NPA treatment. This one, single bank, I gave you 3 loans. 1 loan become NPA, remaining 2 also I'll treat as NPA. See, suppose I have personal loan with ICICI bank. I have a car loan with HDFC. With HDFC I defaulted. HDFC will treat my car loan as NPA, but ICICI need not treat because I'm paying ICICI on time. But if the same bank is giving 2 different loans and 1 loan become NPA, automatically other loan becomes NPA. Clear? Next. And moreover, remember, classification of advance as NPA depends on record of recovery, not based on security or borrower net worth. Sir, borrower is very rich, sir. Don't need to worry about that, sir. He will pay later. That and all doesn't matter. 90 days crossed, NPA. Sir, he gave 10 crore worth of asset as a security. That and all doesn't matter. NPA. If security is there, we will take care of it at the time of recovery. Yes or no? At the time of recovery, we will take care. Just because security is there, it doesn't mean we are exempted from applying NPA norm. So NPA norm will be applied purely based on record of recovery, recovery track record. If at all 90 days more than 90 days I didn't recover, that's it, straight away NPA. Clear? Next. So next, now how much is the provision? If at all an asset is classified as substandard, straight away provision amount, how much bank has to make? 15. See, what is the purpose of NPA classification? Once a loan turns into NPA, you need to create provision on that loan. 15% if it is a substandard asset. Suppose if it is a doubtful. By the way, NPA for up to 12 months. 91st day. Yes or no? That's first day for NPA. 91st day from outstanding date, due date. But first day for NPA. From first day to 365 days after it become NPA, it is substandard. So 1 year after it become NPA, it is substandard. And second year after it become NPA, D1. Third year and fourth year it become D2. After fourth year it become D3. These are all the years which I need to calculate once it becomes NPA. And what is the provision that they need to make? For doubtful assets, if the loan is unsecured, 100% provision. Sir, if the loan is secured, D1 asset, 25% provision. If it is a D2 asset, 40% provision. If it is a D3 asset, 100%. This is the gross amount of provision that they need to make. So in problems, if at all they have to give a problem, they'll give you D2 100 crore. Out of this 50 crore is secured. Then 50 crore into 100% provision and 100 crore into 40% provision. Understood? Remaining 50 crore. Suppose there is a D2 loan. 100 crore is a loan. Split that. 50 crore security is there. 50 crore security is not there. Security is there. D2 into 40%. Unsecured loan 50 crore into 100% is equal to total provision. Able to understand? That's so. So in exam they'll give you D2 amount loan how much, D3 loan how much, D1 loan how much, substandard loan how much. Even you should create provision for standard assets also. Provision is required even for standard assets. I think we don't have that discussion in our book. It is there in CA final. So how much provision we need to make for standard asset at differential rates? Different rates were given at CA final. Theoretical discussion is there. Okay, in inter we don't have that. Only for NPA provisioning is that these percentages are important. Are you clear until now? Then we have something called special NPA norms. But before I discuss even about special NPA norms, how to compute drawing power, rules per DP. In exam they can ask you a 5 marks question, rules per DP. Until now I told you out of order, DP compute, NPA, everything is equally important. Rules per DP computation. First of all, loan accounts must stay within drawing power and sanction limit at all the times, correct? Hello? If at all the loan account is having outstanding balance exceeding DP and sanction limit, or if the loan is obtained using unapproved security, or if the account is irregular, it should be reported to management or head office. Drawings in working capital must have adequate current assets. DP must be calculated based on the latest stock statement, and that stock statement should not be older than 3 months. That's why a bank has to regularly, quarterly once, the borrower has to quarterly give stock statement. DP computation must follow guidelines of bank board of directors. Any stock statement, if it is older than 3 months in a particular borrower account, that particular older stock statement information must be reported to head office. That's it. Now, what auditor has to look at? In case of stock audit, auditor concern is, generally stock audit is required where loan amount is outstanding for more than 5 crore. Auditor can recommend stock audit even in case of other scenarios. For consortium lending, stock audit will be conducted by lead bank. What is consortium lending? I'll come back to it. Now further, when you are reviewing stock audit report, what is a stock audit report? Remember, stat auditor is different here, stock auditor is different. I am talking about stat auditor. What stat auditor has to review regarding stock audit? I should review how valuation of security was done, how calculation of DP is made, how drawing power is calculated, how the security is valued. So as a stat auditor, when I am reviewing the stock audit report, I focus on these two things: how stock has been valued, how drawing power is calculated. MCQ, in one of the items they asked this. MCQ, clear? Now, how to audit advances? How to audit advances? First, evaluate internal controls, then perform substantive. Okay, internal controls. What is the bank checking credit worthiness of the borrower before giving a loan? Is the bank executing necessary documentation? Check whether bank is checking end use of the funds given to the borrower. For borrower said housing loan. See whether the loan amount given to the borrower is used to purchase the house. Check it out. Margin of safety. See whether bank is maintaining adequate margin. Margin amount, remember, stock minus percentage, debtors minus percentage while arriving drawing power. That's called margin. See whether bank has created security. Specifically, in case of shares and debentures, ownership has to be transferred to banker. In case of, see that securities are registered in the name of the banker. Inspect and verify goods in go down frequently. Which goods? Current assets. If inventory is given as a security, you go and physically verify that. Then drawing power. Update the DP register on a monthly basis. Accounts should stay within DP limits. Irregular accounts should be reported to controlling authorities. And there must be a control in the bank for reviewing. Okay, review each loan account once a year or more frequently for larger advances. Review means what? For example, last year I took OD. Once 1 year over, bank will once again review my OD account. Like, is it still okay to give OD with him? Because I already gave you OD limit. Now 1 year over. Now I need to decide, should I close the OD to him or should I continue the OD to him? That closure or continuation decided after the review. So I should once again review. Last year when I reviewed, your position is good, your performance is good, so I gave you OD. But this year, 1 year over, I need to check your financial position once again, right? Yes or no? So that's called review. Banks must do review of every loan account once in a year. Hello? That's it. Once I verify controls in a bank, then I will look at substantive. Like, substantive means what? I will take one actual loan and I will see loan documentation. I'll take one housing loan. I'll see ownership documents. I'll see various other documentation formalities. I'll check whether entire documentation is proper. And I will see how much loan is recorded here, how much loan is given, how much loan customer paid. And I will see operations in the account. I will review operations in the account means what? I will take the customer ledger account. When the loan was given, when he is repaying EMIs, operations. And I will see security valuation and see that security is still enforceable or not. And I will check compliance with RBI norms. And I will perform analytical procedure. In exam they can ask you this as a 4 marks question. Evaluation of internal control, this itself can be asked as 5 marks question. Every one of this is tested in past. Next, now audit of income, but before that I will discuss about special NPA norms. 5 minutes gap. Okay, just I'll pause the video, just 5 minutes, again we'll continue. Yeah, let's continue. Special NPA norms. Generally, NPA norms are applied based on what? 90 days logic, out of order logic. That is what to decide as an NPA. But there are certain loans where we don't apply 90 days out of order logic. We apply a different norm. For example, accounts with erosion in value of the security. What do you mean by this? Erosion refers to gradual destruction or diminution. Loss asset treatment. A loan account, the customer is repaying on time. No default happened, but still I will classify that as NPA. Moreover, I will classify that as a loss asset and I will create 100% provision in the books. When? One of the primary criteria why I give a loan based on the security provided by him. Even though he has a good repayment capacity, all that, I still want security from the borrower. He gave a security. That is one of the main criteria why I gave a loan also. And that security value suddenly drops. Okay. How much it dropped, Right now the value of the security is not even 10% of the loan amount. Whatever the loan I gave, outstanding amount is there, right? Right now he has to pay some 10 crore to me. And I saw the security. That security value is just 50 lakhs now. 10 crore outstanding loan. Security value is not even 10% of the outstanding amount. Security value originally was 15 crore. But suddenly the value has dropped. For example, I gave a loan to a customer, predicting, for example, Dubai you take. Yes or no? Housing loans in Dubai. Suddenly today valuation dropped completely. Yes or no? So earlier the house which is ready for 2 crore or 3 crore valuation, now people may not be ready to buy even at 40-50 lakhs also. After this war incident happened. So anything can happen. Security value might suddenly drops. Yes or no? So if the realizable value of the security is less than 10% of outstanding amount, you need to classify it as a loss asset and directly write off. Understood? If at all the value of the security is less than 10% of the outstanding loan, then straight away treat that loan as straight away loss asset. Sir, security remaining amount is, leave it. It's not even 10%. Why you consider that? Leave it. Straight away treat it as loss and provide 100%. Second one, suppose in exam they'll give you, if this situation does not apply, then apply this situation. How much is the latest value of the security checkout? Sir, latest value of the security is 50 lakh. Okay. Last time also it was valued once again. Before this, because once in 6 months, once in 3 months, once in a year, security will be reviewed. Valuation will be done once again. Last time at what? Last time valuation is how much you see? 1.2 crore. Oh, last time security valuation 1.2 crore. This time the value of the security is just 50 lakh. Compared to last time, how much drop is there? More than 50%. What is it? More than 50% drop. 1.2 crore minus 50%, 60. Now it is just 50. Yes or no? 60 lakhs means minimum 50% also is not there. Compared to last time valuation, now the security valuation is dropped by more than 50%. Here I am not comparing 50% with outstanding loan. I am comparing 50% with previous valuation. Able to understand? So if the realizable value of security is less than 50% of the assessable value by the bank, then the bank will classify that particular loan amount as doubtful asset and provisioning will be applicable as per doubtful asset norms. Clear? You see here, we are not here looking at repayment track record. We are straight away classifying a loan as NPA based on value of security because the security value decline, erosion. Able to understand? That's it. Next, Another one, agriculture advances generally. See, agricultural advance is different. Agriculture advance affected by natural calamity is different. Generally, agriculture advance, what is the NPA norm? Simple. First of all, when a loan is given for agriculture, the loan will be categorized into two types: long duration crop loan, short duration crop loan. Yeah. Whether it's a long duration crop or short duration crop depends upon crop season. If the crop season is more than 1 year, it's a long duration crop. If the crop season is less than 1 year, it's a short duration crop. Crop season is decided by state level bankers committee. It is decided in each state by state level bankers committee. They will decide the crop seasons. And if you give a loan for a long duration crop, then that's a long duration crop loan. If you give a loan to short duration crop, that's a short duration crop loan. A long duration crop loan will become NPA. A long duration crop loan will become NPA if it is defaulted for more than one time, one duration. If the loan is overdue for one crop season, if the loan is overdue for one crop season, straight away it is an NPA. Short duration crop loan will become NPA only when the overdue is for more than 2 crop seasons. A short duration crop loan will be treated as NPA only when the outstanding amount is overdue for more than 2 seasons. A long duration crop, 1 season. That's it. Over. Now, agriculture advances affected by natural calamity. What is this? Here I will not apply crop season logic. You know, farmer is about to get harvested and then sell the produce and then about to repay. Suddenly a big rainfall. Yes or no? A floods and all happened. This entire, whatever the crop he has grown, yes or no, completely wiped out. Now the farmer is at loss. What banker has to do? Okay, crop season logic. He want to apply the crop season logic and then treat it as NPA directly. Second option, your discretion. What is your discretion? You can either convert that loan into a long-term loan, or you can reschedule the repayment period, or give a fresh loan. Yes or no? Fresh short-term loan you give so that he'll repay the old loan. Now for the loan you apply. So NPA classification will be as per the revised terms. That's it. Then we have advances. Government guaranteed advance. What is government guaranteed? That which government guaranteed? Central. I'm talking about which government guaranteed advance? Central government. Suppose I have taken a loan. I'm an MSME. I have taken a loan as per central government MSME program. So central government has given guarantee on my behalf, and I took a loan from a banker. I did not repay. Generally, if I do not repay for more than 90 days, what happens? Banker will treat my account as NPA, and he has to make a provision, right? Either by treating my loan as substandard, doubtful, loss, depending upon the case, he has to apply provision, right? Yes or no? Now, since central government guarantee is there, on my loan, NPA classification will not apply. Able to understand? On my loan, NPA classification will not apply because government guarantee is there. Even if I don't repay, government will repay tomorrow. So loan, NPA norm will not apply in case of central government guaranteed loans. However, you know what? By the way, okay, I gave a loan, right? What is the return for the bank on the loan? Interest. What is the only return for the bank? What is the benefit for the bank by giving loans? Interest amount they get. How banks will recognize interest income? Accrual basis. How they recognize? Accrual. On a monthly basis they recognize. How they recognize? On a monthly basis. What is the consequence of NPA? What is the consequence of NPA? First one, asset classification. Asset classification will be changed to substandard, doubtful, or loss asset. Income recognition, what happens? They will stop recognizing income. Once a loan becomes NPA, the consequence is interest amount will not be recognized on accrual basis. Once the loan become NPA, I will recognize interest income in my books of accounts only when you come and actually repay. Otherwise, I will not recognize interest income. That is the impact on income recognition. What is the impact on asset classification? The asset will be classified as substandard, doubtful, and loss, and provisioning will apply accordingly. Correct? This is what NPA classification impact, right? Impact of an NPA. However, if central government guarantee is there, the account classification norm will not apply, but income classification norm still applicable. For which loans I'm talking about? Central government guaranteed. Sir, it's not a central government guarantee, sir. State government guaranteed loan. Ignore it. Apply as usual rule. Apply asset classification NPA rule. Apply income recognition NPA rule. What is income recognition NPA rule? The moment loan becomes NPA, you stop recognizing interest on accrual basis. If at all in the past 90 days you recognized some interest on accrual but not collected, you recognized on accrual but did not collect, now 91st day NPA already happened, any amount that you recognized but not collected, reverse it. What you should do? Reverse it. That's it. That's called reversal of income. Able to understand? So this is regarding central government guaranteed advance. I hope you are clear. Yes or no? Accounts regularized near balance sheet date. What is it? You know, these accounts, no, originally they became NPA. Originally they became NPA. But by the time 31st March comes, they become standard asset. You know, once a loan becomes NPA, it cannot be upgraded to standard asset. It cannot be upgraded to a standard asset just like that. Upgradation, there is some procedure involved. See, loans, you know, accounts regularized near balance sheet date means what? Originally they became NPA, but by the time balance sheet date comes, they turn into regular. Why? You know, generally a loan account, NP account will become regular only when the customer repay full amount plus penalty, everything he repaid. And then RBI has given certain guidelines for upgradation. If those guidelines were followed, a loan NPA can be classified as regular. What auditor has to check if an account become regular near the balance sheet date? See whether the regularization is correctly happened or not. Suppose if at all it indicates a dummy journal entry, if it indicates a dummy transaction, customer actually did not repay, banker gave some fresh loan so that customer will repay the old loan, so that NPA will be hidden. Yes or no? So if this kind of inherent risk, if at all banker finds out, then the auditor will still recommend the bank to keep it as NPA. Clear? Next. That's it. Consortium. What is consortium loans? Consortium means what? Group of entities together they are giving loans. Some group of entities together they are giving loans. Group of banks together giving loans. Generally, you know, every bank will have a maximum exposure limit for a borrower. A maximum exposure limit. Maybe you want to construct one highway, national highway. The construction cost of the national highway for you is 1.5 lakh crore. Okay, there's a very big highway, 1.5 lakh crore is the construction cost. 1500 kilometer highway, let us assume. Okay, so or maybe some 5,000 kilometer, 10,000 kilometer highway. Okay, you want to construct. You want 1.5 crore, 1.5 lakh crore loan. You are ready to give the entire land, wherever national highway is there, entire land you are ready to give me as a security, and the land value is 3 lakh crore. You are ready to give me 3 lakh crore worth of land as security, and in return you are asking only 1.5 lakh crore worth of loan amount. You know, you have repayment capacity, your security valuation is good, everything is good, but I can't give you 1.5 lakh crore because I have a limit on how much I can lend to a single borrower. So I cannot lend 1.5 lakh crore. No bank can lend, I know, no bank can lend, but group of banks put together, some 15 banks put together, we can lend you 1,50,000 crore. Now one bank will take charge of this. One bank will take a lead of this. That bank is called as lead bank. It will go and convince the remaining banks, and all of them put together give a loan. So SBI Limited, lead bank, they gave 30,000 crore loan. ICAI gave 20,000 crore. HDFC gave 20,000 crore. Remaining like that, I will make sure you get 1.5 lakh crore. But remember, here we are all together giving a loan. But when with respect to collection, everybody have their own risk. You should pay EMI to respective people. Able to understand? If at all you paid EMI to SBI, but you didn't pay EMI to HDFC, HDFC will classify your account as NPA. Sometimes what happens in consortium lending, a single EMI will be paid to SBI. SBI will distribute that EMI to remaining banks. Suppose a borrower paid EMI to SBI full amount, he didn't default, but SBI did not transfer to other banks. Other banks will treat your account as NPA because they did not get from you the money. You paid to SBI, SBI did not pay me, that and all irrelevant for me. Yes or no? I did not get from you the EMI more than 90 days. That's it. I will treat it as NPA. So if a lead bank is collecting money from the borrower, it is the responsibility of the borrower to ensure lead bank transfers other banks' share. In case of CC and OD, lead bank will decide drawing power. How much drawing power? 20 banks put together we are giving you, right? How much drawing power I will take, how much drawing power that bank will take, lead bank will decide, and borrower can negotiate that. That's it. Able to understand? That's consortium. That's it. Main theme is over. Okay, with this, audit of advances discussion is over. Clear? All of you? Now I will discuss about audit of incomes. Audit of incomes. What are the incomes of a bank? One income is interest income. Remaining are other incomes. What are other incomes? In exam they can ask you a theory question. What are other incomes? Commission, exchange, brokerage. The items are as below. Commission on bills for collection. Commission on remittances, foreign remittances, commission on letter of credit, commission, loan processing income, mobile banking income, debit card and credit card fee, rent from lockers, commission on other permitted, commission on government business, commission on brokerage, commission, fees for insurance referral, yes or no, profit or loss on sale of investment. Getting it? These are all various incomes of a bank. They will ask you in exam, what are various other incomes of a bank? 4 marks question. Give examples of other incomes. 7 items you need to write. Able to understand? Then how to audit income? Tell me, for banks, what is the income? They get income which is in the nature of interest mainly. How to audit income? The auditor primarily concerned with whatever income recorded, is it valid or not? Income whatever recorded, is it genuine or not? We need to check. Income pertains to relevant period. We should also check whether the income interest amount which is recorded, is it belonging to the same accounting period? Check out. There should not be any unrecorded income, and income should be recorded at appropriate amount. Validity means what? Occurrence. No unrecorded income means what? Completeness assertion. Income pertain to relevant period means what? Cutoff. Income is recognized at appropriate measurement. These are the assertions which we need to test. Understood the assertions? Yes or no? Next. Banks recognize income on accrual basis unless collection is uncertain. What about NPA? No income is recognized on NPA until it is realized. For newly classified NPA, previously accrued interest will be reversed or provision will be created. Yes or no? Because they were not collected. Because you recognized an accrual but they were not collected. Now it became NPA. You have to reverse it. Yes or no? And once a loan turns into NPA, you will not recognize the interest, no, but that interest amount you will transfer to dummy account called memorandum account. Hello? You have a similar discussion in corporate societies audit. Interest on overdue loan will not be recognized will not be transferred to income statement. It will be transferred to overdue reserve account. Like that, some wordings were there in societies audit. Okay, that's it. Then we have reversal of income, which is important concept now. 4 marks question. What is reversal? If an advance becomes NPA, the entire accrued interest must be reversed or provided for. This applies even for government guaranteed advance as well. Central or state, doesn't matter. Interest income, NPA norm will be constant. Only for asset classification, central government guaranteed advance, asset classification, NPA norm will not apply. That's it. Then takeout finance. In the recent exam they have asked it, Jan 26 or September 25, takeout finance asked. Yes or no? What is a takeout finance? One bank originally would have given you the loan. Now another bank is taking over that loan. Able to understand? Taking over that loan means now the agreement between you and the banker. Suppose ICICI Bank gave you originally the loan. Now HDFC Bank is giving you the same loan. So they will pay entire amount to ICICI Bank and then take that loan amount. So indirectly right now you are the customer of HDFC Bank. So this is called takeout finance, which is popular in infrastructural projects. Okay. Objectives of takeout finance: expand finance sourcing for infrastructure project, address sectorial group or entity exposure and credit mismatch issues, boost availability of long-term facilities for projects. Okay. If at all a loan which a bank is trying to take over, if at all it is already classified as NPA, then the acquiring bank which has taken that loan, they will also classify that as NPA. That's it. Audit of expenses. I think in expenses, no, interest expenditure is only something different here. Operating expense audit. Operating expenses are what? First of all, auditor fee, legal expenses, direct remuneration, rent, rates, advertisement, telephone expenses. And there is another expenditure for the bank. There are only 3 expenses. One is interest, operating, provisions. Provisions for what? Provisions for NPAs. Remaining provisions. Provision for taxation, provision for losses, all that. Yes or no? Now look at interest expenditure. How do we audit interest expenditure? Tell me, bank will pay interest on what? Deposits. Deposits are 2 types. Savings deposit, fixed deposit. Fixed deposits, no, different schemes will be there. I will have to ask the banker different fixed deposit schemes. What is the rate of interest bank promised and how much interest they are paying? I will cross verify that. I will work out average rate of interest which bank has which bank has incurred. I will compare it with average rate incurred last year. If there is a huge variation, why there is a variation like that? I will do analytical procedure. In here, no, they might ask like this: obtain quarterly analysis of deposits, compute weighted average rate, compare with the actual rate, investigate material differences, compare average interest rate with previous year, get the breakup of interest expenditure. Okay, the interest expenditure breakup, because on deposits, no, you pay interest on savings, you pay interest on FD, you pay interest on FD, RD. Get breakup. Test check interest calculation. In exam they can ask you, the auditor has to test check interest calculation. What points auditor will check in interest calculation? First of all, see that interest is provided on all outstanding deposits up to balance sheet date. See that the rate of interest comply with bank regulation, RBI directives. See that interest on savings account must be as per RBI rules and bank rules. Interest on interbranch deposits will be calculated at prescribed rates. And see interest rate changes that happen, compare with interest rate card. Recompute interest accrued by considering various parameters: payment frequency, rate lapse, term sheet, and agreement. That's it. Any 4 or 5 points, that's enough. Provisions and contingencies. In one of the exam 5 marks question, they have asked 4 marks. See that RBI requirements for provisioning are satisfied. See what is the provisioning process which the bank followed for standard asset and NPA. Loan classification must be verified on a sample basis. Loan classification shall be verified with books of accounts, general ledger. See tax provision is calculated correctly. Review provision for various other expenses and see that it is adequate. So that's it. Main incomes and expense audit is mainly over. See, wherever tough is there, I told you detailed. Advances, for example, is bit tough to understand. That I told you detailed. Correct? So audit of advances, audit of incomes, and audit of provisions, everything is done. Now let's see remaining important questions. Long form audit report. By what time you should submit? LFAR shall be submitted by 30th June. Once year is over, no, stat auditor will be there, right? He should give 2 audit reports. One is audit report on the branch to LFAR. Again, there will be central auditor. He will give a normal audit report as per 700 series on the overall bank, and also he will give LFAR. Getting it? So what is LFAR? It is just like a CARO. In CARO we have 21 items, no? LFAR will have so many other items. Okay, just like CARO. LFAR is an electronic report now, which all the auditors file. Auditors of public, private, foreign banks must submit LFAR. Matters for LFAR matters. What are the matters that are included in LFAR? RBI will give time to time. So you need to have a proper planning to ensure timely submission. In LFAR, no, you can give executive summary, which is optional. You can give entire summary of LFAR as a summary report. That is optional. You want to give a summary, you can give it. Next. What is the format of audit report? You must comply with standards and auditing. And in the audit report, you should clearly disclose unaudited branches. There is an information you need to disclose. Unaudited branches. For example, you see State Bank of India, they clearly mention 19,000 branches were unaudited. And not only the number, you should also quantify 40% of advance, 40% of deposit, 20% of interest income, 18% of interest expenditure was unaudited. They clearly quantified. 19,000 branches means what? How do people know 19,000 branches means how much business happened there? You should quantify how much business happening there. So quantification of advance, quantification of deposit, quantification of interest, quantification of expense of unaudited branches under other matter paragraph you should report. CARO does not apply to banks. It will not apply to banks. That's it. Now, for all nationalized banks, auditor has to comment on 4 things: whether financials are true and fair, whether information provided to you satisfactorily, whether transactions of the banks were within the powers of the officers, and branch returns. Some branches, as a central auditor, you might have not visited branches. Have you got the branch statements and all for you? That's it. 4 points you need to report. So in this, LFAR is important for MCQ. Next, authority to appoint the auditor. From bottom you should read always. Okay. In case of regional rural banks, auditor is appointed by board of directors with central government approval. In case of nationalized banks, auditor will be appointed by board of directors with RBI. Remaining all other banks, private sector banks, HDFC, ICAI, IndusInd Bank, all this, auditors were appointed by shareholders at AGM with RBI approval. You understood like this? From bottom you should study. Understood? That's it. Then, this question in one of the exam they've asked as a 4 marks question. The stat auditor, he will be using various reports and documents. Okay. auditor reviews various reports for identifying adverse comments. I want to know what are the adverse comments made by various others in various reports. What are those reports? I will ask, internal inspection report. I will look at previous auditor report. I will look at internal audit report. I will look at concurrent audit report. I will look at RPA inspection report, security verification report, manager charge handing over report. Okay, actually these two are continuation. Managers charge handing over report. Okay, so these are the various reports which the auditor looks into, which the auditor reviews to know adverse comments were there. In one of the exam they tested it as a 4 marks question. Clear? In this there is no other important question, don't worry. What is risk management process in a bank? This once they tested as a 5 marks question, very long back, not May 24 onwards. Before May 24 this was tested as a 5 marks question. Okay, what is the risk management process? Look at the control environment, look at risk identification process. What are the control activities? What are the monitoring activities? What about information? These are 5 components of internal control system. These are 5 components of internal control system. For that, watch my risk assessment internal control topic video, which is available on the YouTube. Then again come back and read this, you will understand better. Next. Now, before we start a bank audit, engagement team must have a discussion. What they need to discuss, what matters they will discuss. Simple, what errors might happen in a bank, what kind of errors identified in the previous years, how banks will do frauds. And I will tell my team member, while discussing, I will tell my team member, be skeptical. And how to respond to engagement risk, pervasive risk, and specific risk in case of a bank. Specific risk related to advances is specific risk. Okay, pervasive risk, overall bank risk is pervasive risk. Engagement risk means by accepting this particular engagement, what risk I am facing. So no, that's called engagement risk. And alertness to material misstatements. These are the matters which auditor will discuss. These are the matters which auditor will discuss with the engagement team. Correct? What is the advantage of discussion? Simple. It will help identify and assess fraud risk in financials. It enables the partner to delegate the work to experienced team member, but in a better manner. It facilitates decision to involve specialists for addressing fraud related issues. Before 2024 attempt, these were asked as 4 or 5 marks question. Okay, what are the matters that are discussed in engagement team discussion? What is the advantage of the discussion? A 4 or 5 marks question they can ask. Next. That's it. Yeah, apart from audit report, there are various other reports which a stat auditor has to give. Central auditor means what? Principal auditor. In case of State Bank, 11 joint auditors were there, they're principal auditors. They should give long form audit report. They should give SLR, statutory liquidity ratio compliance report. They should give report on IRAC as per RBI guidelines. They should give report on adverse credit deposit ratio. In one of the MCQ, they just replaced the word with lending. That's wrong. Credit means lending. Credit lending means lending. There can't be purchase ratio, no? Yes or no? Exactly. So credit deposit ratio, it's not credit lending ratio. And auditor has to give report on banks compliance with Ghosh committee recommendation, Jilani committee recommendation. So these are various reports. They'll ask you a 5 marks question. What are various reports the statutory central auditor has to furnish along with auditor's report? That time you should write this answer. That's it. Bank audit is over. Remaining is just an introductory general matter. That's not that important. Main theme which is important I told. Clear all of you? Yeah. Almost 1 hour 5 minutes. Effectively done. Okay. Hi guys. So I hope your preparation was rock solid for the upcoming exam, and yes, I'm very excited now. For next 1.5 to 2 hours I will be focusing on one of the critical chapter, that is items of financial statements. And trust me, the way we are going to revise this chapter, the order in which that we are going to revise is something different. I want every one of you in the coming exam perform minimum 12 to 16 marks of this particular chapter rock solid just based on this. All that you have to do is this particular topic that we are going to revise now, 1.5 to 2 hours. Revise it. Whatever the observations and points I'm specifically focusing and explaining, please go back and then revise it immediately for another 1.5 hours. And trust me, in the next exam, you can write 12 to 16 marks of the paper. That's it. Fine, guys. So without any delay, let me begin the session. I don't want to waste your time. So let's directly go into the session. And before proceeding further, just comment below where are you coming, where are you watching this from, and please like the video, and it will be recommended to more and more students. Just like the video. That's it. Okay, guys, let me proceed. So the topic of discussion right now is audit of items of financial statements. And if you see how I'm going to discuss this, first I will be discussing about additional regulatory information. First I'll be discussing about something called additional regulatory information. Then I will be discussing audit of P&L items. Then I will be discussing audit of balance sheet items. First, additional regulatory information is what I'm going to discuss. If those of you who do not have any idea, this is nothing but, if you observe below fixed assets, below loans and advances, below capital, okay, below other expenses, at so many places at the disclosure requirements, wherever they have given disclosure requirements, there additional regulatory information, this is something, a schedule 3 disclosure which is to be shown additionally as a regulatory information. Like that, some points were there. For example, you might have seen a corporate social responsibility expenditure related disclosure, important ratios disclosure, and funding party intermediary beneficiary transaction disclosure, like that. So first we need to finish that. Once we finish that, then we'll go to P&L item and balance sheet item. But before I start this, I will also give you an idea about assertions topic. Remember, I told even in the introduction to this, previously also I posted one video saying you must refer SA 500 standard in my previous marathon. My previous, whatever in the timestamp, whatever it is there, if at all you are watching a merged version of this, then different thing. So SA 500 standard, inside that we have audit evidence chapter, right? Yeah, very good. Many people are watching from Kerala, Chennai, all that. Yeah, good, nice. So if you observe SA 500 in your CA Institute book, audit evidence chapter is there, right? Inside that there is a topic called assertions. That understanding is most important for understanding these two, but nothing to worry. I will give you a brief idea about that assertion topic and then only I will proceed. Okay, fine. First, let me begin regulatory information, additional regulatory information. Okay. Now, first I will cover items of financial statements for the day. If time permits, I will also take different types of entities. I don't have an issue. I will cover different types of entities once first we successfully finish this particular topic. Now look at audit of items of financial statements. So inside this, first I told you I will be covering additional regulatory information related points. In the entire book, additional regulatory information, something, there is a concept called additional regulatory information. For example, the first time the additional regulatory information that is there is below share capital. What is there in the below share capital? You know, you have to give a disclosure related to, just 1 minute guys, yeah, you have to give a disclosure related to funds advanced loaned invested to intermediaries, funds received from funding party by intermediary. So regarding this, there is something called additional disclosure that we need to give you. I hope until now, whatever I'm going through, everyone, are you with me? Just tell me whether you're all having a proper, is the audio, video, everything clear? Just confirm me. Like clear, you can just reply me saying clear. Comment, just comment saying clear. I'll understand. Let's not hurry up. Let's neatly discuss everything, every of this. Yeah, perfect. Perfect, guys. We'll proceed further. So we need to give additional regulatory information below share capital. A similar requirement is there even below borrowings. Even below borrowings, this kind of requirement is there. What we need to disclose? If you remember, in audit report you have a topic called reporting requirement. In audit report you have a topic called, just a minute. Yeah, In audit report, you have a topic called legal and regulatory requirement, or we also call it as other reporting responsibility, legal and regulatory requirement. Inside this, 143 subsection 16 enquiries, 143 subsection 3, 143 subsection 3, these are all called as checklist items. Inside this 143 subsection 3, clause J is there. Inside that, subclause D is there, right? Here you might be having, you might have seen, you might have come across one of the toughest point, whether the company acted as a funding party, funded loans to intermediary, where intermediary has to fund to somebody else, like that. So what exactly that I will tell you. And again, 143 subsection 11, this is what CARO, guys, where 21 matters are discussed. Okay, fine. I'm not touching this. I'm not touching this because our point of discussion is regarding audit report and related point discussed in the financial statements by management as an additional regulatory information. Look at, if you have not seen this pointer here also, doesn't matter. Just pay attention to what I'm saying. You will really understand. Okay, you know, there is something, you know, there is, for example, we are doing audit of one company. So we are the auditor of the company, right? Let us assume this company transferred amount. Let us assume this company transferred some amount. To whom they transferred? Another entity, which may be a foreign entity, What this entity has to do? This entity has to lend to, or has to invest in, or has to provide a guarantee. So to whom? Just a minute. Lend to ultimate beneficiary, invest in ultimate beneficiary, provide guarantee to third party on behalf of ultimate beneficiary. Who is ultimate beneficiary? Who is this ultimate beneficiary? This beneficiary is identified by funding party. This beneficiary is identified by funding party. Who is funding party? Our client. We are doing audit of one company, right? That company. So this company has some beneficiary. We call them as ultimate beneficiary, means another company. Now, instead of this company giving money directly to that company, what our client did, our client transferred the money to an intermediary, another entity, which may be foreign entity, which may be Indian entity. But this particular mediator, we call them as intermediary. What our company did? Our company transferred funds to intermediary, where the intermediary has to send whatever money we gave to that company, that company has to transfer these funds to another entity, ultimate beneficiary, either as a loan, or as an investment, or our beneficiary should get some benefit at the end of the day. So our beneficiary will get a guarantee service from the intermediary. What intermediary will do? Our company, some beneficiaries are, right? That beneficiary might be purchasing goods from somebody else. Now they won't pay any money. This intermediary will provide guarantee to the third party on behalf of ultimate beneficiary. I hope you understood this. So our company will give money to intermediary. That intermediary will have to give the money to beneficiary. This is the transaction. We don't directly give to the beneficiary. We use some mediator. That mediator either give a loan or give investment in the beneficiary. Okay? Or this intermediary will provide to third party. This intermediary will give a benefit, will give a guarantee to third party, so that beneficiary will ultimately get a benefit. This is the transaction. Now here, where is our client? Our client is either this company, or in this entire chain of transactions, our client may be the intermediary. If at all our client is a funding party, what disclosures in the schedule 3 they need to give? If our client is an intermediary, what disclosures they need to give in the schedule 3? This is what the question is about. Okay, the question is about this. Look at our client. For example, no, if at all our client is a funding party where funds are loaned, advanced, invested to intermediary. If at all the question is funds advanced, loaned or invested to intermediary, means our client is acting as funding party. If our client is acting as a funding party, our client has to disclose the following information. What information they need to disclose? They need to disclose date, on which date how much amount is loaned or how much amount is invested in intermediary. Here you see our company transferred to intermediary, right? On which date and how much is the amount. This disclosure, first disclosure. Second, intermediary, what they need to do, they need to transfer it to beneficiary, right? Look at that. How much further we need to give details of further investments or guarantees by intermediary to ultimate beneficiary. Now here we gave funds to this entity. What this entity is doing, they are either lending, they are either investing, or they are giving guarantee. That detail. Second one, details of further investments, loans, or guarantees by intermediary to ultimate beneficiary. Then what is the date and amount of guarantee by intermediary? So what is the date, how much this is regarding first one, details of investments, loans, or guarantees by intermediary, and date and amount of guarantee given by intermediary, and last one, a compliance declaration. They need to give a declaration that, under FEMA, under Companies Act, under PMLA, the company has to give a declaration that we have complied with the FEMA guidelines, Companies Act guidelines, RBI guidelines, all that with respect to these transactions. Simple, guys, very simple. If our company is acting as a funding party, we need to give the following details. What details we need to give? We need to give details of how much amount we invested or loaned to intermediaries and the date. When these intermediaries are lending or investing or giving guarantee to beneficiary, date and amount of guarantee given to the beneficiary, and a declaration by the company that they have not complied. Declaration by the company that they did not, there is no non-compliance, or declaration that they have complied with FEMA, Companies Act, RBI, like that. So these disclosures are required if our company acted as a funding party. Now, second one, for funds received, for example, for funds received from funding party, for example, our company, our client is acting as intermediary. Here our client is acting as intermediary, whereas here our client is acting as funding party. If our client is acting as intermediary, we should give details about who is the funding party, who is the ultimate beneficiary. Simple. Look at date and amount received from funding parties with the details of funding parties. So if at all I am acting as an intermediary, I should give details of funding party. Look at, so on which date, how much amount I received from funding party. Further, details of further investments, loans, guarantees by the company on behalf of ultimate beneficiary. How much amount I invested in, how much amount I loaned, how much amount I given guarantee on behalf of ultimate beneficiary, and date and amount of guarantee by the company to ultimate beneficiary. Same details here, just that here I am acting as an intermediary. See, suppose if I am a funding party, I should give details of intermediary, I should give details of the beneficiary. If at all I am an intermediary, I should give details of funding party, I should give details of beneficiary. I hope you are able to understand. If I am funding party, look at it. If I am funding party, I should give details about, if I am funding party, I should give details about intermediary, I should give details about beneficiary. Suppose if the client we are auditing is an intermediary, then they should give details about funding party, then they should give details about ultimate beneficiary. This is the logic. What details they need to give? Details of, for example, funding party. Our company is acting as a funding party. Then who are the intermediaries? What amount we gave? When we gave? And when are they going to make further investment in ultimate beneficiary? Guarantee and amount of guarantee. Declaration that they complied with everything under FEMA. Suppose if our company is intermediary, then first point alone will change. Only first point. On which date, how much amount I received from funding party. Then I have to give details of further investments in intermediary. Date and amount of guarantee given to the further investments to the ultimate beneficiary. Date and amount of guarantee given to the ultimate beneficiary. Are you clear? And compliance declarations for FEMA, Companies Act, prevention of money laundering. These three acts you must quote, guys. A compliance declaration under FEMA, Companies Act, Prevention of Money Laundering Act. That's it, guys. First additional regulatory information is done. First additional regulatory information is done. Somebody is asking, sir, is there any change in my GOAT Notes 2025-2026 edition? No, guys, there are no changes at all. Just at some places, abbreviation has been updated. That's it. Wherever sufficient appropriate evidence that what and all is there, we just replaced it with SAAE, sufficient and appropriate audit evidence. Except that in the GOAT Notes of 25 and 26, there is no significant change. That's it. So this is the first additional regulatory information we completed. I hope every one of you are confident. Just mention that ARI, additional regulatory information, funding party. Yes, done. You just mention that in the comment. Next, Then the next additional regulatory information. In fact, in the entire additional regulatory information, this part right now we covered, right? This is only very complex. Now we are going to discuss remaining additional regulatory information, which is dead easy, not a difficult one at all. Next, look at borrowings. With respect to borrowings, we should again give some additional regulatory information. With respect to borrowings, we should again give additional regulatory information. Borrowings, what we need to give declaration. Suppose you are borrowing with a security by current assets. You might have remembered this point in CARO. If the company has got any working capital limit, did the company got any working capital limit in excess of 5 crore? Okay, you might have seen. If so, the auditor has to report whether quarterly statements, quarterly returns filed by the company with the bankers and FIs, are they tallying with books of accounts? Remember in CARO, that reporting requirement apply only when working capital limit is more than 5 crore. But here, this is additional regulatory information for the company which management has to give. Whether or not working capital is below 5 crore or more than 5 crore doesn't matter. Whether or not below 5 or more than 5 doesn't matter. First understand that. Remember, additional regulatory information is a Schedule 3 disclosure we are talking about. It's something which management has to disclose in the financial statements notes to account. This is not about auditor reporting requirement. CARO 2020 is an auditor reporting requirement as a part of auditor's report. Please be clear on this particular aspect. This is most important. Now, here you need to give a disclosure. What you need to disclose for borrowings? Which borrowings? Those borrowings which are secured by current assets. Borrowing secured by current assets means generally they're nothing but working capital limit like cash, credit, overdraft, like that. Okay, what we need to disclose? Who should disclose? By the way, here management should disclose. What they need to disclose? They need to disclose a fact. What fact? Companies, they file quarterly statements of assets and current liability, current asset information they file with bankers. Now, why they need to file quarterly statements? In bank audit chapter, you might have seen drawing power has to be calculated based on latest stock statement, and the stock statement should not be older than 3 months. Have you seen that? Yes. So stock statement should not be older than 3 months. You might have seen, right, in bank audit. 3 months means what? For every quarter is nothing but 3 months. For every quarter, a borrower has to submit to a banker quarterly statement regarding statement of current assets and statement of current liabilities. Based upon that, working capital amount is decided. Based upon that, drawing power will be computed by the banker. Now, what many businesses they are doing, in their books of accounts, their net working capital, current asset minus current liability is just 10 crore. But when they file with bank, they will inflate it. What they do? They will inflate it. 12 crore, 13 crore they used to show and then file with the banker. In this way, many businesses, many companies are overstating net current asset position to the banker and getting additional drawing power. Now, by mentioning this as a Schedule 3 disclosure requirement where board of directors have to honestly disclose this, that practice is prevented. Why? Today, board of directors have to clearly tell in the notes to accounts whether quarterly returns, quarterly statements filed with the banks and FIs are in agreement with books of accounts. Oh my God. In books of accounts, what is your current asset and liability, and what is the amount that you showed in the documents filed with the banker? Q1, for example, the company has to disclose, for example, ICAI Bank, Q1, net current asset position filed as per quarterly statement 12 crore. As per books of accounts, net current assets 10 crore. The difference 2 crore. Why this difference is there? You should not have a difference between books and statements filed with a bank, right? Why there is a difference? You need to give a disclosure like this. Now, because of this requirement today, most of the companies silently disclosing original asset value rather than inflated value, where earlier they inflate this position and get more drawing power. Now that is prevented. This practice is curbed. Okay, look at. And if not, what do you mean by if not? If not means they are not in agreement. Like quarterly returns, quarterly statements filed with the banks and FIs, they are not in agreement. If not, we need to provide a summary of reconciliation and reasons for material discrepancies. If there is a discrepancy, we need to give a summary of this. Remember, a similar point you might have already seen in CARO clause number 2, clause number 2 inventory, in that subclause B. There, auditor also has to check this and then give his opinion whether company is filing correctly quarterly statements with the banker. Is there a difference between this particular statement and books of accounts? If so, auditor also has to point out this. More than auditor, management has a disclosure requirement. More than auditor, management has a disclosure requirement like this. I hope you're clear. Next. This is first thing. Now remember, in CARO, for auditor has a disclosure requirement. Auditor has to give an opinion on quarterly statements, agreement with books of accounts. This logic only when the working capital limit is more than 5 crore. Whereas here, the management has to disclose it the moment they have a loan based on current assets. That's enough. Is it more than 5 crore, less than 5 crore? Remember, the 5 crore limit also in audit report is based on sanctioned limit, guys. Not outstanding amount, not drawing power, guy. Sanctioned limit, guys. That's it. Then another disclosure. Remember, a similar disclosure is there in clause number 9 of CARO 2020. In a similar disclosure for auditor, it is there. There is a similar disclosure for this in clause number 2 of CARO 2020. Okay. Now here, willful defaulter. What is this? Company board of directors have to check whether their company is declared as a willful defaulter. Check out. If the company is declared as a willful defaulter by any bank or FI or any lender, the board of directors has to clearly disclose in the financial statements, guys. They need to disclose date of default, date on which they were declared as a willful defaulter, details of the default, what exactly we defaulted, like how much amount we defaulted, what is the nature of loan that we defaulted. We need to give these disclosures. Remember, who is a willful defaulter? A willful defaulter is a person categorized as such by a bank or FI under RBI guidelines. As per RBI guidelines, a borrower may be classified as a willful defaulter by a bank based on RBI guidelines. If I am doing audit of our company, one company I am doing audit, and that company was declared as a willful defaulter by a bank. That company, what they need to do? Two things they need to mention. In the financial statement, notes to accounts, as additional regulatory information they need to disclose. What they need to disclose? 1, the date on which they were declared as a willful defaulter. 2, details of what exactly they defaulted, what amount they defaulted, what is the nature of the amount they defaulted. For example, amount 1 crore it defaulted, nature of amount, working capital limit with ICAI bank, it is defaulted. Remember, a similar requirement is there in CARO clause number 9, inside that subclause 1. CARO clause number 9, subclause 1. Subclause 2. Subclause 1 is regarding details of default, lender wise we need to give. In that subclause 2 is there, right? 9 subclause 2, clause number 9 subclause 2 is the company declared as a willful defaulter by any bank. Their audit reporting requirement, whereas this is additional regulatory information which board of directors has to give this data in the notes to accounts of the financial statements. That's it, guys. So another ARI is completed. Now, so with respect to borrowing secured by current assets, we should, board of directors have to comment, board of directors have to disclose whether statements filed by them with the banker is agreement with books of accounts. If not in agreement, they need to give a summary of reconciliation and disclose reasons for discrepancy. If the company is declared as a willful defaulter, date on which they were declared as a willful defaulter, and details of what exactly they defaulted. Who is a willful defaulter? A willful defaulter is a person which is classified by a bank or FI or any lender based on RBI guidelines. That's it. Then third, another information the company has to disclose is whether any charges or satisfaction are not registered with the companies within the statutory period. Disclosure reason. Remember, here unregistered charges, guys. What information you should give is unregistered charges. Unregistered charges created, unregistered charges which we already satisfied. Satisfaction of charge means what? We already repaid the loan. Yes or no? Charge means what? We borrowed a loan and then an asset has been given as a security. Yes or no? So if any charge or satisfaction of charges not registered with ROC, that details we need to. Unregistered charges, unregistered satisfaction of charges, we need to give disclosure. This is another additional regulatory. This might be tested as an MCQ. Be careful. You know what we need to give is unregistered. We need not have to give registered. That's it. Then again, utilization of borrowed funds. This is exactly a repetition of what we have seen in the share capital. This is exactly a repetition of what we have seen in share capital. So I'm not repeating again. The same point is again here. By the way, we are discussing here what additional regulatory information below borrowings. For example, we might borrow money. How a company will get the money, either in the form of share capital or in the form of borrowing. So our company got the money in the form of share capital or a borrowing, means loan. What our company is doing, we are transferring to intermediary, where intermediary might be transferring to beneficiary. Same way, the intermediary has got money as a share capital investment or got the money as a loan. So that is why under borrowings, once again, that funding party intermediary point is covered exactly. Next, additional regulatory information. I hope you are able to understand ARI. ARI is very important. In every attempt, 5 marks question is there on ARI. Another 20 to 30 minutes we are going to finish ARI. Another 20 minutes we are going to finish ARI. Next, look at inventory. Next ARI point we are going to look at. I think PPE has ARI. Yes. Under PPE, we need to give some additional disclosures. Under PPE, we need to give again some additional disclosure. What we need to disclose? Title deeds. What we need to disclose? Title deeds of immovable property not held in the name of the company. If you remember, guys, this disclosure is there in clause number 1 of CARO 2020, subclause 3, guys. In CARO 2020, subclause 3 is there, right? That is talking about title deeds of immovable properties not held in the name of the company. If company immovable property were not in the name of the company, the auditor has to give details. What details? What is the property description? Gross carrying value, guys. Here it is gross, not net carrying value, guys. It's gross carrying value, and in whose name the title deeds were held. Whether he is a promoter, director, relative, or relative of the promoter, director, or he is an employee, who is he? Property held from which date on their name? Why it is not held in the name of the company? So all these details you must give. Now look at, if the company the company shall provide details of immovable property, it may be other than properties where the company is the lessee and the lease agreements are duly executed. Means leased properties you can leave it. Company owned properties, freehold properties, company has to give a disclosure. What disclosure? If title deeds, means company registration document, the registration documents of those immovable properties, they were not in the name of the company, they were in the name of somebody, they were not in the name of the company, then you should give details of what is the description of the property. For example, land and building. What is the relevant line item in the balance sheet? It may be property, plant and equipment. Okay, land and building. Gross carrying value 5 crore. Some 5 crore. 5 crore. Title deeds held in the name of Mr. Ram. Who is Mr. Ram? He is a director of the company. Property held from date of purchase. Give the date of purchase. Okay. Now also indicate why it was not held in the name of the company. No, it was held in the name of the director because it was the company's interest, or it was astrological reasons. Yes, guys, it's an astrological reasons also possible. Or maybe recently company amalgamated, and amalgamating company property has to be transferred to amalgamated company. Still right now the process is going on. For that reason, the property deeds of the immovable property belonging to amalgamated company, which is right now in the name of amalgamating company, because the registration is yet to be done. So reason has to be given. So description of property, gross carrying value, title deeds in whose in whose name they were held, who is he, relative, director, promoter, who is he, employer, and why it was, from which date it was held in their name, why it was not held in the name of the company, reason. That's it. Next, another ARI. Another regulatory information related to fixed assets, another regulatory information related to property, plant and equipment. Okay, with respect to ARI, whether the company has revalued its PPE, the company shall disclose whether the revaluation is based on registered value. A similar point is there in CARO, clause number 1, CARO 2020, inside the subclause 4. If whether the revaluation is done by registered valuer, if there is a change, we need to specify the amount of change. If the change is 10% or more in aggregate in net carrying value of each class. Remember, for revaluation it is net carrying value we should see as an auditor while reporting in CARO. But here we don't have to touch that point. Here we just have to talk about who did the revaluation. Is it by a registered valuer or not? By the way, this is ARI, additional regulatory information. This is something which a director of a company has to disclose additionally in the Companies Act. Look at whether the company has revalued its PPE, and the company shall disclose whether the revaluation is based on valuation by a registered valuer. This we need to disclose. So if the company has done revaluation of PPE, we just have to disclose. Directors have to disclose who did the revaluation, registered valuer or not. That alone they need to disclose. So this is ARI. Then for capital work in progress, the company has to disclose aging analysis for capital work in progress, where the project is in progress. Capital work in progress, the project is in progress means, in fact, the deadline for the project, suppose we are constructing one big factory, the deadline is still there, we have not yet crossed the deadline, estimated completion date we didn't cross. Following aging schedule we should give. So how much amount of work in progress that is there for less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, like project in progress, how much, projects temporarily suspended, how much within that. So you need to show amount. Further, so there will be some projects where the completion is already overdue. Overdue means what? The completion date already we crossed, estimated completion date we already crossed. Now for that we need to give closing work in progress backup. We need, by when, still how long it will take to be completed, in how many more years? Sir, we will complete in less than 1 year from balance sheet date, sir, or we will complete in 1 to 2 years from balance sheet date, sir. We'll be completing within 2 to 3 years from balance sheet date, sir, or we'll be completing more than 3 years from balance sheet date, sir. Project 1, this is already overdue. Project 2, this is already overdue. That also we need to. Further, where the project activity has been suspended, that details shall be given separately. Remember, this is overdue project. For overdue project, this time period is to be calculated from balance sheet date. Okay, now look at, so overdue has exceeded its cost from compared to original plan, the following capital work in progress aging analysis must be given. Whereas here, amount in capital work in progress, this is from the starting date of the project. If the you have spent already an amount, and the amount is in work in progress, capital work in progress, and project is not yet overdue, then as on 31st March in the balance sheet you need to give a disclosure requirement. How much of this amount is there in the work in progress? Less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. This is real aging analysis. Whereas this is, here you are giving aging of till how many more years it takes. That's the basic difference between that and this. In the original aging, you should give breakup between project in progress, how much, project temporarily suspended. Here also, projects that are in progress and crossed already completion date, and you should give separate details about project suspended but already crossed completion date and then they got suspended. That details you should give disclosure. Clear, guys, or not? Next, so this is one more additional regulatory information. I don't know how many of you remember this additional regulatory information. Somebody is asking, some Pramod is asking, sir, should I write CARO subclause number also? Preferably, see, main clause number 3, 4 like this you should write. If possible, subclause number also you write. Okay, getting it? Next, that's it, guys. I hope you're clear until now. Next, again, for intangibles also, additional regulatory information we need to show. For intangibles, no, one word will change. Intangible assets under development word will come instead of capital work in progress. So amount in, sorry, here CWP came, it's nothing but intangibles under development. IUD, you can call it as a shortcut, IUD under development. So for a project which is in progress, for a project which is temporarily suspended, we should give breakup. Again, there will be some intangible assets which are under development whose completion is overdue or has exceeded its cost compared to original plan, where project completion already crossed or estimated cost has already crossed by actual cost that we spent. Then we should give details, intangibles under development, which will be completed in how many years it will be completed, less than 1 year, 1 to 2 years, 2 to 3 years, all that. Again, we should give details of project where it was temporarily suspended. Remember, every asset construction, suppose company is constructing a building, that's one project. Company is constructing one factory, that's one project. Company is constructing one canal, that's a project. So everything will be viewed as a project. Are you clear? That's it. A similar requirement for capital work in progress is there. This is an aging analysis, guys. These are all schedule 3 disclosure requirements. Basically, until now what we are discussing, additional regulatory information, is basically schedule 3 discussion. This is something you must have finished in advanced accounting itself, but then I know you will not be touching there, so that's the reason I'm touching here, I'm explaining here. Clear, guys? Next additional regulatory information, only ARI I am discussing first, then I will come back to remaining items later. So loans and advances, yes, again under loans and advances given by the company. Now this is again an asset item, PP, intangible asset item. There additional regulatory information we saw. Now a company has given loan to somebody, company has given advance to somebody, loans and advances given by the company to somebody. This is here also some additional regulatory information has to be given, what they need to give. And by the way, just like the video, if at all you didn't like the video, so see, you know how much tough it is, yes or no? How tough it is? continuously. That to a revision class is something very, very intense, guys. Revision class is very intense, basically. Fine. And somebody is asking, sir, will you give dinner break? Obviously, man. Within that, we will finish this chapter. Don't worry. Now, look at to be disclosed as additional regulatory information under loans and advances, guys. So in schedule 3, loans and advances, notes, accounts, we give breakup, right? There the company has to disclose this following information. What information? They need to disclose following disclosure shall be made, where loans or advances in the nature of loans. Actually it's a loan only, but you named it as advance. So loan or advance in the nature of loan are granted to promoters, directors, key managerial persons and related parties. Did the company granted any loans or advances in the nature of loans to promoters, director, key managerial persons and related parties, either separately or jointly, that are repayable on demand or without specifying any terms of repayment? So if the company that we are doing audit, if they gave a loan or advance in the nature of loan to a director, promoter or related party along, either separated to them a loan is given or a joint loan to them along with some other party, we gave a loan which is either repayable on demand, which is given, where a loan is given, without specifying terms of repayment. If that is the case, we need to give the following. The company has to give the following disclosure. Yes, somebody saying drink water. Yes, I'll drink water. I'm just remembering right now. Yeah, thank you. So the company has to give the following information. Who is the borrower? Is he a promoter, director, KMP, related party? How much amount of loan or nature of loan is given which is outstanding? How much amount is outstanding? What is the amount outstanding? And what is its percentage to the total loan? What is this percentage outstanding to total outstanding on balance sheet date? What is the percentage? Here, amount of outstanding as on 31st March, how much outstanding loan? And what is its percentage? What is this percentage of outstanding on balance sheet date to the total loans outstanding on balance sheet date? That details we need to give. By the way, remember, once again I'm reminding you, what I'm discussing is not CARO. A similar point is there in CARO also. Yes or no? That's it. Next, somebody is asking, sir, is it beneficial to do a study on my own or watching here? See, what I can tell you is, you watch this and get clarity, immediately go and study. The same point, immediately go and study. It will register in your mind because the coming exam is very near. Just one day, you will do really well. That's it. That's it, guys. I hope you're clear until now. Next. Then we have again audit of provisions and contingencies. Below that, ARI. I hope you are able to understand ARI. ARI below contingencies and provisions. Remember, under which head, under which line item of the balance sheet it is coming is not relevant, guys. This ARI point, if you are able to understand, that's enough. Because in exam they can ask you only Binami property related ARI. Or in exam they can ask you, just now we finished loans repayable on demand, whether the company has given any loans to promoter, director, related party, or either severally or along jointly with somebody else. Yes or no? Then which are repayable on demand, which are given without specifying terms of repayment. Then each person wise, how much amount is outstanding, what is its percentage to the total loans as on balance sheet at this detail. The same way, now Binami transactions. What is it? Directors have to give. The company directors have to give whether any proceedings under Binami law has been initiated. Binami Transaction Prohibition Act 1988. Okay, so if proceedings are initiated under Binami transactions, disclose details of property including the year. So which property, when you acquired, what is the amount involved in the property, amount of the property, who are actual beneficiaries of the property. Maybe your company may be held as a Binami. Your company is holding the building in the company name, but actual company is not the real owner. The beneficiary is somebody else. If the property is in books of accounts, reference to the balance sheet, which item it is there. If not, state the reasons. Some assets were held in the name of the company, but they were not reflected in books. Why it was not reflected in books? We should give reasons. And what are the proceedings against the company? Is the proceedings against the company under Binami law as a beneficiary, or is the proceedings against the company as a transferor of a Binami property? So in a Binami property, there will be transferor, there will be beneficiary, there will be intermediary. Yes or no? Now this intermediary is binami, acting as binami of beneficiary. Somebody else is transferring property to a beneficiary, but they're using some binamis in between. If the company is acting as a binami, that details we need to give. Who should give these details? Directors have to give. What details they need to give? What is the details of binami property? What is the amount of the property? Who are the beneficiaries? If the property in the books, give reference to the item in the balance sheet. If the property not in the books, but company name only property held. Why it was not held in the books? And details of proceedings. What proceedings were there against the company? Is the proceedings initiated as a beneficiary? Is the proceedings initiated as a transfer? And nature of proceeding. What is the nature of proceeding exactly? And what is their status? And what is the company view on that? What exactly the proceeding? Status of the proceeding? What company's view on that particular proceeding? So this particular information we need to give as an additional regulatory information. I hope you're clear, guys. The reason why I started items of financial statements with additional regulatory information, because this is something where many students don't focus. We are about to finish, guys. We are about to finish regulatory information point. Now, next, we need to, the auditor has to, the management has to show one more disclosure. What disclosure? Any transactions. Suppose, the company entered into some transactions. With what companies, with companies where the name is struck off. Where their name is struck off under 248 section of the Companies Act. There is a company where their name has been struck off. Remember, removal of name of the company from register of members, register of companies, removal of name of the members, that's called struck off. Okay, why a company will struck off? There is a difference between passing a liquidation order and removal struck off order. Both are different, guys, be clear. Now here company directors have to give disclosure about whether this company entered into any transaction with a company whose name is struck off by ROC under section 248 of Companies Act. If so, what transaction entered? What is the name of the struck off company? What is the transaction that we entered? Sir, we purchased goods, sir, or we invested in that company, sir. Yes or no? Or any outstanding balance is there with them, sir. Balance outstanding mention. If there is any relationship with the stock of company, no, sir, that stock of company is my subsidiary companies or my associate companies, sir, then give that relation. 4 points you need to disclose, guys. 4 points you need to give. Name of the stock of company, nature of the transaction, balance outstanding, relationship with them. Very simple. The company that you are auditing, right? That company has entered into some transaction with struck off companies. That company has entered into some transaction with struck off companies. Then 4 points you need to give. 1, name of that company, struck off company, what transactions you entered into, what is the relationship with them that you are having, and how much is the amount outstanding as on balance sheet date. Because if the company has been struck off, that is in a severe litigation, guys. That's in a severe litigation. That may even go for liquidation also. So how much balance is there? People have to know how much balance is lying. Our balance is lying with a struck off company. That's it, guys. Clear? Then important ratios, guys. Important ratios we need to disclose. Remember, right now, until in the last 40 minutes, whatever additional regulatory information that I discussed, trust me, every one of this is tested in the past exams. Every one of this is tested in past exam. You have passed 15 attempts. It was tested in the old scheme before 2024 May, November 2023, before November 23 attempt and before attempts. All these points were tested. Even now in the recent exams, they got tested. Okay. Now, key ratios we need to disclose. What are the key ratios? The following ratios must be disclosed. What are the key ratios? Current ratio, debt equity ratio, debt service coverage ratio, return on equity, inventory turnover, trade receivable turnover, trade payable turnover, net profit ratio, return on capital employed, return on investment, and net capital turnover ratio. All these ratios company has to disclose. Not only ratios, you should also disclose. Most important, it was recently asked as an MCQ. Yes or no? They can even ask as an MCQ any of this. Explain ratio. First explain the ratio, numerator and denominator. Also explain, most important, provide explanation if there is a change in the ratio exceeding 25% compared to previous year. Sir, last year my asset turnover ratio, my inventory turnover ratio 2, sir. This year my inventory turnover ratio is 3, sir. Now what is the change? 1 divided by 2, 3 minus 2 is equal to 1 divided by 2 is equal to 50% change, guys. 50%. I should give explanation why there is a change more than 25% in a ratio. So exceeding 25% if there is a change, you should give a disclosure. That's it, guys. This is the disclosure requirement related to ratios. Key ratios: current ratio, return on equity, return on capital employed, return on investment, inventory turnover ratio, trade receivable turnover ratio, debt service coverage ratio, debt equity ratio. See, 8 ratios I already told. And net profit ratio, net capital turnover ratio. Over. Trade payable turnover ratio, that's it. Trade receivable turnover ratio, trade payable turnover ratio, inventory ratio, that's it. And we should give explanation of numerator, denominator. Many students will forget this numerator, denominator explanation point, and some students will forget explanation about change in the ratio exceeding 25% compared to the last year. That's it, guys. I hope you're clear. That's it. Appa, we are about to finish this, guys. We are about to finish this ARI point. Then it's actually very tough, handling this. Yeah. Again, additional regulatory information. Now, remember in CARO, you have a clause number 8, 2020 in CARO, whether any undisclosed income discovered during the year in a tax assessment. If so, the auditor has to check whether the same is accounted in that year or not. Here you see, the company shall give, here ARI is company's requirement, yes or no? The company has to give a disclosure, yes or no? The company shall give details of transactions not recorded in books but disclosed as income during tax assessment under income tax law. The company has to disclose, are there any transactions not recorded in books of accounts, but in the current year we disclosed it to the income tax authorities and we paid tax also. Some undisclosed income is that which we didn't record in books earlier. Now we admitted with the department that yes sir, we have that income and paid tax also. If so, state, the directors have to mention whether previously unrecorded income and unrecorded assets are now recorded in the books of accounts. So earlier some income, some assets, no, we didn't record. In this year we admitted with the department, sir, yes sir, it was a mistake, we admit that, and we paid tax also. Undisclosed money tax 60%, 25% surcharge, 78% due pay taxes, they paid also. Now that unrecorded item, now did they record it? That point you should check. Company directors also should give that disclosure. Very good, guys. Almost continuously in the past 1.5 minutes, continuously 400 students plus were on live continuously. Very good for your dedication. Tomorrow in the exam you are going to rock. That's it. Okay, so this is additional regulatory information. Until now, just reply me, guys. Are you all with me? Until now, just comment regarding black money. Just comment black money, means I assume that you completed up to this black money provision. Okay, just comment yes sir, black money provision completed. This is regarding black money provision. If any black money was admitted by the company during the year and paid tax on it, the company has to disclose whether that undisclosed money, asset or revenue, has been disclosed in the current year or not. Yes, guys. And one more request, if at all any of you did not like the video, just like the video. Okay, and I hope you're all learning the points now. Very good, you're all getting clarity, more clarity. Just tell me whether you're all connected with that. Until now you understood decently, right? You can just reply me understood. That's it. Very good, guys. Then about to finish, guys. ARI is about to finish. Then we'll start P&L items. Okay, then we start P&L items audit. Then CSR provision is there in ARI. Yeah, crypto and CSR. Once we complete these two, additional regulatory information is clear, guys. Additional regulatory information is clear. I mean, it will be done. Now, again, additional regulatory information. CSR. What we need to disclose relating to CSR. Corporate social responsibility expenditure. What we need to disclose. Companies which are covered under section 135. Nothing but those who are liable for establishing CSR committee. Okay, they must disclose the following points. What they need to disclose? Remember, CSR point is there in clause number 20 of CARO 2020. Am I right? CSR, there it's an auditor reporting requirement on ongoing project, other than ongoing project. Whether that funds were transferred to respective accounts or not, we need to disclose. We need to comment there in the audit report in CARO. Whereas here, it's a company's requirement. It's a company's disclosure requirement in the schedule 3 notes to this, notes to account. Yeah, ARI is very easy compared to other items in the chapter. ARI is very easy. Fine. Next. So look at companies covered under 135. The board of directors has to disclose. What they need to disclose? How much amount they have to spend. For example, no, Reliance is having 50,000 crore profit year into 2%, 1,000 crore they need to spend first. Yes sir, sir, our company has to spend 1,000 crore, sir, our company has to spend 1,000 crore. Amount you spent, sir, we spent till now 800 crore, sir. What is the shortfall? 200 crore shortfall, sir. Last year also there is a shortfall, no? Yes sir, last year also 150 crore shortfall is the total shortfall is 350. Total of previous year shortfall. Why? There is a reason, sir. A project is going on, sir. We are going to spend it in the coming few months, sir. Nature of CSR, sir, we have taken rural development activity and we have taken education to poor. Like this we have taken a project, sir. And related party transactions, contribution to trust control, sir, out of this 800,000 crore, sir, we have transferred 500 crore to our Reliance Foundation, sir. Reliance Foundation is a sectioned company incorporated by Reliance Industries Limited. Then where a provision is made for liability under contractual obligation, disclose movement in the provision, so during the year we created a provision for CSR expenditure rural development in our books of accounts, and this is the movement of the provision. We need to give this disclosure with respect to CSR. First talk, how much amount you have to spend under CSR? 1,000 crore. How much you spend? 800 crore. How much is shortfall? 200 crore. Previous year also there is a shortfall, right? That shortfall also you should mention. And what is the nature of activity? Education, relief, medical relief, or rural development, what exactly? Then details of related party. Out of the spending in the CSR, how much of this amount is given to beneficiaries who are related parties to you? Okay. Then where a provision is made in the books of accounts, movement of the provision. That's it. With respect to CSR, ARI is ARI is completed. Clear, guys? ARI is completed with respect to CSR. That's it, guys. Then last ARI, cryptocurrency and virtual currency related disclosure. Crypto and virtual currency related disclosure. What if a company has traded or if the company has invested in cryptocurrency, virtual currency like Bitcoin, Dogecoin, you know, right? Cryptocurrency. If the company has traded or invested, doesn't matter whether you traded or invested, or doesn't matter. Have you touched? Did the company bought cryptocurrency, virtual currency? If so, disclose what is the profit made on the crypto transaction, or what is the loss made on the crypto transaction. What is the profit? What is the profit on transaction involving cryptocurrency, virtual currency? And how much profit? Means some transaction you might have bought and sold it. Is there profit? Is there loss? First disclose the profit or loss. 2, on balance sheet date, the company is still holding some crypto, right? Give the details. Amount held on reporting date. Reporting date means balance sheet date. And how much amount of deposit or advance received from trading or investment purpose? How much deposits or advances received for trading or investment purpose? So deposits and advances we received for crypto related advances. That's it, guys. So whether profit or loss on transaction, amount held as on reporting date, deposit or advance received for trading or investment purpose, either for trading in crypto or for investing in the crypto. How much deposit company received, how much loan company received for that purpose. So that purpose also we have to give. These are all additional regulatory information, guys. These are all schedule 3 disclosures. You will understand only when you read full schedule 3. You will understand this ARI information relevance. Okay, this ARI right now whatever I discussed is an amendment act in Companies Act 2021 Amendment Act, where schedule 3 is massively amended in 2021, and that same time is only CARO 2020 was also implemented. So that time only ARI and all came into picture. That's it, guys. That's it, guys. With this, ARI is completed, guys. ARI. So additional regulatory information is completed. Now let's move to the P&L items audit. Once we complete P&L items audit, remember in items of financial statements the weightage is like ARI 4 marks question will come, P&L items a 4 marks question will come, balance sheet item 4 to 8 marks question can come. This is how generally questions can come in generally items of financials based on the past 10 years analysis I'm doing here. Getting it? So that's it. I hope you're confident until now. Thanks a lot. Everybody's appreciating. Really thanks a lot, because I wanted to make this session very counted. In your coming exam, you need to really perform well if a question comes from this particular chapter. So that's the reason. Okay. That's it. Just 2 minutes. It's so draining. It's actually because no morning I already took a class already 7:30 to 1:30 for CA final, one audit session. But again I'm taking a revision in life. This is very challenging basically. 2 minutes, guys. Yes, guys. Okay, we'll continue. P&L items audit, guys. P&L items audit. Within the P&L items, first I will discuss about other expenses. First I will discuss about other expenses audit in P&L. Okay. Now, generally tell me what are all other expenses include in a company. Very simple: power and fuel, rent, repairs, insurance, traveling, legal and professional expense, and miscellaneous. Sometimes a 4 marks question will come only on what are other expenses includes. Very rare. They won't test this easy question, but there is a chance that they can test this kind of questions. Okay. Now, yeah, I'm taking care of my health 100%. I maintain. Actually, once this session is over, I'll go for a gym actually. Okay, I'll do a minimum gym at least every day. Fine. So I really take care of my health, guys, because I work almost in a day 13, 14, 15 hours in a day. I work 6 months in a year. Another 6 months I work only 6 to 7 hours. I can say 5-6 hours only I work in a day for 6 months. For 6 months I work 14 to 15 hours. So right now I am in that 6 month slot where I generally work for 14 to 15 months. I started in October till May mid. My work is like this only, but it's okay. I'm habituated. So if you also have done like this, if you studied like this, I'm telling you all deserve all India ranks. Everybody can get all India rank, guys. The only thing is it's just attention and time that you're giving. Everyone is capable. The only thing required is your attention is required. If at all any of you have failed earlier, you failed only because you didn't give enough time to this. That's the only reason. Not that you're not smart. You're very good. You're very intellectual. You remember every movie. You remember cricket match. You remember everything that is happening around you, but you're not able to remember the books. Means you're not giving attention that it requires. That's it. Okay, fine. Anyhow, motivation next. First the content is most important. That's it. That's it. Now look at audit of other expenses. What we need to check, what other expenses includes, we saw. What auditor has to focus. This itself can be given as a 4 marks, guys. Many a times 4 or 5 marks question. When you are auditing other expenses, auditor has to analyze monthly trend for some expenses and vouchers for other expenses to verify the following attributes. The auditor analyzes monthly trend for some expenses, whereas for some other expenses I will verify the voucher. For some expenses we verify vouchers. For some expenses we verify monthly trend. So in a question can be given like this: monthly trend for some expenses, vouchers, other expenses, like this. A question will come. What auditor has to do? What auditor has to verify? You know, first to know, verify whether expense is pertaining to current period under audit. First point you should check is the other expenditure which the company is accounting, no, is it related to current period? First of all, is it belonging to current accounting period? Check out. See when the benefit of that expenditure is received. If the benefit is received in the current year, it's a current year expenditure. Second, whether is that expenditure qualified as revenue, because no, other expenditure means what? Other expenditure means P&L item. So if you're debiting in P&L, you should check whether is it really a revenue expenditure but not a capital expenditure. Third point, check supporting documents. Check supporting documents, guys. And an expense is classified under correct expense. See that this expenditure is classified under correct expense head. Sir, what is expense head, sir? Power and fuel is one expense head, rent is another expense head, repairs is another expense head, insurance, traveling, legal and professional fee, these are all expense head, guys. Whether this is classified as expense head or not, you need to check whether it is classified. And not only that, see that expenditure is authorized as per delegation of authority, authorized, and see that expenditure must be related to business and not for personal. If you observe, guys, most of these conditions, most of these points which they mentioned, 6 points they mentioned, right? These are mentioned under section 37 of income tax law also. See, under section 37, deductions you get only when it is related to business, only when it is a revenue but not capital, and only when it is belonging to the relevant previous year. So 3 conditions are common in 37. Same here also, I'm just telling you. So generally some expenses follow some monthly trend like rent, power, fuel. For that, no, we observe monthly trend. And not only that, for remaining expenses we verify the actual expenditure. What we verify in the actual expenditure? We verify is it belonging to current period, we verify it's a revenue and not a capital, we verify it's related to business, we verify whether that expenditure is authorized as per authorization matrix or not? Delegation of authority. Is the expenditure authorized as per delegation of authority in the company? Because in some companies, if the expenditure is more than 5 lakh, finance manager has to authorize. If the expenditure is more than 10 lakh, CEO have to approve it. Like the delegation authority matrix will be there. So as per that, it has to be authorized, and see that expense is classified under correct accounting head, correct expense head. See that proper documents are there. What is the proof that the expenditure is genuine? Look at the supporting documents like bills, tickets, insurance policy, all that. So this itself can be asked as a straight question, guys. Next, how to audit rent. Sometimes they'll ask you how to audit rent, how to audit power and fuel. These two they will ask. Sometimes they will ask you how to audit legal and professional, how to audit travel, repairs and printing and expenses. Either these two combination they'll ask, or these two combination they'll ask. This will be asked for 2 marks, this will be asked for 2 marks, total question is for 4 marks. Like this also they can ask, guys. Please be careful. Now look at rent. How do you verify rent, ma? How do you verify the rent? Very simple, sir. I will see month-wise rent schedule, and I will compare that with rent agreement. Tell me, a company are doing audit, they have one building, corporate office is there, that was taken on a rent. I will first take from the company month rent ledger account, rent schedule account I'll take, and I'll see whether rent is accounted for all 12 months or not, and see whether the rent amount they accounted, is it matching with the rental agreement or not. Simple. Look at, obtain month-wise expense schedule and rent agreements. Verify whether expense is recorded for all the 12 months and it is matching with agreement. See that rent is recorded for all 12 months and it should be matching with rental agreement. And I will see how much amount they need to pay as per rental agreement and how much they paid. Suppose rental agreement is last year drafted. Now this year they are paying rent same amount of rent. Why there is no increment? Generally, commercial buildings, whenever we are paying rent in second and third year, there will be some escalation, there will be some increment. Consider escalation clause for straight line recording, and verify agreement is in the name of the company and pertains to premises used for business operation. It must be ensured that rental agreement contains property address and that property must be used for business purpose. Then only it's a business expenditure. Am I right or not? So see, get a month-wise schedule and rent agreement. See that it is accounted for 12 months and see that the escalation clause is correctly mentioned. See that escalation clause is correctly considered and see that rental agreement is in the name of the company. And fifth point, see that premises is used for business purpose. That's it. Then another point, how to audit power and fuel. How to audit power and fuel. Very simple. Get again month-wise schedule and power bills. You see here, everywhere legal and professional fee, month-wise and consultant-wise summary. Yes or no? Everywhere month-wise is common point here. In all these three cases, obtain month-wise summary. In case of rent agreement. In case of fuel expenses, get power bill. In case of legal and professional, consultant-wise summary. Mr. X, one lawyer. Mr. Y, auditor. Mr. Z, internal auditor. Consultant-wise summary you should get. Month-wise you should get. Now check. Ensure expenses are recorded, power and fuel expenses are recorded for 12 months, and check, you have to compile how many units we consumed, what is the rate applicable for the electricity per unit, and verify accuracy in which power bill is calculated. Generally these points we do in olden days, now we don't do, but in exam you should write like this only. In exam we should write like this only, getting it? And we should analyze monthly trends by linking power units consumed to finished goods produced. Tell me, for example, we are doing audit of 25 to 26 financial year, Q1, Q2, Q3, Q4. Q1, April month, how much finished goods we produced, how much current bill, how much power bill is. In May, how many goods we produced, how much is the power bill. If in any particular month, goods produced were low, but power bill was very high, you need to inquire into it. So for that reason, we need to analyze monthly trend by linking how many units consumed to how many goods produced and investigate variations. If there is an unusual variation, we should investigate, guys. That's it. So this is regarding power and fuel. So first point, get month-wise schedule of power and fuel and get power bills, fuel bills. 2. See whether it is accounted 12 months or not. 3. Compile how many units we consumed, what is the rate per unit applicable, compute how much is the total power bill, compare with the bill to know whether it is accurately accounted or not. Next, analyze monthly trend by linking. See monthly trend, how much power units are consumed, see monthly trend of finished good produced. If there is a variation, investigate why there is a variation. That's it, guys. Okay, next. Legal and professional. Get month by schedule. April month, how much legal expenses we incurred. May, how much we incurred. June, how much we incurred. July, how much we incurred. Up to March, month wise breakup you get. Then you also get consultant wise. Sir, our company during the year consulted 5 lawyers, 2 chartered accountants, 7 persons were there. 7 persons, give me ledger based on these 7 people. Now for retainership agreements, verify 12 months. Sometimes no company will have an internal lawyer where 12 months these people will be working for us, entire 12 months. They are like an employee. Retainer fee, we call them as retainers, full-time retainers for the company. So for retainership agreements, verify 12 months of expenses. Next, for non-recurring expenses, vouch selected samples. What is non-recurring legal fee? Sir, we are paying a fee to a lawyer in Supreme Court, sir, just only 1 day session, sir. He is not our regular lawyer, sir, but for some special occasion we call. That's a non-recurring expenditure paid to a non-recurring lawyer. Okay, and see that all the attributes, vouch selected attributes. What attributes we need to select? We need to verify what attributes. We need to verify that it must belong to current period, it is a revenue, its supporting document is there, it should be accounted in correct expense head, it should be authorized, it should be for business purpose. These are all attributes that we need to test. We need to vouch various expenses to verify the following attributes. These are the attributes we test, guys. Clear? Next, be careful, because when you are checking legal expenses, you might get information about disputes, guys. You might get information about contingent liabilities, pending cases, litigations, where the company has to create provisions, and all these matters must be disclosed to auditors. You need to check. See, when you are checking legal expenses account, ledger of legal expenses, professional expenses, first see month wise and then consultant wise. Verify 12 months of expenses correctly counted. For non-recurring legal expenses, verify the attributes that I discussed here above. What are the attributes? Is it belonging to current period? Is it authorized or not? Is it in the name of the business or not? Is it revenue expenditure or not? Supporting bills and all. That's it. Now be careful when you are checking legal expenses. It might indicate a dispute that the company is involved in. So see that provisions are made and the matter is disclosed to the auditor. That's it, guys. Easy or not? Yeah, yes, only ARI, 5 marks question is highly probable. Somebody is asking only ARI, is the question probable? Yes, there is a high probability from ARI. An MCQ or a descriptive question might come. Next. But having said this, sometimes extremely rare scenarios, sometimes they may not test also, but I tried my level best, assuming that they are going to test. I tried my level best. Look at next, travel, repairs and printing and stationery. This is also one of the other expenditure, right? So select a sample of travel expenses, vouch for attribute discussed about. Select some sample of travel. Suppose some directors have traveled in June month and August month they travel. Take those expenses, verify attributes. What are the attributes? I told you, these are the attributes that we need to check. Verify various attributes. Yes or no? Prepare a monthly summary of analytical trend comparison. Prepare a monthly summary for analytical trend. So April month, how much travel expenditure? May, how much travel? June, how much travel? July, how much travel? In a particular month, why there is so much of travel expenditure? Investigate. Perform analytical procedure to check reasonableness. Last year, how much travel expenditure we spent? This year, how much travel expenditure we spent? Why there is a difference? Analytical procedure. So there are two analytical points. One, monthly summary you prepare and see the trend. Perform analytical procedure as to reasonableness. For example, how much is the travel expenditure per unit of production? Last year, how many units we produced and how much travel expenditure incurred? This year, how many units we produced, how much travel expenditure is incurred? Or last year travel expenditure as a percentage of turnover, this year travel expenditure as a percentage of turnover. You can analyze why there is a difference. You need to investigate. That's it, guys. That's it. And disclosure requirement, how other expenses we need to disclose: rent how much, insurance how much, power and fuel, repairs and maintenance, legal and professional, printing and stationery, traveling. This one very rare. This disclosure requirements can be tested as a 4 marks question. That's it, guys. Other expenses is over. In P&L, other expenses is over. Now the next item of the financial statement, is depreciation. Next item of the financial statement is depreciation. Just a minute, guys. I hope everyone, I think more than all, continuously 400 students are hooking. Very glad. I hope the session you are enjoying, you are learning something. We completed almost, how much time we completed till now? Oh, just 48 minutes. No, 1 hour 10 minutes. Sorry, 1 hour 10 minutes. But we did enough coverage, guys. No problem. Another 1.5 hour also I'm ready to go. I'm ready to go in the same flow. Yeah. So next, guys, we'll continue. Audit of depreciation and amortization. See, guys, this chapter, once we finish this revision session, right, 1 hour to 1.5 hours, you just calmly read. 99% I'm telling you, tomorrow any question come from this chapter, you will do really well, because that's the reason I'm repeating all important topics. I'm repeating. Okay, now from here I will go important points alone. Okay, now depreciation. Key attributes we need to verify. What are the key attributes that we need to verify in depreciation? First, we need to verify accounting policy. Then we need to verify whether the same accounting policy continued. Then we need to verify whether residual value considered or not. Then we need to verify, see that the depreciation calculation is accurate. Then we need to verify if there is a component in PPE, whether depreciation is correctly calculated of that component or not. So these are the attributes. Many a times, what are the key attributes? Auditors should consider the following key attributes while verifying depreciation and amortization. This was asked as a 5 marks question many times, guys. Depreciation key attributes was tested as a tested many times. Next, look at accounting policy. First, what we need to check in accounting policy? Understand what is accounting policy for depreciation and amortization. Ensure that the accounting policy is complying with the Accounting Companies Act and applicable accounting standard. First, understand what accounting policy the company is following, and see that the policy is matching in line with Companies Act. See that the policy is matching with accounting standard. 2 points relating to accounting policy. I hope you're clear. Next, consistency. Verify that the policy, the accounting policy for depreciation, is consistently applied every year. Sometimes changes can happen. Okay, who said change is prohibited? Change can happen. If there is a change, see that change is adequately accounted and disclosed. So policy related 4 points now. 1, understand what policy the company is following for depreciation and amortization. See that it is in compliance with the Companies Act and accounting standard. See that it is consistent from previous year. If there is a change, 4th point, if there is a change, see that the change has been properly accounted and disclosed. Over 4 points. Next, confirm depreciation is calculated only after adjusting residual value from the asset cost. Yes or no? We should remove asset cost minus residual value by number of years. That's the rate of arrival of depreciation. Am I right or not? That's it. And next, see that depreciation and amortization charges are valid. They're valid, they're accurate, they're recorded in appropriate period. See that depreciation amortization charges are valid, accurate, recorded in the appropriate period. So amortization charges are valid, accurate, and recorded in appropriate period. Then verify that each significant component of PPE is depreciated separately. Sometimes, no, within a property, plant and equipment, some major component will be there. That component might have a separate useful life compared to the mission. Then that component has to be depreciated separately. See that significant component of a property, plant and equipment is depreciated separately. And see that amortization charges, all depreciation amortization charges are valid, accurate, and recorded in correct accounting period. All the assets have to be depreciated. All the depreciation and amortization charge has to be accounted. Remember, depreciation is for PPE, amortization is for intangibles. I hope you're clear. Further, ensure most appropriate depreciation method is used for each separate depreciable component. Correct, right? Furniture, we take 10 years. Furniture, straight line method. Building, straight line method. Plant and machinery, WTV. Again, within the plant and machinery, some spares will be there. Some important component will be there. That might be depreciated as SLM method. Depending upon how the asset is being consumed by the entity, the method of depreciation accounting will vary. That's it, guys. Depreciation, key attributes to be verified is over. Now, what is the further we have to check whether depreciation is completely accounted. Further, we need to check depreciation is completely accounted. How we need to check? See that depreciation and amortization are correctly recorded with no understatement, no overstatement. We have to ensure that depreciation is recorded on all assets. For that, what auditor has to focus on? See, generally, opening assets, we provide depreciation. But what about current year purchases? Current year, some assets would have been sold. Obtain a list of additions and deletions with approvals from authorized personnel. In the year, any new asset purchased or any asset deleted. So get a list of additions and deletions with the proper approval mechanism. Then ensure that intangibles are properly amortized. Verify that depreciation is only from the date when the asset is ready for use, not from actual usage. This is called passive usage. Suppose we bought a generator and kept, we didn't switch on the generator, still we calculate depreciation because it was installed. Installation date is important for depreciation. Am I right or not? So installation date is important. Next, 8:30, guys. It will go up to 8:30 or 8:45. I don't know, I'm not sure. By 9 also it will go. I'm continuing with the full flow because I want tomorrow from this particular chapter you should secure 12 to 16 marks. So next, check depreciation on revalued amounts is properly accounted, and then it is amortized, it is debited to revaluation reserve. Suppose if at all there is an increased revaluation and earlier already revaluation has already been happened, if any depreciation related to revalued portion, we should adjust it from revaluation reserve, and ensure depreciation and income tax act align with companies act for additions, and opening WDB matches with tax audit schedule. There is no compulsion, guys. Under companies act depreciation, under income tax act depreciation can be different, yes or no? And most of the companies it is different, because under companies act, company follow depreciation rates as given under schedule 2, whereas income tax act they follow depreciation as per appendix 1 under income tax law. That's it, guys. Next, what are the disclosures relating to depreciation? Accounting policy, useful life of the asset, residual value, and depreciation method. 4 disclosures we should give. So what we need to give? Accounting policy, useful life of the asset as per schedule 2, residual value, and depreciation methods. That's it, guys. Main important point in depreciation I completed. Key attributes is very, very important. What are the points that you need to understand? Accounting policy, whether the policy is consistent, whether residual value considered, see the depreciation is calculated accurately, properly, validly, and see that each component of depreciation is computed separately, and see the depreciation method used is appropriate. That's it. And within the audit procedure, completeness is most important, guys. That's it. Clear until now? Next, HR, employee benefit expenses. In the employee benefit expenses, most important is what? Understanding entities hiring, appraisal, retirement process. This itself was asked as a 5 marks question many times, guys. So understand how the entity is hiring, how the entity is giving increments. Appraising means what? Evaluating employee performance and giving increment or decrement, either promoting him or demoting him. So anything can come as a part of appraisal, okay? And retirement, how a company will retire an employee. So when you're doing audit of employee benefit expenses, first you should understand, don't directly take salary expenses month wise and then start checking. What you will check? First understand how company hire people, how company give increments and decrements, promotions, all that, and how an employee retires from the company, how company settles them. First understand the process behind. Now here you have to test common internal controls over employee payment cycle. You need to test internal control system on employee payment cycle. What do you mean by internal control system for employee payment cycle? There must be attendance record, and you must keep an up-to-date employee master. Employee master means what? It's list of employees, employee master means whenever a new employee join, we have an employee master, means list of all the employees joined in this organization, date of joining, who is the employee, his Aadhaar number, his PAN number, his date of birth, his age, everything will be recorded. That's called employee master. So first, company has to maintain attendance record. Second, company has to always keep an up-to-date employee master. And there must be authorization and approval for payroll processing and disbursement. Remember, payroll means what? Every month company has to pay salary to the employee, right? That monthly process is called as payroll process. Next, accurate computation of payroll deductions. Now tell me, 1 month employee has to pay, we have to pay for one employee 1 lakh salary, but actually 1 lakh salary we won't pay him. In that month 12,000 provident fund deduction is there, 10,000 TDS deduction is there, so we will pay only 78,000 into his bank account. So maybe the employee corporate package is 1 lakh per month, but take home salary is 78,000 because deductions apply, ESI, provident fund, TDS, all deductions apply. And see whether company has created provision for gratuity, leave encashment, and bonus. These are the points that we need to test with respect to internal controls. See that company have certain common internal controls over payment cycle, controls over attendance record, controls over employee master, controls over authorization and approval of payroll process, control on payroll deduction, control on accounting of retirement benefits like leave encashment, gratuity, and bonuses. So on all these controls must be there. And auditor, as an auditor, what you should do? As an auditor, you should test these controls. To determine effectiveness. You should test these controls, whether these controls are effective. Attendance record, company taking attendance regularly, correctly or not. Yes or no? If controls are effective, you can reduce substantive testing. This is a general concept point which every one of you would have already aware of. That's it, guys. Next, further, You need to take some sample employees. Suppose Reliance, no, Reliance has 5 lakh employees. Take some sample 100 employees. What you check? For 100 employees, no, I will check appointment letter. I will check promotion appraisal letters. I will check their attendance record. I will check a HR policy. I will also check whether his name is there in the employee master or not. So I will randomly select some employees, examine related documents. What is his appointment letter, appraisal, attendance, HR policy, employee master. So all these points I will check whether to that employee, as per appointment letter, whatever salary we promised, are we paying it or not. Suppose we are paying extra amount, then I will say appraisal letter, increment letter, promotion letter, I will cross verify. That's it, guys. Now, substantive, I will perform monthly analytical procedure. Analytical, monthly expense reasonability. April month, total employee cost of the company, how much? May month, total employee cost, how much? June month, total employee cost. I will see whether it is reasonable or not. And in each month, I will see sales comparison also. Look at, compare with previous year. Set an expectation of expense based on entities, operations and industry trends. Sir, company, last year 1000 employees were there throughout the year average, and company turnover is 10 crore. Now the company has 2000 employees. Why the company turnover is still 15 crore? Why the company turnover does not double? We need to ask for reason. This is what analytical procedure impact. Next, somebody is asking, I told at the beginning itself 2 to 2.5 hours it will take for me to finish. Okay, that's it. Then next one, audit procedure, guys. Audit procedure. So recorded employee benefit expense was actually incurred. Actually, here completeness is most important. In employee benefit expenses, completeness is most important. First, get a list of employees at the period end, split by how many were newly hired, how many left the company, how many are continuing. So list of employees as on 31st March, get a list of total number of employees during the year, which includes newly joined, deleted, and those who are continuing. For new hires, for company, for those who newly recruited in that year, verify appointment letter, salary processing as per agreed terms with the appointment letter. For resigned employees, see that food and file and settlement like gratuity, leave encashment, everything is properly, paid him. And check that all the provisions have been made accurately for continuing employees. Those who are continuing, right, for them gratuity provision, leave encashment provision, bonus related provision, everything has to be clearly made. That's it, guys. So this is regarding completeness audit. Then that is employee benefit expenses, guys. Then we have purchases. Wow, purchases. Now before purchases, first let me discuss, okay, purchases will continue. Purchases, how to do audit of purchases. In purchases, many students blindly directly go to audit procedure, occurrence, completeness, cutoff testing, analytical. In purchases, no doubt analytical is very important. Okay, I'll come back to this. But more than this, even more important is what, introduction to purchases. Many times, first, this itself can be asked as a 5 marks question. Controls over purchases, a 5 marks question can come. Common controls over purchase cycle, a 5 marks question can come. Any of these three. And in that, another one is special considerations in occurrence of purchases, a 5 marks question can come. Or analytical procedures related to purchases, a 4 marks question. These are all the probable possible questions, guys. Yes. Somebody is asking, sir, will this video be there on the YouTube even after the live is over? Absolutely, guys, it will be there. Okay, next, analytical procedure. Look at now, look at first, introduction to purchases. First, you want to do audit of purchases, first understand the organization and where and all production is happening. Don't directly jump into audit of purchases. First understand the company. Like what you need to understand, what type of products the company is producing, what types of companies the company is procuring, nothing but. First, what are they procuring, what they are purchasing. Domestica, overseas, are they buying locally, are they importing it. Terms and conditions of the purchase. Look at the terms and conditions with suppliers. Who are the major suppliers for the company? For every company, suppliers will be very limited. Okay, and how much credit period company gets, and is the company performing quality checks or not, and what are the purchase terms, are they purchasing in cash or are they purchasing in credit. So auditor obtains knowledge about production centers and purchases. You need to get an understanding of what is the company production center, and you need to understand how the company purchases. Understanding purchases means what? Understanding what products and services the company is procuring, from where they are procuring locally, what are the terms, who are the vendors, quality, credit period, and are they purchasing in cash or credit. That's it, easy. Next, then auditor has to look at controls over purchase point. Controls over purchases, guys. Auditor identifies control points over purchases. Control points means what? Segregation of duty. Purchase order will be placed by purchase department. Goods will be received by stores department. Accounting will be done by accounts department. Payment will be made by finance department in a company. In a very big listed company, only one transaction, purchase, but that transaction is executed by multiple people. That's called segregation of duty, separation of duty. And so there will be segregation of duty. There will be quotes, competitive quotes, tendering process they follow, and there will be some purchase committee, nothing but purchase department will be there, and somebody has to authorize the purchase price and place an order. Then GRN will be there, and quality and quantity check will be there with GRN. And vendor invoice, once GRN, see, we place purchase order, right? We place 1000 units at 100 rupees. Then goods received note, we need to prepare 1000 units. If the goods are received 1000, then mention 1000. And invoice also you check. In the invoice, 1000 units only must be there, 100 rupees only must be there. If at all in the invoice price has been changed, we will not approve it. We will not approve. So vendor, the third party would have sent you an invoice, right? Once the goods are delivered to you, that invoice has to be approved. And two-way match or three-way match, guys. What is a two-way match and three-way match? Purchase order, 1000 units be ordered, sir. Goods received, 1000 units be received, sir. Vendor also billed 1000 units only, sir. And how many be ordered? 100 rupees, sir. Goods received also 100 rupees, sir. Invoice, vendor invoice also 100. So this matching is called three-way matching. Are you clear? And now actually four-way matching also being done, e-way bill. Today they are doing four-way match also, but in exam you just have to write two-way match or three-way match. Two-way matching means what? Purchase order and invoice. Three-way matching means what? Purchase order, GRN. Both are our internal evidences, whereas vendor invoice, external evidence, because third party is giving it. That's it. Next, then auditor has to test purchase control cycle for its effectiveness. So if the controls are effective, it reduces substantive check. Like what is controls over purchase cycle? See whether there is a competitive quotes, whether purchase order numbering is there, whether purchase order authorization over certain limit is there, generation of GRN, quality inspection, two-way match, three-way match, invoice authorization. You know what? Now in exam they can ask you either controls over purchase cycle, or they can ask you control points over purchases. Anything they can ask you. And you know what is a hack? The hack is you write controls over purchase point is there, right? You write the same answer, add one more point here, numbered purchase orders. Numbered purchase orders, here no H is there, right? G one more point you add, whether purchase orders are serially numbered, just mention that, whether purchase orders are serially numbered, add that point alone. So whether they are asking purchase cycle question, whether they are asking control points over purchases, you write the same 8 points, your answer will be corrected, you will get the marks. That's it. This is the hack. That's it. Next, then again there are some special considerations to check whether purchases really occurred or not. Suppose company recorded purchases, is it really occurred? How do I know that really occurred? I will verify. See that I will compare purchase invoices with original copies, and I will see whether company recording purchase only when the risk and reward is transferred, means only when the company took the delivery, only then purchase has to be recorded. Then invoice should be in the name of the company, yes or no? And see that input tax has been booked in separate ledger, ITC ledger, and confirm related party purchases are at arm's length price. See that the related party transactions are happening at arm's length price, and see that if whether these purchases are capitalized or expensed based on professional judgment. Suppose we are purchasing machinery, we should capitalize. If at all we are purchasing machinery, we should capitalize. If at all it's a revenue expenditure, we should charge it to P&L. And journal entries, no, check journal entries. Is there any unusual purchase amount? So identify exceptional purchase transactions. That's it. Then we need to check analytical. Many times this was tested, guys. Analytical. Perform analytical procedure for reasonableness of purchase quantity and price. Perform analytical procedure for reasonableness of purchase quantity and procedure. Analytical. What we need to? Consumption analysis. Compare raw material consumption with previous year and ask management for variation. How much raw material we consumed this year? How much raw material we consumed last year? Why this year there is a huge consumption? Ask. Compare stock composition with prior period. What is stock composition? Last year raw material how much? Last year raw material how much? Last year work in progress how much? Last year finished goods. Composition, stock composition. Last year 30% raw material, 40% work in progress, 30% finished good. This year 2020 60 is there like this. So composition we should compare. Then compare credit turnover ratios and stock turnover ratio with the prior period. Compare credit turnover ratio with the prior period, and reconcile closing stock with opening stock, purchases and consumptions. Reconcile closing stock, opening stock and purchases, all that. In exam they can ask you direct question. While conducting audit of purchases, one of the important procedure is analytical procedure. What are all analytical procedure that we need to perform? 1. Stock consumption analysis. How much inventory is consumed, raw material compared to last year. 2. Stock composition analysis. What is the stock composition within the total closing stock available? How much is the raw material? How much is the finished good? Like that. Stock composition analysis. And then I will compare credit turnover ratio and creditor turnover ratio and stock turnover ratio. I will do reconciliation with opening stock, purchases, consumption. I will reconcile closing stock to reconcile the closing stock with opening stock, purchases and sales. So whether closing stock is correctly arrived or not. Remember, these 3 items are interlinked, guys. These 3 items, purchases, sales, inventory, these 3 items are interlinked, guys. Analytical procedure point will be sometimes similar. That's it. Next. So this is regarding purchases, guys. Important point I have covered. Next, guys. Next I will go with incomes. How to do audit of incomes. How to do audit of incomes. Now first of all, what is income? Other income means what? Any income not related to entity's core business operations. Any income not related to entity. For example, Reliance Industries Limited is there. They are crude oil refinery. For them, they are getting interest and dividend income. That interest and dividend income comes under other income because that is not from the company core operations. That's it. Now, for example, interest on FD, interest on loans given to third parties, returns on mutual fund investments, dividends on investments. These are all other incomes. Yes or no? Now, how a company will recognize the dividend here? A dividend is recognized only when the entity right to receive payment is established. First condition, right to receive payment is established, and probable that economic benefit will flow to the entity. Only when that benefit will come to the entity, means company only will collect it, and the amount is reliably measurable. Remember, this can be tested as an MCQ. So what is the recognition principle for dividend? Dividends are recognized in P&L only when right to receive the payment is established. When a right to receive is established? When the company declared it. When the other company declared the dividend, then only we have a right to receive. And see that the benefit will probably flow to the entity. Means as on the time when the amount is being credited, we will only be receiving. See whether that point is there or not. And see that the amount of dividend is measured reliably. That is one more important point. Next, guys. Next, further, mutual funds, no, sale or profit or loss will be there, right, on mutual fund transaction or investment purchase and sale. See that it is recorded as other income upon transfer of title. Not only mutual funds here, not only mutual fund, even investments. If a company buy and sell shares, investments, any profit or loss is there, we will route it through other income only. And how the loss or gain is determined? It is a difference between redemption price and carrying value. Redemption price is nothing but selling price, man. So selling price and carrying value in the books, if there is a difference, the difference is either a profit or the difference is either a loss. That's it. Now, what is the audit procedure? In this, occurrence alone is required. In this, occurrence alone is required. Guys, whatever topic I'm revising, only that you touch later on. Only that you revise later on also. Now, occurrence. See that recorded other income was earned during the period. For example, if it is an interest on fixed deposit, how we will verify? First, I will get a list of FDs. I'll ask companies, sir, what are all the FDs that the company is having with various banks and FIs? What are the recurring deposits the company is having with various banks and FIs? I will get a list of FDs. What is the rate of interest applicable, and how many days it was outstanding? When we deposited as on 31st March, what is the days? And verify calculation of interest by recomputation. Company has already calculated interest and accounted as other income. I will check, I will recompute the interest calculation. I will see outstanding deposits at balance sheet date and get direct confirmation from bank as on 31st March. In the current assets, I will go and see cash and cash equivalents. I will see fixed deposits, and I will go and get a confirmation with the banker directly. Sir, in our company, these many deposits were shown. In the bank, is this deposit there or not, really genuine or not? I am getting evidence on occurrence, guys. Occurrence means what? Company showed interest income on deposits. Interest, fixed deposit interest. Is it really occurred? How do I know whether it's really occurred? You saw company balance sheet, company bank account. Go and ask banker. Direct confirmation from the banker. Next, reconcile interest income with bank confirmation from form 26As. Reconcile reconcile bank confirmation interest income from form 26AS. Form 26AS is nothing but TDS related details will be there in our company login ID. Our company will have a PAN number, right? Log into the company income tax portal. Form 26AS will be there. In that, how much interest as per banks company got. This form 26AS information will contain incomes details of the companies. These details were given by banks and finance institutions. That details will be there. That's it. Then for dividends, verify recognition in P&L is only when the company right to receive payment is established. How do you verify profit or loss on mutual funds? See that the mutual fund investment profit or loss on sale is recorded only on actual transfer, and the difference between redemption price and carrying value will only be recorded as either profit or loss. And verify mutual fund statement, nothing but demat statement. The company will have a demat account, right? Verify demat account. You will understand whether there is a gain or loss on the company. That's it, guys. Disclosure requirements. How disclosure? Other incomes have to be disclosed as 4 points. How much is interest income? How much is dividend income? How much is the net gain or loss on sale of investments, and any other non-operating income? Net of direct expense. Net amount only you should show. Here also net. For example, company sold 2 investments at a profit of 10,000. Another 3 investments at a loss of 20,000. So net is minus 10,000 loss. So net amount only we should show in the other income, guys. Net amount of gain or loss on sale of investments. Same way, remaining any other non-operating income, net amount only we should show. Net of direct expense we should show. That's it. So these are the disclosure requirements for other incomes, guys. Next, audit of sales. Once we complete this, P&L items is over. Once we complete this, P&L items is over. Then the leftover portion will be balance sheet items. In balance sheet items, inventory, trade payable, trade receivable, and then cash and cash equivalents, PPE, intangibles. Once it is discussed, over. This particular revision session will be over. I hope you thoroughly enjoyed. Until now, just reply me. Are you all clear until now? You can comment saying I am in flow, or you can simply say flow, in flow. I am in flow, sir. You can say flow. I hope you are super confident, or you can reply confident. You can reply. You can comment below that you are confident. Yeah. Yeah. Thank you. That's it, guys. Now sales. Just like purchases, we saw now we should first understand what is the entity, purchase, process, production center. Sales also we should understand similar thing. First we should understand what are the sales and recollection cycle. First we should understand this. Understanding the organization, this is most important. First, whenever we are doing audit of sales, we should first understand sales or understanding of the organization. Like auditor must obtain knowledge about business and revenue center. There it is. There in purchases, no, purchases and production centers. Here it is revenue and business and revenue centers. Like what products company is selling, what is the demand for these products, what are the major products for the company, major customers for the company. Is the company discontinued any product during the year? Check out. And sales terms and conditions. We should also check for sales terms and conditions. Just a minute, guys. Sales terms and conditions also you should check. Then we should understand what are the management controls on the sales. So what are the understand management controls over sales. In exam they can ask you this itself as a 5 marks question. Or understanding the organization, knowledge about the business and revenue centers. This point if they ask 5 marks question. They can ask a control point on 5 marks question, or common controls as a 5 marks question. But when they're asking 3 and 4, either understanding of controls on sales they ask, or common controls on sales, anything they ask. Okay, you need to write like this. Somebody is asking, sir, 10 minutes break before balance sheet. Yes, before balance sheet audit, after I finish sales, I will give break. May not be for you, but for me I need a break. So 10 to 15 minutes we'll take a break and then continue with balance sheet items. Now look at, so auditor examines management controls over sales process, such as same sales also segregation of duty will be there. Segregation of duty will be there, just like purchases. You know, authorization, whenever customer ordered us, we won't directly deliver, we need to authorize the sale order, then we need to issue the invoice, then we need to deliver the goods, then we need to recognize the sale in the books of accounts, and if at all it's a credit sale, somebody in the company has to authorize the credit limit, guys. That's it. Then apart from that, there are some common controls. Auditor test controls to assess the strength and reliability. If controls are strong, substantive testing can be reduced. Deficiencies in controls must be reported. Remember, when you are checking internal controls, if any deficiencies you identify, the deficiencies you have to communicate to top management and management as per SA 265. Then common internal controls. What are common internal controls over sales? See that sale invoices are pre-numbered. See that sale orders must be approved. Customer purchase order authorization, authorizations for write-offs. You know, here you write, you know, write-offs are authorized. Just one point, write-offs are authorized. And see that invoices are pre-numbered. Invoices are pre-numbered. That's it. So whether they ask common control point, on sales, or whether they ask management understanding controls over sales, both are same. Okay, segregation of duty must be there. Who check credit limit? You know, like invoices are pre-numbered, yes or no? Authorizations, write-offs are authorized, issuing of invoices, delivery of goods, recognition of sale. And see, you need to check these controls. Why? If the controls are strong, you can reduce substantive testing. If there are any deficiencies you identify, you should report it to the top management as per SA 265. So that's it. This is regarding sales. Next, in the sales audit, first we'll see disclosure. Very rare disclosure can ask, but sometimes disclosure can be asked. You need to, for non-finance companies, MCQ can come. A disclosure requirement can be tested in the form of MCQ. For non-finance company, how sales has to be disclosed, how much is from products, how much is from service, how much amount is received as a grant or donation, and how much is any other operating revenue. Whereas for finance companies, the revenue is disclosed as interest how much and other financial services how much. That's it. Then occurrence. How do you check whether sale really occurred or not? How the sale is really occurred or not? Means whatever sale recorded in the books, is it really happened or not? How do you check? So see that sales which is recorded in books is not overstated. Not overstated means that there should not overstated means what? It should not be a dummy sale. Like, what do you mean by that? See that sales invoices are not duplicated, and cancelled invoices should not be recorded. A cancelled sale should not be recorded. And see the journal entries. Get customer confirmation for sales. If at all you are having a doubt, get third party confirmation. Ensure no fictitious customer related sales are recorded. There are no fictitious sales are recorded. And see that shipments, means deliveries, were authorized by customers. See that we deliver goods, right? We should receive delivery confirmation from customer. And whether unearned revenue is recognized. Unearned revenue means what? Nothing but we didn't deliver the goods. But we recognized this. Whether significant threat about uncollectability is there. See whether collections, is there a certainty on the collections. Review invoice sequence and sales returns ratio. Invoice sequences we need to, most important. Invoice sequence means what? Invoice number 1, 2, 3, 4, 5, 6. That sequence has to be continuing. If there is any missing invoice number, why it is missing? Is it a cancelled sale or what exactly it is? And you should also see sales return ratio. This year sales returns to sales, how much is the ratio? Last year sales returns to sales, how much is the ratio? And see journal entries for unusual sales. See, is there any sale transaction where suddenly huge amount is there? Look at, match sales returns with supporting documents. If there are any sales return, is it genuinely a sale return or what exactly? You see, sometimes generally what happens is March ending, suddenly we show high sales. In April month, sale return will be there. That's a proof that that's a dummy sale probably. So that's it. So that is what completeness. All sales made during the year, they must be recorded without understatement, without overstatement. You should perform cutoff procedure to ensure revenue is recognized in the correct accounting period. Cutoff means what? Cutoff errors will usually arise when companies recognize revenue based on invoice date rather than delivery. Tell me, in accounting standard also, when you should recognize a sale transaction only when you deliver the goods, only when the risk and reward is transferred, not based on invoice date. Am I right? So cutoff errors will generally come in a company. Cutoff errors will come if the company is recording sale based on invoice date, not based on delivery date. That's why in those companies, when you're doing audit, you should be very careful. Sir, last 1 week March month, no invoice you give me. When the goods were actually delivered, check out. Only delivery date must be the basis for recording the sale. That's it. Verify credit notes issued after year-end to know potential fictitious sale. Very simple, guys. Sometimes no, March last week sale we will record, April first week sale return will show, but for this year profit is already overstated. So check whether is there any sales written in the next month first week. If so, see whether it's a fictitious sale or is it a genuine sale written. Check out. Trace shipping documents or sale journal entries. Check if quantity appears in the sales register. Reconcile stock records and financial records. You know, here something we should really blame ICAI. What? This and all is old method. The same matter is there when I am studying. Now it is completely online. Companies are accounting sales online. Transactions are online. There is happening. Companies are using enterprise SAP software. ERP software are using. Do you think all this shipping document, sales register, all this is there now? Unfortunate thing. Sometimes we need to study outdated syllabus. Sometimes. ICAI has updated the syllabus a lot. Now they need to update this chapter. Technically speaking, many points in this chapter were very outdated. Fine. That's it, guys. This is related to sale. Now, substantive analytical procedures on sales, guys. Auditor will perform sales trend analysis, month-wise trend, year-to-year trend analysis. I will compare with prior period. I will also do category-wise. Suppose company is dealing with 5 products. All the product-wise analysis I'll do. Last year 5 products were there. How much is the sale in the last year? And this year how much is the sale? And I will develop a sales expectation to compare with client record. This year I will develop how much is the sales that is going to happen at the beginning of the audit. And once series are completed, I will see how much sale actually made. Examine sales prices, average monthly price and discount policies. So substantive analytical, a 5 marks question also can come, a 4 marks question. So write about substantive analytical procedures over sales. First, sales trend analysis, comparison with prior period, category wise sales, build a sales expectation, compare with actual sales records, and see that verified discount policy of the company, what is the average monthly price and what is the sales price. That's it, guys. So this is regarding sales audit. With this, P&L items is also completed. Guys, we completed one more element, P&L items, regulatory information, both we completed. Then we are having balance sheet items. Till now 1 hour 45 minutes non-stop without interruption we discussed, and very good that more than 350 students are in live throughout this 1 hour 45 minutes. Really good for your dedication. That's it. We'll just take 10 to 15 minutes gap and then continue balance sheet item. Another 1 hour it will take balance sheet item. I thought of finishing within 2 hours, but I don't want to discuss rapidly and finish it off. I just wanted to really add value to you. And guys, trust me, we are going to rock balance sheet items just like how we rocked P&L and additional regulatory information. I hope your confidence is increasing, and I'll be very happy if you say some appreciation and like the video. Don't miss to like the video. That's it. Just 10 to 15 minutes. We'll come back and then continue. Right now it is right now it is 8:17, guys. We will resume the session by 8:30, 8:32. Okay, we'll resume the session by 8:32. That's it, guys. 15 minutes. Just relax, take a breath and come back. Another 1 hour non-stop. By 9:30 we will finish items of financial statements topic, guys. That's it. Okay, that's it. How do you remember? Some student is asking, sir, I'm understanding everything, how to remember? After we finish the session today night itself, 1 hour to 1.5 hours or 2 hours, just read and try to understand. From here on I will also tell you how to remember these points. See honestly, there is no technique on how to remember. Honest, I'm telling you, there is no technique on how to remember. You read, understand and try to sync, you remember better. In fact, ARI and P&L items is to some extent easy. Balance sheet items remembering is even more difficult, but I will tell you a technique in the balance sheet items. Logic I will tell you more clearly. That's it, guys. Okay, yeah, fine, guys. Okay, just we'll continue after 15 minutes, guys. Yes, guys, let's continue. Let's continue, guys. Yes, let's continue the balance sheet items. Okay, I hope I'm audible. Perfect. I just had some fruits and then coconut water and then returned. So we'll go to the balance sheet items, guys. First, quickly let us finish one after one. You will see a remarkable learning now with respect to balance sheet. Yes. Now, see what we need to verify here. In items of financial statements, what exactly we need to verify is basically assertions. Assertions we need to verify. And I request you to watch my assertions video. I have previously uploaded one topic called audit evidence revision also there. In that revision, a 500 series discussion is there, right? In that assertions topic I covered. Just watch that, okay? So I hope you have watched it. Now, for P&L, income statement. For income statement, what assertions we verify generally? We verify for P&L account, occurrence, completeness, cutoff, measurement, presentation and disclosure. 5 assertions we focus on. Occurrence. Occurrence means what? Did the transaction really occur? Is the transaction really occurred? And is it something related to the entity that we are auditing? So is the transaction really occurred and related to entity? That's it. For example, see that employee benefit expenses incurred during the period, is only for the staff personnel employed and exclude unauthorized personnel. Occurrence focuses on real expenditure. Its objective is to ensure there is no overstatement. The objective is no overstatement. For example, sales. How to test in sales occurrence? See that sales represent goods actually ordered or delivered by the company, and it is dispatched and invoiced during the period. It is not a fictitious one, it's a real one. So this is what occurrence assertion focuses on. Then completeness. Completeness focuses on all. See that all employee benefit expenses accounted for every employee, all the employees. See that all genuine sales are recorded. Completeness focuses on, is there any understatement? Completeness focuses on, is there any understatement? Nothing. But completeness focuses on, did the company miss to account any sale? That did the company miss to account any employee benefit expense? That is what focused on completeness assertion, guys. Then cutoff focuses on right accounting period. See that P&L items, transactions are accounted in the correct accounting period. For example, see that employee benefit expenses, whatever they accounted in the P&L, it is related to current period only, and sales include dispatches made at year end belonging to relevant period or not. Then measurement. Just a minute. Sorry. So measurement. See that transactions are recorded accurately. At what price you are recording, that is measurement. For example, employee benefit expenses are calculated correctly, deductions are correctly accounted, all that. And see that sales are recorded at correct invoice amount. That's called measurement. Presentation. Transactions are classified, presented fairly in the financial statements, which are complete and accurate. So for employee benefit expenses, see that everything is correctly disclosed without omission. Additional employee benefit expenses, we should show salary, ESOP and then welfare expense, all that. For non-finance companies, employee revenue from operations has to be disclosed as products, grants, donations, other operating, less excise duty, like that. That's it, guys. So this is a brief introduction to assertions concept. Now, what assertions we should test in balance sheet? Now let's begin balance sheet. What assertions? For balance sheet items, assets and liabilities, we should check, is the asset existing? Is the asset existing? Is the asset owned by us, rights and obligation? Is the asset valued correctly? All the assets are accounted correctly? And cutoff. Basically, cutoff is an item which is generally coming for P&L items, but very rarely cutoff we will use for balance sheet items, especially for inventory. Cutoff is very popular for inventory, guys. Okay. Now, so existence means what? Suppose in the balance sheet there is an inventory 10 crore is there. What is that trying to tell me? As on 31st March, 10 crore worth of inventory is physically there, existence. And it is also trying to tell me total inventory value is 10 crore, completeness. It is also telling me this is the inventory that is physically there in the godown as on 31st March, within the control of the company as on 31st March, cutoff. It is also telling me that this 10 crore is the value of the inventory which is valued at cost or NRV, whichever is lower. This is what it is asserting me, yes or no? So with respect to balance sheet item, what assertions we need to test? See that asset is in existing, see that all the assets are accounted, see that assets are accounted in the correct accounting period, see that the assets are valued properly, and see right. Asset is a right, liability is an obligation. Remember, asset we call it as right, liability is an obligation. For liability, the assertion name is obligation. For asset, the assertion name is right. Okay, then obviously see that presentation and disclosure, see that the assets are properly classified, described and disclosed, and disclosures are complete and accurate. For example, inventory, we show them as raw material, work in progress, finished goods, stock in trade, stores and spares, and loose tools. We will have to show goods in transit separately. Mode of valuation must be stated. Goods with third party also we should show separately. That's it, guys. Now the actual balance sheet item, here in balance sheet, no, let me discuss in important order point of view. By the way, guys, until now we finished additional regulatory information, P&L items, thoroughly we understood, right? Items of financial statements weightage is what? 12 to 16 marks. From ARI, from P&L, 8 marks weightage will come. Now we are going to discuss another 4 to 8 marks worth of portion. If it is assuming 16 marks, then 8 marks worth of portion we are going to discuss right now. Okay, in this balance sheet items, I will only go by my instinct. What I feel important, I will cover. Okay, so whether you're writing May 26 attempt or Jan 26 or September 26 or Jan 27, this particular important items, whatever I'm going to tell is really important. Okay, now look at equity. If you ask me, nothing is important in equity. Okay, share capital, just 1 minute, guys. Yeah, fine, let's continue. Some fruit seed I had, no, so it's irritating in the teeth. Okay, fine, now I removed it. Fine, next, disclosure of share capital. So what we need to disclose in a company share capital? So what we need to disclose for each class of share? For example, a company might issue multiple class of shares. See, for listed companies there is only one class of equity shares generally, but there is a possibility of multiple classes. For each class of share, how many number of shares were authorized, how many were issued and subscribed and fully paid up? So authorized, issued, subscribed, paid up details, face value, and what is the opening shares and closing shares, reconciliation of opening number of shares and closing number of shares, what are the rights to the shares, preferences for those shareholders, what are the restrictions on each class, rights, preferences, restrictions on each class, and we should give key shareholders list. Any shares held by shareholder having more than 5% face value, sorry, more than 5% of the total company paid up capital, that we need to give. And shares reserved for options, contracts, disinvestments, that we need to give. For the last 5 years, another important disclosure, the company in the last 5 years, in every balance sheet notes to accounts, in the last 5 years, is there any bonus shares, fully paid shares issued without payment in cash, any shares issued as bonus shares, any shares bought back? Now here, without payment in cash means non-monetary consideration. Are there any shares issued by the company for non-monetary consideration in the past 5 years? Are there any shares issued at free of cost, bonus shares? Are there any shares bought back? These 3 details a company has to give. Sometimes in exam they may ask you, in the last 5 years, shareholders, shares related information, something has to be given by the company. What is that? Shares issued for non-monetary consideration in the last 5 years, shares bought back in the last 5 years, bonus shares issued in the last 5 years. Company has to give that disclosure. Then again, a company shall disclose shareholding of promoters, like shares held by promoter at the year end and percentage change. Who is the promoter, how many shares is holding, and how much percentage of total shares is holding, that we should give. And if funds from issue or remain unutilized, suppose a company raises some money, preferential allotment, private placement, IPO, FPO, if any unused money is there, disclosure has to be given on unutilized amount. Remember, this disclosure will come only in standalone financial statements. It will not come in consolidated financial statement, guys. This is the most important disclosure, most important discussion in share capital. In share capital, if you ask me what is important, is disclosure is very important. Rest all other you can easily manage, guys. Okay, now one more important thing which my concern says is valuation of equity. Okay, if shares are issued at premium, see that the premium is recognized in securities premium account. And remember, premium can be used only for certain purposes, like for securities premium can be used to issue fully paid bonus shares, writing of preliminary expenses, redemption premium, premium to be used, premium on redemption, and writing of discount on issue of gold, and for buybacks. The securities premium can be used only for these 5 purposes. See that the securities premium utilization is only for these purposes. Then again, shares issued at discount. Generally, a company is not permitted to issue a discount, am I right? Except sweat equity shares, yes or no? Further, auditor should verify, is the company issued any shares at discount to its creditors as a part of debt restructuring scheme or a statute resolution plan? Check out. If there is such kind of scheme, then no problem. That's it. That's it. That's it, guys. Share capital point is completely done. Then reserves and surplus, guys. Reserves and surplus. Sometimes in exam they can ask you reserves, meaning they can ask you what is a reserve. Reserves are nothing but these are the amounts which are taken from P&L profit. From the profit, no, we allocate some amount for some purpose. That we call it as what? A reserve. Reserve is an appropriation out of profits which is not for the purpose of liability, not for contingency, not for commitment, not for diminution in value. These are not reserves, guys. These are all provisions, guys. Reserves are something which is an appropriation out of P&L for some specific purpose. That purpose is not a liability, not a contingency, not a commitment, not a diminution in value of the asset. Other than this, anything else is called as reserve. Are you clear? Next, what is the purpose of reserve? Reserves are again 2 types: revenue reserve and capital reserve. Revenue reserve and capital reserve. Revenue reserve is available for distribution or purposes like supplementing profit in lean years, financing business expansion, augmenting working capital, strengthening financial. These are also called as free reserves, guys. Capital reserve, like capital redemption reserve, debenture redemption reserve, revaluation reserve, these are all capital reserves, guys. These are not available for distribution. These are used only for specific limited purpose, like securities premium is a capital reserve. Capital redemption reserve is also a capital reserve. Yes or no? Now, if revenue profits are appropriated for asset replacement purpose, then that reserve is also called as capital reserve. That's it. Now, in this entire thing, disclosure requirement, guys. Disclosure for equity and reserves and surplus. Disclosure requirement is most important. Now, how should we disclose reserves and surplus? No, we should classify as below. As per schedule 3, reserves and surplus has to be shown as below. How much is capital? How much is CRR? Capital reserve is how much? Capital redemption reserve how much? Securities premium how much? Debenture redemption reserve how much? Revaluation reserve how much? And share options outstanding how much? And any other reserve, dividend equalization reserve, like that, any other reserve. Okay, special economic zone reinvestment reserve, foreign currency fluctuation reserve, like that. So many reserves were there. Suppose in P&L debit balance is there, it must be shown as a negative figure only under surplus. Remember, you know, when you're showing reserves, no, you must show surplus separately. Surplus means what? A balance in the P&L account, you know, should disclose. So balance in the P&L after appropriations and all, whatever balance left, no, that's called surplus. Example, this surplus can be used for dividends, bonus shares, or transfer to, for, or from reserves. That's it. So this is regarding reserves, guys. Okay, now let's continue discussing about borrowings. In borrowings is most important, many times tested borrowings. Okay, so borrowings, no, what we need to check, every point is important. In borrowing, every point is important. First, how do you verify whether a borrowing is existing? Suppose company had a loans, how do you verify? First, ask the company what are the loans the company borrowed. Get a confirmation from the banker. Download borrowing loans and agreements, loans and borrowings agreements will be there. Look at those agreements. All this will give you evidence on existence of borrowing. Yes or no? First, existence. How do I know? All borrowings on balance sheet represent valid claims by the banks and third parties. So whatever borrowing that is there on balance sheet, it's nothing but some third party claim on the company. Now, review board meeting minutes to confirm approval of new lending arrangements and significant. Sometimes in exam, how they'll ask you, know, they'll give you this option and they will ask you, is it existence? Is it completeness? Is it valuation? Is it disclosure? They'll ask you the assertion. They'll ask you this assertion. Okay, somebody is asking, sir, can I skip balance sheet item? If at all you do not really have a time, yeah, you can skip, but just another 1 hour, that makes a difference. That makes a lot of difference. This 1 hour, whatever I'm covering, only that you try to cover in exam. At least for MCQ purpose, you watch this if possible. That's it. Now, Now look at, so reviewing board meeting minutes to confirm whether new lending agreement are there, or is there any significant debt commitment. Like in the board meeting, they might have entered into commitment, they might have passed a resolution that we will take a borrowing. That is an evidence for existence of borrowing. Okay, then look at the loan details, comparing with the loan agreement. Look at the loan agreement and check the loan details, how much is the loan, rate of interest, all that. This is also an evidence for existence. Next, obtain balance confirmation from the bank, from the third party who lent us, they lent us the money, right? Get a confirmation from them. By getting a confirmation, you get evidence for, yes, borrowing is existing, you get a confirmation from that. In case of hire purchase or lease contracts, again, compare the contracts with agreements. And in case of debenture borrowings, look at the debenture trust deed. Confirm discharge of assets for retired debt. If any debt is repaid, the asset is created for charge, discharge. Asset should have been discharged from the charge. And get a representation from management confirming liabilities represent valid claims. I will ask a representation from the company that all the borrowings whichever they accounted, they are really a liability against the company. These are the points I will focus on. Existence. To check whether the borrowing is really existing or not, I will focus on these points. Then completeness. The second point that I will have to check is completeness of the borrowing. Completeness. Whether all the borrowings are completely accounted or not. Auditor has to get an evidence that all the borrowings have been accounted for in the books. How do I know whether all the borrowings are accounted? I will see subsequent transaction after reporting period for unrecorded liability. I will see after 31st March is over, suddenly in April a new loan is recorded. When the loan actually be received, that you should check. Sometimes companies, they get a loan on or before 31st March, but they will not record it on or before 31st March. Okay, they will record it in April. So check subsequent period. Okay, then get again balance confirmation for borrowings. Ensure interest rate, due dates, collateral, and everything matches the records. Compare balances with confirmation. Send reminders for non-reply. When you are using external confirmation, if they don't reply, send a confirmation request. And trace borrowings to general ledger. Again, this is an outdated point, guys. Today general ledger topic, all this is not there, outdated point. But what to do in exam, sometimes you have to write this. Get a schedule of short-term and long-term borrowing showing opening balance and closing balance, and see whatever borrowings taken and repaid during the year. Pay attention to that. So get a list of all the borrowings, see whether they are all accounted correctly or not. So this is how we need to do completeness audit. Sometimes in exam they'll ask you, review subsequent transaction after reporting period. This is an example of existence, example of completeness, example of rights and obligation. What like that they can ask you. Remember, they have asked in previous attempt or that previous attempt a similar question. Next, valuation. Second, the third thing that we need to understand is valuation. Valuation means what? At what value borrowing is recorded. Tell me, borrowing shall be recorded at what value? Outstanding loan plus accrued interest. That interest that we should pay, right? That accrued interest. If any penalty clause is there, and if at all we didn't pay EMI on time, if there is any penalty, that penalty should also be added. Yes or no? So whether interest is accounted correctly, look at the loan agreement. Look at valuation. Ensure accounting policy for borrowings are consistently applied. Recompute interest and verify amortization of premiums and discount. If it is a debenture, any premium on debentures, that also has to be accounted regularly. And for foreign currency loan, verify closing rates and restatement as per accounting standard 11. Verify due dates. What is the due date of repayment of the loan, and accordingly classify. If it is falling with the next 12 months from balance sheet date, it's a current borrowing. If it is not falling with the next 12 months, it's a long-term borrowing. Compliance with Companies Act 180, 185, 186, and confirm borrowings are within the company's articles of association MOA limits. See that the borrowings are within the powers of the company, and verify whether installment of long-term loans that are due in the next 12 months are shown as current liability. Read loan agreement. Sometimes only this point they can test. While verifying borrowings, one of the important point auditor has to do is reading the borrowing agreement, loan agreement. What points auditor will see in that loan agreement? In one of the items they asked this question. Now first of all, when I'm reading the loan agreement, what I will check? What company did in reality, what is there in the loan agreement. Is the company compliant with the loan agreement? Look at, ensure the entity is in compliance with loan covenants. Covenant means what? Terms and conditions. Covenant means what, guys? Terms and conditions and other significant provisions. Is there any provision with which the entity not complied? Suppose in the loan agreement some terms and conditions were there. Whenever there is a non-payment of EMI on due date, will attract a penalty of 10,000 rupees. Now company during the year 2 EMIs they have not paid on time, but provision for penalty they didn't create. Check out that. If enforcement of the provision has been waived by the lender in case of breach of any covenant, obtain a confirmation. For example, just now I told, sir, 2 EMIs company did not pay, right? 10,000, 10,000, 20,000 penalty should have been levied, right? But the penalty company did not account, sir. I went and asked management, why you did not account? Management told, sir, lender waived it, sir. Get a confirmation from lender for any provision of amount, if at all any provisions has been waived. So if enforcement of any provision, like actually lender has a right to levy penalty for late payment of lender has a right to levy penalty for non-payment of EMI, right? So if at all penalty is waived by the lender, get a confirmation that he really waived it. Suppose he is not confirming it, then that's a real liability. Company has to recognize, company has to make a provision for it. Then verify default related clause, just now I told, and make sure required disclosures are properly made in the financial statements. So when you are reading a loan or debt agreement, you should pay attention to these points. See that all the loan covenants were complied. Okay, see that the entity is complying with the loan covenants, and if any provision is identify, is there any non-compliance? For any non-compliance of any covenants, any terms and conditions company has not complied, see that lender waived any charges or penalty, and see is there any default related clause, and make sure disclosures are correctly made. That's it, guys. That's relating to valuation of borrowings, guys. Then coming to disclosure of borrowings. What we need to disclose: long-term borrowings and short-term borrowings. What we need to disclose: long-term borrowings will be classified as bonds and debentures, term loans, deferred payment liabilities, deposits, and loan from related parties. How long-term borrowings show how much is for bonds and debenture, how much is in the form of term loans from banks and FIs and related parties, how much are deferred payment liabilities, and how much of them are deposits, loans, all that. Deposits means what? Public deposits or any other loan from related party. You should show breakup like this. Further, we should give breakup on secured or unsecured. We should also give details about terms of repayment, and if there is any default, period of default, that also we should see, and all that. That's it, guys. Okay, next then borrowings part completed, and you see ARI we discussed already. That's the reason quickly balance sheet items we are finishing it off. Now next, trade receivable. Actually we are supposed to discuss trade receivables immediately after sale. Technically speaking, we should discuss immediately after sale. Now anyhow, first you need to test controls for trade receivable, a 5 marks question. What are the controls for trade receivable? A 5 marks question. Remember, what is a trade receivable? Only when you make a sale, a debtor will arise. Correct? Points to ensure effectiveness of internal controls over sales as a part of trade receivable audit. When you are checking debtors, there are some control points you should check. First one, only a sale on credit basis will raise a debtor. Only a bona fide sale will create a trade receivable. Check that. Second, see that sale is made only to a genuine and approved customer. Remember, do you think a company will sell on credit to somebody who is unknown to them? No, they will sell only to a known and approved customer. The company directors or company management has to approve a customer. Only then the sale will be made on credit to the customer. And see that all the sales are properly recorded. Only then the trade receivable value will be correct. And debtors can only be settled either by cash collection. How a debtor account will be settled? Either he paid it, or with approval of a responsible officer, we will write it off. Any of this will happen. Then duties related to sale transactions are segregated. See that segregation of duties are there with respect to sales, like sales order receiving, and then goods dispatching department, and collection people, accounting people, all that are different. Accounting, collection, reminders, everything. And see that debtors are collected on time. If there is any overdue customer, company should have a process of sending reminders, taking a legal action, and debtor balances are reviewed by the company regularly. See that the company has a mechanism, control to review debtor balances, and see that there is a follow-up system exists, and adequate provision for bad debts is made using aging analysis. So companies know they will create provision for bad and doubtful debts using aging analysis. See that it is there. That's it, guys. So controls over trade receivable, a 5 marks question can come directly. Next, audit procedure for trade receivable. Inside this, existence is most important. How do you get evidence on existence of sales receivable? How do you get evidence on existence of trade receivable? How do we get the evidence on existence? Very simple, direct confirmation procedure. You send a confirmation, third party, external confirmation as per 505, you send a confirmation, third party will reply. That itself is an evidence that the trade receivable is existing. Like what are they? Use direct confirmation procedure. For all significant account balances, do direct confirmation. Whereas and for small amount, randomly you verify. For all significant debtors, send direct confirmation. For small items, NCR you send. Non-negative confirmation request you can send. And remember, the trade receivable may be requested. We will send a confirmation request, right? What we will ask in the confirmation request? We can ask two things. One, either ask him to confirm on the balance sheet date what is the outstanding amount, or ask some other date you select which is close to balance sheet date. So, for example, 25th March, which is not a balance sheet date. I'll ask later, sir, on 25th March, this is the last transaction happened with you in the financial year 25-26, sir. Last transaction with you happened on 25th March. As on 25th March, how much is outstanding balance? That auditor can ask. So the auditor can ask confirmation from third party to confirm what is the outstanding balance, either on balance sheet date or on any date that is near to closure of the balance sheet date. MCQ can come. Third one, the date, for which date confirmation should be asked? It is decided by auditor after consulting with the company. Further, now the form of request. How can you request? How can you raise the request? Of course, positive confirmation, negative confirmation, any of this you can use, but the form of request can be, what, like you can send a confirmation, sir, we are the auditors of so and so company, sir. We found that you are a customer for our company where you have to pay us approximately so and so amount. I will put 10 lakhs money and I'll ask him, please confirm yes or no. Or I will put a blank. And I'll ask him, sir, I am mentioning blank amount. Please fill the amount and then send me. Any of this way can be asked. Both the forms are permitted. The form of request can be one format is one form where balance outstanding you will mention. Form with balance outstanding and customer responds whether he will agree or not. Second format is what? Without any balance. You just put a blank, and where the customer shall respond with balance outstanding as per his record. He should type and send. Guess what? Here the response rate will be low, whereas here the response rate will be high. If at all you mention the amount, customer will say yes or no directly. But if you ask him to fill, he need to open the books, open the ledger, open the balance, and he need to confirm whether the balance is correct or not, and then has to fill it and then send. So second form is little time taking. This is one of the factor while designing a confirmation request. This is what something we discussed in 505 standard already. I hope you have watched audit evidence revision already. Okay, it was just 2.5 hours, 6 standards I revised in audit evidence. Wonderfully I revised it. Please use that. Next, further, auditor shall maintain strict control over confirmation request and handle replies independently. The auditor should maintain entire control on the confirmation procedure, and every reply that auditor is getting, tell me, direct confirmation means what? Third party should reply to the auditor directly. Auditor should evaluate each and every reply correctly and see that when you are sending confirmation letter, see that it is correctly addressed. When you are sending a confirmation request, see that its address is validated and see that it is properly dispatched, and all replies come directly to the auditor and not to the client. And the auditor should not reveal the method of selecting trade receivable for circulation until trade receivable trial balance is received. So don't tell the company how are you going to select the customers for external confirmation, and give the client only final list of selected receivables so that they can prepare confirmation letter. Look at this point here. The client will prepare confirmation letter. We will send mail to the debtor through the client, guys. Through the client we will send the mail, and the third party has to reply us directly. We will mention in the mail directly like that. And suppose, sir, I am not getting confirmation reply, sir, then perform alternative procedure. How do I know whether debtor is really existing or not? Look at April month and May month. He paid money. Subsequent cash receipt is a proof that he is outstanding, right? That's it. And confirm that these transactions actually occurred by preparing detailed analysis with a transaction breakup. Now, April or May month, no, amount has been received 10 lakhs. Now this 10 lakhs is received relating to some 3 sale invoices. Map it. That's it. These are the alternative procedures. And not only that, apply analytical procedure for debtors. To know whether debtors are really existing or not, apply analytical procedure. What I will see, I will review a trend line of sales and accounts receivable to check whether there is any unusual trend. I will see April, May, June, July, August, September, month wise trend. I will see last year to current year sales trend. I will see, and I will measure average collection period. So I will first compute. You might have learned in working capital management chapter, financial management subject, you might have learned how to compute debtors holding period. Compute that and look at the company credit terms. So 30 days only, but here for us 60 days debtors is outstanding. Why? Okay, make inquiries for reasons in change in trends with management. Document the same in working papers. Look at analytical procedure for debtors. Only this can be asked as a 4 marks question. Direct confirmation procedure. Only this can be asked as a 5 marks question. Or any of these points they can test and ask you as an MCQ. Any way they can ask. Important topic. Trade receivable is important topic, guys. That's it. That's it, guys. Valuation, another important aspect in trade receivable is valuation, guys. So see how companies identifying doubtful debts and calculating allowance, provision for bad and doubtful debts. Review the process followed by the company for identifying slow debtors and then creating provision. Obtain aging report. You know, the best way to calculate provision for debtors is first look at the age of the debtor. Age means what? Are they outstanding for more than 3 years, more than 2 years, more than 1 year, more than 6 months, between 0 to 6 months? What is it? Are they overdue or not overdue? That also you should understand. So get an aging report, compare the aging report with the prior period reports, yes or no, and identify is there any debtor under litigation, and see whether debtor can be collectible or not. See whether the debtor can be collectible. Somebody is asking where can I download this book. Opens rest of a CACMA website, free resources. You can download P5 auditing new GOAT notes 2026 version. There you can identify. Look at it, guys. This is one of the wonderful material. Everything is, you know, very colored. So everything is colored. Fine, don't worry. Fine, I'll continue. Let me not deviate. Next, so identify debtors under litigation and see provision for that particular debtor is calculated correctly, and provision has to be calculated at right rates. The rates of provision is generally decided by board of directors. Verify if any bad debt is written off. See that it is only by authorized person. Generally board of directors approval is required. Prepare movement of bad debts, provisions and write off amounts and compare with last year. Prepare a movement of bad debts. How much bad debt in this year, last year? How much is the provision in this year and last year? Write-off amounts, all that. Check write-off or write-offs are under proper authority. The 5th point and 7th point are repetition. Yeah, same point they're communicating, but that's what they have given in the book, and that's what we also mentioned here. That's it. These are the points that we need to check for valuation. So in valuation, what are the points we need to focus on? See whether provision is collected. Debtors valuation means what? We sold goods, so amount outstanding, that itself is value. But sometimes we can't show the value of sale. We should show any doubtful debts are there, provision we should remove, and then show the net value. Valuation focus on provision calculation, bad debts, you know, all that. Are you clear? Next, disclosures related to trade receivable. Sometimes an MCQ can come. Disclosure, what we need to disclose. If at all any foreign currency receivable is there, AS11 restatement points we need to disclose. Related party transaction we should disclose, and report transactions under 189, and also check schedule 3. Now we need to disclose debtors in 4 classification, guys: undisputed and disputed. Again, between undisputed, disputed, 2 more subclassifications are there. Receivables which are good, receivables which are doubtful. Even in undisputed, disputed also considered good to doubtful, both. Now here, how much is outstanding from the due date of payment? This is only overdue debt, guys. Overdue debtors, guys. Overdue, which means first you should show net debtors not overdue. How much is not yet overdue? Means as on 31st March is a debtor, still due date is there. Oh, not overdue, how much? Overdue more than. Up to 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Up to 6 months overdue, more than 6 months to 1 year overdue, more than 1 year, more than 2 years, more than 3 years overdue. And accordingly, we should show breakup like this. Yes or no? Again, debtors we need to subclassify. How much is secured, how much is unsecured, how much is doubtful. Most of the companies' trade receivables are unsecured. Then again, disclose bad and doubtful debts under relevant head. Separately disclose how much amount is due from the director and officer and key managerial persons of the entity. That's it, guys. Debtors audit is over, guys. Easy. Just comment below whether you understood debtors thoroughly. almost 2.5 hours at a stretch, 2 hours 20 minutes almost. And good part is every one of you, even though you have exam very immediate day, you are still focusing, and very good, hats off to you all. I really wish you all give the attempt wonderfully this audit paper, bank exemption, and you must all come back and then tell me that yes sir I got exemption. And all, don't forget to comment below this video after you write the exam. This video or audit evidence revision you might have watched, right, or my marathon you might have watched, right. Please come back and comment how did you perform well. I'll be really happy. That's it. Next, and immediately after exam I'll be releasing answers also. Don't worry, immediately within 10 to 15 minutes after the paper come, I'll be releasing answers also, so you can cross check. Then cash and cash equivalents, guys. In cash and cash equivalents, completeness is very important, guys. Completeness is very important. How do you check whether cash and cash equivalents are completely accounted? For that we generally do BRS. So we need to ask the company bank reconciliation statement for all bank accounts and verify periodically they are preparing or not, and ensure authorize signature. See that whether BRS is properly signed, because a company will account transaction when a check is issued, they'll account. When a check is received from customer, they'll account. But in the bank, only when the check is cleared it will be recorded. Yes or no? Now to that extent, a reconciliation statement has to be prepared, right? That reconciliation statement will give you a complete picture about whether bank balance is completely correctly accounted or not. Now look at verify BRS. What I will verify in the BRS, guys, in the BRS, what I will verify in exam, sometimes I'll ask you verification of bank reconciliation statement, what points auditor has to focus on. A 5 marks question they can ask you. Bank book balances must match bank confirmation and statements. Checks issued but not presented. Ensuring subsequent clearance. Ensure whether it is subsequently cleared or not. Checks be issued but not presented, and say that it is subsequently cleared. And if there is any over more than 3 months, reclassification. Verify checks are deposited but not credited. Checks are deposited based in the company. We got money from customer, we deposited, but it is not yet credited in our company name. Using bank deposit slip, review unrecorded bank charges or credits, and ensure management adjust material amounts. Honestly, today BRS is not that popular again. Okay, most of the companies today, since online electronic transfers are happening, check usage reduced a lot. Since check usage reduced a lot, the BRS relevance is decreasing over a period of time. Next, get a direct confirmation. To confirm balances from banks, auditor shall obtain 100% confirmation from all banks and FIs. Okay, and you need to agree book balances to balance confirmation or bank statement. You download bank statement from internet banking and then see, download. For any discrepancy, get an explanation from the bank. And for non-replies, perform alternate testing. Suppose if at all bank is not replying, today bank confirmation we don't do. Directly we generate bank statement from internet banking. That's it. Then disclosure. Disclosure is also important in cash and cash equivalents. We need to show cash and cash equivalents as below: balances with banks, cash on hand or checks on hand, and others. And separately we need to disclose earmarked funds. For example, unpaid dividend money, we need to keep it in a special bank account, keep it. Share application money received, we need to keep it in a special bank account, mention it. Money, CSR money, unspent money, we should keep it in a separate bank account, we should keep it. Those bank accounts are called as earmarked balances. Again, state balances held as margin money or security. Suppose if at all you are having a margin money in a demat account, show separately. And mention repatriation restrictions. If at all you are having any money at outside India, where getting that money transferred in India, some restrictions are there, mention those restrictions. Disclose those deposits with maturity period over 12 months separately. Suppose you have a fixed deposit with the bank where the maturity is after 12 months only, disclose that item separately. That's it. Under cash and cash equivalent only you will disclose. Because FD, even though it is maturing after 12 months, don't think it's a non-current asset, it's a current asset only, but you need to disclose it separately. Are you clear? That's it, guys. Then audit of inventories. Inventory means what? Any asset held for sale. The asset is held by me just to sell it, or asset which is held in production, that's called work in progress. That is what? Work in progress. Held for sale is nothing but finished good or any material supply which I will use for production. This is called raw material. So inventory consists of raw material, work in progress, and finished goods, guys. Then valuation. What is the valuation principle? Inventory must be valued at lower of cost or NRV. In the entire balance sheet item, most important thing is inventory, trade receivable, and PPE. These three are most important: inventory, trade receivable, and PPE. Yes or no? By the way, remember, we already covered borrowing, we already covered share capital. Borrowing is also very important, guys. Borrowing is also very important. Okay, next. So, and the valuation principle has to be followed consistently on year-on-year basis. And if at all any changes in accounting policy, it must be disclosed. Now, what is the procedure for inventory audit? Most important procedure: existence. We should get evidence, which is as per 501 standard. We should get evidence on existence of inventory as per 501. For existence, no, what auditor will do? He will participate in physical inventory counting performed by the management, and where auditor will do a test counting also. So, what points you observe? When you are attending physical inventory counting, you observe. What you will observe? How management is counting. Observe the count plan. Ensure supervision. See, is there anybody from the top management or somebody from higher level of management supervising the physical inventory count? Check that. Observe how the instructions are followed. Observe whether inventory supervision is done, physical count, and check that inventory items are tagged, inventory items are properly recorded, and reconcile test count. Reconcile test count means what? For example, I went to the go down, one of the employees counting in one particular rack. In the rack, no, he said 44 items are there. You also go and see how many were there, 44 really there or not. That's called test counting. Okay, and you will see the tax and summary sheets, and you will be alert for empty boxes. Sometimes, no, in some racks, no, empty box will be there. Employee will be counting that empty box also. Go and try to touch and hold, just try to push it. You will understand whether that's an empty box or real box. And conduct cutoff testing, especially last 1 week March month purchases, April 1 week purchases, 1 week sales, March last 1 week sales, April first week sales. See when they were delivered actually, when they were actually received. See whether that is accounted in the inventory correctly or not. That's it. Next. And when you are checking inventory existence, no, when you are counting physical inventory, no, see that third party stock is omitted. Third party stock should not be considered in inventory counting. And investigate differences between physical stock and then recorded stock. In case of perpetual inventory system, counting can be done on any date. Auditor can do physical inventory counting on any date if the company has a perpetual recording, perpetual inventory. Suppose if the company is following periodical inventory, March 31st compulsorily you must attend physical inventory counting. Periodical inventory counting shall be undertaken at year end compulsory. So these are the procedures that we need to perform for existence of inventory. So ask entity when are they going to do counting, and you participate in that physical count activity. Verify consigned goods are segregated separately, and when you are participating in inventory counting, you observe how the count plan is. See, is there a supervision? See that items are tagged. Reconcile the test count. Stay alert for empty boxes. Conduct cutoff testing. These are the points that we need to focus on. Are you clear? Next. Then again, you need to check completeness of inventory. In that, performing analytical procedure is important. Now look at industry average. What is the industry average inventory they are holding, and what is the inventory closing balance as per budget, and look at the trend. This is analytical procedure, guys, very important. Next, compute inventory turnover ratio, especially cost of goods sold to average inventory ratio. Compute that. Conduct vertical analysis. What is the inventory to total assets, man? How much is inventory to the total assets? Total balance sheet asset value 10 crore, inventory 2 crore, then 20%. This is vertical analysis. Then inventory turnover ratio. What is the inventory cost of goods sold divided by average inventory? Turnover by inventory you can put, or cost of goods sold by inventory you can put. Compare budgets with actuals and verify non-financial information related to inventory such as weights. So look at non-financial information. The moment they say non-financial, it's analytical procedure. They say compare, it's an analytical procedure. Analysis vertical, this it's a analytical procedure. Inventory turnover ratio, it's an analytical procedure. Comparing with industry averages, budgets and trends, analytical procedure. So what is the analytical procedure for audit of inventory? 5 marks question is possible. Somebody saying, sir, not feel like studying. Do one thing, take some 15 to 20 minutes or half an hour break and then come back and study. You will definitely come back into form. See, the main reason for sorrow, the main reason for worry is we continuously think about the result. We continuously think about the result. Will I perform better? Will I perform better? Will I perform? Forget about it. Focus on, I have to study better. I have to study well. I have to cover this, I have to cover that, and forget about the result, forget about how we are going to perform in the exam. Focus on what you are doing now. That's why live in the moment, be present, always give your best in the present. You will really do well. Tell me, what is the necessity for me at this time past 2.5 hours, I'm continuously in the live. You can see my voice is already stressed. Beginning of the session, my tone. Now what is my tone? Morning today, I already took 4.5 hours session, and now I'm taking 2.5 hours. Imagine 7 hours of session in a day. It's not that ordinary. It's not ordinary, guys. Only dedication. I know I have to grow in my life. I have to make an impact. I have to change students' perception on audit subject. If my desire, my willpower is so strong, obviously my energy supports me. I am not worried. Will I really get through? Will I become India's top faculty for audit? I am not worried about it. But whatever I need, whatever I have to do to become number one, I am doing everything every day. Yes or no? Whether I'll become or not, that's God's choice. I am not worried. So don't, if you're not feeling like studying, if at all you're feeling demotivated, you're constantly thinking about the result, don't think about the result, guys. Okay, next. So next, one more thing, guys. Ownership, valuation. Another important thing is, guys, valuation of inventories. Another important thing is valuation. Verify what valuation method company is using, because either they can use FIFO or they can use weighted average. Which valuation method is suitable? Look at the how business. Suppose if they're selling old goods first, then FIFO. Suppose they're selling any goods, whatever they want, then weighted average. So see which method is reasonable. For raw materials, no value. How the inventory has to be valued for raw material? Cost inward, carriage inward, non-refundable duty we should add. If standard cost technique is used, what is the basis for standards? Compare with actual cost. Standard cost technique is famous where, ma? In retail stores and all, standard cost technique is famous. Work in progress. See, ascertain valuation of production stage. Remember, work in progress is highly influenced by stage of completion. Overhead allocation and compare with costing and financial date mentioned. Ensure cost of abnormal wastage, ma. Just a minute. Yeah, ensure cost of abnormal wastage. For finished goods, verify reasonable cost is included or not, and see that inventories are valued at NRV only when the finished goods are going to be sold at less than cost. Then only raw material will be valued. And most important, obsolete, damaged and slow moving goods. This is most important, 5 marks question. We need to pay, whenever you are focusing on valuation of inventory, the first point that we should see is there any damaged inventory? Is there any slow moving inventory? Old, obsolete inventory? The auditor has to examine, is there any damaged inventory, slow moving inventory, obsolete inventory, so that you can do a proper valuation. And ask a client for inventory aging split. What is inventory aging split? You know, when the goods were manufactured, and as on 31st March, how long it's been that they were manufactured. That is called as inventory aging split. Okay, whenever we manufacture an article, it will have a tag, manufacturing date or manufacturing month will be there. So that month to balance sheet at 31st March, what is the duration? So you will easily identify obsolete stock data and see whether they were still saleable with, just like any other latest stock. Identify if they are saleable at latest stock along with latest stock parallelly without any reduction in value, then they can be valued at cost. If obsolete, old, slow moving, old inventory, if at all you can't sell them at current market prices, value them at NRV. And compare recorded cost with actual cost for obsolete items. Calculate inventory turnover ratio, identify obsolete inventory if ratio is significantly lower. Inventory turnover ratio, check it out. If at all inventory turnover ratio is reduced, inventory turnover ratio reduced means what? Repetition, number of times inventory being rotated reduced, which means there is a high chance of obsolete turnover. You might have seen inventory turnover ratio in ratio analysis and financial management. Yes or no? There you might have understood. Verify correct application of cost of inventory and NRV principle on obsolete goods, because obsolete damaged goods we always value at NRV. And test overhead allocation rates in manufacturing. See how overhead is allocated between inventory items. That is one more important test we need to. Actually, for obsolete and obsolete and damage, first these 5 points only important. These 5 points are very, very important. Then finally, disclosures. Inventory has to be disclosed as raw material, how much work in progress, how much finished good, how much stock in trade, how much stores and inventory, stores and spares, and then loose tools. And disclose goods in transit separately. And you should also mention mode of valuation separately. That's it. That's it, guys. I hope until now everybody is clear. Until now everyone are clear. Guys, just reply until now whether you're all clear. Inventory, done with inventory. Comment below. So productively we are going, no? Actually, so intensely we are discussing past 2.5 hours, and every one of you really, really cooperating well. Another 15 minutes, we are going to wind up the session. Another 15 to 20 minutes, this items of financial statements chapter will be over. Okay, so which we discussed with real productivity, especially ARA, P&L items, inventory, trade receivable, cash and cash equivalents, share capital, reserves, everything we discussed. Next, guys. But remember, guys, listening to the class alone, listening to this session alone is not sufficient. After finishing this, 1.5 to 2 hours if you spend reading, trust me, tomorrow in the exam, you're going to rock. That's it. Next, property, plant and equipment. In this, most important questions I highlighted here with yellow, you see, very important. They can ask you in exam, what are the elements of cost will be included in PPE? What are the elements of cost that are included in PPE? What are the elements of cost? PPE cost, what cost will include? Obviously purchase price plus import duty, which is non-refundable. Imported duties, non-refundable taxes, less discount, that you should eliminate, purchase price, and any directly attributable cost to bring the asset to present location and installation. Any directly attributable cost to bring the asset, imported machinery, to factory, and cost of dismantling, removal, restoration, decommissioning. We call it as decommissioning liability. Tomorrow, after 20 years, we need to dismantle this machine, we need to restore the site. For that, how much cost you are going to incur? Present value you should calculate, and that also you should capitalize. So what are the components of cost of PPE? What are the components of cost of PPE? What one is purchase price. Purchase price means what? Amount paid to exporter, if at all imported machinery, okay, or amount paid to vendor, plus imported duty, which is non-refundable, and any less, of course, a discount and rebate, plus any cost that you incur to bring the PPE into present location, and dismantling charges, decommissioning liability, all that. Now, sir, what are directly attributable costs, sir? Very simple. Employee benefit expenses, for example, we are using some employee, daily workers for trial run. So whatever expenses that we incur on trial run, salary expense we incur, that we need to capitalize. Site preparation charges, so to bring the machine and then install, the site has to be prepared, the site has to be ready for some issues, for some particular base work. Initial delivery and handling charge, installation and assembly charges, testing cost and professional fee. And when you are capitalizing test run, when you are capitalizing trial run, when you do trial run, some goods you will produce, right? That goods you will sell, right? That sale value should reduce from trial run cost. So trial run cost net of proceeds from sales. That's it. So what are examples of directly attributable cost? 5 marks question can come. Or another question can come, what is the cost excluded from PPE? 5 marks question can come. What are the costs that are excluded from PPE? The following cost will be excluded. Examples of cost not form part of PPE. What are the costs not form part of PPE? Cost of opening new facility. Suppose you open a new factory, opening celebration you did, that is not a capitalized cost. Inauguration, nothing but. Cost of introducing new product or service, like you launched a new product, you did massive advertisement, that advertisement and all will not form part of cost. Cost of business in new location, staff training, that is not a PPE cost. Administrative cost, in exam they can ask you this, what are the items of cost? 4 or 5 marks question, they can ask you, what are the items of cost that are not included in PPE? They can ask you, what are elements of cost? What are the items of cost not included in PPE? 5 and 7 both put together will be there. That's it. Next, what is the audit procedure? What is the audit procedure for inventory? In this, mainly that point only is most important, ma. Okay, just a minute. I think this is enough. Actually, in PPE, this is what most frequently tested. These are all what most frequently tested. By the way, when I can recognize a PPE, only when future economic benefits will flow to the enterprise and cost can be measured. And what cost includes? Cost initially incurred to acquire or construct, and any additions or replacement or servicing cost. Entirely this is to be considered. Correct? Huh? Now here there is one important point I wanted to discuss, guys. Wait. Look at assets which are not in working condition. If an asset is there, PPE, which is not in working condition, or you are not actively using, the organization is not actively using or not in working condition, will be accounted as deletion. You should remove it as a deletion only. You should remove it as deletion only after approval by the management, and depreciation should be stopped. after the date of deletion. So suppose on 10th August 2025, you are stopping the machinery from usage, you are not actively using, you are deleting it from the asset register. And now that deletion can be done only after management has been approved it. Further, depreciation should be stopped or after the date of deletion. So this is only this is treated as a proper deletion. Assets which are not in working condition, which of the following statement is true? Like that an MCQ can come. It was asked in one of the previous attempts. So if the asset is not in working condition, first the asset has to be deleted only after approval of the management, and depreciation must be charged up to the date of deletion only. That's it, guys. Next. So, and rights and obligation is important, guys. If there are any additions, suppose company purchased some new machines during the year, look at the invoices, purchase invoices, see that they are in the name of the entity. For land and buildings, sale deed, registration deed will be there, and verify original title deeds only. Suppose sir, properties is pledged as security, sir. Title deeds are with the banker, sir. Get a confirmation, request a confirmation from the lenders that they are holding the title deeds, and review charges register for any charge that is created on PPE. Okay, that's it. So sir, if time permits, can you show questions will come from this area? Everywhere I'm telling that only how a question can come. Okay, fine. So review register of charges for any charges created. So if any charges are created, just look at the register of charges. You will understand what are the charges that are created. Any fresh loans were taken, all that. So rights and obligation, very important point, guys. What is the point? For any additions, verify the invoice. For buildings, verify the sale deed. Ask original title deeds. If the bank says, sir, building is in mortgage, sir, title deeds are with the banker, sir, ask a confirmation for list of documents, LOD. We call it as what? LOD from the bank. Ask list of documents from the bank and review register of charges. That's it, guys. PPE is over. Intangibles is almost similar, but in intangibles, we will look at examples of intangibles. What are they? Some scientific or technical knowledge, design, all that. Like common examples are computer software, patent, copyright, customer data, franchisee, market share, goodwill. All these are intangibles. Now physical substance, sometimes an intangible asset is there in a physical substance like CD or a pen drive. Now we need to look at the physical substance value there. Some intangible assets exist on physical media. Cost of physical substance is usually insignificant. Such physical item, even though the intangible is in the form of a pen drive, we will still treat it as intangible. So some assets, they have inseparable intangible and tangible. For example, phone is there. A phone is there. A phone, it's inseparable. Software is important, hardware, both are equally important. So judgment is required, whether that's a PPE, whether that's an intangible. So judgment is required, which is most predominant element. For example, software integral to hardware. Example, mission tool software, computer operating system is treated as fixed asset. Software, if it is not integral, then it is treated as intangible. If software is integral, then it is treated as fixed asset. If software is not integral to hardware, then that software is treated as intangible. For example, mobile, you see, software is no doubt important, integral to this mobile. This entire mobile I can classify this as, this entire mobile I will classify this as fixed asset. If at all, this mobile is not at all important, software is not that integral, then I will show it as what? Intangible. Then audit procedure for intangible. Same, if any intangible is not in active use, if intangible is not in active use, see that deletion is recorded only post approval and amortization ceased post approval. Amortization has to be stopped, okay, from the date of deletion. Same point we saw in PPE. That's it. Intangibles, there is nothing much important. That's it. Again, trade payables. If at all trade payables is completed, I think loans and advances is there. Loans and advances and provisions and contingencies. I think that's it, guys. 3 more elements. I'm trying my level best to hold me because fully tired now, but it's okay. Trade payables, guys. Again, in trade payables, what is important? Again, existence, because existence of trade payable is important because of direct confirmation point. This itself can be asked as a 5 marks question. Now, then any other point, I'll come back to it. Presentation, guys. Disclosure details of trade payable, MSME disclosure, trade payable aging report disclosure. Okay, fine, I'll come back to it. Okay, first I will cover disclosure. How trade payables has to be disclosed. We need to disclose separately for MSMEs, guys. What we need to disclose? unpaid principal amount, how much? Suppose I purchased goods from an MSME. How much amount is still unpaid? And what is the interest amount unpaid? That we need to show. Interest paid under MSMED Act and payment made beyond appointed day. Interest paid under MSMED Act, how much? How much interest you paid? Because now under MSMED Act, if you pay after 15 days or after 45 days, you have to pay interest, guys. And payment made beyond appointed day. I mean, nothing but what are, how much payments are made beyond appointed day, beyond 15 days, beyond 45 days. How much is the accrued interest? Accrued or unpaid interest at the balance sheet date, how much? Right now, there are some MSME vendors to whom I have to pay within 45 days or within 50 days, but I have not yet paid. As on balance sheet date, it's already overdue as per appointed day concept. How much interest is accrued? That we need to account separately. And further interest remaining due and payable even in succeeding years. Suppose no, I have to pay interest related to some MSME. Last year only it was outstanding, but even this year, as on this date, still it is not paid. So that interest also we should show separately. Next, we need to show aging analysis for debtors, guys. How we need to show? We need to show MSME and others. Again, undisputed. These two are undisputed. Again, disputed, we should show MSME and others. If at all MSME name comes, it's trade payable, guys, not trade receivable. In trade receivable, aging analysis is undisputed considered good, undisputed considered doubtful. Disputed considered good, disputed considered doubtful. This is the classification of trade receivable, guys. But for trade payable, MSME word will come. If the word MSME comes in aging analysis, that's nothing but you know, trade payable. Again, trade payable, outstanding for following period from due date. Overdue trade payable. Overdue means what? Already due date crossed. We crossed already due date. We should show less than 1 year, 1 to 2 years, 2 to 3, more than 3. Remember, 6 months logic is not there for trade payable. Only less than 1 year, 1 to 2 year, 2 to 3, more than 3. That's it. Less than 1 year. Less than 6 months logic is not there. Very simple. Less than 1 year, 0 to 1 year, 1 to 2, 2 to 3, more than 3. That's it. That's it, guys. Then existence of trade payable. First, you can use direct confirmation. Send confirmation request to vendors, okay, for significant payables and material purchases. Confirm balances either on balance sheet date or any other date which is near to balance sheet date. Same thing we saw in trade receivable. The date will be decided by auditor after consulting with the company. The form of request may be either the form where balance you will mention at the year end and ask the party to confirm, or the form will be no balance wherein creditor has to respond. And never method of how are you selecting trade payables for confirmation, never reveal that method of selection to third parties, I mean to the company. Ensure proper dispatch and receipt of confirmation replies. For non-replies, perform additional tests like reviewing subsequent payments, vendor invoice, all that. That's it, guys. So this is regarding existence of trade payables. Only existence is important, guys. That's it. In this trade payable, existence is important. Then other current liabilities. If the company has any other current liability, we need to give the following disclosure. Other current liabilities will be given as following disclosure. Remember, this is a disclosure requirement. This itself can be asked as a 5 marks question. What is the disclosure requirement of other current liabilities? First one, current maturities of finance lease obligation, interest accrued but not due on the borrowing, interest accrued and due on the borrowing, income received in advance, unpaid dividend, application money for allotment, nothing but share application money pending allotment. Okay, sorry, application money, refundable application money, guys. Sorry, share application money pending allotment comes under, share application money pending allotment comes under equity. Share application money pending allotment will not come here. Application money for allotment of securities we received but is subject to refund. Money received for securities allocation pending refund. Disclose terms including number of shares, premium, all that. Specify if the company has sufficient authorized capital. Reasons why there is a delay in allotment. Non-refundable and refundable, how much? Non-refundable application money show under equity. Refundable application money show under other current liabilities. Very important for MCQ, guys. That's it. Audit of loans and advances. Companies sometimes give a loan and advance, right? How to audit that? In this, I think loans and advances is not a big deal, guys. Disclosure point is important in loans and advance, guys. Disclosure. Suppose the company gave a loan and advance which is a long-term loan. It is classified as capital advance, related party loan, other loans. Subclassify. Is it secured, unsecured and doubtful? Disclose elements for doubtful loans under relevant head. Separate disclosures for loans due from the directors and from companies or firms where directors are partners. Yes or no? So classified as how much is capital advance, how much is related party loan, and how much is other loan. Again, you should show secured, unsecured, doubtful. See, loans and advances, we should show three types: capital, related party, and other loans. That's it. Short term also a similar disclosure, guys. Next. About to finish, guys. Audit of provisions and contingencies. Provisions and contingencies. Audit procedure. Disclosure alone is enough, guys. Disclosure. Long-term provisions. How much is for employee benefit and how much is for others. Short-term provision. How much is for employee and how much is for others. Contingent liabilities. Three classification. Claims on the company, but company did not acknowledge. Claim is there from third party, but company not acknowledged as debt. Guarantees given by the company. Any other contingent liability. Then commitments. Capital contracts not provided for, where any some capital contract is a provision is not yet created. Uncalled liability or other commitments. Partly paid shares, partly paid investments, uncalled liability, and other commitments. These are the remaining items, guys. That's it, guys. I'm done for today. 3 hours almost, just with a 15 minutes break I did. 3 hours I did just with a 15 minutes break, non-stop 3 hours. Entire items of financials predominantly we discussed, guys. Okay, in fact I explained you in detail almost. I hope every one of you thoroughly enjoyed. Okay, so and somebody's asking, sir, can you do different types of entities? I'm really tired, guys. My chart revision is also there. You can watch the chart revision for different types of entities where I gave a reasonable amount of explanation, or my old revision videos were there on different types of entities: corporate society audit, government audit. You can just type C.A. Ramersha government audit, C.A. Ramersha corporate societies audit. You can find my old videos. The content is same, guys. You can use that. That's it. So I'm stopping the live session. Okay, and I wish you to comment below this video. Now you are in the live chat replying, right? Below, comment below the video. Once I end the stream, once I complete this live, just comment how is your experience. I'll be really happy to listen to you. Just it takes 20 seconds to comment. That's it. And those who forgot to like the video, just like the video. And really thanks for your extreme cooperation. Every one of you were continuously active throughout this particular session. I'm really happy for all of you, and really wish you all the best for the exam. And I know you all come out with banging exemptions. Right now, in the past 3 hours, the dedication that you showed itself is reflecting how dedicated you were. And really, I didn't expect that 3 hour students will be there. You know, that too well before exam, just before exam, like 3 hours. That shows how dedicated are you. And now, after this session is over, 2 hours, guys, 1.5 to 2 hours, you spend reading once again this. I'm damn sure I'm telling you, 12 to 16 marks in the coming exam, you rock solidly perform, guys. That's it. Okay, that's it. Thank you. Take care.